two of our allies, Japan and South Korea, where the cost alone to the auto industry could have a real hit to the American consumer. But there's some triumphalism right now here in the White House. They say, well, April 2nd, we did Liberation Day. It hasn't been inflationary. The markets are doing fine. You know, we've had we're having a good run on other fronts. You know, so the president said, this is a time for me to push and show people that I'm not, Trump always chickens out. That it's not Taco Trump. It's a deadline that's set 3 weeks out. Many people were hoping it would go past Labor Day. And so I think it's not him punting. I think it's him doubling down on his seriousness around tariffs.
That'll be the most important trigger to watch out for. Let us also listen in to what market expert Lauren Goodwin had to say about where the market currently stands.
I am less constructive on the policy backdrop for this market. Now, I expect that for the next quarter, especially here in the next month, as we have earnings reports start to roll in, what we expected on April 2nd and what we have gotten for the second quarter are different things. And so I think that we'll see an earnings backdrop that's constructive. I agree that we're not likely to see Liberation Day 2.0 type of movement here in the next several weeks. However, I think the reason that the market isn't pricing really the impacts of tariffs is because we haven't seen it in the economic data, and I strongly believe that that's coming. The Fed is worried about and looking at is an environment where holiday ordering, starting around now, that's where you're going to see the impact of higher goods prices.
Interestingly, even as Wall Street ended at the flat line, a couple of analysts have already raised their price targets on the S&P 500 despite these tariff uncertainties. Now, Dia is now joining in with all the Trump-related developments from last night in our special segment, Trump Watch. Dia.
Starting with major moves on tariffs and foreign policy, President Donald Trump says there will be at least 7 trade announcements on Wednesday. That's later tonight in a post on Truth Social. While there's been no official word on India-US deal yet, maybe tonight we will hear something. Trump also said he is planning to impose a 50% duty on copper imports as part of a set of looming sectoral tariffs, while threatening 200% levy on pharmaceuticals. However, he said drug makers would be given about a year to get their act together.
Ones we did steel, as you know, they're 50%. We did aluminum, 50%. Lumber just came out.
Why don't you announce copper?
And we did cars. And now, today we're doing copper.
Copper and lumber. What would that tariff be on? The sectional tariff?
I believe the tariff on copper, we're going to make it 50%.
50%.
And we'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%. We'll give them a certain period of time to get their act together. But they were all here, now they all left. They went to other places because we allowed, people that sat in this room allowed it to happen. And I don't allow it to happen. The people in this room don't allow it to happen.
Copper is finished. We've done with our study. We've handed the study over to the president. The president knows that he has the ability, since we've studied the market of copper, to set the market tariff for copper. He announced it today at the cabinet meeting that he intends to go to 50%, which will be similar to steel and aluminum, which are both 50%, so copper will be 50%. And the idea is to bring copper home, bring copper production home, bring the ability to make copper, which is key to the industrial sector, back home to America. We need that kind of production in America. It's important, so that'll be out today. With pharmaceuticals and semiconductors, those studies are being completed at the end of the month, and so the president will then set his policies then.
On the diplomatic front, Trump met with Israeli Prime Minister Benjamin Netanyahu for the second time in just 24 hours. The two leaders reportedly discussed possible pathways to end what Trump called the tragedy of the ongoing war in Gaza. Now, turning to the war in Ukraine, President Trump delivered a sharp rebuke of Russian President Vladimir Putin, saying he has approved the delivery of more defensive weapons to Ukraine. This comes after an earlier Pentagon pause was lifted. Let's listen to what he said.
We're not happy with Putin. I'm not happy with Putin. I can tell you that much right now, because he's killing a lot of people. And a lot of them are his soldiers and their soldiers, mostly. And it's now up to 7,000 a week.
And lastly, President Donald Trump said Jerome Powell should resign immediately if allegations from critics that the Federal Reserve Chairman misled lawmakers about renovations at the central bank's headquarters proved true. Listen in.
Jerome Powell, who you've been pressuring to lower interest rates, he's facing accusations of lying to Congress, which is a potential crime about the
Well, then he
opulent.
should resign immediately. We should get somebody in there that's going to lower interest rates.
Do you want congressional?
Why don't you call for his resignation?
Dia, thanks a lot for that update. And of course, Donald Trump there on Jerome Powell continuing his attack on the Fed chairman. Take a short break here on Power Breakfast. On the other side, how will all of these global cues impact our own markets? Our research team joins in with Power Prep. Welcome back. Our research team is ready to set you up for today's trading session. Firstly, Vivek is here to get us all the market cues you need to watch out for. Vivek, good morning. Well, the large caps led the fight back yesterday, but what are the important cues you're watching out for today?
Good morning. Absolutely right. The last hour fight back was led by the large caps, especially the financials. Well, going into trade today, so much uncertainty. U.S. market lines largely make the oil price at a 2-week high. The tariff uncertainty continues. Tariffs. There are talks of tariffs. As far as number one, India is concerned, number two, copper is concerned, you could see some impact on commodity prices. And lastly, watch out for the entire pharma pack. While tariffs are still some time away, given the fact that the tariffs could be quite high, you could see some impact on the Indian listed layers as well. Last evening or second half of yesterday, what happened? A very smart recovery, and it was the financial heavyweights that actually helped the markets recover quite sharply. But the advanced decline ratio continued to remain in favor of the declines. What are the key stocks that stood out? Well, Kotak Mahindra Bank, much better than expected growth. That was a clear standout. And on the other hand, Titan, jewelry, EBIT margin as well as jewelry itself was something that was a bit of a disappointment. So that stock clearly lagged. Asian markets, GIFT Nifty all indicating a subdued start for our own markets today.
Subdued start indeed. Vivek, thanks a lot for that update. Over to Ria now, who would highlight the stocks that you need to keep an eye out for today. Ria, good morning.
Good morning, Homers. Let's take a look at the stocks that are going to be in focus today. First up, we have 5 Paisa Capital reporting their Q1 FY26 numbers. The net profit for this one has gone down by around 42% on a year-on-year basis, and even the revenue has seen a fall of around 24% compared to the previous year. Moving on to some companies that have come out with their Q1 business updates. For JSW Steel, the crude steel production has gone up by around 14% on a year-on-year basis, coming in at 7.26 metric tons, and the Indian operations have also gone up by around 15% for this company. For Tata Steel, the Q1 India production volumes have come in at 5.26 metric tons, largely flat compared to the previous year. And for Q1, the India delivery volumes are also down about 3.8% compared to the previous year. Moving on to Union Bank, the total deposits are up around 3.5% compared to the previous year. Even the global gross advances have gone up by around 6.8%. Moving away from the business updates, CAMS is also going to be in focus today. They have launched the CAMS Pays, which is the new payment gateway that supports over 5,000 transactions per second. Bajaj projects also to be in focus today. They have increased the galvanization capacity to 1.1 lakh MTPA from the current 40,500 odd MTPA capacity, and they're also planning a capacity addition of 170 crores at their Ranjangaon facility. For Ola Electric, they have announced the mass rollout of the Move OS 5, which is the biggest software upgrade yet. Dixon Technologies is another one to keep on your radar today. They have invested about rupees 2.5 crores for a 50% stake in Litanium Technologies. And the last one is India Shelter FinCorp of Kotak Mahindra Mutual Fund has bought a 4.2% stake in the company for about 384 crores. And Nexus Ventures Partners has offloaded about 4.6% equity in this one.
Interesting list there. Yeah, thanks a lot for that. Lastly, Sudarshan joins in with cues from the FNO space. Sudarshan, good morning. Closed above 25,500, but does the FNO data indicate that these levels will sustain?
That was the positive part, that Nifty has held on to levels over 25,500, and that's the courtesy that financial heavyweights like Kotak Mahindra Bank, HDFC Bank and ICICI Bank have been moving higher, because if you remember, both Kotak Mahindra Bank and HDFC Bank have recently released quarterly updates, and the updates were strong by both these companies. That's the main reason that you are seeing gains in both Nifty and Nifty Bank. While market breadth was in favor of declines, that was the reason, because mid-cap index has fallen, and at the end, it was a close in the red. For today also, GIFT Nifty is indicating a start with minor cuts. As far as flows are concerned, FIs sell figures minutely around rupees 26 crore, but DIs have bought more than rupees 1,300 crore. In the index futures too, FIs have sold nearly rupees 270 crore, and they have added long positions of nearly 2,800 contracts, but at the same time, they have also added short positions of more than 4,100 contracts. And now, FI long exposure has increased to nearly 29%. Now, on the option data front, 25,700 call has seen the maximum addition. And here, the addition was more than 18 lakh shares. And 25,400 call has seen shedding of 10 lakh shares. So it tells you that on the downside for Nifty, support remains around 25,400. That's the reason I've taken the support of 25,330, that is around 20-day moving average. And resistance remains around 25,700. One stock that remains in the band is RBL Bank. And apart from this, keep an eye on pharma and metal names on the issue of talks related to trade tariffs.
Interesting, Sudarshan. Thanks a lot for that. Of course, pharma stocks will continue to remain in focus today, not just for the tariff-related threats from Donald Trump, but they may get some GST relief on the free drug samples given to doctors and hospitals. Now, sources have told CNBC-TV18 that the GST Council may consider allowing input tax credit benefits on these free samples. Timsy is joining in now with more details. Timsy, what are your sources telling you?
In what could ease some tax pain for the pharma sector, sources have confirmed to CNBC-TV18 that the upcoming GST Council is likely to consider a clarification that may allow input tax credit, or ITC, on promotional and free drug samples distributed by pharma companies. Currently, under the GST framework, only in a select few cases companies are allowed to claim ITC on goods distributed without consideration, which includes free samples. But pharma companies say that this rule unfairly impacts them because their samples are not marketing giveaways to consumers but are provided exclusively to doctors and hospitals. These free samples, the companies argue, help end users as only doctors assessing a patient gives them for free while prescribing these drugs. The pharma industry has also pointed out that expenditure on such free samples accounts for up to 2% of their total manufacturing costs, marking the denial of a ITC as a significant cost burden. The demand from the industry is clear. Treat pharma samples differently from FMCG promotional items like sachets or retail freebies and allow uniform ITC benefits across the board. Sources tell us that the GST Council may consider issuing a clarification circular to address this anomaly, one that could free up a major chunk of blocked input tax credit for Indian drug makers. However, officials also say that the council will look at this particular framework with several safeguards to prevent misuse and ensure that this relief does not trigger similar demands from unrelated sectors. But so what end it comes out to be, or what is it that the council will decide? Something that we'll have to wait and watch for.
Timsy, thanks a lot for that update. Take a short break. Cues from the commodities market on the other side, and it's an action-packed one. Stay tuned. Welcome back. Manisha Gupta is now joining in with all the updates from the commodity space. Manisha, good morning. It was all about copper last night.
Oh, well, absolutely. Hormuz, 17% of a gain at one point in time in the New York session yesterday, making a record high at $5.9. So we did see settlement up by nearly 10%. This is after the U.S. President Trump has proposed a 50% tariff on copper. The move does align with copper tariffs with existing 50% on steel and aluminum as well. Well, there are various reports really out there suggesting that it perhaps could be signed in July, or the final decision on copper tariffs can be expected by November. So there is no clarity of timing. But one thing is for sure, that ahead of these 50% tariffs that can come in copper, U.S. will be importing a lot of copper ahead of this notification or before this deal is signed there. So you could be looking at a huge disparity into the markets. Yesterday also, even as the U.S. copper prices were trading 10 and 15 and 17% on the higher side, the LME was just about 2 to 3% on the higher side. So there's a huge disparity on the major exchanges where copper is traded, whether it is U.S., LME or Shanghai for that matter. So it's going to be quite interesting to see on how we see copper trading today as well.
Oh, yes, absolutely. Copper all the way last night. Manisha, thanks a lot for that update. But we call time on this edition of Bar Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call on the other side sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week, Wednesday morning. We are coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surbi and Mangalam joins us on the program today. Guys, good morning.
Hi, good morning. Middle of the week and muddling along. That's what our markets have been doing. Actually, not just our markets.
You said middling along.
Muddling along. But the fact is that with so many tariff headlines coming through, markets are behaving as if nothing's really happening. I mean, no matter how high those numbers are, some are as high as 40%. Markets are just doing their own thing as if it's just another day in paradise.
But that's exactly what it is, right? Just another day, because that's what Donald Trump's commentary is all about. He could say 40%, 50%. You remember the times when US and China were embroiled in this 118, 140, those absurd numbers. And everyone's now coming to terms with the fact that these are just conversation starters more than anything else. The good part is that yesterday, the last hour, the recovery that we saw on the Nifty, that up move that we saw, so to say, at least brought some excitement to an otherwise very, very feeble sort of market.
You know, normal people, when conversations are, normal people say, well, you know, let's catch up for a coffee. President Trump says, well, let's start with 100%.
140%. I think that's a good conversation starter. That's what I'll do to my friends. I'll just randomly message them, hey, you owe me 10,000 rupees. And then that person will at least reply.
All right, well, let's just take it from the top because there is, there is a lot. Not very much in terms of the market. So the market was absolutely quiet. You know, the noise to signal ratio, if you can put it, I think it's got to be at a bit of a peak right now, right? I mean, so much noise, but how much of a actual signal, real takeaway from a lot of what we're hearing from President Trump, etc., is there? I think that is entirely very much debatable, and that is, I think, a crucial point. Ignore the noise and look for the signal out of all of what is coming through. So global markets were very, very quiet. S&P ended about 0.07% lower. Trump essentially said, he said a lot, but he basically said that there would be no more extensions past the 1st August deadline. But, we'll see. He's essentially, of course, also said yesterday, we played those sound bites out that, well, we've made final offers and the 1st of August is the new deadline. I mean, the tariff rates, of course, broadly are similar to what we saw announced on the so-called Liberation Day. Now, Trump called for a 50% tariff on copper imports, 50% on a commodity which is used every day in pretty much everything. But you know, it's that's what it is. The point, though, is the timelines for this are uncertain. I mean, will this be done, by in the next couple of months? Will it be postponed after that, etc.? But of course, I mean, prices, copper futures were up 17% at one point. Intraday, it's the largest gain intraday since 1988. But then, of course, they cooled off. Lastly, I think because of this uncertainty around implementation timelines, they were up about 10%, still very, very large as far as copper is concerned. And the other thing, which I think audiences here in India would also be interested in, is pharma. So he said that he would offer pharma companies at least a year grace period, that is 12 months, at least 12 months, before applying a crippling 200% tariff on foreign-made pharma products. 200%. But the thing is this, right? Trump was elected when? In 2024, late 2024. We're in 2025. If these, tariffs are, according to President Trump, going to come into effect at least 12 months out, we are talking about 2026. I mean, sometime in the middle of 2026, maybe a little later, in terms of implementation. Now, it's a 4-year term for President Trump. He cannot run for another term in that sense. So actually, in a counterintuitive way, it looks very, very bad. But obviously, we will not see, new investments, etc., in the US because of the uncertainty around the tariffs, etc. But the point is, in a counterintuitive way, does this actually remove some of the overhang for Indian pharma companies as well? Because he said, 24 is gone, 25, 26, and then maybe, 1.5 odd years. And of course, that also is not very clear. I think he said 12 to 18 months, but at least 12 months. So I think keep an eye out on some of these names. But there is, of course, no rush. It's not as if there is any big trigger, a tailwind apart from this for pharma companies. And this was kind of capping gains. So remember that. But in a broader sense, the way I would put it is, stocks should not fall. I think if anything, you should look at it from the other side. Now, Trump, of course, also repeated his BRICS warning, which is the grouping of countries. He said that traditional 10% tariffs for just being in BRICS. This is something he said talked about earlier as well. He also spoke about EU, China, sectoral tariffs. A lot of this was sort of said earlier, so I'm not going to go into details and repeat many of this. Now, markets globally in a bit of a wait-and-watch mode. Indices have done extremely well. US markets, for example, remain less than 1% away from all-time highs. So it's not as if they've been damaged at all. If anything, the other way. Oil prices $70. So there are reports that Yemeni Houthi rebels are attacking commercial ships. This was a Bloomberg headline. There's also reports that President Trump and Netanyahu, the Israeli Prime Minister, are meeting privately. The agenda is unknown. So again, to keep the Middle East, I think, at the back of your mind, it's kind of sort of faded into the background after the ceasefire between Israel and Iran. But oil, I think, is the one thing you will see as an expression if the markets start to get worried again. Just to tie in the levels, they're not changing very much at all. Yesterday, in the last hour, we saw a sharp spike higher for the Nifty Bank, but it was a Sensex expiry yesterday. So I think you will see some action at least. Nothing like what we used to see earlier. So the support 25,331 on the downside. The resistance comes in at 25,669. For the Nifty Bank, the support comes in at 56,838 and resistance comes in at 57,628. GIFT Nifty will give you a quick sense of how we are likely to start. It's neither here nor there kind of start, about 25 odd points lower. Surabhi.
Yeah, I guess, Prashant, we'll only know in hindsight, right, whether the market got this one right as well, like it did COVID, because the market kept rallying through after the initial dip. The only time the market got it wrong was the global financial crisis, because the market couldn't guess that the financial market itself was broken. But otherwise, the markets have usually called things right. So let's see. Maybe that happens once again, because if you go by market reaction, there's nothing dramatic. President Trump is talking about all these tariffs on countries ranging from 25% to 40%, 50% on copper. Look at the market reaction. It could be just another day, as we are saying. That's what's playing out. In the Hong Kong market, there's some more pressure. That market's down 1%. We've got data out of China this morning. Deflation in China is still a problem, especially at the wholesale level, because look at the producer price numbers that have come out today. The decline is 3.6%. The expectations were for a 3.2% fall. And this is continuing. This is the biggest decline in producer-level inflation that we've seen in 2 years in China. There's some better news on the consumer side, because consumer inflation has picked up after 4 straight months of decline. The CPI number is up 0.1% for the month of June. So that's China data. Now, coming to the copper levies, 50% levy on copper. Just some stats to keep things in perspective here. The US imports 50% of its copper requirement. Bulk of those imports obviously are coming in from Chile. They have the biggest mines, on planet Earth. And now with the 50% levy on copper, steel, aluminum, and copper, all the 3 key metals are at the same, base in terms of tariffs, which is 50% plus. So we have to see how this is digested. The copper price itself was rallying 13-14% yesterday. Some of the copper miners, which are listed in the US, like Freeport, that stock was up about 5% as well. So he spoke about this 50% tariff, and then there was this big scare of 200% tariff on pharma imports, maybe the next 1 year. Let's actually listen into that precise soundbite, and then we'll take it from there.
Ones we did steel, as you know, they're 50%. We did aluminum, 50%. Lumber just came out.
Mention that's copper.
And we did cars. And now, today we're doing copper.
Copper and lumber. What would that tariff be on? The sectional tariff?
I believe the tariff on copper, we're going to make it 50%.
50%.
And we'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%. We'll give them a certain period of time to get their act together. But they were all here, now they all left. They went to other places because we allowed, people that sat in this room allowed it to happen. And I don't allow it to happen. The people in this room don't allow it to happen.
Also went on to say that the people in that room and the ones who were running America were stupid people. It's classic Trump style. But anyway, now we'll talk more about this in just a bit. Let's talk about the flow situation as well, because the market's been absolutely comatose over the last couple of trading sessions, barring yesterday's last half-hour move. That could be in parts attributed to the fact that it was weekly Sensex expiry. Look at the fund flows. FII is on the edge. I mean, basically sitting on the fence. 26 crores of net buying coming in. Domestic institutions bought stocks, cash stocks worth over 1,300 crore rupees. Today is a very important day. Again, we have the monthly MF flow data coming in. Remember, in the previous month, in May, the equity inflows had dwindled to under 19,000 crores. So keep that in mind. Let's see if there's a pickup or not. But the markets become so range-bound that maybe people are looking for other alternate avenues or not. So today's number becomes very important. It's been a continued declining, streak of flows falling in equity funds. So let's see if that changes or not. Stocks and sectors in focus. I'll keep textile and apparel on the radar still. Some of these stocks were up and about yesterday because we still don't know. The hope is that despite this, BRICS tariff that he's talking about, another brick in the wall, so to speak, 10% breaks. If we continue at 10%, then we'll still be maybe competitive with Vietnam, with Bangladesh. So let's see. The pharma index, for sure, though he's talking a year out in the future in terms of this 200% tariff. But let's see if there's any volatility on pharma stocks. Tata Motors wholesale numbers are out and the sales are down 9%. And Union Bank of India, really weak performance for Union Bank. Advances are up less than 7%. Deposits are up just about 3.5%. So not too great. So let's see. We'll watch for some of these stocks. Manglam?
Well, we've been talking about how the market is absolutely range-bound. So I was just looking at the Nifty high minus low over the last 1 month or so. And guess what? If you just look at the range that the Nifty has been trading in, day before yesterday was 82 points. Yesterday, despite the up move that we saw, all of 123 points. And for an index which is upwards of 25,000, 200 points is less than 1%. In fact, over the last 1 month or so, the average traded range on the Nifty has been 195 points, with the highest being 350 points, which is 1.4%. So that's the kind of market that we've been in. Nifty hovering between 25,350 to 25,650, give or take 20 odd points. Despite the up move that we saw in the last hour yesterday, the Nifty added all of 61 points. The good part, however, is that two large parts of the indices, both the Nifty Bank as well as the IT index, did well in yesterday's trading session. The IT index will be in focus ahead of IT sector results. And at the same time, this index is also fairly off its highs. The broader markets, they were under a wee bit of pressure in yesterday's trading session. Yes, there was a recovery in the last hour, but Nifty, Next 50, Mid-Cap Index, Small-Cap Index, all of them ended lower. If you look at, the overall futures position by the FIs as well, they sold about 268 crores. They've been managing their net exposure fairly well over the last 5 or 6 trading sessions. They added about 4,100 longs, added about 4,100 shorts and 2,800 longs. If you look at the FII exposure over the last 5 days, you'll be surprised because nothing has changed. 29, 29, 28%, 29%, even as their net exposure has moved more towards the short side. But because of the up move that we saw yesterday, a lot of the call writers got taken out. So 25,400 call saw 10 lakh shares being unwound. 25,450 call also saw about 10 lakh shares being unwound. So a large part of the up move that we saw yesterday, while it was Sensex options expiry, we saw some of these Nifty option writers also cover their positions. And as they did that, the put writers got into action. So 25,500 put writers and the 25,550 put writers increased their positions. And 25,700 call writers actually went ahead and did some punt buying. So if the market were to break out beyond the range of 25,650, then perhaps there could be an up move, is what these punt buyers are betting. The good part is that, the range seems to have moved higher from 25,350 to around 25,450 at the lower level. And resistance too has moved about 50 points higher to around 25,700. That's about the index. The stocks that I'll be watching out for today have to be the paint stocks, Asian Paints as well as Berger Paints. Why do I say that? Because on the day AkzoNobel and JSW deal was announced, paint stocks were buzzing. We had spoken about 4 or 5 reasons why. The demand sentiment is improving, raw material sentiment is more contained. The stocks have already seen a decline, and more importantly, people are now sizing up competition. Since then, there have been a couple of brokerage upgrades. ICICI Securities turned positive after 4 years, and today we have Goldman Sachs as well as Jefferies and HSBC, all of them turning positive on the paint space. So my sense is that if the consumer sentiment has to improve and staples are doing well, why not paints?
Okay, all right, Maglam, got it. So, pain stocks, some positive cues and voices finally coming through. Well, let's kick it off then with the equity call of the morning. And this one's coming in from Rupal Agarwal of Bernstein, who says earnings revisions was the best performing style of 2024. She means in terms of stock picking. They have been waiting for this style to become attractive again. She says earnings revision is the only factor to be reasonably valued on absolute basis and be one of the cheapest relative to the market. More importantly, the portfolio, she says, is showing signs of bottoming on earnings downgrades after reaching extreme levels on both absolute and relative basis.
All right, that's the view which is coming in, and we'll get you more as we go along. Arvind Sangur is managing partner at Geosphere Capital. He's with us now. Arvind, good morning. Great to have you with us here. Appreciate it. Just a quick word, Arvind, on pharma specifically. Would you agree? I don't know if you heard some of what we were saying earlier. I was saying 12 to 18 months out, these pharma tariffs on foreign-made pharma products. I mean, that is almost going to be in the second half or the last 1 year of Trump's term. So from a market standpoint, I mean, actually, it's not bad at all.
Well, I guess it is okay. It depends on the timing. It depends on the magnitude. And whether the next president will completely roll it back after Trump is gone. So, I suspect there might be a bit of a relief, but I think the overhang of the uncertainty is still there. So, I think some of the more extreme measures, as we've seen before, are unlikely to come to pass. So I think it's going to be a mixed bag. I'm certainly not rushing out to buy pharma names on this news, but some bottom fishing could happen, I suspect.
Arvind, hi, good morning. On India, now there's just so much going on with trade, right? It seems there'll be a deal. He's called it out. But we don't have a sign of it just yet. There are sticky issues, and India is also taking the US to the WTO on several parameters. And then there's this pharma threat hanging. From the market standpoint, what should we read through and what should we take along? Because the market has gotten very quiet in the last few sessions.
Well, my sense is the market may be waiting for some trade news, but as we see the other markets, whether it was Japan or it was Korea or anybody else, the tariff news from a day ago didn't cause a huge, a disruption in those markets. So my sense is, at this point, tariffs are kind of part of the fabric of the noise in the market, and they will affect some short-term moves. I think the problem, in my opinion, in the Indian market is all of our, indicators like four-wheeler sales, two-wheeler sales, CV sales, every high-frequency indicator is showing a really slow economic outlook. So the earnings that is upon us, I think the market is as much waiting with bated breath on what's coming from there as assuming it's all about tariffs. So I think there's a fundamental side of the India growth story, which has nothing to do with tariffs, which is also not firing on all cylinders. So that may be part of the reason why the market is having a hard time, getting any momentum going.
That's interesting because a lot of the, people who watch the market are saying that maybe things are turning and from here on growth engines will begin to fire, especially on the consumption front. But, be that as it may, what would your strategy then be in terms of allocation to the Indian markets, if at all? What would be the places where you think would be, fairly safe to hide?
Well, that's an interesting question. I think, we've been using a much more bottom-up approach in financials. I think clearly, the RBI has been quite supportive and with everything they've done to ease liquidity. Clearly, the financials can be, interesting, and I think that's an area that we definitely like some special situations which have lagged and have valuation support. But other than that, I would say it's more selective rather than any big theme. We certainly, I will say this, we're staying away from IT because of the headwinds of, the technology risks from AI, although, stocks, again, the growth has not been anything to write home about. And valuations are not really compelling. But, there may be a trading play there. But our preference is companies that benefit from what's going on in the gold market long term. That is a theme that we like. But we like companies that have more domestic consumption exposure, like you said. That's an area that we think is in better shape. Although, again, as I said, we've been a little disappointed by some of the higher value items like autos and CVs. But other parts of the consumption story may be a little better position.
Okay. So maybe discretionary consumption, that's the one thing that's worked in the Indian market for the past many quarters. Arvind, but overall, just to go back to just the way the US market has taken all of it in its stride as well, numbers are still good. I mean, the macro numbers are still good. So what, more upsides, at least for the US market, you think?
Well, I think the US market has been amazingly resilient, and the US economy has been amazingly resilient in the face of all the tariff news. There are some who believe that the lagged effect of some of these tariffs is going to start showing up in the next couple of months. But, I think that this is a market which clearly seems to be, more bullish oriented. And we are cautious, but not maybe we've been too cautious. And I think the market itself, till we see signs of economic damage or inflation rearing up, I think the U.S. market and the U.S. economy seems to be on surprising good footing. And frankly, the U.S. is, in great shape from a technology standpoint, from an energy leadership standpoint. So those are all tailwinds for the economy. But the tariff noise at some point, it could create headwinds. But amazingly, from Liberation Day of early April, so far it has not shown up in the economic data.
Anant, we'll leave it there. Thank you very much for joining us. Great speaking with you. It's a pleasure having you here on CNBC TV18 and this program. What we'll do is we'll take a quick commercial break here. A list of top stocks to watch out for lined up on the other side. Stay tuned.
So it's the same headline that we've been repeating for the last today's third trading session, that markets have been resilient. There are no major moves across Asia, barring the Hong Kong market, which also has now cut its losses from 1% to about 0.5%. So tariffs are not really shaking markets too much. Let's pull up the implied open. We've anyway had very quiet sessions so far in the week. let's see, 26 to 27 points lower. That's how we may start. As usual, lots of stocks in focus. Q1 updates have been coming in. Let's look at the list for today then. And we have our team standing by with the CNBC TV18 list of top stocks to watch. Guys, good morning to all of you. Let's start with the updates coming in, production updates and monthly updates. Vivek, JSW Steel and Tata Steel, how do they look?
That's right. So metal companies have gone ahead and given their production as well as sales updates for Q1. These are the provisional numbers. Do note that. So first up, have a look at JSW Steel. Looks like a good set, especially as far as the crude steel production is concerned, up 14% on a year-on-year basis at 7.26 million tons. The Indian operations actually saw an uptick of close to 15%. Now, talking about Tata Steel, remember many moving parts over here. When you're talking about the domestic or India production volumes, that is actually flat on a year-on-year basis, impacted by a blast furnace shutdown as well as maintenance operations. The sales delivery volumes, however, was down close to 3.8%. Now, coming to the Netherlands portion of the business, production at 1.7 million tons versus around 1.63 million tons last quarter, and sales at 1.5 million tons versus 1.47 million tons. So again, expect a marginal red as far as Tata Steel is concerned today.
All right, we take that point. Vivek, thanks a lot for that. Gaurav's been giving us all the updates from the financial space, and today it's Union Bank. Doesn't look very good, Gaurav.
Well, yes, another weak quarter for Union Bank is what we can say, because this is the fourth quarter where we are seeing loan book growth at a single digit. Now, in this quarter, we are seeing the loan book growth just at around 6.8% on a year-on-year basis. Now, this is largely led by retail, agri and MSME segment, which also implies that the corporate growth was actually weak. When we look at the numbers, now it implies that the corporate growth was just at 3% on a year-on-year basis. And this also means that 4% to 5% decline on a sequential basis in terms of corporate growth. On the deposit fronts also, we did not see any good numbers. This was actually 6th consecutive quarter where we saw weak set of numbers from Union Bank. In fact, there have been some reclassifications, and we will be watching out on how the commentary is going to be on that reclassification for deposits. But specifically in terms of advances, weak set of numbers. In fact, let's also not forget that in FY25 also, bank could not meet its guidance for advances and deposits. And for FY26, they have not given any guidance. But for now, weak set of numbers for Union Bank.
Okay, all right. Union Bank not looking that great either on advances or deposits. Thanks for that, Gaurav. Let's get to some more updates. Sonal, I think you're watching out for Signature Global.
Well, yes, I am. For Signature Global, while it was a YOY decline, which the company says is because of high base, quarter on quarter, the number looked really strong. The sales value was up 63%, area sold was up 19%, but these two parameters were down on a YOY basis. The collections were down both on a quarter-on-quarter and on a YOY basis for the company. Debt remained at 890 crore rupees, which is a flattish number on a quarter-on-quarter basis. Now, in terms of their FY26 guidance, it is at 12,500 crore rupees and collections at 6,000 crore rupees. And Nuvama says a rising collections trajectory and improving profitability would mean that the company would be seeing cash flows, free cash flows rising, and they could be debt-free by FY27 as well. So going with green for Signature Global.
All right, going with green for Signature Global. Thanks a lot for that, Sonal. Let's move on to an important corporate story which will have an impact on Sun TV. The family feud has ended. That's a Money Control exclusive. Chandra Shrikant of Money Control joins us now. Chandra, it was just a couple of weeks ago where the brothers were, up in arms in terms of courts and legal notices to each other. You think that it's been sorted now?
That's right. We had reported a few weeks ago that Dayanidhi Maran had sent a legal notice to his older brother Kalanidhi Maran, making a range of serious charges. But from what we understand from our sources, Tamil Nadu Chief Minister M.K. Stalin has played a pivotal role as mediator to bring about a truce between the warring brothers. So we're picking up from our sources that a meeting was held in the presence of Tamil Nadu Chief Minister M.K. Stalin, who, remember, is a cousin of the Maran brothers. So he met Kalanidhi Maran, Dayanidhi Maran, as well as their sister Anbu Karasi to hammer out a settlement and bring this issue to a close. It's not clear yet what the contours of this settlement are, if this will just involve a monetary settlement with Dayanidhi Maran, or if he will also get some businesses that Kalanidhi Maran currently operates. But this should come as relief that, they're not going to fight this out in courts because clearly, the stakes are very high considering the elections in Tamil Nadu are also just a year away. So the Tamil Nadu Chief Minister being about a truce between the Maran brothers.
Okay, all right. So perhaps good news and some relief for Sun TV shareholders as well, if this is settled amicably. Thanks for that, Chandra. Important story there. Let's move on. Vinny is tracking Lupin and CAMS. Vinny, morning. Tell us why.
Good morning. So Lupin, firstly, we're keeping an eye out on this one. They've signed an agreement with Zentiva KS Czech Republic for commercialization of Lupin's biosimilar. And this is a biosimilar called certolizumab, which is mainly used for treatment of autoimmune, several autoimmune, as well as inflammatory conditions that are caused because of that as well. So now obviously they'll be covering a lot of international markets except for Australia, Japan, Brazil, Philippines and India. Now Lupin will actually be responsible for developing and manufacturing and supplying these products, while Zentiva will handle the commercialization in Europe as well as CIS markets. Lupin will commercialize in US and Canada markets and other remaining regions which they've agreed upon. Now Zentiva will actually be making a non-refundable payment of $50 million, which will include an upfront payment of $10 million as well. So we're expecting green here on the back of this agreement. Lastly, we have also CAMS that is in focus. Green expected here as well, as they've launched CAMS Pay that has been launched by the company. This is a new payment gateway and now gateway, I beg your pardon. And they will be supporting around 5,000 transactions per second. And this is going to be mainly to address challenges like there are transaction slowdowns or reconciliation in terms of issues that are going on, and that is what they want to address in terms for users coming in as well. So green expected here as well.
All right, new products for both these companies from different sectors, positive news coming in, but a lot of other stocks which are in focus this morning. Upasana joins in to give us that list. Upasana.
Good morning. First up, let me start with EPAC Durables. The company has commenced the commercial production of washing machine at its Sri City plant for the utilization of the enhanced capacity. Next up is Bajaj Projects on the back of capacity addition. Now, company has planned a capacity addition of nearly about 170 crores at Ranjangaon facility from Q4 FY26 to Q4 FY27 in a phased manner. Now, with this, the capacity addition of the company, the galvanized capacity of the company will increase from 40,500 MTPA to nearly about 1.1 lakh MTPA is what the company has indicated. And the key rationale behind this capacity expansion is to meet the captive demand which is increasing, and the sales in domestic and international market is what the company has indicated. So hence I expect both these stocks to open in green today.
Okay, all right, got it. Thank you for that, Upasana. Let's then wrap it up with Sudarshan, who's watching out for Petronet LNG. Sudarshan, morning. So what is this, some relief on some regulatory issues with the board, PNGRB?
Good morning, Surabhi. So in January of this year, 2025, PNGRB had come out with a proposal saying that regasification activities of LNG companies, both Petronet LNG and GSPC, have to come under the purview of PNGRB to ensure fair pricing and efficient utilization of their LNG infrastructure. But these LNG companies were against that. Basically, they were saying that they are not required to come under the purview of PNGRB. But following that, these companies had moved to Delhi High Court. Now, Delhi High Court has given the interim relief to these companies, saying that no coercive action can be taken until the next hearing, and the next hearing is scheduled on October 9. And remember that the day PNGRB had come out with this proposal, we had seen a sharp drop in Petronet LNG stock. That day, stock had fallen more than 5%. So this interim relief can be taken positively by the street.
Okay, all right. That sounds really important. At least it's not a final relief, but as Sudarshan is explaining, at least some breather coming in from the courts for these regasification players. Thanks for that, Sud. Let's quickly recap our list of stocks to watch. Then the ones that have positive news flow are JSW Steel, Signature Global, Sun TV, Lupin, CAMS, EPAC Durable, Bajaj Projects, and Petronet LNG. Stocks with negative news flow would be Tata Steel and Union Bank. Okay, that's the stock list. But let's not forget, we have to watch out for all the oil and gas stocks as well, because crude oil prices have flared up. And Brent is at $70 a barrel. Manisha is joining in. Manisha, morning. We thought with the OPEC deciding they'll keep pumping more and more, prices should go down, but they're going up. What's happening?
Well, yes, so that has surprised almost everybody in the oil markets there. But with the kind of reaction that we're looking at in the crude oil prices, we've gained a percentage point yet again overnight. With that, we are trading at a 2-week highs, and $70 a barrel is on your screens right now. Well, it is also about tightness in the middle distillates, the ongoing Houthi attacks on cargo ships on Red Sea, and the U.S. inventories have continued to decline. This week is showing a decline of 2.6 million barrels. This is a 6th weekly decline in 7 weeks. So while, yes, a longer-term projection is still of oversupply, pardon me, but for the very near term, the markets do believe that there is tightness, especially in the middle distillates. The Atlantic hurricane season is upon us, and the U.S. demand in sense of its driving season also could be supportive of prices. So $70 per barrel it is.
All right, $70 per barrel it is. Manisha, thank you so much for that. Higher from what we saw earlier, but still lower than what we've seen before that as well. Take a short break. On the other side, we'll get speaking about the consumer space. The management of Bazaar Style Retail joins in to discuss their FY26 outlook, their first quarter update, and what the consumer sentiment is like. Welcome back. You're watching us here on Bazaar Morning Call on CNBC TV18, and the company on our show right now is Bazaar Style Retail. Their first quarter operational update was good. 37% revenue growth, 22 new stores added. Same-store sales growth were under pressure because of the shift of Eid in the previous quarter. Shriram Finance, who's the MD of Bazaar Style Retail, joins in. Shriram, sir, before we speak about the numbers, etc., I have a grouse to make, not just with you, with all the other retail companies. In the first quarter update, they've given their normalized same-store sales growth had it not been for the shift in Eid. But what's interesting is that none of you guys in the fourth quarter gave us an adjusted same-store sales growth downward when Eid was in that quarter itself, right? So basically what has happened is that the fourth quarter same-store sales growth was upstated because of Eid, and y'all did not downstate it. And the first quarter, y'all give us an update which was lower, but then y'all give us a normalized number as well. So when it suits you, you go ahead and give us a normalized number. But be that as it may, that's not just you, that's the entire sector. 37% growth in the first quarter. What's your target for the entire year, and how has sentiment picked up in the second quarter so far?
So basically, in the fourth quarter, the last year, the Eid was on 11th April, and last year it was on, this year it was on 31st March. As a result, when we were delivering the updates about the Q4, we were not able to clarify the amount which should be adjusted. But in the Q1, we have adjusted that 11 to 12 days of each sale, and we have given that normalized growth. We have grown at around 37% for this quarter. And if you see for the first half, we have grown at a rate of 45% with an L12 growth of 8%. We have also given that number. In terms of this year guidance, we have guided for 25% revenue growth and with an L12 growth of around 7 to 8%.
So, Shreyans, let's talk about the year as a whole, right? Because then there'll be Eid and then there'll be Diwali and something will fall in Q1 and Q2 and then that's an ongoing debate. But for FY25, you did about 13% same-store sales growth, right? So let's talk about the full year. I mean, can you improve that performance? Can your SSG, grow to maybe 15% or something thereabouts? What's your full year expectation? Revenue you've told us, but same-store sales?
It's around 7 to 8%.
Oh, that'll be 7 to 8%. Why are you working with a possible decline in same-store sales growth?
It's not a decline. Actually, for the last 3 years, we are growing at a rate of more than, last year it was 13%. Before that, it was around 10%. So we always take a conservative growth guidance for our mature stores, 7 to 8, with intent to grow higher on that term.
Got that. And what kind of store addition are you factoring in? Because, in the previous quarter, you added close to around 21 stores. You have a target of 40 to 50 stores. You've added stores at over 25% CAGR over the last 3 years. What's your target for this year?
Again, between 40 to 50 stores.
40 to 50 stores. And what about the availability of real estate? Because a lot of people are saying that while they're, looking to open stores, availability of locations is a bit of a concern. And that may also lead to increase in the rents that they have to pay. Will that be a problem for you?
So I don't think we are facing right now that is a problem because most of our stores are opening in tier 2, tier 3, tier 4, where still there are only 2 to 3 organized retail players. And because of our approach of the cluster-based strategy, we are working state by state. We are not going pan-India. Wherever we are going, we are finding good locations over there.
Shreyans, let's also talk margins. For the full year, you were at around 13.5%. For this year, FY26, you've said that margins may improve to 15-16%. What's driving this? Give us some more color on the pulse of the consumer. Is the consumer up trading? I don't know if anyone's even thinking of price hikes at all. Or is it going to be a difference in the mix that will drive it? What makes you confident on margins?
So margin guidance is around 14 to 15% on EBITDA. Not 15 to 16, it's 14 to 15.
No, your target.
15%. You're targeted for FY26.
Yeah, for target for 26, EBITDA is 14 to 15%.
Oh, okay. 14 to 15%.
Because the last time you joined us, you did say that, it'll be 14 to 15% for FY25 and 15 to 16% for FY26. And that's what we remember.
So this year the guidance is around 14 to 15% only. The similar guidance last year. And in terms of pricing, we are not increasing anything. Our ASP is around 300 per article. The target is simple that any customer walks in with 1,000 rupees note, we give him 3.5 articles and a style for a day. So it will be more in volume and assortment is rather than price.
Very clear value proposition, right? Walk in with $1,000, get at least 3.5 articles. You're fully styled from head to toe. Pretty yes. On volumes itself, then again, what would be the increase in volumes that you project, and is it going to be more back-ended when the full-blown festive season comes in, or what are you expecting in terms of H1, H2 trends?
So see, in terms of trends that we see, last year also in terms of growth, we have grown at 37%, whereas volume has grown more than 40%. So I think that will be the trend. We will work on more volume and more width in our stores during the festival time. Because higher will be the width in the store, more will be the sales in the festival times.
Could you give us a character of the way revenue will shape up going forward in terms of how much will come from core markets, which account for 85% of your sales, private labels are 45% of your sales, and the men-women split is fairly even, 40% men, 30% women, nearly 30% kids. Will this continue, this mix, or are you expecting any significant change from this?
So right now the mix 86% revenue comes from apparel section, and 87% comes from apparel section, and 13% comes from general merchandise. Out of 86, 36 comes from men's, 28 comes from ladies, and around 22 comes from kids. So this is the mix for us.
All right. And net debt, where do you target that to be by the end of this year?
So I think the mix will remain similar only. 87% revenue will be coming from April section only and 13% will be coming from Jan section only.
No, I was talking about net debt.
Okay, on the net debt will be on the similar lines that we have posted this year. This year, I think the net debt was around 104 crores, and it will be on the similar lines for this year also.
All right, take that point. Thank you so much for joining in and giving us an outlook on this year, and wish you good luck for this year, be it Eid, Diwali, wedding season, festive season, better monsoons. All of that works well for value retailers. 25% plus growth with 7 to 8% same-store sales growth. 14 to 15% margins is the broad target for bazaar-style retail. Let's get in Deven Choksi on the show as well. Thanks a lot, Deven, for joining in. Good morning. Value retailers, we've got the update from Avenue Supermarts, we've got the update from V-Mart, we've got the update from players like bazaar-style retail as well. And the consumer sentiment, by and large, looks like it is improving, especially on the staples and beyond metros space. Would you bet on any of these players right now?
Yeah, Mangalam, good morning. Well, I think that's important to know that, yes, I think the rural demand is picking up, most importantly. Consumer is spending money on different types of format. I think the larger retailers are probably attracting the consumer for the high value-added formats, as well as I think the smaller retailers, I think starting from grocery onwards to apparels, I think they are attracting consumers. The most important part is that on a per store realization basis, I think most of these companies are talking double-digit growth. And that's where I think one could possibly argue that they're leaving more money in the hands of consumer is definitely resulting into higher spending power. Now, whether I think this is immediately reflecting into the kind of a buying opportunity of any of these stocks, I'm not completely sure on that aspect, because most of these companies are fairly valued. In fact, I think they are comparatively valued, I think, in rich valuations, taking benchmark of demand. So frankly, I think I don't see the opportunity immediately in buying those companies, because I think the valuations are already at scale level at this point of time.
Got that. Deven, morning. First off the block in terms of earnings will be, of course, IT services. I mean, it's been a pretty, except maybe one or two of the mid-cap companies like Persistent, Coforge. You can look at it, look at the data over the last many quarters. Everything else has been very small growth of 1%, 1.5%, some decline even. You think similar kind of quarter this time around as well? And any trades here in the IT space?
Hi, Prashant. Good morning. Well, I guess I think the larger IT companies are still trying to find its space in the bigger order wins that they are targeting. Current year also, I think, has started, but I don't think that immediately we are getting many signals from from America or from other markets of the world, where they've been watching out for getting the larger part of the orders. I think that's not immediately being seen. However, in the mid-tier IT companies, particularly those which are into the engineering R&D space, they continue to attract a good amount of attention because they are a B2B solution provider to most of the companies in their product programs. And that's where probably I think these companies are relatively sure of, I think, higher growth. What one is not fully convinced about is the valuation. Again, I think all the mid-tier IT companies, even though they are growing in a double-digit growth, they still do not have the kind of a valuation advantage in marketplace at this point of time. So yes, if you're invested, I think you better stay invested. But otherwise, I think the fresh buy definitely at a lower levels, I think would be more recommended in my view.
Where does fresh buying happen according to you right now? What sector looks interesting?
So I think we continue to like the manufacturing, which is connected with the high-end part of the manufacturing in supplying to, say, for example, railways, supplying to, say, for example, defense, supplying to the power and power utility businesses. That's where probably I think our conviction level remains high. Yes, I think the larger companies are fairly valued, so there is no argument on that aspect at this point of time. But some of the smaller players who are basically mid-sized to small-sized companies, which are now fitting well into the entire growth program of these particular verticals. In my report, I think they are the ones I think who are getting into the opportunity space at this point of time. So this is one area which we continue to like it. The second area, as I was mentioning, is about engineering R&D space. That's where the companies like Tata Tech in particular, or Tata Elxsi for that matter, I think they are looking at relatively more stable companies from an investment point of view. However, I think they will be reflecting higher amount of growth in this year in course of, I think, next couple of quarters, wherein some of the projects are going to start materializing into billing part of it. So we like, I think, that proposition. available at a comparatively, I think, a lower values at this point of time. Similarly, I think we continue to like some of the the top level NBFCs, like some Bajaj Finance, Bajaj Housing Finance. There, the growth rate is in excess of 25%, and they are growing, I think, at a steady pace. For a little bit of valuation expensive, but again, I think they are giving good visibility for next 3 to 4 years from a perspective of doubling the book size, etc. So we
manufacturing plays, engineering plays, and good quality NBFCs. Those are the three places which you like right now, right?
Yes.
Do you have a view on some of these real estate names? Signature Global, for instance, reported its first quarter update, 63% value growth. We've seen good performance continue for the real estate space. Do you think, we're towards the middle of the cycle right now, towards the end of the cycle? Where do you think real estate stocks and the underlying cycle is?
Yeah, I think, Mangalam, we find that I think the companies which are typically focusing on redevelopment projects are relatively better off at this point of time, because I think they know how exactly I think they're investing their money in the construction area of activity, and they can focus well on selling part of it. I think somebody who is carrying the land parcel, we are not completely sure, because I think they end up selling either the community living kind of projects, or they end up selling some of the mass housing kind of projects. We are more comfortable with real estate companies which are in the premium segment of housing. We believe that I think that's an area where probably I think you're likely to see higher amount of growth and realization, apart from getting better income on your investment that you do, that is return on equity. So we love those kind of companies more. At this point of time, maybe I think some of the new companies which are entering into the IPO market, they may be also equally a compelling proposition in the real estate space. But listed space, I think more or less companies are priced adequately at this point of time.
Okay. That's on real estate. Devin, hi, good morning. What about textile and apparel? I mean, these companies have been waiting for their time under the sun for a long time to really become huge global players, right? And who knows? I mean, the tariffs are changing every day, but we know Bangladesh is at 35%, Vietnam is at 20%. If somehow India can manage a tariff less than 20%, then this could make the sector very interesting, won't it? Do you like any players here?
So we all have, I think, good amount of expectation on this front, and I don't think that things are immediately seen happening in my view. But even if I think one has to assume that I think we would be having the advantage of tariff, do we have the large size facilities, I think, which can give equally better amount of output? I think one is not completely sure. Maybe significant amount of investment may be required in some of the units. I think that's what I gather. At this point of time, I think we as investors, I think, don't like this particular sector because it is too much vulnerable, I think, in different spaces, I think, including the one's current situation in which we are. Suppose if everything materializes, nothing like it, but it will be a 3-year story to roll out that kind of a business. We will wait for some time.
Okay, all right. So wait and watch till we have actual proof on ground and the final tariffs themselves. Got it. Thank you very much, Devin, for all the thoughts and ideas. We need to take a very quick break on that note. Coming up on the other side, we'll have Sudarshan Sukhani and Mitesh Thakkar joining in with some technical trading ideas.
Welcome back. Well, I think you've got the market, which is 7 minutes away from the pre-opening. Sudarshan and Mitesh are with us with what they'd want you to do in terms of the start this morning. Gentlemen, great to have both of you here. Markets have quietened down, although with the Sensex expiry, you saw a little bit of excitement with that sharp spike towards the end yesterday. Mitesh, what's the advice? How are things looking? And is this going to be, once again, back to sort of a quieter session, ranged in that sense, at least on indices, and then we'll get to stocks?
Yeah. So, good morning, Prashant. I've been actually suggesting that, we are going through a contraction phase, and that is how things are playing out. It is a market, which after that hitting that levels of 25,200 plus has kind of come back and now is, showing signs of a situation when the volatility indicators are turning flat. The moving averages are turning flat. So it's a market, which is not giving clear-cut directional signs. My sense is that this could mean that few more days of range-bound activity could happen. The threat would come in case we break 24,200 on the downside. But as of now, that is also something which I'm not very sure about. So we just believe that the markets will move around within some kind of a trading range.
And that trading range has become as narrow as, like Mangalam was telling us, taking an average last couple of sessions, 100 points, 150 points, barely going to 200 points. It's quite something. Morning, gentlemen. Sudarshan, so yeah, we're in that kind of a market where a 10-point move on the Nifty, you have to keep seeing, and then eventually it may happen. But what are you doing? Any index trades at all, or is it all stocks?
Yeah, good morning. I think there's an index trade now coming up. See, for the last many days, we have been in a narrow range. You just spoke about a 100-point range, 150-point range, whatever. That range cannot last for long. I think we are now on the verge of a significant move in the Nifty. Unfortunately, I can't predict whether it will be on the upside or the downside. Usually, I would have said up, but we don't know this time. I can give you some support and resistance zones somewhere around 25,550. If we cross that level, then we are breaking on the upside and we should be positioned on the long side once those levels are touched and crossed. On the downside, I have something around 25,425. This is a 125-point range where no trades are possible, either above it or below that 425 level. I think a significant trading opportunity will emerge.
Yeah, interesting, and we'll keep that in mind. And it seems from the market's move that it wants to go higher. It's not falling. All kinds of fundamental negative news you're throwing at it, and it's not falling. But let's see. We'll take a very quick break on that note, come back on the other side, and then we'll get some stock-specific ideas with our technical experts as well. Welcome back. Just about 16 minutes before we kickstart today's trading action. Will the range break? Will there be some action in the market? Well, let's see. Talk about individual stocks now. Mitesh, morning. Let's get to your stock list.
Yeah. Morning, Sudhir. I have a mix of buys and sells. On the buying side is DLF with a stop at 828. I'll look for targets of 870 here. Aditya Birla Fashion appears to have given some kind of a mild reversal, so buy with the stop at 78 for a first target of 82.5. A sell on Axis Bank with a stop at 1173, and it's a conditional sell. So if it breaks 1160, then take a short positions. Take a stop at 1173, look for targets of 1130. And Delivery is a buy with a stop at 399 for targets of 430.
Interesting one, Delivery buy. We have a Motilal Oswal initiating coverage on that stock today as well. From the lows, the stock has actually seen a big up move. So keep an eye out on that one. Thank you, Mitesh. Sudarshan, your stock picks?
Yeah, it's an all buy list. ITC is a buy with a stop under 410. Balakrishnan Industries is a buying opportunity with a stop under 2560. Asian Paints, despite all the adverse news, is giving a decent chart. So it's a buy with a stop under 2437. And finally, Cummins India is a buy with a stop under 3400. It's an all buy list, primarily mid caps.
Okay. Got it, gentlemen. Thanks very much for that. So those are some of the stock ideas that perhaps one can look at today. It's 9 a.m. The first of the rates are coming in. They're all over the place. So maybe we should just wait. Nifty in the first at 900, it's suddenly down some 300 points. So let's wait and see how it plays up. In the meantime, what we should do is perhaps take stock of a lot of the banking updates that we've been getting over the last couple of days. And the updates have been fairly mixed. Some banks are talking about double-digit growth. Others have been struggling in single digits. So let's discuss all of this with Digant Haria, founder at GreenEdge Wealth Services. Digant, thank you so much for joining in. Just wanted to start with the Union Bank because that's what we saw after market hours yesterday, where the advances growth is, I think, 6.8%. The deposit growth is, just about 3.5% thereabouts. So it's really, it stands out in terms of weakness. And there were some other names as well. I think PNB on the PSU side, where the growth numbers were, at least advances, were in single digits. How do you look at PSU banks right now from a growth standpoint and the valuation standpoint?
Yeah, morning, Survi. See, this entire growth slowdown started probably around elections of last year. So if you look at the credit growth data of India as a whole, it's around 9% for, like the YOY credit growth in that June quarter was around 9%. So see, when the growth is 9%, we know that maybe the private sector will grow at 11-12 and the public sector will grow at 7-8% because the system growth itself is 9. So I don't see, this, PNB or, Bank of Baroda or anyone's performance as very, very ghastly or anything because, see, system growth minus 2% is what generally the public sector bank is used to growing. But yes, I think the system growth at 9% itself is a very, very weak number for a country like India. Like we should at least be at 12%. And now we see that, the whole macros, the RBI has, taken a lot of initiatives to ensure that this growth starts. I think that, 1 quarter later, like once the monsoons are over, the slow season is over, we should see this number improving. These are not great numbers, not something which instills confidence, but I think improvement is coming on its way, Survi.
Digant, hi, good morning. Always great to get a perspective. And, what we like about speaking to you, Digant, is you pull back a little bit and then you sort of zoom in as well. So that's very useful. And NBFCs has been, a happy hunting ground for at least a few people. I was just, for example, looking at IIFL, right? I mean, underwent so much damage. The first time it started falling was that gold ban. It never really recovered, even though the ban went away. Went down to all the way to about 300 kind of levels, back to about 500 after many months. Is this a broader kind of a sort of rising tide lifting all boats kind of situation, or it's more idiosyncratic, in your opinion?
I think, morning, Prashant. I think it's a little bit idiosyncratic because, see in NBF, when we say NBFCs, there are a lot of pockets. I think the brightest pocket is gold loans for the next 12 months. So just Surbi was just hinting that, okay, 6, 7, 8% growth, and we were talking about credit growth of 9%. Really, really boring numbers. But I think gold loan as an industry, Prashant, this year can easily do 20% growth. And then good players can, easily do 30-40% growth. IIFL, after a long ban, has come back. So I think growth will come back in IIFL. I think the stock price is yet to react, like the Muthuts and Mannapurams and Fed Finas of the world, they have reacted to a good gold price, a good RBI policy, and a good gold demand environment. IIFL hasn't. I think it should over a period of time because, once RBI ban is lifted, getting the liabilities or getting borrowings takes time. And I think IIFL is sorting those issues out.
And in NBFCs, actually two questions. In NBFCs, what are your top 1 or 2 ideas? You like IIFL clear, I think so. But what are your top sort of rated ideas? And broadly, if the RBI is trying to jumpstart this credit cycle, in a way, the NBFCs are clearly higher risk in that sense as compared to banks and the top tier banks, which are much more stable. But this is where perhaps you make a little bit more in terms of alpha. What's your sense?
Yeah, absolutely. I think, if one has to bet on financials, Prashant, I think, PSU banks is something which gives 10 to 15% returns because the cycle will pick up, over the coming months. But I think NBFCs is something where, people can look for alpha. So just like we said that, gold loans as a space is probably the fastest growing and the best placed space. So, anything in gold loans should, generate decent alpha for the investors. Similarly, there is one sector which is an avoid, which is a commercial vehicle finance, okay, or the CV finance. I think that we have finished 3-year cycle. So we will see that as, going very, very slow. But the space which I like, apart from this gold loan space, is something, which is in that personal loan, microfinance, this entire high yield lending space. That's because, this space has gone through a lot of pain. I think now the asset quality cycle is coming to an end. The regulatory cycle is improving and the demand environment will improve in the coming months. So I think this entire, banks and NBFCs which are linked to high yield lending, something like, say an AU Bank or an RBL, on the banking side, those will see the biggest alpha in terms of earnings. And, when we talk of NBFCs, companies like, say, a Northern Arc or a Fed Fina, or, even say an Ujjivan Equitas, something like that.
We've seen an up move in Northern Arc earlier. We had the management join us last week. They said that 22 to 25% growth is what they're expecting. So, Digant, what your point is that loan growth at some point will pick up, but yields will pick up a lot faster because loan growth which picks up will pick up on, the high yielding sides as well. The concern that one had was, a lot of the people who are getting fresh loans are the ones who are already leveraged. At what point does this net widen and you go to underserved places, and what companies benefit the most from that?
Yeah, so I think, this whole, Mangalam, this whole space below 50-60,000 of ticket size, that is a space which is really over leveraged. And that problem is still not over. We are still in that problem because the incomes of those customers are not going up. But I think, the space between that, 1 lakh to 5 lakh kind of a personal loan ticket size, that space should really do well. Because, some amount of deleveraging has happened there, and this entire tax cut by the government and this rate cut, this benefits this space. So I think Northern Arc is is very well placed to ride this boom. Then, even something like a Federal Bank Financial Services, it's an NBFC of the Federal Bank Group. I think they are into this high yield lending. So they are into gold plus small lap plus, some bit of business loans. So they can also benefit out of that. Something like an SBFC, there are a lot of small names, Mangalam, it's a buffet out there.
So smaller names is what you're betting on. Where do you stand in the PSU versus private banks debate right now?
Mangalam, I think, the entire large cap space, be it the top 4 PSU banks, the top 4 private banks, and the top 4 NBFCs like, Bajaj, Chola, Shrirams, I think all of them will give you market returns, maybe 10 to 15%. There is no real big case of saying that this is better than that. I think everyone will suffer this slow credit growth in India. It is only the smaller guys who can really outperform in the next 1 year. At least that is our view.
Okay.
So no great picks in, all the large caps. Maybe you can just invest in a large cap banking ETF or something. You'll get your market returns out of it.
Yeah, so the alpha is in the tier 2, tier 3 names, and that's why the perspective that you gave really helps. Guys which are very granular with respect to MFI, high-yielding consumer businesses, gold financiers. Got that. So really helpful takeaways. To wrap it up, Digant, the market also loves to play some turnaround stories. And everybody wants to make a huge killing by buying out stocks that are in distress. And here we're talking obviously about IndusInd Bank. And everybody thinks that you buy the bottom and then you would have a great story to tell a couple of months down the line. But I don't know how that could play out because there's a lot that's still that we don't know. The forensic audit is not done. And if you look at the numbers that the bank has been posting, I mean, all of this is taking a toll on the business. Advances, deposits, everything's been falling. Your thoughts and what would your word of advice be to investors who've been looking at this name?
See, I think, Surabhi, there is no pot of gold in IndusInd Bank, to be honest, because right now we have just identified a few areas of problems. Now, fixing it itself, it will first require a new MD to come. Then the whole new team will come. They'll start to work. So I think it's a long journey. And see, the stock has, been quite firm in the face of all this bad news. So I just feel that, this is like a trading range kind of a stock where, 750 to 1,000 or 700 to 1,000 is where the stock trades at, depending upon what kind of news. But business is really, really affected, and it takes 4 quarters for it to revive, even if there is a good cycle. So I think you're better off hunting somewhere else. I think IndusInd is for the traders, who like to trade volatility. I think for people who want to buy and hold for a cycle, say 1 year, 18 months, I think there are better, smaller bets, to take than IndusInd Bank.
And you've given us some names. I'm just recapping: AU Small Finance Bank, RBL, IIFL, Federal. Some of the companies that Digant likes. All right, Digant, thank you very much. Great conversation. And we look forward to the next one as well. Okay, let's quickly, check back with the market, which is now as quiet as ever. Nothing really has changed. So about 8 points down on the Nifty, and the Bank Nifty is also absolutely flat at this point. Let's go back to our technical experts for the technical ideas. Sudarshan, what would your call be? 910?
Well, it will be Cummins India buy with a stop under 3,400.
Okay, and Mitesh, yours?
Well, you go with a buy on DLF for targets of 870.
Okay. So, yeah, I mean, lots happening. Let's just look at names like Vedanta, etc., right? I mean, those copper tariffs. If we can just quickly pull up as we wrap up the pre-open session, I think 1% higher on Vedanta. It's just the US which is the problem. But, and of course, and the timing in terms of effectiveness is uncertain. The rest of the world, of course, is open in that sense. Let's shift focus to a slew of brokerage notes which are coming in on a select real estate names. And of course, the EMS pack as well. Sudarshan has got the top ones here. So, good morning.
Morning, Prashant. So we have few stocks where brokerages have initiated coverage. So first one, Nomura has initiated coverage on Godrej Properties, and their call is reduced and target price is 1,900 per share. It believes that pre-sales momentum are going to be weak, and in FY26, pre-sales are expected to be rupees 31,000 crore against company's guidance of 32,500 crore. Also, it believes that challenges to execution in Godrej Properties are very much visible. On Phoenix Mills, it has initiated coverage, and here also the call is reduced and target is 1,400 per share. It says there is a slow consumption growth in mature malls, and retail consumption CAGR by FY27 is expected to be 9%, and by FY30 it's expected to be 11% versus 40% that company did over FY22-25. Last one, JP Morgan has initiated coverage on EMS companies. It has an overweight call on Syrma, Dixon and Keynes. For Syrma, target price 800, Dixon 17,700 and Keynes 7,150. And it has a neutral call on Amber Enterprises and Cyan DLM, and underweight on Avalon. For target for Amber is 7,350, Cyan DLM 450 and Avalon 650 per share. For Syrma, it believes that company is expected to see a growth acceleration and expansion on margin front. For Dixon, it will be mobile-led growth till FY27, and beyond that, it would be led by non-mobile. For Keynes, it may see fastest growth amongst all the EMS companies. That would be 46% CAGR over FY25-28. And for Syrma, Cyan, DLM and Avalon, exports could be the next leg of growth driver.
All right, Sudarshan, thanks a lot for that. So those are a bunch of initiating coverages. But looking at the consumer staples and paint companies, we've been speaking about how, brokerages are now turning positive. Jefferies has written on consumer staples. They've said that several consumer firms have faced severe issues in the past few quarters. There have been issues regarding growth, margins, as well as competition. While some of them are abating with his growth and margins, competition may persist, but these stocks have factored that in, and they believe that from here on there is more upside and less downside, which is why they've upgraded both Varun Beverages and HUL and Asian Paints as well to buy from underperform, and they've upped their target price as well. HSBC, on the other hand, has specifically written on paints. They've said that their market checks suggest dealer incentives have achieved broad parity across players. Basically, all players are giving the same thing to every dealer. And from here on, for Birla Opus to go ahead and do that 10,000 crore revenue target means that they have to sell a lot more per tinting machine versus what they are right now, which is a very big ask. So we need to be mindful of that. They remain optimistic about the underlying industry growth improving in the second half of this year. Asian Paints, they're buyers on that, target price up to 2,900, and Berger Paints, buyers on that, target up to 640.
All right, we got the first rates which are starting to come through, and we've got the market open absolutely flat. My God, I mean, will it be, under a 10-point day, 25,510 on the Nifty. And it's got nothing on it. The Nifty Bank is absolutely flat as well, 0.1%. The 57,200 is where we're at. The small cap index is up a little bit, but it's barely in the green, 0.12. And I think you've got the mid cap index, which is starting up about 10 points as well, but it's absolutely flat there as well. So, yeah, I mean, not very much to go with as far as indices are concerned. 1,100 stocks are higher, 500 stocks are lower. The Nifty heat map up on your screen. So you've got about 20, 22 names which are lower. Bulk of it, though, is in the red at this point in time. It's actually FMCG. I mean, so Monday you had FMCG index up 1.5%. Lever Asian Paints are the two names which are on the green side, and some tech names are in the red to begin this session. Surabhi.
Okay, 29 points lower at this juncture. The weakness is coming in from a couple of IT names. Wipro is down 1%, Infosys is down 0.5%, Tech Mahindra is also starting lower. HCLTech is down 1% as well. So IT is getting nervous ahead of the earnings. L&T is seeing about 0.5% shave off. Mahindra & Mahindra is seeing very mild profit booking. Titan, by the way, that was down 6.5% yesterday, is down another 0.25% this morning. Trent is also slightly lower. So that's the losers list. Let's look at the winners. HUL, 1.5% on the upside, up and about. Asian Paints, 0.7% higher. Manglam was just telling us about some of the broker notes, which are sounding a little more optimistic on the paint sector now, on paint stocks. There's Geo Financial, there's Cipla. By the way, let's pull up some of the pharma names. Cipla is up. Dr. Reddy's is down 0.25. There's no meaningful move on pharma because anyway, I mean, you heard that soundbite from the US president. He was saying we could put 200%, but it's in the future. Want to give the industry some time, etc., etc. So nothing concrete. So pharma seems to be all right for the time being, but it's more down than up. Eternal is also lower. So very clearly, the trends are more, defined on the downside this morning. 30 points lower now. 35 points lower actually on the Nifty now. Manglam?
Both of you all are sounding like the first 20 minutes of a classical concert where an alap happens, not much in terms of stuff, but there are a lot of nuances under that alap, and that's exactly what is taking place right now. The Nifty, the frontline indices absolutely flat, marginally lower, but look at the nuance out here. You have the consumer staples doing well. We've been speaking about how Jefferies has gotten positive on, HUL, Asian Paints, as well as Varun Beverages. All these stocks are among the top gainers, not by too much, but gainers nevertheless. We are seeing some traction on, Berger Paints as well. HSBC is written too. But Union Bank, weak update coming in. That stock is down 4.5%, 5% straight off the bat. While a lot of the other pharmaceutical companies are doing well, the domestic ones in particular, the ones that have foreign parentage are not doing very well. So Pfizer, for instance, down about 4% at open itself. And then we have, I'm looking at Sun TV, wondering whether there is a move on that one on the back of an alleged truce between the brothers, the Maran brothers. That stock too has opened about 1% higher. Dish TV, 5% higher. The Z Group stocks have been doing well. Obviously, it's a 5 rupee stock, but Religare is the other one, which is up around 5% as well. The hospitality companies continue to do well. Sami Hotels is one of them, which is up around 2.5%. Then you have Garden Reach Shipbuilders, the usual suspects, the ones which are higher. And on the lower end, we have Phoenix Mills, Godrej Properties, and Dream Folks, which continues to see some traction on the downside. So it's an alap with a lot of nuance in the broader markets. And the movers aren't very big when it comes to volume. So maybe towards the end of the concert, there is some more percussion that comes in.
जिनकी हिंदी थोड़ी तंग है, आप उसको उनके लिए बताइए आलाप का मतलब क्या है?
आलाप
हमें तो पता है, पर आप बताइए.
मुझे खुद भी इंग्लिश में मैं आलाप नहीं समझा सकता because it's a Hindustani music concept. I don't think the foreigners have got into the greatness of an alap.
Well, let's just hope the market picks up from that alap and moves to a nice crescendo, so to use a English word when it comes to the music world. But yeah, by the way, I think it was JP Morgan upgrade on a lot of EMS stocks, electronics manufacturers. Syrma is up about 3.5%. Dixon & Keynes also on lackluster morning, managing about 1-2%. So this space is a little buzzing and active today.
Absolutely. We got 1,400 stocks higher, 800 stocks which are lower at this point in time. Vari Energy. I think it was up yesterday as well on decent-sized volumes yesterday. Actually, volumes did pick up on Vari yesterday. So Monday it closed at 2,900, yesterday at 3,100, and it's up a little bit, 1.5%. But it's the largest, the number one volume traded gainer on the NSE. So that's the reason I'm mentioning it. And of course, a name like JP Power, I'm not sure what's happening here, penny name. But JP Power was up 20% on Monday. Yesterday, it didn't go anywhere. It's starting 2% higher. That is Jayaprakash Power, JP Power. Number 2, volume-led gainer on the NSE. So that's the other one. I think Mangalam already mentioned Syrma, etc. Syrma is up 3%. A name like Religare is coming up, 4% higher on Religare. Again, the Burmans are in and they're in the driver's seat. In Religare, but stock has not really done very much. I've heard from many the downside is limited, but the upsides have been hard to find here for a while. Maybe it'll come, but that's Religare for you. Lal Path Labs is up 2.5%. SW Solar is up about 2.5%. So it's low. It's low in terms of the price action and volumes right out of the gates, at least as you look at things at this point in time. All right, well, let's talk about the markets in some more detail. Karthik Kumar is fund manager at Axis Mutual Fund. He's with us. Karthik, great to have you with us here in the program. Good morning. Thank you for your time. How are things set up, Karthik? Just in terms of the price action, momentum, or the lack of it for the last few days now. What have you been doing and your thoughts on the market structure itself?
Okay. So actually, if you look at it over the last 6 months, essentially the markets have done fairly well considering that we've had geopolitical tensions and economic tensions because of tariffs. And in that context, what we saw was market taking umbrage under value as a style, and value did quite well over the last 6 months, whereas traditional momentum growth, these styles kind of took a backseat. However, over the last 2 months, what we've seen is a much more risk-embracing style where high volatility, high beta stocks have done well. Momentum has been the better performer over the last couple of months. And we've also seen that in terms of cap space, where while over the 6 months, small caps and mid caps have lagged, over the last 2 months, we've seen sort of a comeback by small caps and mid caps compared to large caps. So I think there has been a bit more risk appetite that we've seen over the last couple of months. And that was because of certain policy certainty. That was because of a pro-growth stance both by the central government and by the Reserve Bank in terms of taking proactive steps. And all those things, I think, kind of helped the risk appetite over the last couple of months.
Okay. All right. Got that. Thanks for joining in, Karthik. Good to have you on. So investors are really wondering what next, because now we're within striking distance of the all-time highs. And, one is looking for further ammunition. So which are the sectors where you think growth could come through? Because there is no better fuel for a bull market than actual earnings growth. What are you most optimistic on?
So I think the growth sentiment across industries and across sectors should improve going forward for a couple of reasons. First, in terms of we've got a favorable base where last year was elections, so the activity was on the muted side. Plus, we've got actions by RBI that essentially have ensured that interest rates are lower, liquidity is higher, plus the tax relief that kind of kicks in. That's from a macroeconomic standpoint. And also, if you look at it purely from an earnings standpoint, we front-loaded a lot of the earnings cuts for FY26 over the last 3 months. And which is why I think going forward, and the extent of earnings cuts have been intensity of earning cuts have been quite significant over the last 3 months. And I don't expect that to persist. So I expect earnings environment to progressively improve over the subsequent quarters, and which I think will prompt the market to kind of look at good return opportunities in the near term.
All right. Where do you stand on the entire consumption, space conversation here, Karthik? Are you betting the discretionaries which are likely to outperform when the stocks are highly valued, or are you looking at some recovery in the staples where the stocks have seen a lot of time correction and maybe things are improving for the better? Where do you stand on that?
So we still like specific themes within consumer discretionary, especially with related to hospitality, travel, tourism. But in terms of traditional FMCG, we are yet to see an uptick in the underlying data. The earnings previews that have come in so far kind of reiterate that point, where we've still not seen an uptick both in the rural and the urban side. Commentary is getting better depending on which company you're speaking to, but largely we are yet to see it in terms of earnings upgrades as well. So for now, we'll still stick to our conventional themes, but at some point, the traditional consumers will also become attractive once we see an uptick in earnings estimates.
Yeah, no, absolutely. Makes sense. We were just having this discussion with Digant earlier and he said, well, NBFCs is one area which is perhaps a space in financials which offers opportunity. I mean, would you kind of agree with that, Karthik? I mean, and what kind of positions do you have? What segments really, broadly?
We are positive on financials, partly because of the fact that we are still seeing a mid-cycle kind of valuations there, and the fundamentals for the sector are turning positive for the reasons I already elaborated on. And within financials, we like both the private banking space, and we like NBFCs. We like both categories, so we have a reasonable exposure across that spectrum.
Okay. Karthik, on the manufacturing side, manufacturing, Make in India, because there's such huge shift going on, right, between the whole realignment of global supply chains as well. Specifically, are there any verticals that you would be optimistic on?
We remain, while the whole policy action in the West and the ramifications still need to be watched out, but we need to watch out for. But in the near term, we remain positive on power, T&D. Those are the areas that we are kind of bullish on.
Okay, power and
space.
Power and T&D. Okay, utilities. Part of that category?
Somewhat, but more T&D place, I would say.
And valuations are comfortable?
Valuations are reasonable. I would say we all know our market itself valuation is at the higher end of the spectrum. So, which is why I would argue over the next 3-4 months till we see an uptick in earnings, the market is likely to be range bound. So I think that applies across sectors as well, largely.
In the auto space, is there something that you like? Are you looking to play this? Because, the per capita auto is still the lowest in the country from a macro standpoint. But a micro standpoint, the largest player has been losing market share because SUVs and, bigger cars are seeing more sales than entry-level cars. Then you have the two-wheelers. Then there are the auto ancillaries. Then there is the one which is exposed to global markets. So there is uncertainty there. How do you play this?
So with Autos, we've kind of trimmed our exposure through time. We have selective exposure to autos through some that have exposure to the segments that you talked about, which are largely the beneficiaries within the four-wheeler space. So we do have selective exposures both in the four-wheeler and two-wheeler space within autos. But overall, we've trimmed our exposure through time because if you look at the sales trends, if you look at earnings trends, expectation trends, all have moderated, and valuations have kind of are full as well. So we've kind of trimmed that exposure and are more selective about it in that space.
Okay. All right, Karthik, good conversation this morning. Thank you very much for joining in and giving us your perspective on the market. The market's actually okay, 40 points lower on the Nifty, but one stock is definitely catching my eye at least, and that's BSE. BSE has made a sharp move from its very flat opening. So now the stock's about 60 rupees higher. And it seems to be trying to recover some of its loss yesterday. It was down very sharply yesterday as well. Well, speaking of BSE, let's talk about what lies ahead for whether it's exchanges, whether it's market participants, and of course investors themselves. We're talking about all the ongoings in the futures and options market. Retail investors in India lost over 1 lakh crore rupees in the derivatives market in FY25, and about 91% of these individual traders lost money in F&O. This is according to, of course, the latest study released by market regulator SEBI. Let's discuss this and the way forward with Gaurav Seth, Managing Director and CEO at 5 Paisa Capital, and Ashish Rathi, Whole-Time Director at HDFC Securities. Ashish and Gaurav, thank you very much for joining in. There's just so much going on in the futures and options market. The last 1 year, we've seen the regulator tighten a lot of the screws. We've had the whole drama play out in terms of expiries, now reducing the products to one per exchange. And this morning, there are reports suggesting, I think the Mint put out a report, that maybe they'll look at, instead of a weekly expiry, now a fortnightly expiry, if they're not satisfied with the reduction in just the sheer amount of speculation. Your thoughts on, first of all, whether the F&O market needs further tightening? Ashish, let's open with you.
So in terms of tightening, you will see a lot of measures have been taken already by SEBI. I think so there's an October 1 circular wherein 5-6 measures have been taken, which came into effect mostly in the last quarter of last year. But yes, in terms of tightening, so the major concern is on the retail side. So one kind of tightening which we can look at is a product suitability test. Depending on the risk appetite of the customer, maybe he is allowed to take positions in derivatives. I think so that is where we will reach a situation wherein, okay, you have the risk appetite, then you are allowed to take that risk and you understand the risk better. I think so that would be a good thing that which SEBI can look upon it. In terms of structural measures, a lot of things have already gone about, making from 5 expiries to 2 expiries, then increasing the margining, upfront collection of option premium, plus all these market-wide limits. A lot of measures are already in place or still in the process of implementation. So we can wait and see for some which are still in the process of implementation, what is the impact. But yes, in terms of retail investors, product suitability test is something which SEBI can look at introducing.
Ashish, this is a very interesting, just Ashish, allow me to come in over here. This is an interesting concept you're bringing in. Yeah. I don't know, does it exist in any other major market worldwide? And then the onus will be on whom? Maybe SEBI can design a test. How do you design it? How do you decide if, F&O trading is suited for me or not? And maybe it is for Prashant, maybe not for me. Anyway, we don't trade. I mean, that's aside because of our regulations, internal regulations. None of us actually trade in the market. But how do you decide it? Will the onus be on the broker? Can it really be a feasible solution?
Yes, it can be a feasible solution. So you take the inputs from the customer, depending on your net worth and everything. Then you take the risk suitability. Okay, so how much is the risk you can bear? Basis your risk appetite, you may be quantified as a high risk. You are ready to take high risk with. And basis that, and depending on your net worth and everything, you will be allowed exposure in derivatives. So that can be worked out. Maybe in stages, at an initial stage at a lesser level, at a later stage, maybe at a higher level. So these things can actually, then what happens is the customer himself is declaring, yes, I'm ready to take riskier bets. And then even if he make losses, I mean, the understanding is that he has understood it much better.
All right. That's an interesting point that you're bringing to the table. Let's see whether that gets implemented or not. But let's, bring in Gaurav in the conversation as well and to see how things have changed. Gaurav, there was a serious amount of trading and speculation in F&O that was taking place. And a large part of that, whether it gets attributed to, the underlying equity cult or not, definitely gets attributed to the surge in discount brokers and access to market by itself. Could you give us a sense of what proportion of your volumes right now, traded volumes on 5 paisa, come in from F&O? How has that number changed over the last few months ever since tightening has come in from the regulators? And once there is a higher tightening, which is on the cards right now, as discussed by a lot of people, will that impact your business a lot more with options traders looking to come down from here on?
So look, I think I just go back to your earlier question. I think this is definitely a wake-up call, but also in terms of I see this study coming from SEBI, which was published recently as a follow-up to what was done last year, right? A lot of the tightening and a lot of the structural reforms that the regulator wanted to put in place were already put in place, and of course that did have an impact not just on us, but across the industry, and which is a fact to see, right? So the volumes were impacted temporarily. So if you look at volumes compared to last year, we are lower, and a lot of our peers are lower. But if you look at it from the last 2 years perspective, it's actually higher. So while I think discount broking and platforms like us have played a great role in bringing access to the market, I think what needs to be spelled out here is that whether it is F&O or whether it is any other kind of product, right? I think the mandate of actually figuring out whether this is right for me or not, which I think even Ashish was talking about earlier, instead of pushing it to the brokers, it should also be in terms of how am I educating the customers? What is it that we are doing as platformers, as brokers, to upskill some of the people who are coming into the market, so they can figure out for themselves. So in any case, after last year, so the moment you log into a platform, every single time, you have an acknowledgement that is done by retail investors, any investors, right? Those 6-7 points, which are whether F&O 9 out of 10 people lose money and so on and so forth, right? I don't know how much impact does have on people, right? I think over a period of time, it is for you to self-realize that, right, is this working for you? What is the level of skill you have? What do you need to do, etc. And I think we as brokers and as platforms have to play a major role in that.
Well put. Gaurav and Ashish, morning. Prashant here. One thing is clear, and then of course, all of this, we're talking in the backdrop of that Jain saga, right? Which has happened. And it's kind of still, in a way, amazes me that many are still talking about whether, this was, of course, I mean, it'll have to be proved in court. But the simple point that, a normal player in the market would try to buy or sell with minimum impact in the price, right? But with the business model itself is to impact the price. I mean, I think that is where that SEBI order sort of comes in from. Let's just, Gaurav, talk about what else can happen. There are reports this morning, for example, that this is not one and done in that sense. On the option side, the regulator wants to, and we have that report also, which shows how many people have lost money. So there is perhaps more action coming in that sense. One proposal perhaps is the regulator may revise the weekly contract expiry schedule. So from the current weekly, they may go to fortnightly. Gaurav, any thoughts on this?
Well, I would not like to comment on what the regulator is thinking. I think they probably know better than us, and in terms of like what are some of the decisions they want to take for overall market stability. However, I would like to make a point is that again, it really boils down to people figuring out for themselves, where they are in the spectrum, right? If you look at, and I actually, to be honest, I have not read every single page of the report, but I was glancing through it and went through this 33-page report. Where there is a statistic which shows certain correlation to how much money you are making based on what your income level is, right? As an example, in declared income now on paper, and what that shows is, while you can't say that people with high income are necessarily better traders or people with low income are necessarily inferior traders, but the fact is how much thought you are putting into what you are doing. And actually be clear about where you are in the spectrum, what you need to do to become a profitable trader, and so on and so forth. I think once that culture comes in, where people sort of self-analyze over, I mean, there is enough data out there. There's no dearth of data. Like anyone interested in figuring out.
No, Gaurav, you've done this a long time as well. This is, if reports, I mean, and this is, I'm not saying this is not necessary, absolutely necessary, but it's at the end of the day, it's an addiction. I can put it bluntly. You lose money, you make money, you can't step away. And I think we all kind of recognize that. So that is the reason why I'm saying, I mean, as some of the news reports suggest, they perhaps may look at additional measures. Awareness, self-realization, etc., as both of you said, is one thing.
That we need to have for a lot of things
in
life.
For a lot of things in life.
But we may not.
But it doesn't happen.
So you need regulation.
So, Gaurav, again, my point is, you said, yes, it is for them to decide, but you think, the cost-benefit in that sense. Some would say, what about liquidity in markets, depth of markets? Others would say, perhaps, this is more important. So that's what my question was, Gaurav. Gaurav?
Yes, sorry, could you repeat?
No, my question was with regards to going from weekly to fortnightly, the argument, the cost benefit in that sense. How do you look at that? If this were to happen, of course, the regulator knows best, as you began by saying, but what is your view?
So my view is that obviously it may have some impact on the volumes in the short run. But as we've seen, if the data is anything to go by for the last 1 year, volumes start to return to normal in the course of time. I mean, if you're asking me a specific point, what my personal opinion is, whether it is going to be weekly to fortnightly, yes, it could have an impact. Definitely, it could have an impact on the volumes in this segment.
Sure. And, gentlemen, what we've been discussing is so far the regulator taking all of these tightening measures to curb what it feels is perhaps excessive speculation leading to retail losses. And that is a separate debate. I mean, whether the regulator should have a moral view on this or not. But what my next question is that post the Jane Street episode, does this get another layer altogether? I mean, would we perhaps see tighter regulation or a change in some F&O frameworks to avoid what the regulator feels was market manipulation and abuse? And would you say, and I mean, I know this is going to play out over the next couple of days, but to say that Jane profited off retail traders and investors, would you completely agree with that? Because that adds a whole new layer of why we need tighter regulation, if that were to hold true in the courts of law. So quick thoughts on this from both of you. Ashish?
So in terms of, probably the episode in hand of Jane Street, they had accessibility to, maybe you can say, sophisticated instruments with which they did trading. Okay. So right now, if you look at whatever algo framework they could do, it's in the form of HFT. They had sophisticated instrument. And whereas retail currently, as things stand by, obviously effective August 1, they will have accessibility to algo trading and everything. However, that created some kind of an advantage to them. Plus, obviously, their appetite to have large money. Now, that is a structural advantage that they have and they will continue to have. Let's understand that. But however, in terms of regulatory measures, definitely the view is that we may see some measures in terms of some of the sophisticated traders benefiting out of retail investors. That's the understanding which everyone is getting. So we may see some measures. Now, whether these measures are structural measures in terms of making the changes to expiry, reducing the number of expiries, all things, or whether it comes by way of what I said is product suitability test at the retail investor. That needs to be seen. But yes, definitely what I think so after this episode, there could be some structural changes in the derivative. But as Gaurav rightly pointed out, so whatever structural changes are there, in the short term, you may see a blip in volume, but in the long run, again, that it comes down to the same level. See, finally, it is up to people to decide, retailers, while they make losses, but as long as they know the risk about it, then it should be okay.
True. So just very quickly, Gaurav, same question to you. Because of the Jane episode, would you expect any more new stringent measures? And if yes, what kind?
Look, I don't want to speculate here, but I think just logically thinking, you could potentially expect some measures. What they would be, I mean, I'm in no position to comment. But again, I mean, if you look at the data, especially if you're looking at the report, like a lot of, I mean, it is very clear that a lot of the FPIs, the more sophisticated traders on the other side, as a proportion, made higher percentage of profits versus compared to a normal retail trader, right? So again, comes back to the same questions: your level of sophistication, your level of skill, and so on and so forth. So if you have to be in this market for a longer time, what is it that the retail traders do? And especially being a retail platform, I think that's the lens that at least we bring to the table in terms of thinking that, like, how do we do what is necessary for our customers. But what the regulator will do, we will see in the next couple of days or next couple of weeks.
All right, gentlemen, thank you so much for joining in and giving us this view. Obviously, it's at the end of the day up to those who are participating in this to know what their risk appetite is out here. In that, I would, believe that players like you would also, be responsible in informing the clients about what their risk appetite is and the product that you're offering, the risk nature of that product, along with what the regulators are doing to curb this speculation and ensure that everyone participates in this in a fairly equitable and knowledgeable manner, knowing very well what the underlying risk of what this offering is. Gaurav, Ashish, thank you so much for joining in. We'll invite you once again where we have more clarity on what the regulations are post this as well. Let's move on to another conversation then. We have Signature Global on our radar. The company has reported a steady first quarter business update. Sales and volume have declined year on year, but risen sequentially, while realizations have improved by about 33%. Let's discuss the business momentum and growth outlook. Rajat Kathuria, who is the CEO, joins in now. Quarter on quarter, there's been a big jump, 63% to be precise, but year on year, it's down 15%. Even the area which has been sold is lower, both year on year as well as quarter on quarter. You did have some sales from premium projects. This decline year on year, is it largely because of base effect? Or do you think that there is something underlying which has shifted a little bit in the real estate space?
No, you're right with the former understanding that it's largely because of the base effect. So last year, while we achieved about 10,300 crores of sales, the first quarter was the best quarter in terms of pre-sales for us, where we did about 3,100 odd crores. So we were competing against, the best performing quarter of the previous year. But in general, I think we had a fairly steady show. The last 3 months, we recently, just in the month of June, launched our first, new project for the year by the name of Cloverdale. This is in Sector 71, Gurugram, which is on the southern peripheral road and one of the key micro markets for us. And within a span of less than a month, we've seen a fairly robust sort of response to it. And we are, quite happy, and it's a good validation that these new launches are seeing a good uptake in the market. So from our perspective, it's a good sort of quarter where we've achieved more than 20% of the annual target.
Last year, the entire year was front-loaded with a lot of sales in the first quarter, like you pointed out. This year, you expected to be more back-ended because you've given us a target of 12,500 crores for the year. And the first quarter, you've done just about 2,500 crores. So the remainder of this year has to be, doing almost 3,300 crores per quarter for you to meet that guidance. So wanted to know whether that is happening. And secondly, on collections as well. While your sales have seen a decline, even the collections are lower by about 26%. You stand by your 6,000 crore collection targets for this year?
So on both the aspects, this year we have a sustained set of launches. So the best case scenario even for us is that there's not a lumpy quarter which we see during this year, and sales happen through the course of the balance 3 quarters. And that's our anticipation because there are quite a few planned launches. Like within this quarter, we are doing 1 or 2 large launches on the Dwarka Expressway micro market. As far as collections are concerned, this is in line with budgets. In terms of collections, we'll see a good spike towards end of Q2 and Q3 because some milestones of a few large projects are getting achieved around that time, and hence collections will not be as equally distributed through the year. But around Q3, we anticipate it to be a fairly good quarter in terms of collections. So the number is in line with budgets, business as usual, new projects seeing good uptake, new business development happening, and collections in line with budgets.
Are you sure about this being business as usual? And I ask this largely because from anecdotal evidence that we have and a lot of chatter that we get on social media, I'm not sure how credible that is, which is why the question to you speaks about affordability issues, especially in the region that you're operating in. A lot of them also speaking about something as direct as artificial inflation of prices and creating this sort of, mirage that these houses are selling off like hotcakes because they're selling it to agents, etc. Just wanted to understand what your assessment of the situation in NCR is right now. Are prices anywhere closer to bubble territory? Is underlying demand under pressure?
See, prices have spiked over the last 2 to 3 years, and that's why this conversation comes up very often, even on one-on-one basis. But if you really look at the prices over the span of last decade, you will not see them really spiking beyond a particular limit. Our per square foot realizations up just because we've launched a project which is at the most premium location of ours, and that's why you've seen a spike. Over the course of the year, this number per square foot realization is about to go down. So I don't think on an average prices are going up beyond 7 to 8% in any of these micro markets. So, this per square foot realization will come down. Now, with the kind of land prices and with the kind of commodity prices and the kind of product being offered, I don't think, price of, let's say, 13 to 14,000 rupees per square foot basis is something which is, obscenely priced or absolutely unaffordable. I think any given market across the country, these are the baseline sort of numbers which exist as of today.
Okay. Rajat, let's also talk about your overall expansion that you're doing. And what that will mean for the balance sheet, because in the past you've told us that you plan on becoming net debt free by FY27. So just run us through, the cash flow position, how you'll be reducing this debt as you go ahead with the expansions.
So see, the net debt position is still almost static. We are at less than 900 odd crores, about 880 odd crores of net debt, 890 crores of net debt exists on the books at the end of this quarter. So that number per se doesn't seem very high to us. And in general, we are not like, we were never rather very highly leveraged. I would say that, as collections pick up, it's in normal course, this net debt number will come down. So there is nothing additional or very special effort which needs to be, made in terms of reducing this net debt. I would also like to add on that most of the land position which we have, in all of these key micro markets, which is, let's say, between recently launched and yet to be launched projects in close vicinity of 40 million square foot and, upwards of 55 or 1,000 crores of, GDP value. This land is mostly owned by the company, with less than 5% belonging to, the landowners with whom we may have done collaboration shares. And it is paid for. So see, there is no, sort of hidden or, liability which is there. So there is net debt, which is 890 crores. There is nothing particularly due on the land side. So the land ownership belongs to us, so as this converts into sales and collections, it's all going to trickle down to cash for the company. And hence we feel very comfortable not just bringing down net debt, but even the gross debt number, significantly over the coming 2 to 3 years.
All right. Nuama says that you'll be net debt free by FY27, so wonder whether that's doable or not. But, on the launch pipeline itself, you said that it is sustainable, you have this timeline. Could you give us a sense on a quarterly basis, what exactly does this mean in terms of GDV being launched in this year, and what do you have in the pipeline for the next one?
So see, for the year, we've taken a target of about 17,000 crores of launches. In the first quarter, we've launched about 1.7 million, which is close to 3,500 odd crores. Again, reiterating that, let's say the launch we've done, the land is fully owned by us. And hence, it's not just a sale, which is getting created. It's going to create cash, net cash for the company. Likewise, in the coming quarter, there is almost close to, you could say, between 3.5 and 4 million square foot getting launched. So again, Q2 is a big quarter in terms of launches, and likewise, Q3 and Q4 also will see more launches. So this balance, 13 to 14,000 crores of launches, we are comfortable because we are at very advanced stages of approvals across these projects, and hence we don't see any possible slippage in terms of the launch pipeline.
Okay. All right. By the way, guys, 10 days back, the PM Awas Yojana, which was meant to boost affordable housing, completed 10 years. This is 25th of June. Of course, the contrast can't be starker.
Yes.
Luxury has done phenomenally well. Affordable Nothing at all. I mean, actually, lenders have told us that there is not enough supply to fund on the affordable side. And I think Signature has told us that earlier as well. Thank you very much for joining us as always. Appreciate you coming on and thanks indeed. We'll take a quick commercial break here. We're going to come back with Biswajit Dhar of Center for WTO Studies and Anup Vadhavan, a former Commerce Secretary. We're going to talk about the Trump tariff letters, the possibility of India-US trade deal. You know, we're at the deadline, so will we hear something tonight? That's the big expectation. Stay tuned. Welcome back. The market, of course, is doing what it is doing, which is not very much, about 1/3% lower on the Nifty Bank for now. But this is a CNBC-TV18 exclusive. GAIL pipeline tariffs may see an increase of near 20%. Sudarshan is here with details on this. So take it away.
So what we understand through sources that GAIL pipeline tariff, which is expected to come in a month or two, and that tariff revision for its pipeline, there are 10 pipelines for which tariff can be revised higher by 20%. So currently tariff for GAIL pipeline stands at rupees 58.59 per MMBTU, and that can be increased to rupees 70 per MMBTU or higher than that. So if you calculate from 58.59, that increase comes to around 20%. Now, why this is positive for GAIL? Because most of the brokerages in their estimates have factored in the range of 10 to 15%. For an example, Investec is saying it's hoping for a 20% increase, but conservatively, it has modeled a 10% hike in FY26. Jeffrey says it expects 10% increase in GAIL tariff, and if there is a 10% increase in GAIL's tariff, fair value for GAIL as per Jeffries comes around rupees 235, and if there is an increase by 20% in its tariff, then fair value comes around rupees 250. And GAIL management had earlier spoken to CNBC-TV18. It had said that it had submitted for increase to around rupees 78. But if PNGRB, that is the oil and gas regulator, approves an increase of up to rupees 70 or to 71, that will be taken positively. Yesterday, PNGRB member A.K. Tiwari had spoken to CNBC-TV18. Let's listen to what exactly he had to say on the tariff.
I'd like to say one thing, that system use gas is one of the important component, important OPEX for them, for which we have already brought the regulation here. How to reduce the cost of system use gas, wherein we have given that they have to plan 75% of their estimated quantity which they are going to consume. They have to plan domestically or international market long-term basis for 3 years, they have to allocate the whatever the least cost is there in their kitty for the system use gas, so that the cost will be reduced. So all these factors are being analyzed, and we are going to take view on that, and we are going to conclude the tariff order very soon.
Okay, well, that's, the gas story. GAIL, positive for GAIL, because as Sud pointed out, expectations were 10-15%. We're talking about 20%, nearly 20%. Stocks, for now, right there at down about 2% or so. Let's talk about tariffs now. And the big question is, with the deadline here, will actually we see that mini deal between India and the US, perhaps tonight. Biswajit Dhar, professor and head of the Center for WTO Studies, is with us, and so is Anup Vadhavan, former Commerce Secretary, who's with us. Gentlemen, great to have both of you here. Thank you very much for joining us. Mr. Vadhavan, chitti milegi ki deal milegi is the question, if I can put it in. But what's your sense, sir? Where are we at?
That's a million dollar question.
Yeah.
So certainly, it seems from the reports one has been seeing in the press that some agreement has been worked out at the official level. It's lying on the president's table, so to say. And the reactions which have come since then seem positive. There is continued talk from the US president that a deal with India is forthcoming. So that's a good sign. And maybe there is some adjustment in that agreement that would be required, which might be worked out at the official level. So my sort of sense from whatever information is in the public domain is that things look positive, and broadly around the agreement that has been worked out at the official level, some, final initial agreement, it's called an early harvest, will be worked out. So I'm quite, positive based on what one has seen. Although, there's certain concerns, even where the US has entered into agreements, whether it's UK or China, now Vietnam, those are, not very balanced. And the US interests, of course, have been taken care of, but it is debatable whether UK got what it wanted out of it or Vietnam has got what it wanted out of it. So I think it will be important to see the content of the deal. But what I understand is that Indian sensitivities on agriculture, dairy have been addressed, but then our ambitions should have been adequately addressed also. We have certain ambitions in labor-intensive products and things like that.
And we'll see.
At the end of the deal, we'll still be facing duties on steel and aluminium, which are across the board and now amounting to 50%. Of course, I think for the UK, they have been taken off. It will be interesting to see as to what India gets out of it. Our labor-intensive interests and
we will certainly, absolutely. And the other question is, what does this deal, in a way, not just with what we will see, but I mean other deals, as you pointed out as well, right? The China deal, for example, there was that handshake over that weekend, but then after that, nothing, silence. Same thing with Vietnam. I mean, trade deals are not two-page documents, right? Which you announce and then that's it. So we'll have to see. But yesterday, for example, Japan, for example, got a letter. Their tariffs were bumped up from 24% to 25%, and I think both the US and Japanese representatives are on record to say that they're going to be intensifying their talks into that 1st of August deadline. So that is the other thing. Even if you get, are given an offer, this is still time for negotiations in that sense. Mr. Dhar, your first thoughts, sir? What is likely?
No, I also think that, there could be some kind of early harvest. And, there are a lot of low-hanging fruits that can be plucked at this point. I would say that, as long as India's sensitivities, and Mr. Vadhavan was mentioning about some of these sensitivities, these are taken care of, then I think it will be possible for us to move forward. But then there is, yesterday's announcements that President Trump is going to impose 200% tariffs on pharmaceuticals. Now that's a problem area because our pharma industry has a large footprint in the U.S. market. The generic industry has a large footprint, and that could get affected. So I think this copper and aluminum, copper and pharma tariffs, which have been sort of the speculations are that they are going to be imposed. These would be a kind of a kind of a dampener. But I still think that there can be some possibility of an early harvest, some low-hanging fruits, as long as agriculture, dairy can be left out of the deal. It's possible to sort of do something right away.
Yeah, absolutely. But the thing is that, I mean, that pharma tariff that he's speaking of, 200%, I mean, it's a year down the line, and let's see, too much changes here within 24 hours. So 365 days is a very long period. Let's see what actually eventually comes out of it. But gentlemen, I just wanted to get your thoughts on, what we could be realistically looking at in terms of this mini deal or this interim deal, if it were to come through. So Mr. Vadhavan, so, what could be India's best case? That the prevailing 10% tariffs continue? And that would not have seemed so bad if it was not for this new BRICS threat. Now he's saying 10% additional tariff on BRICS. So that could mean, I mean, speaking today, so we are around 10% tariff, so 10 plus 10, 20 straight away. What India was originally handed out on 2nd April was 26%. So yeah. What would be your best guesstimate in terms of what could be a realistic interim near-term mini deal, so to speak?
Yes, it seems that 10% is going to be the new default kind of MFN tariff which everyone will face. So I suppose if that becomes the case, then India will face 10% on most items, and things which are included in the deal. Hopefully, they'll be at a lower rate. So it's all very confusing. And, as was just mentioned, these letters also which are coming, they're open for negotiation because they are not going into effect immediately. There's a 1 month, kind of deadline, 1st August. So scope for negotiation remains. And the other thing we need to see is that the US cannot, sustain as an economy such high tariff barriers. It'll elevate costs in the US economy, it'll undermine US industry, it'll undermine the competitiveness of US businesses. So the end game cannot be that there is 10% duty on every product at a default level. So I'm a bit confused as to where this is going. It is certainly this 25% and 40% which is being imposed certainly is not the end game, because there is a notice period and it's open for negotiation, and it will be, even the other day when there was some of these duties were announced, the stock market didn't take it well. So the end game is not going to be 10% across the board. So I think somewhat confused manner and somewhat random, ununderstandable ad hoc manner, it will go ultimately to a outcome where duty levels have to be sustainable and reasonable for the US economy to function efficiently and competitively. So let's see. It's open for conjecture as to this mini deal. Are we going to get zero tariffs on the labor-intensive products? As is the normal practice in a trade deal. Trade deal is always 0 for 0. It is not 20 for 0 that you impose 20 and I give you 0. So let's see what it throws up. But the way it is going at this interim stage, I won't be surprised if there are some elements like that in our initial agreement also. But then it's all conjecture. One can't make a very reasonable guess as to what it is going to be like. But ultimately, it is in India's interest that we do get 0 for 0 on all the items which are included in the deal. And of course, some areas are sensitive to the extent India allows little bit of access on agriculture, then that has to be with protections. It can't be zero duty. There has to be some tariff rate quota. So safeguards like that. So I won't really conjecture, but all these possibilities, seem open. Let's see what happens, when it's announced.
I hope both of you will join us, later today if we do hear something in terms of the actual stuff, and then we won't have to, do so much in terms of conjecture, but we'll have the details then, hopefully. Thank you very much, Mr. Vadavan, Mr. Dhar, for joining us. Great conversation as always, and some perspective for our viewers. We take a break. Manisha is with us on the other side. Commodities in focus. Okay, welcome back. The market's not really doing very much, and you've got 4-point change. That's it, 25,530. Let's shift focus to what's happening on the commodities side. And there were some moves. Oil's at 70. There was that big move as far as copper is concerned. Manisha standing by with what is top of her mind. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm absolutely looking at copper because overnight markets, that was one thing that was buzzing, and how. The U.S. copper futures settled nearly 10% on the higher side in the overnight markets. But there was at one point when that cabinet meeting was still on and the U.S. president was still talking, that you saw the copper prices run up by almost 17% to hit an all-time high at around $5.9 per pound. This comes in after the U.S. president has said that he's proposing 50% on copper. This is being aligned with existing 50% on steel and aluminum as well at this point in time. Well, the U.S. had launched probe on copper imports in the month of February, and the reports do suggest that the final decision on this is expected by the month of November. But whether or not an announcement can be done before is something that the street really seems to be guesstimating at this point in time. Apart from that, it also has to do with the U.S. importing nearly 50% of its copper requirements. Much of that comes in from Canada, from Mexico, and major part of that comes in from Chile as well. And there are supply concerns for many of these countries at this point in time. If you look at the import numbers, well, higher imports are expected in the U.S. ahead of the tariff implementation. As of now, this is an announcement of a proposal. The implementation date is yet to be decided, but before that, you will see a lot of copper being imported into U.S. The U.S. to LME premium currently stands at a record $250 a ton. So that's a very high number onto that side there. Also, when you look at the overall markets, we have seen those gain up as well. And that arbitrage or disparity is quite clear to see. The US copper prices in the first half of this year gained up by 26%, while the LME copper prices gained up by 12%. So we are looking at US copper prices trading at a strong premium than what the copper seems to be doing in other two exchanges globally, that is in London and in Shanghai as well. Apart from this as well, there is various supportive factors. A very, very bullish report coming in from Goldman Sachs says that China in 2025 will see copper demand rise up by 6%. A PwC report says that 32% of global semiconductors production could face issues by 2035 with the kind of supply concerns and disruptions that we are seeing in case of copper. Also, there have been reports of roadblocks by informal miners in Peru due to the transportation there. There also is disruption at Panama mines, Congo. Chile drought concerns also have led to lower mining and lower grade mining there in sense of copper. That has been supportive. And when you look at the LME stocks as well in sense of copper, they have continued to decline in this year, down by 64% from mid-Feb. So at this point in time, it is a very, very bullish copper prices continuing into the Indian Asian markets right now. Much would depend upon on what is the follow-up announcement, proposal on sense of tariffs in copper, and that could take the prices higher.
All right. Thank you very much, Manisha, for that. Well, copper is the story, the big story, really, in that sense. We'll take a quick commercial break here. On the other side, it's our special segment. It's the economy. Latha in conversation with Suresh Ganpati of Macquarie Capital on what to expect from a bank and NBFC results in the first quarter. Stay tuned.
Welcome to It's the Economy. Bank loan growth as of mid-June, that is 2025, stood at a mere 9.6% versus 19.1% in the previous June of 2024. So clearly, the first quarter bank results are going to reflect lower advances growth, lower loan growth. Separately, the Reserve Bank's giant 100 basis point rate cut in April and in June is going to pull down the bank's margins because loans are linked to the repo rate, not the deposits. Given this backdrop, the market is going into the Q1 results with muted expectations. But who will stand out in the crowd? And is the current muted prices the right time to accumulate bank stocks and NBFC stocks? If yes, which stocks? For all these questions, I'm joined by the finance expert from Macquarie, Suresh Ganapathy, is Managing Director and Head of Financial Services Research in that company. Thank you very much, Suresh, for your time. Good morning. Well, like I said, the ecosystem is not very conducive for either loan growth or for margins. but who is likely to stand out of the crowd?
Look, it's going to be bad across the board. I mean, the ones which will stand out are going to be, in my opinion, non-banking financial companies because they are not affected much from a margin standpoint going into the quarter, right? But if you look at both PSUs and privates, both of them will end up showing a pretty weak earnings growth or performance because the margins will be down both YOY as well as QOQ. And loan growth will in general be weak, while PSUs may have a slightly better loan growth, but the system level itself being a 9.5% means you're really talking about quite a sluggish loan growth performance. What could happen clearly is PSU banks typically tend to have a slightly higher treasury profits. So in that sense, maybe the quarter is not as bad as one would expect because the treasury profits could save the day. But the beauty here, Lata, here is the markets are, in my view, going by the Nifty bank outperformance in the last 6 months over the overall broader market is overlooking the next 2 quarters because many believe this is just, and including us, this is just a timing impact. The margins will indeed recover over the course of next 12 months. Just the 2-quarter impact and then the margins start recovering post that because the deposit rate cuts have also been pretty aggressive by the banking system.
Okay. One more question before I come to specific banks. What is your sense about end-year credit growth? As you say, the margins may be a U. You know, you'll see it falling, perhaps down even for the second quarter and then start recovering. Perhaps even the exit number for FY26 is going to be as good as the exit number for FY25.
Correct.
But what about loan growth?
Yeah, so this is the area where we are, of course, a bit concerned because, we are at 9.5%. And if I were to really slice the dice and look at the various components of the loan growth, clearly, we believe the triggers are missing. The bulk of the loan book, obviously, is corporate book. And you have seen the amount of equity raising, the promoter sell down, and all kind of cash which has been raised by the corporates. And the corporates continue to deleverage. So that section of the credit growth is missing, or rather, it's not really contributing to the overall credit growth. And even things like unsecured loans, that the banks have already tightened the filters. Now, they're not going to relax the filters, right? So the filtering criteria will still remain quite stringent. So there would be some modest recovery. So at an overall level, let's put it this way, that we ended FY25 with a 10.5 to 11% kind of a credit growth. No major recovery from that levels. We may be around the same level at about 11%. So I'm not very convinced that the lower rates will spur credit growth. I mean, we have done our analysis in the last 15 years. The correlation between credit growth and interest rates in India is totally non-existent. In fact, it's all over the place, right? So I think there are more than interest rate triggers which is necessary from credit growth recovery standpoint, which is missing at this point in time. So overall credit growth in India is going to be a little bit more muted this FY26.
Okay. If that is the case, then we do have, a problem in terms of top line. But now let me come to the specific numbers. The number that completely stunned me was actually Kotak Bank.
Yeah.
The initial numbers giving 14%, both advances and 14.5% for deposits. So does it mean that we are going to get at least one big surprise in the earnings season?
Okay, so we will have to see how the margins play out. Because see, what's also happened in case of Kotak here is that the ban got lifted in January, right? January, Feb. I can't remember the exact date. So there is an effect of the fact that the full impact of the revocation of the ban could be slowly felt in the April to June quarter from a base effect standpoint. And they could have done better in some of the both retail as well as corporate loan categories. The fact that even the digital 811 banking was lifted means there could be more both secured and unsecured sales done through the digital banking. We don't know. We have to see the finer prints to see the segments which have contributed to this overall growth. So the balance sheet growth for few banks here and there could be better. As I said, at the end of the day, remember Kotak has the highest EBLR portfolio related to the other banks in the system. So their loans will also get repriced downwards a bit faster. So eventually we will have to see how the margins play out clearly. As you know, the margin impact is always going to be higher than the growth impacts. Even if you surprise positively, Lata, 100 or 200 basis points in the loan growth, if margin performance is not satisfactory, then the earnings could be under pressure. And that's something that everybody will be looking forward. I do believe currently going into the quarter, most bank analysts as well as the market has already factored in a 10 to 15 basis points QOQ margin compression across the board, including Kotak. If the actual margin compression turns out to be lower, it's a positive surprise. If it turns out to be higher, then it's going to be a negative surprise. That's how you should look at going into the quarter.
What's your best guess in terms of who will be least impacted by margin?
NBFCs.
Among the big banks?
NBFCs. Otherwise, everybody is down 10 to 15 basis points QOQ. I mean, we are just looking at marginal. Some will be at 15, some could be at 10, just the timing impact. Cumulatively, the next 2 quarters, you could see 20, 25 basis points. Yeah. Again, the timing could differ from bank to bank, but going into the quarter, 10 to 15 basis points across the board, including PSUs.
Yeah. Actually, even in Q4, I think HDFC sidestepped in terms of margin performance. They were better than the rest. Let me come to the mid-cap banks, because over there are a couple of banks which seem to stand out. One of them is Bank of Maharashtra. I don't know if you have coverage, but that always seems to, they had tax write-backs. They had a few things going for them. And they have reported decent numbers, 14% and 15% loan growth and deposit growth. Likewise, Karur Vysya, again, probably because of the gold factor, that's also been a standout performer. What's your pick of the mid-cap space?
See, amongst the mid-cap banks, the only bank that we cover is clearly a City Union Bank, and we are positive on the name. Valuations are attractive. The ROA is pretty decent at 1.4, 1.5%. And also in case of mid-cap banks, Lata, I think it really depends upon the loan portfolio composition. So, CUBK would be having a lower floating rate composition, and even within that, possibly a lower EBLR composition, because the retail proportion is lower, more it is SMEs, which are a little bit more, the growth is strong. There you can actually have a little bit amount of pricing power, and therefore you'll end up having a slightly better margin outcome. So we do like City Union Bank, but there could be differences between few banks here and there based on the composition of their overall portfolio, whether it is more EBLR linked or not.
Fair enough. See, you began by saying that NBFCs will stand out because they're less likely to be impacted. What's the pick of the pack there?
See, the interesting part in the case of NBFCs here is growth guidance. Now, the way we are looking at it is that there is a challenge with respect to the vehicle finance NBFCs in our view. The vehicle finance outlook isn't great. Most people are expecting passenger vehicle sales and truck sales to be around 1 to 2% this year. That's not a very encouraging number at all. So there could be disappointments on growth, right, across the board. Now, so we will have to closely observe what is the growth guidance for the rest of the year. Some are sitting at greater than 20% plus kind of a growth guidance. So I think, the quarter should be okay. Because the full impact of a real slowdown or a lower growth will be felt over the course of next few quarters. The quarter is good for them because the margin performance could be relatively better. So going into the quarter, I will be a little bit more cautious about vehicle finance NBFCs because I do believe from the credit cost angle, things could still be stubbornly high. There is stress in the vehicle finance segment, especially in the NBFC space. Where they could really do better is more in terms of margins. Again, there the housing finance companies, because of a very competitive housing loan book, which tends to reprice faster, they will have a greater degree of margin pressure. So selectively, if I were to slice dice, the two stocks which should stand out going into the quarter could be, in my opinion, AB Capital, Aditya Birla Capital, and to some extent Shriram. Shriram, most numbers should more or less remain flat on a QOQ basis, which is a decent outcome going into the quarter.
Yeah, it has been a good performance from Shriram after the merger. Suresh, what's the word on Indocent? What would you look for? Is the worst behind?
Yeah. So look, we did downgrade the stock to an underperform from outperform about a couple of days ago. And I think our view here is that irrespective of Lata, whoever joins as the new CEO, while there could be a pop-up in the stock price, stock could go up 5-10% on the day the new private sector CEO is announced. The challenges are quite multifold, right? And therefore, what happens in case of IIB here is, as per our analysis and projections, I don't think the stock even crosses the bank, a double-digit 10% ROE in 3 years' time, right? So our ROE projection for FY28, if I'm not wrong, is 10%. So when you have a bank which is earning return on equity as per our projections, as I said, irrespective of any CEO joining, below the cost of capital or equity at about 12-13%, why would you give it more than one-time price to book? And the stock is already trading at that, right? So clearly from a fundamental standpoint, we believe the upside in IIB is missing at this point in time.
Okay. It's always not enough time to interview you, Suresh. We will have to postpone the rest of the discussions for another day out of time on Bazaar. Thank you very much for sparing time for us. That's a great conversation. We have to wrap up on Bazaar. Chartbusters coming up.
The stock of BSE recovers from yesterday's slump, trades higher by around 3% as market regulator SEBI clarifies that no proposal to link option leverage limits to cash positions is currently under consideration.
Jefferies upgrades Varun Beverages to a buy rating and hikes its target price to 650 rupees, expecting a recovery in demand and margin going ahead.
JP Morgan initiates coverage on electronics manufacturers with an overweight rating on Keynes Tech with a target of 7,150, expecting a revenue CAGR of 46% till FY28.
Union Bank slumps following a weak first quarter business update, reflecting its weakest loan growth in the last 4 quarters. The stock now down by 5%.
B2B education platform Crizac makes a steady debut on Dalal Street, listing with gains of about 14% to its issue price. The management will join in shortly to discuss their post-listing strategy.
Good morning. You're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me today is Ekta Batra. No change for the frontline index. The Nifty absolutely flat, as is the Sensex. The broader market's doing a lot better, though. We have a lot of stocks advancing, 1,500 stocks in the green for about 1,000 stocks in the red. Has your portfolio feel a lot better today? And the nature of stocks which are doing well belong to the consumer staple space and some of the consumer discretionary names as well. The last 1 hour or so has belonged to the stock of Whirlpool, which has moved to the high point of this morning as we speak. Hi, Ekta.
Hi, Manglam. Well, yes, absolutely. We have also a couple of the frontline stocks which are doing better today. So Asian Paints is up around 1.6% at this point in time. HUL is seeing a good week. So HUL is up around 1.3%. At current reckoning, it's gained around 3.6% on a week-to-date basis. So good going for a couple of these FMCG counters. On the downside, HCLTech, LTI, Mindtree, all of these stocks are a bit under pressure. So it seems as though that's going to be, one of the key things to watch out for, considering that we do have TCS, which will be releasing numbers at the end of this week. But nonetheless, this is what's taking place for the markets right now. The mid-cap index just about consolidating, but yes, a little bit of green that you can see.
Interesting data that is coming in at the bottom of your screen as well, especially at a time where the market has been consolidating and is, looking to kind of move on from the global uncertainty that we're seeing. The data that has come in for the month of June from the mutual fund corner, the AMFI that is, overall assets under management at around 74 lakh crores. Large cap inflow has increased month on month. And we have some more data as well. Mid cap inflow also has increased by about 30%, 2,800 crores going all the way up to 3,700 crores. And we have net equity inflow, which too has seen an increase, perhaps on account of the large cap and the mid cap flows increasing, month on month. So total AUM doing well. Large cap seeing an increase, as have mid cap. So maybe the street continues its bullishness on the market, the investors. The one number that we'll be watching out for likely in the next 20 minutes or so, a little after that, would be the SIP number. Over the last few months, it has been hovering between 25 and 26,000 crore rupees every month. The last month was, again, at the higher end of that range, among the highest that we've seen. So we'll watch out for the SIP data that comes in as well. But for now, the fact that there has been an increase in the month of June after a decrease that we saw between April and May should make things a lot better. And also between April and May, there was a lot of global and local uncertainty. We had the Operation Sindoor, we had, all those things take place, the tariff-related issues, and then a bunch of wars globally as well. So that led to a bit of, the kind of inflows coming down month on month. But now, with the market having moved on from those issues as well, looks like the funds are just following that.
Yes, so just to sum it up, the net equity inflow is up 24% on a month-on-month basis. We have the small cap funds which have seen an increase of around 25% this time round. So that's also seeing quite an uptick. Large cap inflows, 1694 crores. It's up around over 35%. And even the mid caps have seen a good amount coming in at around 3754 crores. So overall, seems as though the momentum continues in terms of inflows. And yes, the SIP figure is something that we'll be waiting by for. It will be out probably in the next 30 odd minutes. We'll let's shift focus to our special segment where we will get you a few ideas for profit from Money Control Pro. Bharat Girenani of moneycontrol.com now joins in to talk about the stock that he's tracking very closely. Bharat, over to you.
Today's ideas of the Hindalco Jewellery Limited. Despite a sharp increase in the gold prices, the jewellery companies posted strong performance in Q1 FY26. The listed jewellery companies posted growth in the range of 18 to 30% in the quarter gone by. We expect Hindalco Jewellery to have witnessed strong growth in Q1 FY26 as well. Strong festive sales led to the healthy growth momentum for jewellery players. Another noticeable trend was consumer shift towards lightweight and low-carat jewellery. Hindalco Jewellery continues to rapidly expand its store network and aims to open 10 new stores in the current fiscal. The recent fundraise of about 510 crore would enable the company to undertake rapid store expansion. The company is tapping new urban areas as well as deepening presence in the rural areas. The company wants to increase its strong customer base. The margins which were under pressure last fiscal are expected to normalize in FY26. We expect the company's EBITDA margins to revert back to its historical range of 5.5 to 6% in the current fiscal. Hindalco Jewellery is amongst the few quality listed players in the jewellery space. At the current market price, the stock is trading at a PE of 26 times FY27 projected earnings. Investors with a long-term view can add the stock report.
All right, a new fund inflow coming in lower this time around versus the last month, perhaps on account of lower new fund offers itself. And we've seen some outflow from the liquidity funds as well, telling you that maybe more money is moving into equity versus liquidity funds for fixed income. Just keep an eye out on a couple of these stocks. Bajaj Finance from the broader markets has moved higher. In fact, from the frontline end, we have Bajaj Finance, which has moved to the high point of trade. Bajaj Finserv is spiking as well, and as is Axis Bank. Axis Bank has moved to the high point at this morning. Let's move on. Let's get you some insights coming in from the policy makers, business leaders, and economists shaping the world and India's future. This is CNBC TV18 Prime that we're talking about, which decodes global shifts and their impact on Indian businesses. Gives you unparalleled insights as well. You can tune into CNBC TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C, and Global Lens at 8:30 p.m. on weekdays and weeknights. Welcome back. Let's get a technical perspective on the market, even as we are consolidating in a very, very narrow range. Chandan Taparia of Motilal Oswal Financial Services joins in. Chandan, absolutely flat for the frontline index, trading in an average range of 180, 190 points over the last 1 month itself. Where does the frontline index go, according to you, after such a narrowly traded band? And individual stocks, what are you bullish or not so bullish on?
Mandam, thanks for having me. So the market has been consolidating the range, but the good part is that declines are being bought. The reason behind the narrow trading band is the VIX, which is quoting below 12 marks, which is at the multiple months low. So lower VIX clearly indicates that market will be narrow range, but overall undertone of the index is positive. So that's why we will continue to be with buy on decline stance. As of now, till Nifty holds about 25,200, we are expecting bullish stance to continue towards 26,000 marks. But for intraday point of view, one can keep the support near 25,400. So for swing as well as positional point of view, we are expecting index to head towards 25,650 to 26,000 marks. Looking at the Bank Nifty index, here we have seen buying interest and declines are being bought. However, the consolidation is clearly visible. Until it holds above 56,750, we are expecting Bank Nifty to head towards 57,750 to 58,000 marks. So positive view on both the indices. However, because of the lower VIX, momentum could be slow, but undertone could remain bullish in the market as of now. Now, talking about individual stocks, first it is buy on ICICI Pru. We have seen a formation of a cup and handle pattern, which is a bullish implication as per the technical setup. So we have seen momentum in the counter. In fact, the longs are being added. So expecting a positive stance in the counter, one can buy with support of 669 for an upside target towards 705 level. Second trading idea, that is buy on Cummins. Strong breakout has seen just 2 days back, and after that follow-up buying is clearly visible. Rollovers were better and stock is in momentum as delivery volume is also visible in the counter with some long additions. So one can buy Cummins with support of 34.50 for an upside target towards 36.50. One more trading idea that is from mid-cap basket, that is buy on ITC hotel. Selective hotels counters are doing well, and ITC has been making high top, high bottom with a fresh breakout on the daily and the weekly chart. We have seen surge in the trading volume, which also increased the positive stance in the counter. So with support of 222, we are expecting a rally towards 238 in the ITC hotel.
Okay, all right. Thanks very much, Chandan, for joining in and taking us through all of those calls on the technicals. Let's now get in Sandeep Bagla, who is the CEO at Trust Mutual Fund. He's joining in to discuss more about the data that has just come in. Sandeep, hi, welcome to the show. Well, it seems as though the equity markets are not having a problem. They've discarded all of the uncertainty at this point in time. The net equity inflows are up over close to around 25% on a year, 25% for this month gone by. Tell us more. Do you expect this kind of momentum to continue?
Yeah, I think, good morning. So I think that the flows are quite robust. And of course, flows are influenced by a number of factors. The immediate past performance of the equity market is a bit of an influencer. The liquidity conditions are also have some minor role to play in the short term. I think the number of NFOs which are hitting the market, they tend to galvanize the distributor community and mobilize large amount of money. As we talk now, I could see that there are at least 15 NFOs which are approaching the market in pretty soon, including our own fund, Trust MF Multi-Cap Fund. So I think this month is going to be very, very good in terms of retail mobilizations. I think the money is coming steadily through SIPs. The SIP number I can see has increased from 26.6 thousand crores last month, the previous month, to 27.2 thousand crores. So, the SIP flows are very robust, and the NFOs will help mobilize more funds into the equity markets this month.
All right. And what is your sense on how the SIPs will be this year? We don't have the number so far. It's 26,000 crores, 26,000 crores has been what the norm was over the last few months. But what was also interesting was the trend of SIP accounts closing. What is your sense of that number in this month, in the previous month?
The SIP gross inflows are coming in at 27.2 thousand crores, 27,000 crores odd. I think that is the number we need to focus on, because that number is going to come month after month going forward for the years to come, and is only going to increase. If somebody had started their SIP 10 years back and that's closing, that I think has no relevance. I think this is the number that we need to track. And I think this number will only increase because more and more investors are now realizing that they can meet their financial goals better by participating in the India growth story through the mutual fund route, which is simpler, clearer, consistently they can do that. And I think that this number will keep on growing. At the ground level, there are thousands of distributors who are working closely with investors, making sure that they launch, they register for new SIPs, and the older SIPs also continue. So I think this is a phenomenal story in India, which is underplayed, that the SIP story, which will ensure that a large amount of retail money is coming into the Indian markets consistently and for a very long period of time.
Okay. What's your sense in terms of the interest that we're seeing back in terms of mid caps as well as small caps this time round?
See, in fact, if you look at the next 2 years earning forecast, I was looking at the index levels. The mid cap earnings are slated to grow by about 15%, small cap by 13% for the next 2 years, while large cap is expected to grow only in the smaller single digits. So mid caps, if growth is considered, mid caps are not as overvalued as one thinks. So I think that by experience and by performance, it is getting reinstated in the consumer's mind and the investor's mind also. And people are investing in mid caps and small caps. And I think if the growth materializes, then these stocks will start looking cheap again. If not cheap, more reasonably valued.
All right. Thanks a lot, Sandeep, for joining in and giving us the initial thoughts on how this has been. What we'll do is we'll, get some more data and then pull in, some other experts along with you to discuss this in further detail for now. So looks like the mutual fund industry and the equity market, the cult or the discipline of Indian equity investors continues to stay, as we've seen in the month of June as well. With that, we'll slip into a short break. And as we do that, let's give you some good news. India's business news leader is now just a click away, which is the CNBC-TV18 app, which gives you instant access to breaking news, in-depth articles, and all the financial world updates coming in at your fingertips. You can download the CNBC-TV18 app from either the Apple Store or the Google Play Store, or just scan the QR code, which is up for you on the screen.
Welcome back. Well, just watch out for a couple of these stocks from the broader markets, which are showing good amount of traction. Garden Reach Shipbuilders is up 4.5%. Good amount of volumes traded on that one. We have Keynes Technology, which is up around 2.6%, and a couple of others such as GSK Pharma, which is showing a little bit of traction in terms of at least pricing, if not volume. So that stock is up around 1.7 at this point. Edelweiss Financial too has had a decent week. It's up around 1.6% at current reckoning, is up around 1% at this point in time. So overall, for the market, still very quiet. The advanced decline ratio just about holding in positive terrain. But let's get to an exclusive interaction then. CNBC TV18 Shriram Finance caught up with Chuck Robbins, the chair and CEO, and Jeetu Patel, the president and chief product officer at Cisco, and asked them about a whole host of issues, including the impact of Trump's tariffs, the opportunities it sees in India, and the AI revolution in the country. Listen in.
Well, this is the issue in the business community right now is the uncertainty just freezes everyone. Because if and when we get to the end game, then we can adapt appropriately. And so if you look at the tariffs that were put in 2018, I think it was, you know, we knew what they were put in, and we were able to kind of flex our dynamic supply chain in order to adapt to those things. And we'll do the same to the extent we can once we see what the end game looks like. But right now it's a little more complicated, looking at a multi-quarter P&L for the business because you just don't know which tariffs you have to consider. So what we've effectively decided to do is we're just going to look at our numbers based on what's in effect today. And then, I mean, we can do all sorts of speculating and scenario planning, but tomorrow they could be useless. Well, for us, it's not meaningful yet because a lot of the products that we sell are under the 232 investigation that is happening now, the national security view on some of the technology stuff. So as of now, we don't have meaningful impact, which again is the reason we're anxious to get to the end so we know exactly what we're dealing with. India is one of the top 3 countries around the world from our perspective. If you look at the next 5 to 10 years from a growth perspective and an opportunity perspective, G2 and I came here together September, I think was the last time, and we left with this unbelievable view that we needed to begin to invest even more heavily here. And we were very pleased, I was very pleased at least, and that we had already made the decision to deploy the manufacturing platform. You know, we've had a couple of false starts on manufacturing over the years. This time we did it right. We went full node. We turned it into an export hub. We had a plan for multiple products. We're now doing PCB assembly. So we've got that rolling, which is a good baseline. We've got our R&D and Innovation Center in Bangalore, which is really good. G2 and I are pressing our team in a massive way here that we should be able to triple the size of the business here in a much more compressed window than our team believes. And my team's listening to this interview right now, so we want to make sure. And that's going to require us to invest. It's going to require us to invest our time and our team's time. G2's coming here with his entire product leadership team in January. They're going to do an offsite here. We're going to host a big event here that's going to focus on cybersecurity, AI. And so we have to invest here to enable our teams to actually achieve what we see as being possible. And that's what we're going to focus on.
There's such a huge advantage that India has right now because of the demographics, the young workforce. I think we are kind of in this mode of just getting into this AI wave, the second phase of the AI wave. You're moving from, you know, chatbots intelligently answering questions for us to agents that are going to conduct, you know, automate workflows and conduct tasks and jobs autonomously. And so what I think we have is this unique opportunity in India where there's going to be an exponential rise in throughput per capita. And that'll require India to make sure that, you know, they've got the right infrastructure build out. And just like you folks had the huge infrastructure build out during mobile, and you were very successful, I think there's going to be data center capacity build out that's going to be a huge opportunity for India. And I think there's hopefully a lot of opportunity for Cisco to participate in that and helping India.
Right, and you can catch excerpts of this interview all day today on CNBC TV 18. With that, we're out of time on this edition of Chartbusters. You stay tuned. Trading Guard comes up next.
Hello and welcome to Trading Hour. We are live from the Motilal Oswal CNBC-TV18 studio. I'm Sonal Bhutra. With me are Hormaz Patakia and Reema Tendulkar. Good morning, guys. Well, we're just in the middle of the week. So far, Nifty has been consolidating, right? And today as well, it's quite flat. We're just seeing that 1 point gain, 3 point gain now. Sensex is absolutely flat. Mid-cap slightly outperforming, but we do have a very stock-specific action. Again, it's the quarterly updates, news flow that's keeping the market active in terms of individual names, but at the borderline, or if we say at the broader market level, there's not much that we are seeing. Absolutely flat. Somebody yesterday called the market very boring because they're not seeing a lot of action, but I think a lot of news flow that the market is expecting, and it is in the wait and watch mode right now.
You know, that intraday chart is a bit deceptive. Look at that. You feel like there's been a big up move in the market, whereas from the day's low, it's only a recovery of about 50 odd points, right? The intraday low today was 25,470, 75, thereabout. So it looks a lot more magnified than it actually is. Things are still very, very quiet.
Objects in the mirror are closer than they appear, as they say. But yes, indeed, it's not, well, precious little is what the market has done over the last 4 or 5 trading sessions for that matter. They remained locked in a very tight range. And the broader markets were underperforming yesterday. They recovered from the lows of the day, but ended lower today as well. Again, precious little here as well. A 70-point uptick on the mid-cap index is not something that we see very regularly for an index that is used to seeing 400, 500-point moves on either side. But of course, there are plenty of stock-specific reactions, as Sonal was highlighting as well. Phoenix Mills is one of them among the top losers today on the Nifty 500 after that initiation that came in from Nomura. The Union Bank of India, after a very weak business update too, down 4%, the top loser on the Nifty 500. On the flip side, though, Niva Bupa is among the top gainers today, 5% higher. Sterling and Wilson is up 6.5%. So there are plenty, and there are some defense names that are perking up today. Garden Reach is up 4.5%, and some of the other names. And the one sector that has been resilient today, though, is pharma. Be it Natco, be it the likes of Mankind Pharma, all of them trading with gains of 3 to 4%.
Yes, so at least there's some sectors which are doing well. There's some activity, so to say, be it on the upside or the downside. Let's talk about the real estate space now. We do have reports coming in. It is coming in from Nomura right now. So they have initiated coverage on Godrej Properties and Phoenix Mills. So let's start with Godrej Properties first up. They have initiated with a reduce and a target price of 1,900 rupees a share. They say that pre-sales momentum will be weaker than expectations. Also talk about how valuations are looking stretched. Godrej Properties has always traded at a premium in the entire sector. They expect FY26 sales of around 31,000 crore rupees versus the guidance that the management has given of 32,500 crores. Volume-driven strategies is posing risk for further equity dilution. They are talking about execution challenges that Godrej Properties might see, and challenges to executions are given considering the deliveries have been very late. For Phoenix Mills, Nomura has initiated with a reduced target of 1,400 rupees a share. They're seeing slow consumption growth in the mature malls, while the new malls are now contributing to the growth that we're seeing in consumption. Ramp-up will be likely from FY28 itself. However, valuations again appear very stretched. So despite decent numbers yesterday for the Q1 update, the stock did not react like that. In terms of retail consumption, they're expecting a 40% growth over next 3 financial years. They've seen it in the last 3 financial years. For FY27, they're looking at 9% and FY30 at 11%. All of this is coming on a very high base.
Thank you very much for that. Let's now go across to Upasana. She's looking at some of these EMS companies, electronic manufacturing companies, Syrma, SGS, Dixon, Keynes, and all of them have got an upbeat note coming in from JP Morgan.
Well, certainly, Reema. EMS sector continues to remain in focus today as JP Morgan has initiated coverage with the overweight rating on Syrma, Dixon and Keynes Technologies. Now coming to Syrma first, they've set a target price of 800 per share. In terms of Dixon, they've set it at rupees 17,700 per share and Keynes at 7,150 per share. While it has given a neutral rating on stocks like Amber, Sign, DLM. Now it has given an underweight rating on Avalon Tech, and also it has set the target for Amber Enterprises at 7,350 per share, and Sign DLM they see nearly around 450 per share, and Avalon Tech nearly around 650 per share. Now coming to the key drivers that on the back of which they have initiated this overweight rating. Now coming to Syrma first, they see that the company is expected to see a growth acceleration and margin expansion going forward, which is why they are overweight on this. And for Dixon, it believes that the mobile-led growth will be the key driver until FY27, and beyond that, non-mobile segment will pick up. Keynes, they may see a 46% revenue CAGR from FY25 to FY28 is what they're expecting, with a revenue target of nearly about $1 billion by FY28 is what they have indicated. For Syrma, Cyient DLM and even Avalon Tech, export could be the next frontier for growth over the long term is what they have highlighted, which is the main key growth driver. Overall, it sees a three-year rally and also a demanding valuation, which is leading to an earning upcycle, which is one of the main key factors for the earnings upgrade is what the brokerage has estimated. So overall, all these stocks remain in focus today on the back of this.
Interesting there, Upasana. Thanks a lot for that. In fact, it's a 52-week high for Syrma SGS in today's trading session. Although Dixon and Keynes Technologies, both, the Dixon's down almost 18% from the recent 52-week high that it had made. And Keynes Technologies too is down well over 20% from those levels of over 7,800 was the record high, currently at 6,100. But the three of them still doing fairly well for themselves in an otherwise wobbly market in today's session. But on to a CNBC-TV18 exclusive. Now, the subject of discussion over the last few days has been the pipeline tariffs for GAIL, and that may see an increase of close to 20%. Sudarshan is here with the details of this exclusive. Sudarshan.
So first, if I can give you the background, in the month of April, PNGRB had floated the consultation paper regarding the revision of tariff, and in the month of May, it had held the open discussion. And now after that, it was expected that PNGRB board will soon consider revising the tariff for GAIL pipelines. So now, as per PNGRB, remember that decision can happen in next 1 to 2 months. But what we understand from the sources that PNGRB board is likely considering increasing the tariff for GAIL pipelines by almost 20%. So currently, tariff for GAIL pipeline stands at rupees 58.59 per MMBTU, and if there is an increase of 20%, that will reach to rupees 70 per MMBTU. Also, if you remember, GAIL had submitted for increase in tariff to rupees 78, but 70 or 71 will be taken positively, and that was even announced by GAIL management on our channel as well in after Q4 of FY25 earnings. Yesterday, PNGRB member had spoken to CNBC-TV18, and even he had hinted that tariff can be increased to rupees 70 or northward of that. Now, why this rupees 70 will be positive? If you take a look at the brokerage views, for example, Investec is saying that it's hoping for a 20% increase, but in its estimates, it has factored in 10% increase in FY26. Jeffrey is saying that it's expecting a 10% increase in tariff for GAIL pipelines. And if there is an increase by 10%, fair value for GAIL is rupees 235, and if there is an increase of 20%, fair value will be rupees 250 per share. So let's listen what exactly PNGRB member A.K. Tiwari had to say to our reporter Sapna Das yesterday.
They have to allocate whatever the least cost is there in their kitty for the system use gas, so that the cost will be reduced. So all these factors are being analyzed, and we are going to take view on that, and we are going to conclude the tariff order very soon.
Would it be more northwards of 70 or somewhere around that, if I may ask? It's up to you.
You are correct.
Okay, somewhere around that. Or northwards of 70?
I can't give any figure for this.
Okay.
The lowest point of the day now is GAIL, 2.5% lower on that stock as we speak, and it hasn't done a lot, whether it be over the last 1 month or whether it be so far in 2025 as well. The stock has remained completely flat. Now, some of the other movers, though, in the broader markets, we just mentioned Sterling and Wilson. Stanley Lifestyles is one of them. That too is up 6% in just in today's session. Enviro Infra is up 5.5%. Force Motors is up 5%. And Bajaj Projects, of course, they announced that capacity expansion plan last evening, currently locked in an upper circuit. And just before we take that break, also pull up Pesalo Digital. That stock is now up 9% among the top gainers on the BSE small cap in today's trading session. Take a short break. On the other side, all things commodities with Manisha Gupta. Stay tuned. Welcome back. On to commodities then, and it's only one that has been in focus over the last 24 hours, and that is copper. Manisha is here with a lowdown on all of that. It's all about copper, Manisha.
It is all about copper, and copper is the new gold, the way it seems to be running up. We've seen 10% of gains in the overnight market. And at one point in time, as that cabinet meeting was going on and the US President Trump was talking, we did see copper prices go all the way up by 17% to hit an all-time high at around $5.9 a barrel. Well, the US in the cabinet meeting has proposed 50% tariffs on copper, and that really seems to be taking the prices on the higher side. The move aligns the copper tariffs with existing 50% that you already have in case of aluminum and steel there. Well, the US had launched a probe on this. This was way back in the month of February, and that has been supporting copper prices. A lot of import has been happening into US. Now, the expectation is that the report suggests that the final decision on this probe, perhaps that report could come out in the month of November. But this announcement of a proposal of a 50% of tariff on copper clearly seems to have put the markets in a very big disparity there. Now, remember, US imports nearly 50% of its copper requirements. It comes in from Mexico, it comes in from Canada, and a major part of that comes in from Chile as well. So the markets are looking at conditions in all of these areas too. And then you are looking at higher imports within US, and that has led to a higher premium also building up in case of the US markets there. Remember, US will now start buying copper from everywhere before these tariffs hit. So we've seen US continuing to buy copper, and that has led to US copper at a premium of a record $2,750 a ton. I mean, that's the way the copper prices are moving. If you look at the markets, and the disparity clearly has been there in the first half of this year as well, because when you look at LME copper prices, they gained up by 12% in the first half of this year, while the US copper already was pricing in those tariffs, and we've seen 26% of gains come in there. For the month of July, until now, the LME copper prices are up by 3%, and the US copper is up by nearly 13%. So that's the kind of disparity that we already are working with. Now, there is support to copper coming in any case because of other factors as well. A very bullish Goldman Sachs report says that even with all that is happening, in the year 2025, the copper demand in China will increase by 6%. The other report comes in from PwC, which says that 32% of the global semiconductor production could face issues due to supply disruptions in copper by 2035. In any case, there are roadblocks by informal miners in Peru that has disrupted transportation. It also has to do with disruption at Panama, in Congo. The Chile droughts also have led to mining, and mining of good grade copper continue to see a decline. I also want to put a final number on your screens, and this is about LME copper stocks. If you look at from the month of Feb, we've seen that decline by 64%. While, of course, the US copper inventories are on the higher side, but at this point in time, the best that it puts you through is a very disruptive and arbitrary market.
Okay, all right. No wonder you said copper is the new gold. The kind of disruption we are seeing, you're dressed in gold as well right now. So it makes sense. Thank you so much, Manisha, for making sense of what's happening in the copper market and the reasons why we could see further price hike as well going forward. Well, that was about copper, but we have to pay attention to the mutual fund data yet again. The SIP numbers, they have also been reported on the call, and it is again a record high. These numbers have been consistently increasing. It's a 27,269 crore number right now. It's close to, actually, if we say, around $3.5 billion now of SIPs per month that we are seeing. It's a jump on a month-on-month basis, and as I said, a record high number as well. Generally, if we look at the MF data, so far it has been decent. We did see that uptick in the equity flows, rising 24% on a month-on-month basis after that dip that we saw in the month of May. The investors have also looked at the mid and small cap funds. Now, mid cap flows, they are up 33% on a month-on-month basis. They've crossed that 4,000. They are close to that 3,700 crore mark. Again, we've seen that small cap funds have also done well this time. And the good part is, you know what? It hasn't come on the back of any new NFOs or any new thematic funds. NFO flows, in fact, have come down on a month-on-month basis. That number should come up for you. The thematic funds sharply down from 2,000 crore rupees to around 475 crore rupees. Even the NFO number should come up for you on the screen. That number has also declined. So this equity flow that has come about is not because of NFOs. It's not because of sector or thematic funds. It's something different. And it is the contribution that we've seen to large caps, mid caps, and small caps otherwise. So that gives a good indication, because there was a lot of fear that this new money that is coming in is Is it from the NFOs? Is it from the sector funds, which are very risky, right? So this gives a good indication of where the investments are going. But of course, the SIP number continues to be the big number that we are talking about. And we'll also like to know what the cancellations have been. They've been consistently increasing. I remember at a point in time, the cancellations reached number of 70%. So we'll want to know what the June number looked like. But so far, good said as far as the contribution coming in the month of June.
Indeed. Thank you very much for that, Sonal, for explaining and breaking down the numbers for us. Get into a break. But before that, remember to tune in to our all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insight. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. The index is still unchanged, though the Nifty Micro Cap 250 index is a gain of about 0.6%. The small cap index is also up more than about 0.5%, and that pretty much maybe explains the positive advance decline ratio. Sectorally, it's FMCG higher, auto. FMCG we'll discuss more with Mankalam on the Jefferies note, but that's a sector where you are seeing strength with names like HUL, Asian Paints gaining in trade. But the big story is what's happening globally, because things are quiet on the domestic front. So here's the latest on the tariff front. Donald Trump has said that there will be at least 7 trade announcements on Wednesday. That's later tonight, in a post on Truth Social. While there has been no official word on the India-US deal as of now, maybe tonight we will hear something. Trump also said he's planning to impose a 50% duty on copper imports as a part of a set of looming sectoral tariffs, while threatening a 200% levy on pharmaceuticals. However, he said drug makers would be given a grace period of 1 year to get their act together.
Ones we did steel, as you know, they're 50%. We did aluminum, 50%. Lumber just came out.
And that's copper.
And we did cars. And now, today we're doing copper.
Copper and lumber. What would that tariff be on? The section tariff?
I believe the tariff on copper, we're going to make it 50%.
50%.
And we'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%. We'll give them a certain period of time to get their act together. But they were all here now. They all left. They went to other places because we allowed people that sat in this room allowed it to happen. And I don't allow it to happen. The people in this room don't allow it to happen.
Copper is finished. We've done with our study. We've handed the study over to the president. The president knows that he has the ability, since we've studied the market of copper, to set the market tariff for copper. He announced it today at the cabinet meeting that he intends to go to 50%, which will be similar to steel and aluminum, which are both 50%, so copper will be 50%. And the idea is to bring copper home, bring copper production home, bring the ability to make copper, which is key to the industrial sector, back home to America. We need that kind of production in America. It's important, so that'll be out today. With pharmaceuticals and semiconductors, those studies are being completed at the end of the month, and so the president will then set his policies then.
Okay, here's some opinion from Atlantic Council's Fred Kempe and Arvind Sanger on Trump's tariff moves.
The markets still haven't priced in their potential impact on growth, their potential impact on inflation. He's particularly going after two of our allies, Japan and South Korea, where the cost alone to the auto industry could have a real hit to the American consumer. But there's some triumphalism right now here in the White House. They say, well, April 2nd, we did Liberation Day. It hasn't been inflationary. The markets are doing fine. You know, we've had we're having a good run on other fronts. You know, so the president said, this is a time for me to push and show people that I'm not Trump always chickens out. That it's not Taco Trump. It's a deadline that's set 3 weeks out. Many people were hoping it would go past Labor Day. And so I think it's not him punting. I think it's him doubling down on his seriousness around tariffs.
I think the overhang of the uncertainty is still there. So, you know, I think some of the more extreme measures, as we've seen before, are unlikely to come to pass. So I think, you know, it's going to be a mixed bag. I'm certainly not rushing out to buy pharma names on this news. You know, the tariff news from a day ago didn't cause a huge, disruption in those markets. So my sense is, at this point, tariffs are kind of part of the fabric of the noise in the market, and they will affect some short-term moves.
Well, all of the developments from last night has so far not had a very significant impact on our own market. Still holding on to those levels above the 25,500 mark is the Nifty. So Mitesh Thakkar now joins in with a quick chart check and some trading ideas as well. Mitesh, good to have you back. Still holding above that 25,500 mark so far. Do you see that the index is poised for an upside, is just awaiting some positive triggers to take it higher? What are the levels you're tracking here and your stock ideas as well for the morning?
I think the index, almost I've been telling that it's going through a period of contraction. I think that still continues. There's no change in that outlook, and 350, 400 has emerged as a pivot, but broadly 25, 200 is the medium-term spot. And on the upside, I don't see the strength to get past 25, 650, 700. So we might just be in this range for some time. Therefore, trading the index may not be the best idea. On the stock side, I think, there's a big breakout happening on the charts of Vedanta. I think that's just come to my focus. So it can still be bought. Maybe you want to buy it slowly, and, if you get more intraday tips, add there. But keep a stop below levels of 1260, and this is a 1400, 1420 kind of a target, which the stock price, the price chart suggests, could be quite possible. The other one is a buy on Bajaj Finance with a stop at about 927 for targets of 965.
Thank you very much for that. We will slip into a very short break. We'll come back and get chatting about the consumer space. Asian Paints, Varun Beverages, all these stocks in focus. We'll also invite Siddharth Vora of PL Asset Management to understand the market dynamics and how one should position their portfolio. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. But a couple of stocks from the broader markets that should be on your radar. While we have seen an uptick on the Nifty as well, it's a mild uptick, but nevertheless, we are seeing that 17-point uptick on the Nifty right now. If we talk about some of the stocks which are doing well, Stanley Lifestyles, that should come up for you on the screen. It's up 6.5% right now. We do have some of these chemical names which are doing very well. So something like a PCBL, that stock is up 6% right now. We do have Rosari Biotech, which is up 4%. There's Budal Chemicals, which is up around 3.5%. Some of these agro or fertilizer names, the likes of Coromandel International, that stock, remember, was down around 7% day before yesterday. Fact is the one which is seeing a gain of around 3%. So a whole host of stocks from the chemicals and the agrochemical space are making a comeback. And there's an indication that Q1 could see a recovery in earnings as well. So we'll watch out for that one. But we are talking about Q1 updates. Gaurav is joining us now and he's going to be talking about Union Bank. How did the numbers look this time around, Gaurav?
Well, yes, when we look at Union Bank, now the bank is actually struggling in trade today. And the reason being that weak set of number is what we saw for the first quarter. Now, advances growth was just at around 6.8%. Let's not forget that this was actually the fourth quarter where bank reported single-digit advances growth. Now, this was actually led by retail, agri and RAM segment, but this also implies that the corporate growth was just at around 3% on a year-on-year basis, and this also implies that 4 or 5% of the decline in the corporate growth on a sequential basis. This is actually a weak update for bank. On the other hand, on the deposit side also, bank reported weak set of numbers, only 3.5% of growth on a year-on-year basis in terms of deposits. So definitely a weak set of number is what we are seeing from Union Bank in this quarter. Let's also not forget that the bank has reclassified some of the deposits in terms of total deposits. That is also something that we will be watching out for. We will also watch out for how the NIMs are going to be for the bank, given that the rate cuts are already happening. But all in all, for at least for the provisional update, weak set of number, and on back of this we are also seeing stock is struggling today.
Among the top losers on the Nifty 500 is Union Bank of India, among the worst performers on the PSU Bank Index as well. But a sector which a lot of brokerages are now believing that the tide is turning, the worst is over, and a lot of these phrases coming around is paints. And Asian Paints, of course, is one amongst them, and a slew of upgrades coming in for that one as well. Mangalam is here to tell us more on that. Mangalam.
Well, I don't know how it will sound, but it's one of those I told you so sort of things, because I'll tell you why. When the JSW Paints and AkzoNobel deal took place, you know, there was something that was telling you that the demand sentiment is improving. We have the raw material environment, which is, you know, a lot more controlled right now. And at the same time, the paint stocks had seen a correction of almost 30 to 40% at a time when everyone's already seen one full season from the big disruptor that is Birla Opus. And we had this conversation with Abhijit Roy of Berger as well, who said that, you know, the disruptor that had to be in the industry has come by. And now this deal will perhaps be of, you know, a known competitor, which is that of JSW and Akzo, both of them which have been in the industry itself from earlier. And now Jeffries, as well as, we have a note coming in from HSBC as well. They are turning positive on the consumer staple. Remember, immediately after the deal was announced, we had ICICI Securities upgrade their 4-year negative view on these paint stocks. So Jeffries is a broader theme on the consumption space, the consumer staple space, where they believe that, you know, 3 of the big parameters that were disrupting the industry, demand, supply, as well as competition, of which there is improvement in both demand and supply, as a result of which margins, competition, while it still persists, the stocks have factored in that risk. So they believe from here on there will be more upside than downside on all these stocks. So they've upgraded Varun Beverages, they've upgraded Hindustan Unilever, and they've upgraded Asian Paints as well. On Asian Paints, of course, the target price is from 2200 to about 2800. For Varun Beverages, they've actually pared the target price a little lower. But more importantly, HSBC has said that the dealer checks suggest that every deal that each of the company is giving, paint company is giving at the dealer level, is now at parity. So from here on, growth will be led by higher throughput per store. How much more can one store sell from the existing setup that they have? And in that, HSBC believes that Birla Opus's 10,000 crore paint revenue target, looks a little tall when it comes to the asking rate right now. And that, they believe, will not accrue as much as what was earlier feared. And that is a turning point for players like Asian Paints as well as Berger, where they have to turn buyers, and they've actually upped the target price from Asian Paints from 2,700 to 2,900. Berger Paints as well has been up marginally from 620 to 640. So maybe the color is turning green for the paint stocks.
Indeed, thank you very much for that. The other story that we're looking at is the pharmaceutical companies, because they may get some relief on free drug samples given to doctors and hospitals. Sources have told CNBC-TV18 that the GST Council may consider allowing input tax credit benefit on these free samples. Timsy joins in with more on what she's learned from her sources.
In what could ease some tax pain for the pharma sector, sources have confirmed to CNBC-TV18 that the upcoming GST Council is likely to consider a clarification that may allow input tax credit, or ITC, on promotional and free drug samples distributed by pharma companies. Currently, under the GST framework, only in a select few cases companies are allowed to claim ITC on goods distributed without consideration, which includes free samples. But pharma companies say that this rule unfairly impacts them. because their samples are not marketing giveaways to consumers but are provided exclusively to doctors and hospitals. These free samples, the companies argue, help end users as only doctors assessing a patient gives them for free while prescribing these drugs. The pharma industry has also pointed out that expenditure on such free samples accounts for up to 2% of their total manufacturing costs, marking the denial of a ITC as a significant cost burden. The demand from the industry is clear. Treat pharma samples differently from FMCG promotional items like sachets or retail freebies and allow uniform ITC benefits across the board. Sources tell us that the GST Council may consider issuing a clarification circular to address this anomaly, one that could free up a major chunk of blocked input tax credit for Indian drug makers. However, officials also say that the Council will look at this particular framework with several safeguards to prevent misuse and ensure that this relief does not trigger similar demands from unrelated sectors. But so what end it comes out to be, or what is it that the Council will decide? Something that we'll have to wait and watch for.
All right. Thank you so much for joining in, Tim C, with all these details. So with that, we'll slip into a short break. As promised, we'll get Siddharth Vora of PL Asset Management up next to talk about market fundamentals.
Back, Siddharth Vora from PL Asset Management is joining in now to take the market conversation forward. Siddharth, good morning. Thank you for joining in. We're on the cusp of yet another earnings season, starting off with TCS tomorrow. So do you expect any fireworks this time around from the IT sector, at least as a positive surprise more than anything else? Is there a specific segment within this IT space that you're watching out for this time around?
So I think the only firework we do expect from IT this time is no negative surprises, and I think that will be enough to keep the sector in check, avoid any major correction, and continue the gradual build up and accumulation that's been happening in the IT sector. But no, we don't expect any major positive surprises this time around, given the state of the global economy and the US commentary as well.
Siddharth, hi. Morning. This is Reema here. So some of the companies that you've backed and they've done well for you include those in the entire capital market ambit. AB Capital and MCX, Motilal Oswal. Now, increasingly, there is that, impact on account of what's happening with Jane Street. That will play out. Plus, SEBI is looking to tighten certain regulations to protect the small retail shareholders, maybe link the leverage and the leverage in the F&O position and the cash position. All that might hurt, the companies listed in this space. So how are you approaching it? And is there going to be a meaningful impact from a fundamental point of view?
So I think getting better regulation, protecting the retail investor, all of this is better for capital markets in the medium term. And most of the names we own, I think they are fairly shielded, because they don't rely too much on a very heavy option trading volume as a big part of their business. So we're not too concerned about it, to be honest. And also SEBI has released a clarification that none of this is official yet, and they're not sort of considering any moves at the moment. So instead of acting on rumors or hearsay, I think we'll just wait for the data to talk. These sectors are well positioned, and we continue to back them till data changes.
Okay. So that you mentioned that what's happening with the US, the geopolitical risk, that is something that could keep the markets consolidated at these levels. What are some of the other domestic risks that you're watching out for? Are there certain things which investors should be aware of?
So I think the only domestic risk right now is that the valuations are not very lucrative, which means that any upside will be capped to a certain extent. The good thing about the Indian market is that it's now, after almost 8-10 months, it's become a buy on dip market yet again, as opposed to a sell on rise market, which it was before. Overall, in terms of the structure, we are coming out of a market that was range bound with much higher volatility and a bearish bias earlier. Now it is still going to be range bound. The volatility is going to be much lower, and now there is a bullish bias as well. So I think domestic cues, whether I talk about growth, earnings, macros, interest rates, domestic liquidity, all of that is very stable. And I think Indian markets are healthy right now. We don't need to worry too much about domestic risks as much as we do need to worry about global risks. And even on the global front, factors like crude, a weaker dollar index, and the overall chaotic world will put India in a relatively strong position in the global world order. So I don't think we have too much to worry about. We just shouldn't expect a runaway rally from here.
Chaotic world. That's the most important bit of what Siddharth just said, is something that the market needs to get used to as well. Siddharth, what about paints? It's been the talk of the town over the last couple of weeks now, ever since that JSW AkzoNobel deal took place. Is the worst finally over for sector leaders like Asian Paints? Now that the competition is being priced in already, there are demand trends that are emerging towards the positive. Do you now see this as an emerging opportunity, say, for the next 6 to 8 months?
So currently, we don't own any of these paint stocks at the moment. But I think with more consolidation in the market, crude tailwinds and demand tailwinds, these stocks have not really gone anywhere in the last 2-3 years. One could expect a 15-18% sort of recovery rally in these. And structurally, of course, if you take a much longer view, the company that is going to be better managed, that is going to be able to hold margins and distribution better, will likely outperform. But right now, it's still not a very exciting space for us to participate in. So we're staying out of it.
You've completely exited private sector banks?
Yeah, we
Siddharth?
just
When
did.
was
Over the last 15, 20 days, we made our exposure to private banks zero after being a very large overweight for like 5, 6 months. So, yeah.
And is this just a tactical trade for you, and what drove that decision?
So, I think our quantitative models make all the decision of which stocks get what ranks based on the different factors that are given importance in the current market setup. But if I have to try to explain it with an economic or fundamental rationale, I believe these stocks have done well. There are no fundamental triggers left ahead. I think we've seen a couple of rate cuts. The whole cycle for repricing loans and repricing liabilities, it will take some time. And given that the market is finally transitioning from a low volatility, high quality defensive market to a slightly higher beta market where growth is coming back, where momentum is coming back, these stocks didn't make it, to the top of the quant models, and therefore we exited the whole sector because the sector is now no more in the top pecking order.
Okay, so Siddharth, would some of the small caps or some of these sectors which are high growth sectors, but because of higher valuations, we could see a lot of sell-off in them come back in this list? What's your take on small caps and mid caps per se? You do have around 40% mid caps in your portfolio. Small
Right.
caps are though 12.5%.
Right.
What's your take here?
So I think from a valuation standpoint, it's very clear that large caps are the best positioned. I think that's that's a consensus view now. Small caps are still trading at very, very rich premiums compared to historic cycles, compared to the historic rolling return averages. So I think whether I look at a price to book measure, a price to earnings measure, a rolling return measure, in all the metrics, small caps are much more expensive than mid caps. Mid caps still have a 20% discount compared to small caps and therefore some more comfort. And in our current portfolio positioning, I think 80% is large and mid. And even within mid, it's almost large capish mid caps. So very large mid caps. So I think we will continue to stay polarized towards a higher market cap average in this market setup because there's no clarity as such. And it's going to be a range bound market. And we rather manage our risk and gain some alpha on the way than, take a lot of risk in this market. It's not a very high risk market condition for us to participate in right now.
So would that 8% cash level that you currently have, Siddharth, remain at 8%? Would you want to deploy it somewhere, since you mentioned that it's not a market you would want to participate in? But is there a sector you would want to put money to work right now, or would you wait for a better entry point? And if so, which are those sectors?
So we've created this cash, mainly from exiting some of our private bank holdings. We do have a very high financial allocation still, across insurance, capital markets, a couple of NBFCs still. The latest pool of 8%, and it might go up to 10-12% as well. That cash, we might find new sectors which are currently not in the portfolio. We're still evaluating, fertilizers, chemicals, pharmaceuticals, maybe consumer staples. We're still evaluating. Models are still going to, go into a rebalance sometime in the next couple of weeks, and that's when we will take a call, how to redeploy this 8-10% cash.
Just to go back to that point about private sector banks, what was the exposure before? Because you've exited it just in the last 15-20 days.
So we had roughly 16-17% exposure to just private sector banks.
And where has the 16% been deployed? 8%, I presume, is the cash that you're talking
Right.
about.
So
in the last 15-20 days, the deployment?
So we've increased some allocation to metals and mining. That's one sector we've increased some allocation to.
Okay, take that
And
point,
industrials,
Siddharth.
yeah.
Okay, take that point. Thank you so much for joining in, Siddharth, with those inputs and the outlook on the markets going forward. That's the word coming in from PL Asset Management Company. With that, we'll slip into a break. As we do that, here's some good news for our viewers. India's business news leader is now click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Now, in an exclusive interaction, CNBC-TV18 Shriram Finance caught up with Chuck Robbins, Chair and CEO, and Jeetu Patel, the President and Chief Product Officer at Cisco, and asked them about a whole host of issues, including the impact of Trump's tariffs, the opportunities it sees in India, and the AI revolution in the country. Listen to a slice of that conversation.
Well, this is the issue in the business community right now, is the uncertainty just freezes everyone. Because if and when we get to the end game, then we can adapt appropriately. And so if you look at the tariffs that were put in 2018, I think it was, we knew what they were put in, and we were able to kind of flex our dynamic supply chain in order to adapt to those things. And we'll do the same to the extent we can once we see what the end game looks like. But right now it's a little more complicated, looking at a multi-quarter P&L for the business because you just don't know which tariffs you have to consider. So what we've effectively decided to do is we're just going to look at our numbers based on what's in effect today. And then, I mean, we can do all sorts of speculating and scenario planning, but tomorrow they could be useless. Well, for us, it's not meaningful yet because a lot of the products that we sell are under the 232 investigation that is happening now, the national security view on some of the technology stuff. So as of now, we don't have meaningful impact, which again is the reason we're anxious to get to the end so we know exactly what we're dealing with. G2 and I are pressing our team in a massive way here that we should be able to triple the size of the business here in a much more compressed window than our team believes. My team's listening to this interview right now, so we want to make sure. And that's going to require us to invest. It's going to require us to invest our time and our team's time. G2's coming here with his entire product leadership team in January. They're going to do an offsite here. We're going to host a big event here that's going to focus on cybersecurity, AI. And so we have to invest here to enable our teams to actually achieve what we see as being possible. And that's what we're going to focus on.
And you can catch excerpts of this interview with the Cisco management all day today, only on CNBC-TV18. Well, even as the index continues to remain choppy, there are plenty of movers in the broader markets, and Force Motors has now surged to become the top gainer on the BSE Small Cap Index, 7.5% higher now. It started off the show with a 5.5% gain. Now it has built on to that. Force Motors, 7.5% higher now on that stock at the highest point of the day. Global Health is the other one, also known as Medanta, 8% higher on that stock as well at the highest point of the day. That started off lower, and since then it's been a one-way traffic for Global Health. Sami Hotels is the other one, 6% higher on that stock as well. So good going for a lot of these names. And Garden Reach Shipbuilders among the defense names, 5% higher on that stock as well. To round up, one stock that is not doing very well though in today's trading session is Car Trade Technologies, seeing some bit of profit booking after that one-way rally that it has seen over the last couple of months, 4% lower on that stock at the lowest point of the day. Take your leave on this edition of Trading Hour. From Rima, Sonal, me and the team that put this show together, thank you so much for watching. We leave you with the markets absolutely unchanged with Halftime Report taking over on the other side.
Market trades in a range as uncertainty around trade lingers, and we have a couple of these staple stocks which are doing extremely well. Alongside that, we have a few of the banking names like Union Bank, etc., lower in today's trading session on the back of their first quarter update. But the range for the frontline index continues.
Mutual fund net equity inflows in June sees a sharp 24% jump with higher flows across large, mid and small cap funds. Gold ETFs too see a surge with over 2,000 crores flowing in versus under 300 crores in the month of May.
Maintenance shutdowns constrain output for Tata Steel and JSW Steel in Q1. Tata Steel sales too take a knock, though its Netherlands arm notches up some production gains. The stock sulks.
Heads of brokerages tell CNBC-TV18 that structural steps by the SEBI to protect retail investors from sophisticated traders in F&O may be in the offing, but product suitability for retail may also get a look into. They add, while owning up their responsibility in guiding customers. Good afternoon. You're watching us here on Halftime Report on CNBC TV18. We come to you live from the Motilal Oswal studio. We're joined by Ekta and Vinny. If you look at the frontline index, you know, nothing much has happened over the last few trading sessions. Yesterday, yes, the last hour, there was that big spike, but I was just looking at data. You know, over the last 30 days, the average range of the Nifty has been 180 points, which is basically less than 0.6, 0.7% on a daily basis. And the day the Nifty moved the most was just around 350 points, which again is 1.4% on a base of nearly 25,000 for the Nifty. So we've been absolutely flat for the frontline index. Can't say the same for the broader markets because a lot of these cash stocks in particular today are doing a lot better. We have more number of stocks which are advancing than the number of stocks which are declining, even as the mid-cap index at an index level has moved to the low point of trade.
Hi guys, yes, absolutely. I think it is a lot about specific stocks as well and what they've done while the Nifty is consolidated. But your point is taken, Mangalam. You know, you go for a walk, you come back, the Nifty is probably just going to be the same. Take a long lunch. This is probably the day to do so as of now. So let's see. We're still waiting for the details with regards to the tariff negotiations, the trade deal. And once that comes through, that'll probably be a trigger. And of course, earnings season once it kicks off. Hi, Vinny.
Hi, good afternoon, guys. So obviously, range bound is what we are watching out for. Just highlighting the Nifty small cap. That's still managing to hold on to some bit of a green in today's trading session as well. So surely keeping an eye out on that one. And Realty, because yesterday that was buzzing in trade, but today, you know, seems like that's down and out as well. And Nifty Realty is among the top sectoral losers, while FMCG manages to hold on to some bit of a gain. Individual names today, we're seeing Global Health. That's been buzzing in trade today. So keep an eye out on that one. 8% gain coming in for the stock today. Sterling and Wilson managing to hold on to strong gains as well. So broader end of the market managing to see some bit of a move coming in on these individual stocks today.
Okay, but let's kick off the show with some primary market action. We have Anthem Biosciences, which will be launching their 3,395 crore IPO on the 14th of July. The IPO is an offer for sale, so there will be no proceeds to the company, with the price band set between 540 to 570 rupees per share. To talk more about the IPO, we have the chairman and the MD and the CEO of the company, Ajay Bharadwaj, and the CFO, Mr. Beg, joining in. Mr. Bharadwaj as well as Mr. Beg, thank you very much for joining in. Well, you know, Ajay, I'm going to kick off the conversation with you because you're a CRDMO company which is hitting the markets. And the big opportunity is possibly China plus one when it comes to the entire space. I wanted to start by asking you how tangible an opportunity is China plus one for you and how is it playing out in terms of your P&L?
You know, I mean, good afternoon, everybody. People have been talking about China plus one for some time now, but in the last 6 months or so, we've actually seen a lot of traction. The number of inquiries that we are getting from our potential customers have increased quite significantly. So we do feel that this is the, you know, we are at an inflection point where we can see a lot of demand come from customers. Nobody's leaving China in a hurry. But are they willing to put in their next project there? Is a new company thinking of going there directly? That anxiety is actually driving them to come to tried and tested partners like Anthem Biosciences. So we've been in the business 19 years, and we've established a very strong credibility with our customers, which is allowing us to be the partner of the go-to choice, partner of choice for drug development. And that's, I think, where Anthem is really going to benefit.
Okay.
You also asked us about the impact it goes on our P&L. So as you know that we are a CRDMO company, so we do work on entire discovery, development and manufacturing. So we have been proactively investing in our manufacturing facilities. We are expanding in our facilities in Unit 3 and also starting work on Unit 4. That helps us in terms of catering to the demand which comes in on account of this China Plus One as well.
Okay, so my follow-up question is that you've done very well in your FY25 numbers. Your revenue growth is around 30% on a CAGR basis. You've actually beaten the other your peers who you are compared with. How much of that is actually the China Plus One opportunity playing out, Mr. Bharadwaj?
Well, it hasn't. Sorry, it hasn't played out as yet fully, but definitely, what is actually playing out at this time for Anthem is that the projects that we've been working on for 10 to 15 years with very sticky customers, many of them have gone commercial. You see, we have 10 large commercial molecules where we supply either the active ingredient or the advanced intermediates to global innovators. 4 of these are billion-dollar drugs. This has played out a good part in our growth till now. But going forward, we are seeing, as I said, the drug development is actually a long cycle. The gestation period is long. So if we start a project today, maybe it will see the light of the day 7 or 8 or 9 years later as a commercial product. So that is where we are seeing the China Plus One strategy playing out more at this point. Secondly, people are also looking at, if they are manufacturing in China, to de-risk or to risk mitigate their situation, they have approached us and said, can we help them developing the product for them? Those revenues will kick in the future, in the near future, some of them actually.
Right. Gavin, I had to ask you this question because you're talking about the opportunity from China coming back, and as the management, you have been speaking about newer clients coming to you as well. If you could give us a sense over the last 3 to 5 years, what are the large clients that you have gotten? How long are these contracts? And, what is the US FDA status of your plants? Because for you to be China Plus One, you have to supply to all these markets, etc., right?
Yeah. Thanks for asking this question. See, if you look at the top 10 clients of ours, because we do work on the entire CRDMO space, and these are all sticky relationships that we have. The average length of relationship with our top 10 clients is 12 years. Which means we have worked with them right from the very early stage discovery, supplying them samples for their development batches, and eventually once the product goes commercial, we continue to supply to them. So it's a very sticky relationship that we have. And to cater to the needs of these customers, we have also scaled up our facility. We have an exemplary track record when it comes to compliance. We have gone through US FDA audit 6 times. 4 times in our first flagship unit, which we set up, Unit 1. All of them have been cleared successfully without any 483s or without any observations. The second unit that we set up, that has also gone through our US FDA audit twice. The last one was as recent as March 2024, successfully cleared without any 483s or observations. So we have an exemplary track record, which gives the confidence to our customers who are trusting their crown jewels from a development or a discovery to us in order to be able to help them out in this entire drug discovery cycle.
Right. Ajay, while we're talking about opportunity about China as well, what I want to also know your dependency in terms of China when it comes to your supply chain as well. And also, if you could highlight in terms of opportunity that is there in GLP-1 drug as well.
So, see, this is a very important part of the whole chain. A lot of the Indian pharmaceutical business is still dependent on China in terms of input. So, in spite of the best efforts in the last few years to move away from that supply chain, even today, 60 to 70% of inputs are coming from China. At Anthem, that number is 20% or below. We have worked very hard in the last 15 years to move away from this dependency on Chinese supply chain. So we have developed vendors, we have developed actually partners all over India as well as around the globe, so that we can de-risk this part of it. So that is something that gives our clients a lot of comfort, because when they are trying to move away, the first thing they want to know is, okay, is your supply chain dependent on China? And we compared to any of our peers can say this very emphatically, that no. Secondly, the peptide opportunity that everybody is talking about, GLP-1, as definitely some of those products are going to go generic in the next few years, but where Anthem is actually doing a lot of work is we have 10 new peptide projects. Now, the next generation of drugs in obesity, in metabolism, could be the ones that will change the game even further, and that's where Anthem is actually working with innovators to develop the next generation of drugs. You see, we have built our business you see, the disease burden over the last few years has changed as urbanization and lifestyles have changed. Instead of infection, now the diseases are more in metabolism, cardio, neuro disorders, and we are working with clients to develop the next generation of life-critical drugs. And that is where differentiates us from the other pharma industry in the country.
All right, so that's so specifically, Ajay, if you could just tell us if you are participating in any kind of GLP-1 opportunity.
So yeah, we are supporting development of some of these products. See, again, in GLP-1, there is in some products the products are actually biosynthetic. There is a biology fragment followed by synthesis. Now, very few people in the country have the capacity to do fermentation at the scale. Anthem has developed that from inception. So yes, if when we develop a GLP-1 analog or a GLP-1 product, we will be able to do both fermentation as well as synthesis. Many of the companies who are doing this in the country are still dependent on China for importing the fermentation fragment. So again, it doesn't really move you away from the supply chain.
All right.
Chinese supply chain.
The other segment which I wanted to talk about was your small and emerging biotech segment. I think it's around 20% of your sales. There's a big crunch in terms of US biotech funding which is taking place, and it's been there for a couple of quarters now, and a lot of the companies have been impacted because of that. Any sort of impact on Anthem because of the US biotech crunch?
Garvin, you want to take it?
See, you need to understand a little bit more about our business model. We do discovery, but most of our discovery work which we do is late stage discovery or early development. That's where the product is identified. We are working towards synthesizing the molecule on a lab scale level, or you're looking at process optimization. So the molecule, the target has been identified, and we work on significant amount of programs in that space. And we have given those numbers in the RHP, which quantifies that we work on much diverse level and close to about 150 programs which are in across levels of development. And all of this has come from the emerging biotech clientele. Because these programs are slightly more advanced, so we are not subject to the vagaries of the biotech ecosystem. Unless the US biotech crunch lasts for a very long time, then and there is a significant funding freeze, then there could be some element of impact. But because the development cycle for our programs have been slightly more advanced, so we would be slightly more insulated from the ecosystem, from the biotech funding.
If I may add to that. See, we have actually, as I said, we are at an inflection stage in our growth. We have 16 projects now which are in late stage or are ready to be filed. That actually gives us a tremendous opportunity going forward, because, as I said, we have 10 commercial molecules at the moment, but 16 are at late stage of development. So this will be potentially the growth engine for Anthem in future.
All right, so let's wrap this up, Ajay, with some, a peep into what the future holds for you guys. You're saying that the best is ahead of the company right now. And there is more importance to this because a large part of the fundraise is, in fact, the entire fundraise is an offer for sale. So no money coming into the company. You have 600 crores plus of cash on your books, so funding is not a problem. But going forward, do you think this 30-32% sort of growth CAGR that you've been doing will sustain? And what levels do margins sustain at? Because they've been upwards of 45% at one point, now down to 36%. What levels do margins sustain at?
So we will be able to sustain our margins, but I'm pretty sure of that. Of course, I can't give any guidance on what the growth numbers will be, but we are very confident of the future because, as I was saying, this is the company is poised for. Everything is aligning. We're poised for a quantum jump in our growth. We have new facilities coming on stream. We have the new geopolitical situation, which gives us more traction with our customers. We have more projects, like as I said, waiting to be commercialized. We have very sticky customers till now, and we have an exemplary track record of approvals from regulators. All these things are coming together at the right time for Anthem. So I do not see any challenge going forward in terms of growth as well as in terms of margins.
Okay, all right, Ajay as well as Mr. Beg, thank you very much for joining in and speaking with us. So that's Anthem Biosciences. The IPO opens on the 14th of July. Some more details. It'll be an interesting one considering that they have done margins of around 36% in FY25 and has probably been better than most of the other companies that they are compared to. We'll take a short break on that note, but we'll get back with Foo Keen Yap, who's the Senior Investment Strategist at Stancy Bank, to discuss the implication of Trump's trade tariffs and the much-awaited trade deal with India.
Welcome back to Halftime Report on CNBC TV18. Now, while obviously we have a lot of updates that come in from US President Donald Trump overnight, we had him levying 50% tariffs on copper imports and has threatened to impose 200% tariff on pharma. We're still waiting as India's deal is still pending. So waiting out for that. What are going to be the implications of all of this? We have Phuc Yap, who is a senior investment strategist at Standard Chartered Bank, joining in with us to talk to us about the overall global trade and what we are expecting to see in terms of equities. Phuc, good afternoon, and thank you so much for joining in with us. While obviously, the first half of the year that we look at it has been mainly related to President Trump, trade war, tariffs, global and geopolitical tensions that continue as well. But in terms of equities, now what are we watching out for? India still left and pending with the deal still coming with US. What should we watch out for now?
Yeah, thanks very much. Thanks for having me. I think we are still constructive on the environment. Obviously, the first half with Liberation Day, Trump saw a lot of changes. And I think that can be ongoing, that can continue. Look, the average tariff levels will be higher. I think we know what to expect. My question is where it settles at. But really, I think what the market wants is certainty, right? What the market does not like is the back and forth and uncertainty. I think once we are nailed down and having more certainty and having more clarity, that will be positive, as the companies are already expecting this in terms of the inventories. We saw a lot of front loading, but it's really the certainty that they need to nail down so that they can adjust their investment plans a little bit better. I think we're looking beyond the geopolitics and just stepping back and looking at the fundamentals and the economy and whether growth can continue. And we still are in a soft landing camp on that basis. And as long as the growth continues, if we avoid a recession, especially in the US, that environment is still positive for equities, positive for global equities. So we are constructive overall and in this environment because we do expect a soft landing, especially in the US. Now, a big trend for us, though, is a weakening US dollar. And the weak US dollar is something that we're telling investors to be positioned for. And a weak US dollar tends to be better. While one is good for equities overall, and two is good for equities outside of the US. So we're looking for a diversified equity portfolio with a tilt towards Asia ex-Japan because we believe that they would benefit from a weak US dollar environment.
Okay. Phuc, while we wait by for the details, how feasible or realistic do you think a couple of these headlines are? For example, 200% levy on foreign drugs. That in itself would be detrimental to the US itself.
Absolutely, absolutely. I think we hear mixed comments on that. I think I've also heard him say that we'll give them 1 or 2 years, possibly to bring production onshore. We see a lot of pharma companies committing into it. And look, I think he is trying to get headline wins in terms of, we're seeing X billion of investments in the US, which is going to create X number of jobs. And I think that is very much what he's looking for. He is kind of adhering to the promises that he made during his campaign. And so he's following through with that. But in terms of the impact on the consumers, impact on healthcare, at the end of the day, I think moving into the end of the year, when a lot of the politicians will be looking towards midterm elections and preparing for midterm elections next year, they will be very conscious as well on how the impact on cost, impact on sentiment is. We've seen a lot of survey-based data being very downbeat. Even though the hard data is looking good, the soft data is quite downbeat. So coming into year end, I think they'll be much more sensitive as to the impact they would have on cost, impact they have on sentiment, because they need to win the election next year. So a lot of high numbers at the moment. I think he's trying to secure a lot of commitments, but the commitments from companies are also multi-year commitments, right? And they will last through his second term. So I think it's the headline win that he's looking for.
Okay. Phuc, you did highlight that in terms of equities, ex-Japan in Asia, what are the markets that you're liking? What's your pecking order?
Great question. Thanks for that. Pecking order, I would say we are overweight on China and overweight on Korea at the moment. India is a core holding for us, and we do like the structural growth longer term. Why we are overweight on China and Korea? We're a bit more sensitive to valuation. Their valuations there are cheaper, and we believe there is a catalyst as well in terms of improvement. In China, we're looking out for more policy stimulus. There's a lot of stimulus in there for consumption and for white goods at the moment, but also more in terms of the AI development we expect, and there'll be a catalyst for the Hang Seng Technology Index especially. So that is going to be supporting China, and valuations are still very attractive. And Korea is another market where post-election, I think President Lee there with his KOSPI 5,000 and the measures that he's introducing there is again very supportive for a market that is very cheap, less than 10 times PE. So we think there's still scope for re-rating in Korea. These two markets are our preferred markets. India, very good structural story, longer term. I think our preference within India is in the mid-cap size, where we're seeing much higher earnings growth, which justifies the valuation premium. But for the overall India large cap index, we're very a core view at the moment because the valuations are high and then the earnings are still good for the midterm.
Okay. Fook, any changes to your India structure based on the trade deal that you're watching out for?
India's structure, I mean, in terms of the sector?
Your India holding.
Okay, well, I think no. At the moment, no. I think it remains a core holding. I think we might change our views a bit more nimbly around the large cap versus the mid cap. At the moment, we do prefer the mid caps. And we don't really expect India to be disadvantaged, versus the other countries. Look, I mean, all countries, exporting in the US are going to be facing higher tariffs. We've seen Japan and South Korea already at 25% being rolled out. And so all of them which sell into US will face these kind of headwinds. But India has got a lot of domestic strength within itself, a lot of structural strength. And that's why we think that will sustain the earnings. And it's going to make us, it's a core holding for us within Asia, Japan.
Okay, Fook, just a quick one. Last time you mentioned you were overweight on gold. Continue to be overweight on gold, or do you like silver as well now?
We are neutral on gold at the moment. So gold is the core holding. We are still telling investors to have gold in the portfolio, helps to diversify. And in a weak dollar environment as well, gold tends to be an asset that will do well if you look at the correlations. So gold is neutral, but definitely it's something we would keep within the portfolio. Silver is something that we've got not necessarily a house view on, but preference really is with gold. The central bank buying as well is another place, a positive factor for gold.
Okay, all right, Fook. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's a quick update coming in from the global perspective. Well, for the markets, extremely quiet at this point in time, just about in wait and watch terrain. We'll take a short break. But as we do that, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. From the start of the show to now, the Nifty has moved all of 20 points in the green right now, and two heavyweights taking the frontline index higher. So pull up the intraday chart of Reliance. That's moved to the high point, and we are seeing some traction build up in HDFC Bank, the biggest component of the Nifty Bank, and among the biggest on the Nifty as well. So HDFC Bank and Reliance, both of them have moved to the high point of trade. But key indices remain in this consolidation mode. We have Nifty, Nifty Bank, and Midcap Index, all of them coming up for you on the screen. The Midcap Index mildly in the green right now. The Nifty Bank off lows. The market breadth firmly in favor of advances. All through today's trading session, the green line has been above the red line, even as they did come close a couple of times. But the good part is that there are stocks which are buzzing beyond the F&O names as well. So look at some of the cash stocks. Global Health, huge volumes, up 6%. Stanley Lifestyles up 6%. Emami, staples have been doing well. Emami is up around 5% in that as well. But the street believes that maybe the base of the Nifty is moving higher, even as the consolidation remains at higher level, the congestion. So 25,500 put writers are fairly active, premium of 40 rupees, telling you that the base from 25,350 has moved higher to 25,450. But at the upper level, we have 25,600 call writers. They are active as well. They too have a premium of 50 rupees, telling you 25,650 thereabouts, we will see some supply. Those who are writing both the 25,500 put and the 25,600 call are playing for a broader range of 25,400 on the Nifty at the lower level to 25,700 at the upper level. A lot of long positions added on a few names. We have Mankind, which is doing well. Keynes Tech, buzzing on the back of a brokerage note, a long position added on that one as well. And PG Electroplast is the other one, which is up 5%. With some long positions backing it. The one stock that may enter F&O ban will be the second stock to enter the F&O ban this series will be Hindustan Copper. The open interest has crossed well past the threshold limit before which the stock goes into an F&O ban. So we'll keep an eye out on Hindustan Copper. With that, we'll take a short break with the news that the market continues to meander around the flat line with a mild green tinge now. On the other side, we'll focus on the commodities arena. Manisha Gupta joins in. And with her will be Vikram Dhawan, who's the head commodities and fund manager at Nippon India Mutual Fund.
Welcome back. Well, for the Bank Nifty, just about flat at this point. In fact, for all of the indices, just watch out for a couple of these stocks on the downside. So Tata Steel is your top loser on the Nifty. It's down around 2.3%. Hindalco as well, which is down around 2%. And a couple of the IT stocks ahead of all of the earnings kicking off is showing some amount of profit booking. So HCLTech, Wipro, TCS, all of these stocks are under pressure at this point in time. L&T also that heavy weight, along with even a couple of other stocks from the healthcare space. Apollo Hospitals, Dr. Reddy's are showing weak signs at this point, down over 0.5% for all of these stocks. But now let's go across to Manisha Gupta to take us through what she's tracking in the commodities space. Manisha, over to you.
Thank you for that, Ekta. And joining me is a very special guest, Vikram Dhawan, is head commodities and fund at Nippon India. Vikram, hi, thank you so much for joining in. And very strong numbers really coming in when it comes to inflows for gold ETFs. The global numbers have been on the stronger side, and for the Indian markets as well, after what we saw as an outflow in the month of March and April and okay kind of numbers for the month of May, June clearly seems to be shining for us too.
Thank you very much, Manisha, for inviting me on your show. 2025 has all been about gold ETFs, and after maybe a hiatus of 2 to 3 years, the net flows in gold ETFs globally went positive by end of last year. And the surprising thing is that the flows have been fairly well distributed geographically. Whilst we have seen very strong flows coming from North America, but we've also seen very strong flow from Asia, especially China. And India, although the base is still low compared to global peers, but yes, we have seen increase in interest in gold ETFs, especially in the past couple of years. And I think one very important thing is that the the asset allocation story or the the multi-asset story is really picking up in India, and I think this bodes very well for the gold ETF flows going ahead.
Vikram, what is the total AUM holdings right now, and how would you look at the first half of 2025 for India especially?
So I won't know the exact number, but I think it is somewhere around the total holding would be about 70,000 odd crores. I think, last financial year, the flows into gold ETFs were about 3 to 4 times of the previous year's average. And I think this year also we have seen very encouraging start to the financial year. But again, you have to understand that gold also has seasonality. There will always be an element of profit taking. And obviously, this is a very news-driven market. So not only prices, the flows may also remain volatile. But overall, I think it is looking very steady for gold ETFs in this financial year as well.
Vikram, would be interesting to know on what is the kind of participant increase that we've seen in the first half of 2025 for India. And also, how do you look at the ticket size as well?
So when gold ETFs were first started in India in 2007, it got a very lukewarm, response. And I would say up till COVID, or rather till 2017-18, it was, dominated by retail, players, especially the ones who are active in the mutual fund ecosystem. But I think post-COVID, we have seen a bigger participation from institutions, which also includes mutual funds, mutual fund schemes like multi-asset funds, from family offices, institutions. And I think if you look what is happening across the border, the Chinese government is actually encouraging the insurance company to, have their holdings in gold. And I think we saw a similar news item running in the Indian press. So I think it's looking very, very strong and very, very good as far as the institutional part is concerned. And my personal view is that going ahead, the reason why I'm very bullish on the flows is because once the institutional participation increases, the flows will increase exponentially from here.
Vikram, we've seen these very strong numbers coming into in 2025, even as the gold prices have been trading at near record highs. And there haven't been much redemption when you look at the overall net inflows, really. What is, in a sense, on what your calculation on how the rest of the year could look like?
So to begin with, I think the global investors were underweight on gold, despite what the performance of gold post-COVID. And I think from being, the global investors were actually underweight on gold. And from being grossly underweight, I think we are not even close to being equal weight. So I think this process will continue for a few more quarters, if not years, which means that the investors would have to, tolerate higher prices. Because as I mentioned, at the end of the day, whether it is a retail investor or an institutional investor or a central bank, they are using gold for portfolio diversification. I mean, I think that there was a very important update on gold, and this was given by the European Central Bank, which said that gold is now the second largest holding after US dollar in an average central bank portfolio. So I think it's not just the investors, institutions. I think it's become more of a secular trend as far as using gold for diversification is concerned.
All right, thank you so much, Mr. Dhawan, for joining in and giving us that insight. Manisha, thank you for taking us through that conversation. It will be very interesting if such, ferocious purchase with all these institutions will further take the gold prices higher and impact customers as well or not at some point. We'll watch out for how the story pans out. With that, we'll take a short break, come back on the other side. Samir Dattani, who's the Executive Director at Sanathan Textiles, joins in to discuss the impact of Trump's tariffs on the Indian textile sector. Stay with us.
Welcome back to Halftime Report on CNBC TV18. Now let's shift focus and talk about a textile sector, the textile industry. What's that going to be looking like? Given that, Trump tariff announcements are coming in, Bangladesh, Vietnam, they have gotten their trade deals set with US. India, we are still pending on that front. But how is all this going to be impacting the global trade and the textile industry? To talk to us about all of that, we have Samir Dattani, Executive Director at Sanathan Textiles, joining in with us. Samir, good afternoon, and thank you so much for joining in with us. So many changes that, we are waiting out for, watching out for. Now, for you as a company, overall, obviously, FY25, around 4% was exports. And obviously, that's the strategy-wise that you all are moving. But given that you will have the trade deals coming in, also you have the UK FTA that's already signed, right? So how is all this shaping up for you? And how do you see exports moving for you as well as the industries?
So I think the current situation is very, very favorable for the Indian textile industry as far as the global exports are concerned. We all know that the largest textile exporters are China, India, Bangladesh, and Vietnam. And if the current tariffs are relatively more favorable towards India, I think we have a damn good opportunity in front of us to really expand our global market share of textile supply. And as you know, textiles are the second largest exports out of India. So the entire chain is going to benefit from it. As far as Sanathan Textiles is concerned, we manufacture the yarns, which is the starting point of the textile chain. So obviously, we will have a direct as well as indirect benefit of our product. When I say direct, I mean the direct exports that we do will definitely go up. And the indirect exports, customers who buy our yarns domestically and convert them to fabrics and garments, will see a big bump up in their demand in the export market once these tariffs are more favorable towards India.
You know, yesterday we spoke to an expert and they said that even as tariffs are a lot more favorable for India versus, say, something like Bangladesh or Vietnam, the labor costs in India make it the cost of production at par, if not more, for India. Plus, our capacity is a little more limited than those countries. So, be that thing considered, how do you think would our exports grow from here on? And secondly, for you, you said last time that 5% of your sales comes in from exports, and the rest is indirect exposure to the US by you supplying to domestic players. What is your experience been with them? Has their offtake increased for them to increase their exports to the US from here on?
So, the first point you made regarding production limitations is a very valid point. I think the entire industry needs to scale up its production capacity, looking at the kind of opportunities we have in India as well as globally. And ample support from the government is there today to increase the exports, especially focusing on man-made. Even the PLI, as we know, is very focused on man-made because globally the consumption of yarns and fibers, 70% is man-made, and polyester filament yarn having the largest market share of that. I definitely see an increase in exports for us and our customers. And as far as the costing or the labor cost that you mentioned, I think we're similar or cheaper than Bangladesh, if not cheaper, at least similar for sure. But if the tariffs are more favorable to us, all that will get evened out very easily in our favor. So I don't think the cost is largely a concern. Yes, increasing our capacity is definitely a concern that we all need to work on and quickly scale up our capacities from where we are today.
Okay, so exactly on that point then, Samir, are you looking to increase your capacity? What do you have in the pipeline? And if you are incrementally looking to increase your exports from this level of around 4 to 5% of total sales to take advantage of the situation, how much would it probably go to and by when?
So we are at the last leg of starting up a new greenfield facility in Punjab. And this new facility is totally focused on polyester filament yarns because we see this as the future. The domestic India consumption growth and the global consumption will be more skewed towards polyester filament yarns, man-made fibers. So at Sanathan Textiles, our current capacity of 223,000 tons per annum of yarn manufacturing, we are going to more than double this year in FY26. Our new plant, our new facility is just at the last leg of commissioning. We are very optimistic and hopeful to start commercial productions in the next 3 to 4 weeks. And as our production will increase, so will our supply domestically and globally. And this is all in sync with what we see, what our outlook is over the next decade. We are very, very bullish and optimistic about textiles and yarn being the starting point of the entire textile chain. And us as suppliers, we have a wide variety of yarn products that we supply to home textiles, apparels, garments, athleisure, sportswear, automotive fabrics. So we have a wide variety of products, and we see a great bump up in demand domestically and globally across all these segments.
Right. Samir, I just wanted to understand what would be the margins for your export orders if you would see an increase. What is the margin for export orders normally versus domestic?
This is direct exports that you would like to touch upon? So the margins for direct exports are probably similar to domestic, sometimes higher. So it's a very seasonal thing as far as margins are concerned. But the difference between domestic margin and export margin is not very large. It's a % here or there. In some seasons, it's more favorable towards exports, the margins, and in some seasons, it's more favorable towards domestic consumption.
You spoke about the Punjab capex. You had last said that it'll be commissioned in the first quarter of FY26. So obviously that's gotten a little delayed. In the next 10 to 15 days, you think it'll get commissioned and you stick to the 70% revenue growth guidance with double-digit margins for this year?
Absolutely. We're very much on track. We're on that last leg, just nearing the finish line. It's a very big project. It's a capex of almost 2,100 crores for us. There are more than 1,500 workers on site completing the site, which is spread over 80 acres of land. And we have about 23 lakh square feet of construction. And we should be starting the first phase of commercial production within the next 3-4 weeks is what we're seeing.
Okay. How do you think FY26 is going to pan out as a whole? I know, earnings season is around the corner, or numbers are around the corner, but if you had to talk about it on a broader scale, would FY26 be better than this 1.4% growth that you clocked in FY25?
Yes, for sure. At Sanathan Textiles, because of our new facility coming on stream this year, we should get at least 60-70% of the new additional revenue in FY26. So that will give us a big bump up as far as our revenue is concerned, and also as far as the absolute EBITDA numbers are concerned. As far as margins are concerned, last year FY25 we did close to a 9% EBITDA, and we are very optimistic and positively looking at a double-digit EBITDA for FY26.
Double-digit EBITDA margin and 70% revenue growth, right? 60 to 70%. That'd be a fair estimate.
From the new facility, we will get about 60-70% contribution this year, because we won't get the full running this financial year, right? Since we'll start now.
So the net growth will be what versus last year?
The capacity that we're putting up there is a bit more than doubling our current capacity. So our current capacity is 235,000 tons per annum. And the new capacity in the first phase is designed to give us 250,000 tons. And an additional 1 lakh tons will come in phase 2.
Okay. Samir, so, you had spoken about FY26, 4,800 crores. Is that the revenue that you're still expecting, or could we expect it higher?
Yes, 45 to 4,800 is what I mentioned earlier, and that's very much what we're looking at.
Okay. All right, Samir, we're going to let it go on that note. Thanks very much for joining in and speaking with us. So that's the word coming in from another textile company. So let's see what exactly the opportunity plays out to be. But manufacturing is definitely something that India would probably have to scale up on in order to probably take full advantage of any kind of opportunity. We need to take a short break, but we'll get you more on the markets once we're back. Stay tuned.
Virtually unchanged for the market, but a couple of these broader market names are doing extremely well. Nykaa, for one, has moved to the high point of trade, up around 4%. MRF is the other one, which too has moved higher. And in the last 20 minutes or so, there were some flashes coming in as comments from, the Power Controller General, and that seems to have had a positive impact on names like IEX. That stock too has surged to the high point of trade. Yesterday, we had a volume update coming in on Container Corp. There was nothing much to write home about, but if the domestic outlook is improving and the EXIM outlook is improving, then perhaps someone like a Container Corp stands to benefit on that as well. So even as the frontline indices are virtually unchanged, less than 10 points move on either of the major exchanges, we do have a lot of stocks which are doing well. With that, we wrap up on this edition of Halftime Report. From Ekta, Vinny, me, thank you so much for watching. Business Lunch comes up with all the market action ahead.
Stocks trade in a range as uncertainty over a potential US-India mini trade deal continues. Consumption stocks and those of utilities manage some gains, while metals and realty are the big drags. Mutual fund net equity inflows in June sees a 24% jump with higher flows across large, mid and small cap funds. Gold ETF too see a surge with over 2,000 crore rupees flowing in compared to just under 300 crore in May. Maintenance shutdowns constrain output for Tata Steel and JSW Steel in the first quarter. Tata Steel sales also take a knock, though its Netherlands arm notches up some production gains. The stocks sulk. Heads of brokerages tell CNBC-TV18 that the structural steps taken by SEBI to protect retail investors from sophisticated traders in the F&O space may be in the offing. Product suitability for retail may also get a look, they add, while owning up to their responsibility in guiding customers. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. Flat as flat can be as the markets are in between this sandwich session between the Sensex expiry yesterday and the Nifty expiry tomorrow. Still awaiting more contours of that potential mini trade deal between India and the US. And that is why the index continues to trade in this very narrow 70-point range in today's trading session. It'll be interesting to see how the last hour pans out, is because it was the last 1 hour which had led to that slight bit of recovery that the markets had seen in yesterday's trading session. But of course, there are plenty of movers in the broader markets, be it in the mid caps or across the small caps. Phoenix Mills is one of them, still trading around 4% lower after the initiation that came in from Nomura on the reduced recommendation. On the flip side, though, stocks that are doing well, Mankind Pharma, and a lot of these pharma names are doing fairly well for themselves. Mankind Pharma is one such stock. Laurus Labs is the other one. In fact, Laurus Labs is at a 52-week high in today's trading session and is also the top performer on the Nifty Pharma Index on a year-to-date basis. So pharma stocks holding up despite the 200% tariff threat from Donald Trump. Some of the other movers today include SML Isuzu, that's up 12%, and Force Motors continues to build on to those gains. We left off at around noon with the stock around 8% higher. Now the stock is around 11% higher as we speak. Getting you the latest now on the tariff front. Of course, that is the big trigger for the market going forward. President Donald Trump has said that there will be at least 7 trade announcements on Wednesday. That's later tonight in a post on Truth Social. While there has been no official word on the India-US deal just yet, maybe tonight we might just end up hearing something on that too. Trump has also reiterated that his 10% tariff threat for the BRICS nations still stands, claiming that the bloc was set up to hurt the United States.
They have to pay 10% if they're in BRICS, because BRICS was set up to hurt us. BRICS was set up to degenerate our dollar and take our dollar as the standard, take it off as the standard. And that's okay if they want to play that game, but I can play that game too. So anybody that's in BRICS is getting a 10% charge.
Is that immediate, sir, or is
Yeah,
that
pretty
if
soon.
they engage in some behavior?
Well, if they're a member of BRICS, they're going to have to pay 10% tariff just for that one thing, and they won't be a member long. I thought BRICS was, I said this about a year ago, and it largely broke up. But, there are a couple that hang around, but I thought it largely broke up. BRICS is not, in my opinion, not a serious threat. But what they're trying to do is destroy the dollar so that another country can take over and be the standard. And we're not going to lose the standard.
Now, the US president also said that he's planning to impose a 50% duty on copper imports as part of a set of looming sectoral tariffs, while threatening a 200% levy on pharmaceuticals. Now, however, he said that the drug makers would be given about a year or a year and a half to get their act together.
Ones we did steel, as you know, they're 50%. We did aluminum, 50%. Lumber just came out. Why don't you announce copper? And we did cars. And now, today, we're doing copper.
Copper and lumber. What would that tariff be on? The sectional tariff?
I believe the tariff on copper, we're going to make it 50%. 50%. And we'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that, they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%. We'll give them a certain period of time to get their act together. But they were all here. Now they all left. They went to other places because we allowed people that sat in this room allowed it to happen. And I don't allow it to happen. The people in this room don't allow it to happen.
Now, let's also listen in to what Donald Trump's Commerce Secretary Howard Lutnick had to say on the president's latest moves.
Copper is finished. We're done with our study. We've handed the study over to the president. The president knows that he has the ability, since we've studied the market of copper, to set the market tariff for copper. He announced it today at the cabinet meeting that he intends to go to 50%, which will be similar to steel and aluminum, which are both 50%, so copper will be 50%. And the idea is to bring copper home, bring copper production home, bring the ability to make copper, which is key to the industrial sector, back home to America. We need that kind of production in America. It's important, so that'll be out today. With pharmaceuticals and semiconductors, those studies are being completed at the end of the month, and so the president will then set his policies then.
Now, earlier in the day, we also spoke to Arvind Sanger, the managing partner at Geosphere Capital Management, on the tariff impact on the pharma sector. Listen to what he had to say.
I think the overhang of the uncertainty is still there. So, I think some of the more extreme measures, as we've seen before, are unlikely to come to pass. So I think, it's going to be a mixed bag. I'm certainly not rushing out to buy pharma names on this news. The tariff news from a day ago didn't cause a huge, disruption in those markets. So my sense is, at this point, tariffs are kind of part of the fabric of the noise in the market, and they will affect some short-term moves.
Now, my colleague Shriram Finance also caught up with Chuck Robbins, the chairperson and CEO of Cisco, who only sees a limited impact of tariffs on their global business so far.
Well, this is the issue in the business community right now, is the uncertainty just freezes everyone. Because if and when we get to the end game, then we can adapt appropriately. And so if you look at the tariffs that were put in 2018, I think it was, we knew what they were put in, and we were able to kind of flex our dynamic supply chain in order to adapt to those things. And we'll do the same to the extent we can once we see what the end game looks like. But right now it's a little more complicated, looking at a multi-quarter P&L for the business because you just don't know which tariffs you have to consider. So what we've effectively decided to do is we're just going to look at our numbers based on what's in effect today. And then, we can do all sorts of speculating and scenario planning, but tomorrow they could be useless. Well, for us, it's not meaningful yet because a lot of the products that we sell are under the 232 investigation that is happening now, the national security view on some of the technology stuff. So as of now, we don't have meaningful impact, which again is the reason we're anxious to get to the end so we know exactly what we're dealing with.
I'll take a short break here, but just as we do that, a programming note, remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at noon for the Global Reset, 1 p.m. for the Big C, and the Global Lens at 8:30 this evening. Now, the Sun TV family feud has ended, and that is a Money Control exclusive. Chandra R. Srikanth of Money Control joins us with more details on this. Chandra.
Tamil Nadu Chief Minister M.K. Stalin has played a pivotal role in bringing about a settlement between the Maran brothers, Sun TV Chairman Kalanidhi Maran and his brother Dayanidhi Maran, former Union Minister and DMK parliamentarian. Now, a meeting was held in the presence of Stalin, who is a cousin of the Maran brothers, his son, Deputy Chief Minister Udayanidhi Stalin, as well as the Maran brothers and their sister Anbukarsi, where they decided to hammer out terms of a settlement. It is not clear yet what the terms of this settlement are. If this is going to be a cash compensation for Dayanidhi Maran, or if he and his children will also get some of the media assets that are currently controlled by Kalanidhi Maran. Now remember, this truce comes weeks after Dayanidhi Maran shot off a legal notice to Kalanidhi Maran, making some very serious allegations from fraud to money laundering to cheating. He also threatened to enforce civil, criminal enforcement and regulatory proceedings against his older brother unless the shareholding of Sun TV was restored to the 2003 state. Now, we don't know what will happen to those charges, but clearly this is not going to be a publicly fought out battle. The brothers have settled thanks to the intervention of DMK leader and TNCM M.K. Stalin.
Chandra, thank you for that update. But the big data point came out earlier in the day. That was the mutual fund data for the month of June. That was released a short while ago. Surabhi is here with the analysis. Well, inflows are still better on a month-on-month basis, isn't it, Surabhi?
Well, the monsoons have brought in fresh hope, shall we say, because the numbers for June are looking much better than May. In fact, if I talk about the net equity inflows from falling to sub 19,000, the numbers have now improved to about 23,500. So that's a pickup of almost 24%. That's headline number one. The improvement in equity flows is being led by SMIDs, as they're called. Again, small and mid-cap funds. That's where the action is. Mid-cap fund flows are up almost 33%. The small cap funds have also done very well. The flows are up 25% month on month, and they've crossed the 4,000 mark all over again. Large cap funds, about 1,700 crores coming in. Still not the top preference, it seems, when it comes to equity funds for mutual fund investors. But something that's very, very interesting is that hybrid funds now are getting almost as much money as equity funds. And this has happened in the second month in a row. Look at the hybrid funds. I mean, we're talking about 23,000, a little over 23,000 for hybrid funds and 23,500 crores for equity funds. What does that tell us? One, investors seem to be understanding the message of diversification, and perhaps they're getting smarter because many of the hybrid funds have very tax-efficient structures as well. So the category is definitely gaining popularity. Let me talk about thematic funds. Thematic funds have been, bringing in dwindling sums because the NFOs are lesser. This month, we've got under 500 crores, just that much amount coming in from thematics. Bringing me to the NFO picture. NFOs have pulled in less than 2,000 crores this time around. And this is that one engine for the MF industry that's not quite firing as much. Some prudence coming in, maybe the market sentiment that's been weighing on the NFO party. Finally, the big silver lining, as always, is SIPs, rock solid as ever. In fact, the monthly SIP numbers have now crossed the 27,000 mark. In fact, the total inflows for the month of June are 27,269. So overall, looking good, stabilizing, equity flows picking up, and hybrids making a big mark as well.
Monsoons go on for a while. The hope should also go on for a while. Surabhi, thank you for that update there on the Amphi data reported just a few minutes earlier. A number of stocks are also buzzing on the back of news flow. Ria is here with more on this. Ria, tell us which are the stocks on your list?
Well, yes, Hormuz, a lot of stocks buzzing in trade today. First up is Phoenix Mills, trading 4% lower after Nomura initiated coverage on the stock with a reduced rating and a target price of rupees 1,400 per share. They say that the retail consumption CAGR is expected at just 9% and 11% by FY27 and FY30 versus the 40% CAGR growth that we've seen over the last 3 years. On the flip side, Sirma SGS is trading 4% higher after JP Morgan initiated coverage with an overweight rating and a target price of rupees 800. They're expecting to see a growth acceleration going forward for the stock as well as margin expansion. Coming to 5 Paisa Capital, they reported their Q1 FY26 numbers yesterday. The stock is still down about 2% even after recovering off the day's low. In terms of the numbers, the net profit has gone down by around 42% and even the revenue has gone down by 24% compared to the previous year. For JSW Steel, they've come out with their Q1 business update. Crude steel production has gone up by around 14% and even the India operations are up around 15% compared to the previous year. For Tata Steel, for Q1, the India production volumes have come in largely flat at 5.26 metric tons and the India delivery volumes are down about 3.8% on a year-on-year basis. For Union Bank of India, they also came out with their Q1 business updates. They've seen poor loan growth of just about 6.8% on a year-on-year basis and the stock is also 4% lower on the back of this. Coming to CAMS, this one has been in focus after the company has launched the CAMS Space, which is the new payment gateway that supports over 5,000 transactions per second. Bajaj Projects is another one that has been in focus. The stock has been trading at an upper circuit of 5% after the company has said that they're going to increase the galvanization capacity up to 1.1 lakh MTPA from the current 40,500 odd MTPA. And they're also planning a capacity expansion of about 170 crores at the Ranjangaon facility. Dixon Tech has been in focus after investing 2.5 crores for a 50% stake in Litanium Technologies. And the last one that we've been keeping on our radar today is India Shelter FinCorp. After Kotak Mahindra Mutual Fund has bought 4.2% equity in the company for an amount of 385 crores and Nexus Ventures Partners has offloaded around 4.6% equity in the company.
Long list. Ria, thank you for that update. And just as Ria was describing her stocks that are on her radar, the business update from Prestige Estates was flashing at the bottom of your screen for the June quarter. It's a strong start to FY26 is what they mentioned. Sales are up 300% from last year. That's almost a 4x jump. The collections too are the highest in a quarter till date for the company, which is a 55% increase on a year-on-year basis. Average realizations too have now increased to almost 13,339 rupees. Here's some news also from the aviation space, then India's airline regulator. Just before we get to that, focusing on CNBC-TV18 exclusive, since we are on the subject of stocks, the GAIL pipeline tariff may see an increase of nearly 20%. Sudarshan is here with more details on this. Sudarshan.
So while the stock of GAIL is under pressure, it's currently at day's low down more than 3%, but there is a positive news on the tariff for the GAIL pipeline. So sources indicate that in the upcoming board meet of PNGRB, that is the oil and gas regulator, it might approve an increase up to 20% for the GAIL pipeline tariff. And currently tariff is around rupees 58.59. It can be increased to rupees 70 or more than that. So if you remember, GAIL had submitted its view on tariff, and earlier it had told that its submission had included of rupees 78, around rupees 78. But earlier talking to CNBC-TV18, it had told that if PNGRB approves in the range of rupees 70 to 71, it will be taken positively. Also, brokerage views, if you talk about, Investec is saying that it's hoping for a 20% increase, but as far as its estimates are concerned, that's factoring in 10% increase. Also, Jefferies is saying that if there is an increase of 10%, fair value of GAIL comes around rupees 235 per share, and if there is an increase of 20%, fair value comes around rupees 250 per share. So if in reality PNGRB board goes ahead and increases tariff up to 20% for GAIL pipelines, it would be taken positively.
Interesting. Point of the day, 3.5% lower on GAIL as we speak. Now, here's some news from the aviation space. Then India's airline regulator, the DGCA, has informed the parliamentary panel that it is working on a mechanism to curb increase in airfares during times of high demand. Now, the DGCA has suggested that airlines can fix a price ceiling on certain routes during periods like festivals. Let's take a short break here, but just as we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is the CNBC-TV18 all-new app, where you can get breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen to download the app. Take a short break. We'll be back with more on the other side. Stay tuned. Welcome back. Now in some tragic news, at least 9 people have lost their lives after a section of the Gambhira bridge connecting Vadodara and Anand collapsed in the Vadodara district of Gujarat. Preliminary information indicates that at least 5 vehicles had fallen into the river after the collapse of the bridge. Rescue efforts are currently ongoing, aided by the fire department and local residents. Chief Minister Bhupendra Patel has ordered a technical probe into the collapse. Meanwhile, Prime Minister Narendra Modi condoled the deaths and announced an ex gratia of 2 lakh rupees to the kin of the deceased. With that, we call time on this edition of Business Lunch. From me and the team that put the show together, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Consolidation, that's definitely the name of the game right now. We're seeing Nifty absolutely flat right now. It's up around 8 points as we speak, and it's a very stock-specific market. I hope I'm getting my rates correct as well. Important flash at the bottom of your screen, actually. You should be reading that. Viceroy research report is malicious combination of selective misinformation. That is what Vedanta Group has told CNBC-TV18. They've issued this clarification on short seller Viceroy research report, and this is the reply or response that CNBC-TV18 has received from Vedanta as well. Remember, the stock fell sharply after that report had come out, and Vedanta has responded to that. They call it baseless in terms of allegations, and they are saying without making any attempt to contact us, this particular report has been issued. It's a report that is coming from a short seller, and they are absolutely denying any information that has been presented in this report.
Absolutely right. Very, very important clarification, timely clarification. Remember, like you can see on your screen, actually the stock took a very sharp beating, but post this very important clarification, they're calling it baseless, and they're also saying that Viceroy Research did not make any attempt to reach out to the Vedanta Group before publishing this particular research. It's on their Twitter handle, and which is where most of the market participants have actually picked up. But Vedanta has given a response and a clarification to CNBC-TV18. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks trade ranged as uncertainty over a potential US-India trade deal continues. Consumption stocks and those of utilities manage some gains. IT, metals and realty drag. Mid-caps in line.
Union Bank slumps following a weak first quarter business update that has come by. Loan growth comes in at 6.8%, making it the fourth consecutive quarter of single-digit growth. The stock falls 4%.
JP Morgan initiates coverage on electronics manufacturing with an overweight rating on Keynes Technologies, Syrma and Dixon. Says exports could be the next frontier for growth over the long term.
Hindustan Copper under pressure after US President Donald Trump announces tariffs on copper imports that are aligned with existing 50% on steel and aluminium. All right, those are top headlines that we are tracking for you. The Vedanta stock continues to be on our radar. They say that this report has come in ahead of some financial or corporate announcements as well. So they are calling it malicious and baseless as well. The stock has recovered from the lows, so keep that on your radar. We'll keep getting you more information as and when it comes by. For the markets, as I've been saying, it's in the wait and watch mode, and the biggest talking point, of course, is the India-US trade deal. Parikshit is picking up some updates right now. Let's go to him. Parikshit.
Well, we've been speaking to our sources in the government, and they say that a trade deal with the United States is imminent, but the timeline is now unclear. It is now totally up to the US president to accept India's proposal or indicate that the White House and his economic team will seek further talks from India. One also has to keep in mind the scenario that is resulting because of the deadline, the 9 July deadline for reciprocal tariffs to have been extended till the 1st of August. Now, this means there could be more room for talks on the interim trade deal. And sources are not denying that possibility. While, for the moment, keeping the 9 July deadline in mind, we had negotiated and concluded talks from our side, given our proposal, given the best offer we could make to the United States. Now that this reciprocal tariff deadline has been extended, one can expect the US to seek further talks as well. But it all remains to be seen whether tomorrow or day after the US president will explain whether he wants a trade deal with India or wants to have more negotiations. But on the whole, we have been told that the talks between the two sides have largely been positive, barring a few outstanding issues. And we can assume that these would be around agriculture and dairy. How much does Donald Trump wants to push India? How much is India willing to compromise at this stage? That is something we'll have to wait and see. But perhaps in the next 24 to 48 hours, there will be some clarity on whether we will have this trade deal or whether US will say, yes, we are intending and are committed to having a trade deal with India. But at the same time, let there be more talks till the 1st of August.
Thank you so much, Parikshit, for joining us and keeping us up to date with this all-important trade tariff deal that could happen between India as well as the US. But moving on, remember, this is our special segment, Mid-Cap Movers. Hormaz is standing by the wall to take us through all of the mid-caps that are moving around in this session. Hormaz, a very stock-specific day today.
Absolutely, as has been the case over the last week or so now when it comes to stock-specific action, even as the markets are in almost snooze mode, if you could call it that. We start off with some of the gainers then, and two auto names stand out in today's session. SML Isuzu is one of them. Force Motors is the other one, both trading with gains of close to 10% each. Both of them are trading at a 52-week high in today's session as well. What are also doing well, Global Health and Sami Hotels. Sami Hotels is a post-listing high for the stock, and Global Health too trading with gains of around 6.5% in today's session. Pharma stocks have stood tall today despite the 200% tariff threat from Donald Trump. Mankind is up 4.5%. Laurus Labs is also at a 52-week high today, as is Natco Pharma, which is doing well for itself. Among the underperformers this year, but doing well for itself in today's session. In some of the newsmakers, of course, Vedanta has been dominating the headlines over the last 60 minutes. The stock has recovered from the lows of the day, though, as has Hindustan Zinc. But Phoenix Mills and GAIL continue to languish at the lowest point of the day on the back of some weak news flow, respectively. Stocks that are doing well on the volumes front today, and LG Equipments is one of them. PCBL, Sterling and Wilson is extending its gains now 7.5% higher, and Rossari Biotech is up 4% on very strong volumes. And lastly, some other stocks that are at a 52-week high in today's session. And look at MRF, now worth $1.5 lakh if you could add at a 52-week high as well. Thyrocare, Sirma SGS, a positive brokerage note, and Gabriel India too continuing to build on to gains, another high for the stock today. Back to you guys.
All right, these are some of the stocks which are on our radar. Thank you so much, Hormuz, for joining us as always. Let's welcome Jay Thakkar from ICICI Securities for a technical check on the markets. Jay, good afternoon. Thank you so much for joining in. What is the next important level on the Nifty that we should be watching out for, and what will you suggest?
Good afternoon to you, Sonal. Congratulations and welcome back. And good afternoon to you, Vivek, as well. Well, Sonal, as far as the Nifty is concerned, it's definitely trading in quite a narrow range, a tight range of, say, 25,600, 700 on the upside to 25,400 on the downside. Now, week on week, we aren't seeing any much of the change. The options data suggests that, till, we are holding out 25,500 levels, Sonal, at least until tomorrow, the probability of upward breakout is quite higher. So, Nifty might inch towards 25,600, 700. That is the upper end of the range until it manages to hold on to 25,500. Failing to do so, it might just fall to the lower end of the range. That is 25,400. So it's just 300 points range, which is just a bit above 1%. If we get a breakout from this range, definitely, a new trend will be established. So beyond 25,700, you can expect 26,000 and beyond levels, or maybe, below 25,400, you can see the retest of 25,000. That's how the index is placed as of now. And as far as stock-specific ideas are concerned, definitely, the FMCG pack has taken some lead in the momentum since past couple of trading sessions. And I've got one buy recommendation from the same, that is on Godrej Consumer Products. I mean, it's trading around the levels of 1294 right now. The idea should, or the strategy should be buy now and buy on dips as well. One can add on dips around the levels of 1280, placing a stop loss at 1250. The average would be somewhere around 1270, 1285 or 1290. One can place a stop loss below 1250, and one can target 1370 to 1400 in this July series. And the second buy recommendation, because Godrej has seen a good long build up now, and second buy recommendation is on Varun Beverages. Here I'm expecting a good short covering. There's a good trend line breakout, a positive divergence in the momentum. Since the entry of the stock in the F&O or derivative segment, we have seen a good short build-up. Despite the price reversal, the stock is still has not seen much of short covering. So, it's trading around the levels of 466. I'm expecting a bounce until 485 to 500 in this series. One can place a stop loss below 450 and go long here as well. So there is a good risk reward on Varun Beverages as well.
Well, thank you so much for joining us, giving us your view on the markets as well as your individual trading calls. But before we slip into a short break, we'd like to remind our viewers to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and for the Global Lens at 8:30 p.m.
Welcome back. It's time to focus on IEX. The stock is surging in trade. The government sources have told CNBC-TV18 market coupling reforms is not in itself a big ticket reform for the power sector. Abhimanyu is joining us with all these details. And what does it exactly mean, Abhimanyu?
Now, even as the report on market coupling is submitted by the Grid Controller of India to the CERC is under review, government sources have indicated that market coupling in itself is not that big ticket a reform to be looked at as far as the electricity market is concerned. Government sources pointed out that several recent and upcoming initiatives like electricity futures contracts will contribute to the power sector reforms in India. Now, the multi-commodity exchange is slated to launch its electricity futures contract tomorrow, even as government sources added that it can be looked at that further expansion in energy derivatives market may take place in future as part of power sector reforms which are still being effected by the government. Last month, CNBC-TV18 had reported on sources that Power Minister Manohar Lal Khattar may meet stakeholders to apprise them about the benefits of market coupling and also as and when market coupling takes place, it will happen via a broad bid and not through any internal bid. It remains to be seen how early market coupling is going to be undertaken by the union government, since the initiative has been pending since the past few years, even as there have been indications from the government side that it will be implemented soon, but there is no timeline which has been ascribed so far as implementation of market coupling is concerned.
Thank you so much, Abhimanyu, for joining us and giving us that all-important update as far as market coupling is concerned. Well, just to give a little bit of perspective, when we're talking about market coupling, what does it mean? We're actually discussing the spot power market. The spot power market, we have three players in India. The dominant player, of course, IEX, over 85% market share, also known as the day-ahead market. What actually happens over here is that there is price discovery on these exchanges, and if market coupling is implemented, price discovery will move to a third party. In most likelihood, it will be done at Grid India basis. Now, this particular process, as Abhimanyu pointed out, has been going on for quite some time. The latest development was that Grid India had been given the mandate to go ahead and do a test pilot study, post which they submitted the report to CERC. Now, the CERC report indicates that there may not be too many advantages as far as market coupling is concerned, which is why market is currently reacting the way it is. What is the next step? CERC itself will go through all of the proposals of Grid India, post which there will be a consultation paper. There will be recommendations taken from all of the stakeholders as far as the spot power market is concerned, and post that, CERC will take the final decision. So it's definitely some time away, but this is an important development that Abhimanyu has just pointed out.
Oh, yes, and it's been ongoing for such a long time. So let's see which way things go for this one. Thank you, Vivek, for explaining that to us in detail. That's about IEX, but delivery is also in focus. There's an initiating coverage that has come by. Manglam is here to tell us more. Manglam.
Well, for delivery, it's one of those stocks which has the street always divided, some on the sell side, some on the buy side. Now we have an initiating coverage coming in from Motilal Oswal. They've initiated coverage of the buy rating. They have a target price of 480 rupees on the stock. They say it's India's largest third-party logistics provider, which serves nearly 19,000 pin codes with offerings across express parcels. There's less than part truckload, full truckload, and supply chain as well. They command over 20% express logistics market share. And, Motilal's own estimates account for nearly 14% revenue CAGR over the next 3 years. And they believe the operational performance could be a lot better, with EBITDA growing at 36% and on a favorable base, the net profit growing over 52% as well. So if you look at these numbers, plug that in and look at the Motilal Oswal target price, then it is implied at a valuation of 36 times FY28 EV to EBITDA. So that's what they're justifying as the good growth opportunity here. Just remember, the bear case for delivery, however, is the fact that one of its largest clients, Meesho, has been looking at insourcing their own logistics, so they stand to lose market share out there. And the second part is that at every higher level, because of the high institutional interest in the stock, there is always that liquidity overhang that continues, with some of the other looking at a block deal on delivery. So that's what divides the street. But the fact that it's one of the largest delivery players in the country is undebatable, and as a result of which, some on the positive side.
Thank you so much, Manglam, for joining us and telling us about delivery and what Motilal makes of it. That stock doing quite well in the session today. But before we slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. You're still tuned into Midcap Radar. Well, let's talk about some more operational updates. Prestige Estates came out with its Q1 update just a while back, and it is an all-time high sales number that we've seen for the company this time. Sales are up 300% to come at 12,126 crore rupees. Their sales volumes are up 234% to come at 9.55 million square feet. They've done in a quarter what most companies do in a year, actually. Collections are up 55% at 4,523 crore rupees. The special part about this quarter is that geographic mix has changed. You remember, Prestige is primarily a Bengaluru player, but this time around 59% of their sales have come from the National Capital Region at 59%, Bengaluru just at 21%, Mumbai is 12% and Hyderabad at 5%. Majority of their launches as well, 14.94 million square feet, majority of that is coming from the NCR region this time around. 5.45 million square feet of projects are completed in Q1. So it's a stellar number that Prestige has reported this time in Q1. In terms of their office business, the leasing has come in at 1.21 million square feet and occupancies have come in at 93.7%, which is steady on a quarter-on-quarter basis. For their retail business, occupancies are strong. They have come in at 98.9%. So overall, it is looking like a good set when it comes to the Q1 operational update. And looks like the expansion plans that they have beyond Bengaluru are coming to fruition, because a lot of sales, almost 60%, have come in from the NCR region this time around. So Prestige is in focus on the back of that. Let's talk about other set of realty names. Godrej Properties, Phoenix Mills, both of them are in focus. Nomura has initiated coverage on both these stocks. Both of them are under pressure. Now they have initiated with a reduce on Godrej Properties. The target is at 1,900 rupees a share. They are worried about their pre-sales momentum. It is weaker than what the street was working with. Valuations are looking stretched on the stock as well. They expect FY26 pre-sales to come in at 31,000 crore rupees versus the guidance of 32,500. They are looking at volume-driven strategy, the company that is, but that is not working so well for the company. They expect execution challenges to come by, and this is visible given the deliveries which are delayed by the company as well. For Phoenix as well, it is an initiation on a reduced rating. The target is at 1,400 rupees a share. They see slow consumption across mature malls. So whatever consumption growth is coming in, it is coming in from the new malls that the company has come up with. They expect ramp up to come by only in FY28. Valuations again for this stock also seem stretched. So that is what they don't like right now. So far, it has seen a 40% CAGR in terms of retail consumption over the last 3 financial years. They expect it to reduce to 9% in FY27 and 11% in FY30. So high double digits to low single digits or high single digits is what they are expecting now. And that is the reason they have a reduced rating on the stock.
Both the stocks reacting today. Godrej Properties down 2%, Phoenix Mills down over 3%. But moving on, the EMS space continues to remain a hot one. JP Morgan today has initiated coverage on quite a few stocks within the EMS basket. Upasana joins in with more details.
Well, EMS sector continues to remain in focus today as JP Morgan has initiated coverage and recognized this sector as the sunrise sector with a strong revenue CAGR of nearly about 32% for the next 5 years. It says that this growth will be mainly led by rising electronics content in products, Make in India push, and even realignment of global supply chains to India, with China Plus One strategy playing out. Now, they have recognized 2 emerging opportunities in this sector, that is OSAT and PCB, while exports could be the next growth frontier, is what they have said. Now, in terms of companies, they've given an overweight rating on Syrma, Dixon Tech, and Keynes Technologies, and it targets 800 price target for Syrma, 17,700 for Dixon Technologies, and 7,115 for Keynes. While on Amber and Sign DLM, it has given a neutral rating and underweight on Avalon Tech. The target price for Amber, the JP Morgan has given, is around 7,350 for Sign DLM, 450, and 650 for Avalon Tech. Now, in terms of key growth triggers of the top 3 companies on which the brokerage is overweight on, firstly, coming to Syrma, it expects the exports to make a comeback from FY27, due to which it expects a growth acceleration and margin expansion going forward. For Dixon, it believes that it will be mainly a mobiles, which is the key segment of the company, mobile-led growth until FY27, and after FY27, the company's non-mobile segment will pick up. Keynes, it expects the fastest 46% revenue CAGR of over FY25 to FY28 with a target of nearly $1 billion of revenue by FY28. And overall, for Syrma, Sign, DLM and Avalon, it believes that the export could be the next growth frontier over the long term. And overall, it expects a 3 times 3-year rally and demanding valuations in the sector, which is leading to an earning upcycle, is what the brokerage has said. So overall, it remains positive and bullish on EMS sector. Hence, it remains in focus today.
Okay, makes sense. Thank you so much for joining us with all those details, Upasana. For the markets, very stock specific right now. So something like a Metropolis Health should come up for you on the screen. Reported its Q1 update on Monday or over the weekend actually. That stock is picked up 5.5% right now. VIP is up 4.5%. There's Wockhardt 4%. Some of these pharma names or the healthcare space names are surging in trade. There's Natco Pharma 4% higher. We do have the chemical stocks doing well as well. So something like a Coromandel International. There is Rosari Biotech, PCBL, all these stocks are surging in trade. So the pharma and chemical space continues to be in focus. The expectation is chemicals could see some recovery in Q1.
Pharma, remember, yesterday it was a weekday. There was a Macquarie downgrade note on quite a few of those names, and there was a multiple cut across the sector. Today morning, we actually came in with some negative news as far as pharma is concerned, with Donald Trump saying tariffs could be as high as 200%. But despite most of those concerns, the entire sector today has recovered quite sharply. A couple of stocks that are actually trading quite weak. The number one is actually GAIL. So GAIL is almost 4% lower. Now, remember, our colleague Sudarshan did tell us in the morning that there could be tariffs in the range of close to Rs 70 per MMBTU. And despite that, the street doesn't like the fact that there could be a delay. Now, the back of that, GAIL down almost 4%. Some of the other oil and gas names, too, names like BPCL2, now trading near the day's lowest point. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon and welcome to Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, range-bound trading session. That's what is going on even the markets right now as well. 25,500, just about that mark is what the Nifty is managing to hold on to. Flip-flopping between the red and the green today, but typically in this range is what we've seen it move in this week as well. So nothing exciting happening, but broader end of the market. I want to pull up the Nifty small cap because that's where all the action seems like it's there. Nifty small cap is up almost 0.7% in today's trading session as of now. Day's highest point is what we're seeing the Nifty small cap at. Nifty Bank on the flip side, not managing to hold on to gains as well. Very, very flat in today's trading session. So that's something we'll keep an eye out on. And mid cap also is flip-flopping between the red and the green as of now is what we're watching out for. Now, other than that, in the small cap space, like I was saying, right, that's the one that's moving in the trading session. So we have Global Health among some of the names in the broader end of the market. We have Philip Carbon, we have Sterling and Wilson among the names that are buzzing in today's trading session. Niva Bupa also, that seems like has picked up pace as well since the last time I checked. So Niva Bupa is something that we should be watching out for. It's up 6% approximately as of now as well. So that is something interesting that we'll keep an eye out on. But this is a show where we solve all your stock-related queries, and that's what we'll be doing with our experts today. Our Jain, research analyst at HIM Securities, as well as Saumil Mehta from Mirai Asset Share Khan joining in with us to just help us solve all your stock-related queries that you all have sent us. Asta as well as Saumil, good afternoon and thank you so much for joining in with us as always. Saumil, a quick check is what I want to do in terms of the charts and technicals because range-bound is what the Nifty has been and nothing exciting is happening in the last few days. What are we watching out for? Is this how the market will be in the next week as well? Or maybe something that we could hope for a up move or a down move?
I absolutely agree. Afternoon to both of you. I absolutely agree. Nothing is happening. Nothing exciting is happening in the market. It's been very, very range bound. We've seen a very good rally from 24,500 levels to 25,700 levels in the last couple of months. But last couple of weeks has been very sideways. And I'm expecting this small consolidation between 25,300 and 25,700. This small consolidation to break on the upside. So my view is positive. Buy on decline should be the strategy. And my short-term view for Nifty, short-term targets for Nifty is 25,900. Medium-term targets are definitely higher, 26,200, 26,300. Same with Bank Nifty. My target for Bank Nifty is as well 58,000 for short term. So yeah, buy on decline should be the strategy. Short term and medium term view both positive.
Okay. Short-term and medium-term view is positive there. But on that note, let's get started with the stock-related queries for today. The first query for today is coming in from Bala Subramanian, who's writing to us from Bangalore. 30 shares of ACC is what he's holding. This is at a price of 2,561 rupees. Average cost is that. Currently, the stock is trading at 1,990. He's asking if he should continue to hold the shares for another year. So 12 months is his time period of holding now. Asta, your view coming in for ACC. What are we watching out for here now? Nothing much has happened and they're making a loss on this one. Would it merit or in the next 12 months? Is there anything going to be changing for ACC now?
Hi, good afternoon to everyone out there. So talking about ACC, I think the major reason behind the soft performance in the quarterly number was, yes, we have seen a volume-led growth of around 14%, but there was a miss on the realization part because there was a weak realization. So I think that was the major reason we were not able to show very strong performance in the stock prices as well as the company's financial performance. Going forward, I think the capacity expansion is on the track, and that is the major point where we need to keep our eyes on. So my idea here is to stay invested in this counter for at least 3 to 4 months coming, because till that time also we'll get to know Q1 FY26 numbers. So idea here is to stay invested in this counter for the price target of 2,050 to 2,100 at the initial levels.
Okay, keeping an eye out on those levels over there. And ACC on the charts and technicals, what are we watching out for there, Saumil? Not much of a move in the last 1 month specifically, just almost 4% return kind of a situation that's coming for ACC. Charts, is there an indication of an up move now?
ACC has been struggling to go above 200 daily moving average for a very, very long time. The last time it went above 200 daily moving average was in last year, November. So I think from here, at least for medium-term outlook, still remains negative till the time it does not close about 200 daily moving average, which is at 2035. So any close about 2035, that will be a bullish sign for the stock, and then we can revisit this stock and start accumulating. But below that, below 200 daily moving average, I would suggest to avoid.
Okay, avoid coming in there. Next query for today, we have a caller query that's coming in. Jyoti is on the line with us from Mumbai, and she's made an investment in Ola Electric. Jyoti, good afternoon, and go ahead with your query. What do you want to ask our experts?
Yeah, hi, good afternoon, everyone. So I have invested in Ola Electronics at around 130, 200 shares. I'm sitting with a loss. Just wanted your advice if I should continue to hold, because already sitting with a 70% loss. So I'm not sure if my entire capital would be eroded, or I should still hold and wait for the stocks to rise.
Okay, and you want to hold it for the long term, short term now?
Yeah, it is a long term, but
whether it merits holding or not.
Yes, right.
Okay.
And if I have to sold this stock, then any other optional stock where I could invest.
Okay. Thanks for the query, Jyoti. Astha, your view coming in, Ola Electric, right? It has had those turbulent times as well, and Jyoti is making a significant loss on this one. So what should she do? Does it merit holding? Do we expect any better performance coming from Ola Electric in the next 12 months at least? They're willing to hold it, but if it merits holding, and if not, then what should they be looking out for? Any other stock that you would suggest?
So the problem with the counter is that, first of all, the negative cash flows, there is a pressure on the sales, and they are continuously losing market share. So amid all this chaos, I think the stock is not able to perform in a decent manner, and that is what we are also seeing right now. My idea here is to exit from this counter, not fully, but start exiting, in the partial way, and make entry into any other automobile space. In that, M&M is looking good to us. Although M&M has risen a lot, but I still believe that there is a chance for this counter to show more upside from here. So I would prefer that start exiting from this counter in the partial manner, like 25% of the quantity at the current price, then remaining 25% of the quantity at some higher prices, in case if stock shows some upside momentum. But don't wait for a long in this counter, because I think right now losing market share as well as the financial performance is not in favor of this counter. And M&M is looking good to us, so we believe that she can move to other automobile space as of now.
Okay, you can look at other automobile players. That's a word coming on the fundamentals. Technicals also, Somil, anything different, or better to just get out right now?
I absolutely agree. Not a good counter to be in at this point of time. I've been negative on the stock for a little while. It's been struggling to go about 20 and 40 daily moving average. So definitely exit from the stock. My preferred stock in auto space would be Hero MotoCorp at the moment. A small triangle pattern has been forming. Short term, medium term, both looks good. We've seen a very good correction in the last 6-7 months since last year. So I think correction is already done. It's just time a correction going on, and it's a great time to buy the stock.
Okay, Hero MotoCorp, that's the word coming in there. Jyoti, I hope that answers your query as well. Get out of Ola Electric. Astha said M&M, and Somir also said Hero MotoCorp. Next query for today is coming from Pranav Bala, who's writing to us from Pune. He has an investment query. He's asking if he can invest in Amara Raja, and this is for a time period of 12 months. Astha, your view coming in for Amara Raja batteries. Obviously, given that there's so much change happening in the industries as well, but at one point of time, there was a lot of focus coming in on these battery companies. Amara Raja batteries, what's your view?
So yes, view is positive, but idea here is to make entry at the lower levels. If I talk about this counter, what we have seen is the steady performance, and in fact, their capacity expansion in the energy projects is also working well. However, the results were not very good, because what we have seen that there was a pressure on the raw material cost, and hence results were not in that favor. But I think they're moving towards the energy projects will definitely give a way to this counter. So in the long term, yes, this counter is looking good to us. Make entry, but at the lower levels of around 950 or 920 odd levels for the price target of 1050 to 1060 at the initial junction.
Okay. And Amara Raja Batteries, your view coming in, Somil, is it a good time to enter right now or maybe wait for some bit of a time?
I think overall, if you see the trend in the long term, it's definitely positive. In the medium term outlook, it is struggling to go about 200 daily moving average. However, in the very short term, there is a small ending dangle pattern formed, and I think I'm expecting this pattern to break on the upside. Stop loss should be 950. The target should be towards 200 daily moving average, which is 1070. Once it closes above 1075, I think the next medium term to long term outlook rally should start for a target of 1500.
Okay. Keep an eye out on those levels over there for Amara Raja. Let's move on to the next query. This is coming from Jyoti Khurana, who is saying that she's holding 50 shares of LIC. Price is 600 rupees per share. Wants to know whether to hold or look to sell at the current levels. Her buy price is 600. She's making a profit on this one. Asta, what's your view coming in for LIC? Does it merit holding LIC now? And she's making a profit on this one.
I think it does merit holding this counter from the longer term perspective with a price target of 1050 to 1090. So overall, we can say that 1100 is our ultimate price target for this counter. Now, if I look up to the fundamentals, first of all, what we have seen is a good sales, and in fact, their VNB and the growth in the AUM is also being witnessed in the numbers which they have posted. Going ahead, also now the non-par business, which is the high margin business, it has started contributing very well, and in fact, what we are seeing that this business is growing at a growth rate of 50%. So overall, this counter is still looking good to us. We believe that it is well poised to move till the level of 1100. So hold is recommended from our side for this counter.
Hold recommended from your side for LIC. So, Amil, on the charts and technicals also, what's your view coming in? Because seems like, after 2025 has been a better year for LIC versus 2024. And we're seeing at least some bit of that up move that has started coming in for the stock, especially since February around that mark. We're seeing a better move. On the technicals also, does it merit holding the stock?
Absolutely. For a medium to long term outlook, should hold on to the stock, not for short term. Short term, I'm still expecting a sideways correction, a small correction till 900 levels. But in the medium to long term outlook, I totally agree with Asta for the targets of 1100 levels. It could definitely go above that as well. But at the moment, 1100 should be the target.
Okay, 1100 should be the target, medium-term outlook coming in for LIC over there. But on that note, we're actually going to sip into a very short break, viewers. So do remember that you can always tune in to CNBC TV18 Prime as well, because that's a new launch that's coming, and we're bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to your stocks on CNBC TV18. We still have with us Asta Jain as well as Somil Mehta to solve all your stock-related queries. Let's move on to the next query for today. It's an investment query that we have coming in. G.H. Rao is writing to us from Vijayawada. He's saying that he wants to invest in BSE at the current levels for a time period of 2 years. Asta, BSE, what's your view coming in? You know, there's so much happening right now on that front as well. And the last few days, we did see that correction coming in. There's a lot of announcements coming in from SEBI front as well, or what we understand also coming in from their side. So what should one be doing with BSE now? Should they look to enter BSE for a 2-year time period?
So not right now, maybe at the lower level, because right now also we are seeing the kind of environment and the news flow which is going around this counter. So it is a little bit volatile. So idea here is to invest at the lower levels of around 2400 to 2450 with a price target of 2750 to 2800 at the initial level. Meanwhile, I think till that time also we will be able to see the Q1 FY26 numbers. So overall, I think the shift in the expiry, we really need to see how this pan out for this counter, which we have seen as a news flow that there's a shift in the expiry date. So how the volumes are affected, we really need to see that thing. And hence our idea is to wait for making a fresh entry into this counter and we make entry at the lower levels.
Okay, make entry at the lower levels. And on the charts and technicals, you know, Somil, BSE, is it a good time to enter, or would you also say just wait out for a bit before you actually enter the stock right now, given it's trading at 2,500 and in the last 1 year also we have already seen such a good up move. So what should one be doing?
Absolutely. I mean, wait for a little while. Since March, the stock has gone up more than double, I think. 1,230 was the bottom, and very recently the top was around 3,000 levels. So more than double. I'll be expecting a small correction here. It has already started low top, low bottom formations. It has given a close below 2040 daily moving average after a very long time. So a correction is due, definitely, and it's very normal. I'll be expecting this stock to go down till 2,300 or 2,100. These are the levels to watch out for, and probably that will be the right time to go ahead and buy the stock. Not right now. Price-wise correction and time-wise correction, both are expected.
Price-wise, time-wise correction, both are expected. 2,100 to 2,300, around that level, maybe one could look at buying. So not right now. Wait out for a bit because you're looking for the long term. That's the word there. Let's move on to the next query for today. We have Sri Hari, who's writing to us from Chennai. He's holding 500 shares of Kalyan Jewellers. Buying price is 550 rupees per share. The future prospects of this one. Asta, yesterday we had Titan also that reported its Q1 update. Now, obviously, Titan wasn't as good as what in terms of the growth that one saw coming in for Kalyan or Senco. So the viewer is holding Kalyan Jewellers. Would you say that they should continue to hold Kalyan Jewellers?
Yes, because the Q1 of FY26 updates that were released by this company were very optimistic because they have shown a 31% growth in their domestic sales due to the good Akshaya Tritiya season and the wedding demand. In fact, international business has also shown the growth of around 31%. They have launched 8 new Kalyan showrooms in India. So overall, what I believe, the way this company is posting a strong growth in the international as well as domestic business, it is worth praising, and we believe that definitely this will have a positive impact on the financial performance also, which we will be awaiting now as the result season has already kicked in today by the TCS coming out. So overall, I think it's better to wait for this counter with a price target of 610.
Okay, waiting out for the price target over there as well. TCS, Asta, we have still one more day for TCS. Tomorrow is the numbers, but yes, it's all in action. But yes, it's around the corner now. So we will wait out for the numbers before you take that call. Somil, your view coming in for Kalyan Jewellers as well.
Kalyan Jewellers, definitely positive medium-term outlook in the short term as well. In the very short term, probably a small consolidation is going on, and I'll be expecting this consolidation to break on the upside. Supports are around 570, very close, and 200 daily moving averages at 540. I'll be expecting this stock to go till 650, 670 levels in the medium-term outlook.
Okay, 650, 670 levels in the medium term is what we could expect in Kalyan Jewellers. Keep an eye out on those levels over there. Next query for today is coming in from Kanan, who's writing to us from Kerala. He's holding 500 shares of Trident, and this is at an average price of 37 rupees per share. Short-term outlook for the stock. Trident Limited, you know, it's one of those textile players that come in over there, I believe. Asta, your view for Trident, what should they be doing? They're making some bit of a loss here, but as such, not much of an action that we're seeing here.
Yes, but I think the way now management is sounding very optimistic. They have a plan of around rupees 250 billion by clocking rupees 250 billion by calendar year 25 with the 12% profits. And in fact, they want to make it as a national brand. So I think all these efforts which will be taken by the management, and maybe they are taking it right now also, can yield some good results in the financial performance of the company. And hence, we can see a positive momentum in the stock prices as well. So overall, my idea here is to continue this counter with a price target of 37 at the initial levels.
Okay, price target is 37, which is the buy price. But yes, they are doing a lot of action. That is what Asta is highlighting. So keep an eye out on this one. Your view, Somil, coming in on the charts and technicals for this stock as well. Last 1 month, seeing some bit of that up move that has come. But will this continue in the short term?
Absolutely. Short term looks great. Just about 200 daily moving average. We've seen a very good move yesterday. I think it should continue the uptrend in the short term. Stop loss should be 30.50. And the target, the first target would be around 34 levels and then 37.
Okay, keep an eye out on those levels over there for the short term. You can maybe see it coming at least towards your buy price as well. 34, 37 marks is around what you know, our experts have highlighted. But with that, you know, we're actually absolutely out of time on this edition of Your Stocks. So thank you so much, Asta, as well as Somil, for always joining in with us. And viewers, thank you so much for tuning in and always sending us your queries. But do not forget that you can always email us your queries. At email IDs at the top of the screens for you all right now. So send us your queries. We'll solve them every Monday, Wednesday, and Fridays with our experts. But with that, it's a goodbye from myself as well as the team who put the show together. Don't go anywhere. The last hour of trade, you'll have closing bell to take you through all that market action.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng is a bit of an underperformer today, almost 1% lower.
I believe the tariff on copper, we're going to make it 50%. And we'll be announcing something very soon on pharmaceuticals.
So the support 25,331 on the downside. The resistance comes in at 25,669.
I think, it's going to be a mixed bag. I'm certainly not rushing out to buy pharma names on this news.
The market opened absolutely flat.
High volatility, high beta stocks have done well. Momentum has been the better performer over the last couple of months.
Our pharma industry has a large footprint in the US market. The generic industry has a large footprint.
Sensex is absolutely flat. Mid-cap slightly outperforming.
Mid-cap fund flows are up almost 33%.
Consolidation, that's definitely the name of the game right now. We're seeing Nifty absolutely flat right now.
And flat has been the story so far this week, and for the better part of today, you're with us on Closing Bell. And of course, as always, we're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay, and a bit we'll have Prashant and Rima join me as well. But it's been a flat day. The bias has been negative. And right now, we're looking at, once again, about a 30-point cut in the morning, which was the situation of the morning. We started lower. Then there was some attempt at a recovery, but it wasn't, it wasn't really sustained. And like I said, the index has spent the better part of the day around the flat line again. So let's take a look at where this slight Nifty weakness that we're seeing, where it's actually coming in from. If I look at it, the movers and shakers on the downside, about Tata Steel, HCLTech, Hindalco, BEL, these are some of the names that are the biggest drags on the index today. And in terms of the contribution, you can see over there big stocks like ICICI Bank, Reliance, L&T. They're responsible for some of the weakness. Though we do have the FMCG names, which are still continuing. Actually, consumer and FMCG, that's been the only theme that's worked so far this week. And we're seeing some more evidence of that. HUL, for instance, is up and about. Some of the NBFCs are actually having not a bad afternoon. Look at Shriram Finance, 2% up. Bajaj Finance is up a little over 1% as well. So that's pretty much where the story is. Beyond that, it's all, like I said, it's all FMCG. There's Nestle, there's ITC, Asian Paints. So plenty of consumer names that are still finding traction. So yeah, that's the story. Mid-cap index has also been flat for the better part of the session. Right now, the mid-cap index is looking at a cut of about 0.2%. There you see, days low on the mid-cap index. Bank Nifty, absolutely flat. Not really getting any sense of direction from any of the indices, you would have to say. The advanced decline ratio, that's something that's a little better than yesterday, because we had, far more many declining stocks than advancing stocks yesterday at the same hour. Today, that situation so far held up. We had more advances than declines, but now the lines are coming very close to each other. So let's see what the last hour brings. We'll talk about the individual stock level action in the mid-cap arena. I'll just give you an example of that, a snippet of that. For instance, look at the EMS companies, names like Dixon, Sirma, Keynes. This whole pocket is quite active today because of a JP Morgan note. JP Morgan has initiated coverage in the sector, the EMS players. And these are some of the stocks that it likes. So there's some green over here. So therefore, news flow is driving stocks. And we'll talk about that as we go forward. But let's start with the strategies for the last hour. We have Mitesh with us as always. Mitesh, good afternoon. What do you make of the session today? Once again, very choppy, very range-bound, tight range. What's the understanding now for the indices?
Yeah. So, my sense is that, and I've been maintaining the stand that the Nifty is still in that big process of contraction. The hourly, 2 hourly, and the daily charts are all turning sideways in the sense that the indicators are flat, the averages are turning flat. So not much action is happening on the index. And I still believe that this is a process, the way the charts are shaping up. This process could possibly extend for next few days. So avoid the index. The counters have already defined 25,200 to about 25,650 is the range. And on the stock side, I have a buy on Container Corporation of India. that's something which has had a good move today. So buy here at the stop below 603 and look for a target of 630 to about 635, while a sell on Bank of India with a stop at about 117.3 for targets of around 100.
Hey, just hang on for a second. There's suddenly a bigger drop on the index. Pull up the Nifty intraday and pull up Reliance. Reliance single-handedly has pulled down the Nifty an additional 20 points or so in the last 10 minutes since we've spoken. Let's pull up the Nifty intraday and so that's the Nifty intraday. That's what happened. And then I was checking for what the reasons could be, and it's Reliance. Look at that stock. Pretty dramatic, that kind of a fall. 12 rupees suddenly gone in a matter of 10 minutes or so. Mitesh, any thoughts here? And once again, just the Nifty levels that you're tracking, and also Reliance, exact similar moves, Reliance dragging the index down.
In fact, Reliance is one, which has just dropped off in the last 30-40 minutes. You look at the chart pattern, there's a negative rising wedge, and the stock is also roasted on the hourly charts. My sense is that 1510 to about 1500 is the first support area. If it breaks that, then we'll look at 1470. But in the short term, I think it's slightly headed negatively.
Okay. All right. Thanks for that, Mitesh. We've got Rima joining in as well now. Let's see if Rima can bring us some luck, because otherwise this has been such a lackluster market. But we don't know. I mean, let's see if the range breaks on the downside, Rima, because we've been in this tug of war right from the morning, looking a little tentative right now.
But at least for the first time, you're seeing a 40-point move in a span of few minutes, right? Like, when was the last time in the last 1 week that you saw even this kind of volatility? It used to be par for the course.
Yesterday, after 3 o'clock, because we had the Sensex expiry, so we had a little bit of a flutter. Otherwise, it's almost like, I keep using the word comatose. It's just not moving the market.
It's a fairly dull market. But let's talk about individual stocks. That's where all the action is. IEX is surging after the government sources told CNBC-TV18 that market coupling reform is not in itself a big-ticket reform for the power sector. So a bit of a sigh of relief coming in from IEX. Abhimanyu is now joining in with the details.
Now, even as the report on market coupling submitted by the Grid Controller of India to the CERC is under review, government sources have indicated that market coupling in itself is not that big ticket a reform to be looked at as far as the electricity market is concerned. Government sources pointed out that several recent and upcoming initiatives like electricity futures contracts will contribute to the power sector reforms in India. Now, the multi-commodity exchange is slated to launch its electricity futures contract tomorrow, even as government sources added that it can be looked at that further expansion in energy derivatives market may take place in future as part of power sector reforms which are still being effected by the government. Last month, CNBC-TV18 had reported on sources that Power Minister Manohar Lal Khattar may meet stakeholders to apprise them about the benefits of market coupling and also as and when market coupling takes place, it will happen via a broad bid and not through any internal bid. It remains to be seen how early market coupling is going to be undertaken by the union government, since the initiative has been pending since the past few years, even as there have been indications from the government side that it will be implemented soon, but there is no timeline which has been ascribed so far as implementation of market coupling is concerned.
Thank you, Abhimanyu, for joining in. Prakash, the flip-flop on IEX and if market coupling is coming or not coming continues. Before now, there seems to be at least positive news for IEX. You want to share your comments on IEX and generally what have you been doing in this, market? Have you been buying anything or just sitting out? I mean, what have you made of this consolidation?
So let me take the IEX thing out of the way. Very simply, this will keep on happening till market coupling gets a decisive, outlook. But what's important is that people have to accept the fact. Just 1 second. People have to accept the fact that you cannot have a market which is dominated by just one player. So either there will be multiple players coming in, or you'll probably see some sort of a rationalization of what sway IEX holds on this entire market. From that perspective, it's going to be good because the overall market gets a fillip to grow in scale, Rima, and that's always good for exchanges. In fact, we've not reached optimal scale, and that's exactly why it's hurting IEX every time something like this comes up or the thought of something like this comes up. So I would believe give it some time, let the market build up. There's a new power policy that's a blueprint that's been shared, and that involves a lot of play that exchanges will have going forward, a meaningful sense. So I would rely more on that from a secular growth perspective rather than these ifs and buts on market coupling. What have we been doing? We've been enjoying the weather. The market's been giving you wonderful opportunities to look at a lot of businesses to be evaluated. And there's this whole host of primary issuance which came through the IPO route in the last, let's say, 12 months, where some of these opportunities would start looking very promising once the levels, the price equilibrium decides on optimal levels of these stocks. Great businesses which are now available, very new kind of businesses, market leaders in some cases. So, there's a whole host of opportunities if you look slightly harder, if you work slightly harder and look beyond the surface. So I would believe those are things that will promisingly come to the fore. We haven't allocated any fresh monies to defense, to cap codes, or to things like which have been very good performers all this while YTD. But BFSI is probably one space which looks promising, at least in terms of the next 12 months of allocation. But no autos, no defense, no cap goods, so all these players stars of the last 1 year probably will take some backseat in terms of the portfolio churn that's evident when fresh money is coming.
Okay, so not running after the recent stars, so to speak. Prakash, we're going to ask you about one such pocket that's also been a recent star, and I'm talking about the EMS space. We'll just allow you to collect your thoughts because there's this JP Morgan note, right? So we want to, take it to Upasana first to tell our viewers what is JP Morgan's thesis. Now, these stocks have already done very well in the market. They've run a lot. But JP Morgan has now initiated coverage, and it likes several of these names, including Dixon and I think Sirma as well. But Upasana, you tell us more.
Well, certainly, JP Morgan has recognized this sector as one of the sunrise sector and hence has initiated coverage on this sector with a strong estimate in terms of revenue growth at a rate of 32% CAGR for the next 5 years. It says that this growth will be mainly led by rising electronics content in the products, Make in India push, and also realignment of global supply chains to India with China Plus One strategy playing out. It has also recognized two new emerging opportunities such as OSAT and PCB, while export could be the next growth frontier is what they have highlighted. Now, coming to companies first, it has given an overweight rating to Sirma, Dixon Tech and even Keynes. The target price for Sirma, it sees around 800 per share, Dixon at 17,700 per share and Keynes at somewhere around 7,150 per share. While on the flip side, it has given a neutral rating on Amber and Cyan DLM and underweight rating on Avalon Tech. Now, target for Amber is 7,350 per share, Cyan 450, while Avalon at 650 per share. Now, let us look at the key growth triggers highlighted by the brokerage in terms of the three companies on which the brokerage is overweight on. Firstly, Sirma, it expects the export to pick up FY27 onwards, which will lead to a growth acceleration and even margin expansion is what the brokerage has highlighted. For Dixon, it believes that the company's key segment, that is the mobile segment, will drive growth until FY27, and beyond that, non-mobile segment is likely to pick up. Keynes, it sees the fastest growth at a CAGR of 46% from FY25 to FY28 and also targets revenue at $1 billion by FY28. Now, for Sirma, Cyan, DLM and Avalon Tech, the brokerage believes that exports could be the next frontier of growth over the long term. And overall, a 3x times 3-year rally and also demanding valuations is likely to see earnings upgrade and upcycle in this EMS space is what the brokerage has highlighted. So overall, JP Morgan remains positive on these companies and has highlighted it as one of the sunrise sectors.
Okay, all right, Upasana, got it. Thank you very much for that. So JP Morgan sees more triggers ahead, more growth opportunities, including probably the export markets in a bigger way. Prakash, now I don't think anyone can argue with that. The only issue is how much is already in the price, right? Because the stocks have had a great journey. Your thoughts?
Yeah, absolutely. You're right. See, while we do love to categorize these businesses as sunrise, it's no more 6:30, 7:30 in the morning. It's already past 10:30 for their growth as well. So, at some point we will realize that competitive intensity, market saturation, market segmentation will start playing out within the dynamics. And if export orientation is what the focus is or the trigger is, remember we are in such a world where overnight anything can happen. Export disruption or potential disruption is a reality. So I would really not bet too much on that. Yes, but there are performers like Keynes which are talking about super growth for the next 3 years, and some of them might make sense at lower valuations. There's a lot of hard work that the brokerage has put in terms of researching this space, and it's great to read such incisive, insightful stuff. But whether to buy it at these levels is a question that individual investors will have to answer given their risk appetite. But the valuations are definitely stretched. It's all relative. You've seen them at higher valuations. You probably find these valuations softer, but they probably deserve to be even much more softer. So I'm a value investor, and I would be willing to wait to buy into some of these, not because of the fact that things are changing dramatically, but things are the same. It's just the right valuation that will fetch you better rewards.
Prakash, you said that you've been enjoying the rains and also analyzing some of the recent IPOs.
Yes.
So which one caught your fancy? Which one did you invest in?
No, so we are still, as I said, when we started this exercise, we thought, we could identify some good names, allocate some money. But the surprising thing is there's so much more to kind of, choose out of. It's a whole buffet out there where, whether it's housing finance companies which have got listed, it's some of these engineering companies which have got listed. Some of the companies in the renewable space which are there. Quite a few of them are very small, so I would refrain from discussing those on air. But what I can tell you is just a case in point. It's again an illustration, no recommendation yet. But there's a company which got listed in February of this year, if I'm not mistaken. So that's very recent. And it's into self-loading concrete mixers. Now, SLCM, as they're called, is something which is, this is in use everywhere, wherever construction happens, whether it's roads, buildings, and that. And this company owns almost like 75% market share. It's a company by the name of Ajax Engineering. So, you will find some of these very interesting businesses. And as I said earlier, some of them also enjoy leadership position, very good ROCs, very good ratios. It's just whether, the growth is sustainable or not at these metrics. But having said that, again, post IPO, there's always a little bit of a time that you have to give to businesses for the price equilibrium to be derived. And once you're satisfied with the growth expectation and the pricing, then you probably have a good match. But I can leave you with this thought that the newer businesses that have got listed are what are attracting our attention in terms of there are companies which are into pharma but very specialized with dyes and color, pigments. So this is not run-of-the-mill stuff. That you're not adding one more company which has so many Me-Too plays already in the sector. So that's where we are talking about. Hopefully, we'll be able to narrow down on sometime soon.
I remember this company, I think it had a market share of 75%. So clearly a leader in the segment.
These are those big cement mixers that you see going all over Bombay, around the roads. I mean, I'm not sure. Self-loading concrete cement mixers.
Yeah.
So these are regular cement mixers. Very, very curious. I mean, and since the stock came in at 600, since Prakash mentioned it, I started looking at it. IPO happened around 600. It's at 700 now.
Yeah, so that's what I'm saying. So even it made some high, I don't know when, sometime in the month of May, it's rationalized out beyond that. And remember, of course, it has a peculiar nature of its shareholding. There's still about 5% which promoters will have to dilute because they own 80%. So there's a bit of an overhang, and all those technicalities will be there. But what I'm, why I'm using this to illustrate is the kind of businesses that you have, which are very interesting, right? And there are some metal cutting machine tool manufacturers. Now that is so specialized to me that you'll be surprised. No defense project can do without these machines. And there are very few players who actually have an established track record to supply to these defense players. So there's going to be a host of newer businesses within the listed space, and I'm always excited. Companies which come through the IPO route, give you a fair chance for everybody to buy it, at more or less the same levels and from a time perspective. So, it's kind of easy to identify businesses which you would like to go along in the long term. But yeah, there's lots that's happening in this space.
Prakash, you like Ajax?
Yeah.
So we'll wait to of course deep dive into it, Prashant. But yeah, it is definitely something which caught our attention. It's fairly interesting.
And their market share, you said, the market share is 70%, what, across India?
Yes, that's what I'm saying. See, what happens is the way these businesses have grown, and it's, by the way, it's not a very recent startup or some business that just come out last 8-10 years. They've been around for 30 years plus. So they understand the market, and there is, of course, the business growth is likely to come more from the after-sales service, the spares, and the hydraulic parts, and units that get fabricated and things like that. But once you have a USP, a moat, it becomes extremely difficult for others to kind of just come in and upset the apple cart. So you need visibility of growth, and that's what some of these businesses.
No, absolutely, but I must put out the caveat as well, because we've spent a very good long time talking about this company. But like Prakash is saying,
Prakash
he also
has still not told us whether he likes it.
Yeah, he's saying he has to do more homework on this, right?
It's interesting, but is he interested? He's not told us.
he's saying he'll do a deeper dive, perhaps.
Prashant, I'm much lazier than most, so I take some longer time to decide. So
you're not lazier, Prakash. You're wiser. You're on Goa enjoying rain. That's wise. That's being wise. So,
hopefully that's a coincidence.
Thank you very much for joining us, and appreciate you joining us with some of those insights. It is surely an interesting sort of environment. Lots of newer businesses making it to the market. We'll take a quick commercial break here. We're going to come back with Dinshaw Irani, who's joining us. Dinshaw, of course, is another wise man from Helios Mutual Fund on the other side. Dinshaw Irani is now joining us. He's CEO, Helios Mutual Fund. Dinshaw, great to have you with us here on the program. Thank you very much for joining us. Markets have quietened down significantly last 10 days, haven't they, Dinshaw? I mean, you look at the screen every day, look at, it's kind of much quieter.
Prashant, thank you for having me on your show, and a very good afternoon to you and your viewers. Yeah, you're right. I mean, the markets have probably, I think they're in the consolidation phase. And frankly, I mean, our feel was that they will remain so. Basically, the call was that the quarter is not looking good. I mean, the June quarter. March was a disappointment. June looks another disappointing quarter. And unfortunately, it's going to be kicked off by the tech names. And I don't think the tech names are going to light up any fire in the market that way. And secondly, the trade deal, which has been a total overhang. I don't know what's going to happen here. Every day we hear that they're a couple of hours away, and it's like, what, couple of weeks that nothing has been announced. But I don't think that's also the trigger for the market. I think the trigger would be basically earnings growth. And probably the September quarter will be the start off of that season, I think. So mainly a consolidation phase.
So this consolidation will last till the next earnings season, through Q1, because you're not expecting any fireworks. You think this range-bound move will continue? And it's only in the festive season that, we start getting some good news about growth and earnings.
Yeah, I won't be too surprised, but I'm sure the markets, like to discount a couple of months earlier. So once the news might start coming out about how the corporates are doing and things like that, probably you'll see some kind of, festivities coming back. But yeah, I totally agree. I think it's the festive season, which will the October to December quarter, when you'll really see the fun beginning, because even by then you'll see that the liquidity infusion by RBI, which will kick off sometime in September, will start having some impact, and probably you'll see people coming back into the markets and demand picking up. And yeah, I mean, I hope the party begins then.
Speaking of funding infusion and liquidity, at least mutual funds have reason to cheer. I'm sure you'll agree, Dinshaw. Just give me a second. I'll quickly run through the numbers in case someone missed the data today. I want to come back and talk to you about the capital markets theme. So here's the story, and the story is actually looking good. After a really disappointing May, when flows had dipped below 19,000 crores, mutual fund equity inflows for the month of June have recovered. There's about a 24% recovery. You can see that last bar is now at 23,500. Now, how is it split across mid-cap, large-cap, small-cap? The preference for investors is still small and mid-caps. That's the headline, because you can see the large-cap funds there. They've recovered from May, but now compare this with how the flows are for mid and small. Mid-cap funds flows are about 3,750 crores. Small-cap fund flows are even better at 4,000 crores plus. So overall, there's a recovery coming in. But I do want to point out here that the data is telling, and it probably is telling us that the investors are becoming very smart. Because while equity funds have pulled in 23,500 odd crores, look at hybrid funds. They have also pulled in over 23,000 crores, 23,200 something to be more precise. So we're almost neck to neck in terms of pure equity flows and hybrid flows. And it's telling you that people are taking a balanced approach. They are looking at diversification. And the fact that a lot of the hybrid funds have very attractive tax structures as well now after the budget. This is making, this particular category fairly popular. The other good news is that the SIP picture is rock steady. In fact, monthly SIP flows are now above 27,000 crores. So that pillar is rising higher and higher. So looking fairly good. So now let's go back to Dinshaw, and he had that wide smile, right? Because in between, Dinshaw, I know this was becoming a bit of a concern that there's all the supply coming in, promoters are selling, QIPs are happening, MNCs are exiting, so who's going to buy? But your thoughts on not just the flows, but in general, I mean, the MF industry's appetite to come in and buy, average cash levels, and what we can expect given the paper supply, IPOs, etc., everything that's coming to the market.
So basically the supply and the flows, I mean, both are, it's a catch-22, right? I mean, if you have the supply, if you have the flows coming into the market, the supply is bound to come by, because there are quite a few people waiting in the queue. You talk to any investment banker and he'll tell you he's got these crores of line just waiting to come and offload in the market. And that's a function of the kind of flows that are coming into the system. I mean, at some point in time, the FIs2 were buying, and obviously the DIs have been going on seeing flows. By the way, having said that, whenever you see a down day, you see a lot of flows coming into the mutual fund industry, and that's very peculiar. I mean, we are a part of this, so I can vouch for it that on a down day, my flows go up 2-3x as such, and that is really interesting because I think basically the retail guys are still there. Quite a few guys sitting on the fence, waiting for a correction and just using that as an excuse to come back in. So I don't see that flow ebbing. In fact, with this, with the new tax thing going on, I mean, as in the new tax structure, I'm sure the savings also will be moving up for most of the investors, and that's why you're seeing these kind of healthy flows.
Okay, so that brings me to the wider question on overall capital market plays. Flows are fine, but then there are other issues that capital market players are dealing with, whether it's F&O regulation or Jane or Jack or whoever you're calling out these days. But your sense, again, stocks have done very well in the past, but is there a risk now in terms of further exposures to capital market stocks?
So if you see the exchanges, I think they're overdone. Frankly, I mean, the valuations are totally stretched. Same is the case with I suppose the RTAs, who are basically having a problem on the fee front. I mean, the renegotiations happening for these guys. And obviously the depositories, I think they're also the bulk of the move. I mean, as you saw, the 2 crore demat accounts becoming 22 odd crore demat accounts in like 5 years. I think that phase of growth is over for those guys also. So from here on, whom do you look at? Obviously, the guys who are raking in the money, which is the likes of us, which is the asset managers, or for that matter, the wealth managers. I think there's still a few left in play out here, and that's why we like these guys. And obviously, the diversified brokerages and stuff like that were basically the gatekeepers to wealth. So I think those are the guys you want to look at in the capital market space, and nothing beyond that.
Dinshu, some green shoots about consumer, coming back, the consumer story, or at least brokerages are betting that it's going to come, perhaps maybe by the festive season. So you are seeing some upgrades across some FMCG stocks in the paint industry. Where do you stand on consumer and the individual segments?
So my feel is that obviously FMCG and paints and all, I don't know. I mean, the valuations look pretty stretched out there. Even if growth comes in, what are we talking about? From mid-single digit to, say, high single digit kind of growth, at least in the FMCG space. Our feel is that with this kind of liquidity infusion that RBI has gone about doing, it's like fuel just being poured, and you just need a little spark for that fuel to light up. And that spark, I think, is mainly the consumer durables. I think that's where the real fun will be, the discretionary spends, rather. That's where the real fun will be. And I think that's the area one should look out for. And frankly, I mean, that is what you need, because if you get these kind of demand infusion in discretionary, you'll see that even the private sector capex will start kicking in, and that's a long-term party that we're talking about. So that's the only thing that we are looking at, and I think that's the way to go.
Any thoughts, Dinshu, on this? You must have seen the news around Vedanta. Any thoughts?
No thoughts. We don't own the stock. We've never owned the stock, and I don't want to comment on it.
Point taken. Hang in there. You may want to listen into this sort of conversation because the stock did react. I mean, it was down sharply intraday, about 7-8%. I think this is a short seller report which has come through, alleging all sorts of things. Vedanta, of course, has come through with a strong denial. It's calling that most of these allegations, etc., are completely, it's on your screen, baseless misinformation to discredit the group. So let's go across to Aditya Velekar, who's Senior Research Analyst, Axis Securities. Aditya, good to have you with us here. I've not looked at much of this in great detail. I'm sure you have. So I just wanted your thoughts. What have you made of this report today? And of course, we put out Vedanta's response as well. What did you make of it?
Yeah, good afternoon. So difficult to make an immediate comment on this, but means I can speak from an operational perspective. So fundamentally, the company is strong and it is well placed, and it adds at the cusp of expansion. So there are various segments like aluminium segment, zinc segment, and then power segment. All these segments are the transformation is going to happen this and next fiscal, and we expect a good amount of earnings growth post this turnaround in these critical segments, especially in aluminium, once they acquire the raw material integration and then they expand the zinc smelting capacity and post their power plant commissioning. So all these things are operational, and that will surely drive the profitability of the company. Their free cash flows will increase. Also, their focus on deleveraging is also there. We have seen in last couple of years they have deleveraged their parent Vedanta Resources debt by almost $2 to $3 billion. So currently it's at $5 billion, and they have a plan to further reduce it by $2 billion additional. So the focus on deleveraging is there. At Vedanta Limited also, their net debt is almost near around 53,000 crores, and they want to keep it under 1x net debt to EBITDA. So looking at all these things, the company has achieved a good turnaround, and the future also looks pretty operationally stable as such.
Aditya, just allow me a second here, and it's really important that you brought up the point on debt, because the central issue in this report that Viceroy has put out, I'm just quoting certain parts of it. I mean, they've used very, very strong language, so adding that caveat, and I'm just simply quoting, not even paraphrasing, saying that comparing the Vedanta parent, I mean, their issue is with VRL, Vedanta Resources, saying that, VRL is akin to a financial zombie or a parasite being kept alive by transfusions of cash from its subsidiary Vedanta. And they go on to say that, servicing the VRL debt is its own, a burden. Saying VRL's actions to meet its short-term obligations directly impair its creditors' long-term ability to recover their principal, a situation that resembles a Ponzi scheme. So very, very sharp language and harsh words over there. But to go back to understanding the debt interlinkages, Aditya, you said that Vedanta Resources' outstanding debt is $5 billion, right? Now, we don't know whether the listed entity, whether it's a guarantor to that debt in any way, what more can you tell us about the debt interlinkages between the listed entity and the parent?
So for parent, means you are right, means they don't have, the parent doesn't have a direct source of cash to refund that debt. So it depends, the parent is dependent on the Vedanta Limited Indian listed company and Hindustan Zinc. So they get a brand fee, and the dividend upstreaming happens from both Hindustan Zinc and parent Vedanta Limited. So that is their only source of income to repay that debt. And I think they have done a restructuring activity on their outstanding debt and bonds. So that has given some comfort. But it is true that at resources level, there is no source of income to repay that debt directly. It is dependent on the performance of
the Indian listed entities.
Yes.
Yeah. So are there any immediate near-term repayment obligations? Because the thing is with Vedanta Resources, every now and then we have the situation where some bond payment is coming up and the market wonders whether it's happening or not happening. And then eventually it's gone through up until now. I mean, we haven't seen a major default. Are you aware of any? Yeah.
No, I don't think so. That scare of immediate bond default was there sometime last fiscal, but that they have managed to spread around the bond repayment schedule quite well now. I don't think the immediate liability is there or any maturity for bonds is coming. So bonds are slightly critical. Once they come for a repayment, loan can be restructured. But what I recall is that their debt maturity is quite spreaded, and near-term challenge I don't foresee as such.
Okay, so that takes care of the debt issue and the debt questions that we had. One final point. Let's remember this report has come at a time when Vedanta is going through a demerger, right? They're supposed to come up with different entities. Do you see any implications in the whole demerger exercise? You're overall positive on the stock, I guess, right?
Yeah, means operationally and fundamentally, the stock, the company has and the management has turned around the stock quite well, the company quite well. And operationally now it's at the cusp of execution. Means if they execute all these projects, the backward integration projects at aluminium, their power expansion and zinc expansion well, then definitely the cash flows should improve and this leverage issue should sort out in future. So that is the perspective. So we have to see from that angle. And as far as demerger is concerned, I guess there was some news that some issue was raised by Petroleum Ministry, but we have to wait and see. I think August 20th, they are once again, we will get some clarity what happens on that front. So demerger is one trigger where we can see some value unlocking, especially with respect to aluminium division. But yes, these are the issues which the stock has almost grappled with last several years, and it remains a kind of overhang on its performance. And so we have to wait and see. Means these issues will persist with the stock until we see a clear path where we can see that the deleveraging progress takes a front step and the debt at the parent level reduces substantially. So that is a key thing. Means now it's at $5 billion. If it goes down to 1 billion, 2 billion, then the comfort on the stock will increase further. Until that, all these issues will keep on, these question marks will be raised.
Okay. All right, Aditya. Thank you very much for the perspective. So let's see what the next couple of days bring, whether this issue simply stabilizes from here on. We'll take a break on that note. Thank you very much for joining in. And thanks to, of course, Dinshaw also for being with us today. Quick break. Come back on the other side. We'll get you all the buzz from dealing rooms and then some final trading calls with Mitesh. Welcome back. You're with us on Closing Bell. Well, let's take a look at all the buzz that we're gathering from the dealing rooms, because the last, half an hour at least has been a little volatile. We've got Nimesh joining in. Nimesh, suddenly from being a very flat day, again we're seeing some red. So I guess if there's any action, it's more from the bear side than the bull side today.
Not too sure whether it's a bull or a bear, but it's been lackluster. So that's been the trend for the last few days now. And now I think there is a bit of a joke as well in the dealing rooms that where is Jane Street? They are the ones who are bringing a lot of volatility, and that seems to be missing now. So from a trader perspective, it's not a great market, but a lot of individual stocks are buzzing. I'll add to those chatter as well, but largely it's been flat. Even the flows are quite muted, is what I understand from larger institutions. On the negative side, though, from FIs, at least in today's market, there is a bit of profit booking now in the PSU stocks as well as the real estate names. Real estate, on the back of that Nomura, initiating on few companies, that has dragged a few of these real estate stocks in today's market. But there is a lot of chatter in the broader market, so to speak, and relatively, a lot of these mid-cap, small cap stocks have continued to outperform and on decent volumes. So the HNI activity seems to be quite there, but there is a lack of institutional participation, and of course the traders are also feeling a sense of missing out on the Jane Street volumes.
No, absolutely. What about individual names, Nimesh?
Long
What's
list,
on your
Prashant. We call it a dull day, but there is a long list, at least from a chatter point of view. So the first stock on my list is Fino Payments Bank. Big move on that stock, up 8% last I checked. The volumes too have also picked up, and the street is anticipating some corporate development very soon. For Fino Payments Bank, the most important trigger in the very near term would be the approval of the small finance bank license. That's something which the street is hoping for very soon. The second stock is Natco Pharma. Even that's been buzzing in trade and actually has relatively outperformed the pharma index, so to speak, in the last few days. And for Natco, there is a very strong buzz of an overseas acquisition coming very soon. So that's a trigger there. The third stock is Samman Capital. We've seen a bit of an uptake in the last 30 minutes of trade after a large block. Nearly 1 crore shares got changed hands, and after that we've seen a bit of an uptake on that stock as well. I understand it was a clean out trade from a leading long only FI. So again, if there is a disclosure, it could be interesting as to who's bought in that block deal. So Samman is the third name on my list. The fourth stock is Laurus Labs. Again, within the pharma name, this is relatively outperformed in the last few weeks within the pharma names. And again, for Laurus Labs, I guess the whole excitement seems to be towards the export data, which can come in the next 1 or 2 days, and that seems to be very strong, and hence you're seeing an outperformance there. And the last name is VIP Industries. Again, for a very long time, there has been an anticipation or a buzz of an M&A deal happening very soon. Looks like that could be around the corner. I guess the street is sensing something in VIP very soon, so that's the reason why even VIP is buzzing in trade today.
Nimesh, the Fino payment news, right?
Yeah.
It's a regulatory thing, right?
It's a regulatory thing, yes. So I think the approval has to come from the regulator, that is RBI. For Fino Payments Bank, essentially, Prashant, it's a move from payments banking to a small finance bank license. So that's been pending. So I think the request went all the way in 23. So it's been 2 years since then that they've been waiting for this approval to come in. But for others like AU Small Finance Bank, it's going to be a migration from to a different kind of approval. So AU is something different, and Fino Payments is something different. For Fino Payment Banks, it's essentially the small finance bank, which they are waiting for a very long time.
And VIP, it's higher in anticipation of a large deal. When you say large deal, usually I add the word block in front of the deal.
But Prashant, so no, which is why I've mentioned that block is unlikely, Prashant, because the trading window is closed for the promoters now. So at least in the block, the promoters can't sell. That's my understanding. But from a pure M&A point of view, it can still happen whether it's a closure of a trading window or not, because M&A can still happen. So I mean, and the street is anticipating an M&A deal, not like a block, but more of an M&A transaction in VIP Industries.
Interesting list, and longer the better. So Fino, Natco, Samman Capital, Laurus, VIP Industries. Thanks very much, Nimesh, for that. We'll come back to you for more. Well, let's for now take a quick stock of the market as well. We're down about 40 points, 25,480, and sideways too, slightly lower. Mitesh is back with us with what he wants you to do near term, buy or sell today for a reverse trade tomorrow. Mitesh, what do you have?
The STVT on Gas Authority with the stop at about 186.5 for targets of 182.5. ICICI Pru, that's a stock which has done very well in the last few hours, giving a breakout over here. So BTST here with the stop at 674, 673 half and target of 695.
Thank you very much for that. But all eyes are going to be on the India-US trade deal. What's going to be announced when? What will be the contours of it? Parikshit has picked up some updates. He joins us for more. Parikshit?
Well, we hear from our sources that the India-US trade deal is likely to happen. Talks have been positive for the last 1 month. However, there are some outstanding issues, some sticky points which are yet to be resolved. Having said that, earlier, the deadline for the reciprocal tariff was 9th of July, and both sides were trying to get a deal before that. And India was making more effort because it wanted to avoid the reciprocal tariffs. Now, with the deadline having been extended till the 1st of August, there could possibly be more talks behind the scenes. What we've been told right now is this. India, after extensive negotiations, finished everything, gave a deal to the United States. We proposed a fair and decent deal to the United States where we gave good amount of access to their heavy industries and also sought access for our labor-intensive sectors without compromising on agriculture and dairy. Now, President Trump has to sign off on the deal. He's been making positive statements saying that we are very close to a trade deal with India, but eventually he has to take a decision whether this deal is now going to go through or not. So while a deal is imminent, the timeline is not clear, whether it's going to happen tomorrow or day after, or whether there will be more talks in the next few weeks. So all options are on the table. While the deal remains imminent, the timeline is something we cannot comment on, and sources in the Indian government also saying that the ball is in Washington's court. They have to take a call and decide whether they want to announce a deal right now or they want to indicate more talks with the Indian government.
Thank you very much for that. And while we all await the details of that, markets have been very, very quiet and consolidating. And plus, earnings season begins tomorrow. Anand Tandon is now joining in. Anand, we've seen a little bit of a volatility in the last 10 minutes, but markets are still down, give or take, just about 50-odd points today. What have you made of the way markets have been moving sideways over the last couple of days?
Obviously, the market is still fairly resilient because, you are at the price at which it is and with the expectations of news flow in terms of results, etc., not necessarily being great. You are not really expecting to see an earnings growth of anything more, which is even remotely a two-digit growth. There aren't that many triggers for the market to move up. I think the nearest trigger that one can get is this trade deal. If it comes with somewhat positive, which means that relative to other countries, we don't get hit as much, then that may provide a bit of a rally.
Okay, let's talk about delivery. That's in focus after Motilal Oswal, I think, initiated coverage, sounding positive. Manglam joins in for more. Manglam?
Well, delivery is one of those stocks, which always has the street divided. Some don't like the fact that there is always liquidity pressure on the stock. Some of the other institution is looking to sell their stake. And the other part is looking at the strength of the network. Motilal Oswal is backing the strength of the network right now. They're saying that, the company has the strongest logistics network in the country. When it comes to reach, they have 19,000 pin codes and they have across-the-board services, be it express parcel services, full truckload, part truckload, or even, supply chain solutions. So they have a target price of 480 on the stock. They've initiated with a buy. They believe that with the 20% market share that they have in express logistics, e-commerce logistics, the company can see revenue growth compounding at around 14% for the next 3 years. And the EBITDA as well as net profit will grow at a lot higher rate, 36% growth for the EBITDA, over 50% growth for the profitability. And given their valuation metric, they believe that at current levels, the stock is trading at close to 36 times EV to EBITDA when it comes to FY28 estimates. And that is a compelling opportunity for one to buy delivery. Having said that, remember, one of the bigger risks for delivery is that one of its larger clients, Meesho, has gone insourcing when it comes to logistics, and as a result of which, in the third-party logistics space, their market share stands to come down from over 40% now to around 20-25%. So that could be something that may put a lid on the gains, along with all the institutions that are ever so often looking to offload their stake in delivery. So we'll keep an eye out on those factors.
All right, Mangalam, thank you very much for that. We'll take a quick commercial break here. More market conversation on the other side.
Oh, welcome back. Well, we've got about 5 minutes to go before the day closes out. And let's take some final thoughts with Anand Tandon as well. Anand, we're talking about the earnings season starting. And obviously, the large cap IT services have really failed to impress or enthuse. But some of the mid cap names like Coforge have done better. Would you look at some of these mid cap plays, or would you be a contrarian and look at going back to large cap IT at all?
Well, I think IT services by itself, to me, doesn't hold too much attraction at this stage. No doubt, Coforge, the management commentary has been extremely bullish. They seem to be servicing Mars, while the rest of the markets, companies are unable to grow anywhere close to double digits. Coforge is guiding for very strong growth. And obviously, that is already in the price. So even if you were to believe that kind of growth will come through, it is not as if that is not already reflected in the price. I think you have to be looking at differentiated models rather than just IT services per se. To my mind, the time for high premium for IT services is not now.
Anand, what about EMS? JP Morgan is calling it a sunrise industry, saying that the revenue potential is for 30% plus CAGR growth till FY30. But it's not it's not a new theme. It's been well discovered. Valuations are high. Do you like any EMS stock?
Well, the part that has not yet been discovered is what we are seeing now, which is China holding back rare earth supplies. And, if you cannot even make a speaker, leave alone anything more complex than that because you don't have a supply, it can very well become like HAL where, you can make the body of the plane, but, it refuses to fly because it doesn't have an engine. So, we have to also look at the risks associated with this kind. In general terms, this is clearly a sector that can continue to grow. We have almost a very small fledgling industry in terms of anything to do with electronics. The whole ecosystem needs to be built. So it's an area that can absorb large amounts of capital and therefore has a long runway. But whether that runway has the potential will also depend on the kind of geopolitics that we live in. And I would argue that we are ignoring the risks already.
Ignoring the risks already. You said initially that this trade agreement perhaps is a bit of a trigger, Anand. Will it be a trigger? Or will it? Because what we've seen, it's not managed to move any of the other markets which have got these deals, right? For example, Vietnam or UK or even actually China for that matter supposedly has a deal, although no details are out. Go on.
So we are looking for good news, right, at this stage. So, for example, if we were to get a tariff on textiles, which is lower than Vietnam, I think you will see a sharp rally perhaps in some of the textile stocks, and perhaps justifiably so, because if our competitors are not going to get a kind of better position in terms of tariffs, and Bangladesh is not in any better position or Vietnam is not, then clearly we have some amount of edge. Will it be in high technology areas? I would very much doubt it. One hopes that India is still viewed as an ally for the US and someone that they want to support against some of the other smaller countries, which could be used as gateways to of exports of China. But otherwise, we are looking for items where we can actually service a larger market than we currently have. And that will mean that you have to service the US. So if you're not going to be able to service the US because of the tariffs, certainly it will be a negative. But broadly, I would imagine that, as I said, we are looking for positives. I don't think earnings is going to be it. Tariffs could be.
Earnings, of course. Sector after sector, I don't think there's very muted expectations. Nimesh was talking about Fino payment. I don't know if you heard some of that conversation earlier with that small finance bank license. Will that be a game changer if it comes through? Markets have been waiting for it for a long time.
Well, certainly, if anybody becomes a bank, you have now the license to take deposits. And with that, it means that if you are lending money to people who are not likely to pay you back, you will still not fail because RBI will step in and so will the taxpayers. So essentially, if you look at it, my belief remains that, microfinance in India is the equivalent of India's ninja loans. And the only reason why everything needs to go and become a bank is because that's the only way you can let those entities to survive on the medium to long term.
That is particularly harsh, huh? Anand, the way you put it with a straight face.
It's not, the moment you go below 96% recovery, and we do it regularly, right? People call it one-off. How many times are you going to call it one-off? From the time, if you look at the last 2 decades, there would be at least 6 incidences I can think of where, you would have got to a stage where your recoveries were less than 90%, which means those companies are bankrupt. But we still continue to survive, and that is why you see RBI forcing many of those companies to become small payment banks or merge with banks and so on. The largest was merged with IndusInd Bank, pretty much for the same reason. So
but to call some banking license is the license to lend money to people who won't pay you back and not get into trouble. That's a new definition.
Which have gone under, and yet the depositors continue to be paid.
Now, anything? Okay, fair enough. That's anything you've heard on VIP again? Something that Nimesh was talking about, possible. Deal and M&A.
Yeah,
again, it's been doing the rounds for a while. Yeah.
That's right. Like you said, the only thing one hears is that there is likely to be the promoters are looking to possibly get out. But I have no greater insight in that than anybody else on the street.
Okay, I think, Anand, interesting conversation. But stay with us. We'll continue some of this post-market analysis because it is post-market. The bell's gone off. Markets have shut. Nifty down a 0.25%. The Nifty Bank ending absolutely flat. Mid-cap index, nothing. But the small cap index is the only index which ends with about 0.5% odd gain. So that is the overall state of affairs as far as today's session goes. Guys.
Well, the FMCG index managed some gains, so about 3/4 of a percentage point higher for FMCG. HUL, Asian Paints, ITC on the buyers list. NBFCs like Shriram Finance, Bajaj Finance with the top 2 gainers, the only stocks with gains of about 1.5% and plus. And a couple of PSUs like Coal India, Power Grid, also higher in trade. On the way down, IT weak, HCLTech top loser, metals corrected, Hindalco, Tata Steel under pressure, DLF, Apollo Hospitals too, down nearly 1.5%.
Okay, let's talk about some of the movers and shakers from the broader markets. In terms of today's newsmakers, Union Bank ends down about 3.5% because of a weak Q1 update. Of course, we've discussed stocks like Vedanta and Hindustan Zinc. Vedanta final count is down a little over 3%. Let's pull up Hindustan Zinc as well. It'll come up on your screens in just a bit. The ones that actually stood out on the green side today would be some of the EMS names like Sirma, even Amber and Keynes for that matter, 2 to 5% up on these stocks because of the JP Morgan note, which sounded pretty bullish on it. And then you had a delivery. Again, it was a Motilal Oswal note, which led to a 3% pop on delivery. But overall, a very even Steven kind of a day for mid-caps with the advanced decline ratio absolutely neck to neck. So another flat day comes to an end with the Nifty around 25,476. Well, with that, it's a wrap on this edition of Closing Bell. Many thanks for watching. We have to take your leave here, but do stay tuned. Market Forward coming up next.
The large trade fails to hold recovery, ends with minor cuts. A sharp fall in Reliance drags the Nifty below 25,500, closer to 25,476. Broader markets fall in line with the blue chips.
Heads of brokerages tell CNBC-TV18 that structural steps by SEBI to protect retail investors from sophisticated traders in F&O may be in the offing. The product's suitability for retail may also get a look they add and will, while owning up to their responsibility in guiding customers.
All eyes on trade tariffs. Experts warn US President Donald Trump's tariff threat on copper and pharma could be a big dampener amidst the India-US trade talks. However, experts remain positive about the deal. Shares of copper mining companies skid while pharma stocks did hold ground. Good evening. You're watching us here on Markets Forward. I'm Mangalam Malu. With me, Vinny Motiwala. This is your go-to show where we aim to get you all the key data points to get up for trade next day. We come to you live from the CNBC-TV18 Motilal Oswal studio. The important part, the market continues to be in that range. Yes,
I think yesterday where we started off the show, and today it's the similar same.
Today is the same thing. You know, the only difference between yesterday and today, yesterday last hour there was a big spike and we gained all of 60 points. Today there was a big downtick and we lost all of 45 points. All in all, between the high and the low of the Nifty, the range has been around 125 points. And that's exactly how the market has been over the last 1 month or so, where the average range on the Nifty has been about 180, 190 points. And if you were wondering whether the bulls won today or the bears, just look at the advanced decline ratio. You'll realize that at the end of the day, both of them shook each other's hands and said, you take one, I take one. There were 1,350 stocks advancing, 1,350 stocks which were declining. For most part of today's trading session, we had the advances line above it. But now, towards the end, both of them shook hands and said, one for the bulls, one for the bears. Hi, Vinny.
Absolutely. Hi, Mangalam. So, yes, interesting day coming in. Not much of an interesting day, but from where we were yesterday, just that range-bound trading session. Only thing I want to highlight is the Nifty small cap today. That's the one which managed to close on to in the green with gains of almost 0.5% in today's trading session. And yesterday, what we were talking about in terms of Nifty Realty being the top gainer, today it's among the top sectoral losers. We had Nifty Metal that was among the top sectoral losers as well. And tomorrow we'll be watching out for TCS's numbers. So keep an eye out on the IT pack. Today Nifty IT was down almost 0.8%. But yes, that's how the market setup was looking like. But we have an exciting lineup for you all on the show today. And first off, we'll start with the top movers and shakers for the day with Urmas Fatakia. Then we move on to Vedanta issuing a clarification on a report published by a US-based short seller, Vicery Research. And then reactions will come in on EMS stocks that were in focus today after brokerage commentary came in on the sector. Also, we'll turn the spotlight on IEX, and last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. So let's start with the first segment for the day, and we have Hormas joining in with us from the big wall to take us through the top movers and shakers for the day. Hormas, over to you.
Almost getting used to having dull days on the street, as was the case today as well. But the pharma sector stood tall today, despite that 200% tariff threat from Donald Trump. Mankind Pharma doing well for itself. In fact, Laurus Labs ended at a 52-week high today, almost 75% higher now in the last 12 months. Torrent Pharma too, seeing some bit of gains. And it was Metropolis Healthcare that was not technically pharma, but yes, 8.5% higher on that stock as well. The newsmakers today, of course, the second half dominated by Vedanta, and the clarification issued by the company at one point was down 7%. So a slight recovery from the lows. Vedanta's fall took Hindustan Zinc lower with it as well, and Union Bank after the business update, and GAIL too ending at the lowest point of the day in today's session. Real estate was another sector that sulked, and that is courtesy some bearish commentary coming in from Nomura on names like Phoenix Mills and Godrej Properties, and the rest of the pack too saw losses of anywhere between 1.5% to 4%. FMCG stocks did well today. Imami was an outlier in today's session, ending almost 6% higher today. Varun Beverages, after some positive brokerage commentary, and HUL too, that note from Jefferies, along with some of the others, saw gains of 1 to 2%. And stocks that ended at a 52-week high today. Two auto names dominate this list, Force Motors and SML Isuzu, both of them ending at a 52-week high. India Shelter after Kotak buying stake in the company, and Sirma SGS too after some positive brokerage commentary, a 52-week high for the stock. Back to you guys.
Ormaz, a bunch of stocks which were buzzing around in today's trading session: Metropolis, Imami, SML Isuzu and Force Motors standing out in terms of gains that we've seen on the upside. Market expert Anand Tandon and Sudeep Shah of SBI Securities join in now. Anand, how are you feeling about the market? Not much is expected from the earnings this time around, but there are still a lot of stray stocks which keep moving around, and some of them with a fair amount of gusto. Is there any particular pocket where you believe that there is still money to be made, the opportunity is still around?
So long as the market keeps going up, there will be some stock or the other which will obviously move, and some of them will outperform. That's how the market has to go up. Which means that today, if you look at a top-down approach, I don't think that there are any sectors which you could call undervalued. There are relative valuation gaps, like, for example, the banks are probably still relatively cheaper, both from the historic as well as relative perspective. Maybe given the fact that there is now surplus liquidity in the system, maybe NBFCs are things which can grow a little bit faster. And some of the domestic industrial stocks, etc., will continue to have reasonable growth because of the government capex and the rest of it. Not that they are particularly cheap. So the best way, in my view, to play the sector is to play the market is to just ride the index. There is no need to try and discriminate too much about and try and move along with every twist of the market, because the market is not actually presenting any great value in almost any of the sectors.
Right, that's very interesting. But the interesting part about this is also the index itself has been in this very narrow 180-point range over the last month or so. So if you were in the ETFs, you wouldn't have lost money, you wouldn't have made too much money either. But we take that point, we'll discuss individual stocks in just a bit. But there was another stock too.
Absolutely, and that's going to be Vedanta, because a report was published by the US-based short seller Viceroy Research, and they had said that the Vedanta group structure is financially unstable, operationally compromised, and pose a severe underappreciated risk to the creditors. The 87-page long report claims that the parent company is systematically draining steel major Vedanta Limited and resembles a Ponzi scheme. Vedanta declined in trade as well. It was down as much as 7%, and then the company hit back, calling the report a malicious combination of selective misinformation and baseless allegations. Urmas, you did highlight the stocks in the top movers and shakers as well, but what are the details here? What is the clarification that's coming in as well?
Another short seller saga that has emerged here, and this time around it is Viceroy Research. This has come out with a note against Vedanta, and they've mentioned the fact that this entire group structure is financially unsustainable and operationally compromised and poses a severe underappreciated risk to the company's creditors. Now, they have highlighted the parent company, that is Vedanta Resources, that is systematically draining the listed entity by draining cash out to service its own debt burden, and this entire arrangement, according to Viceroy Research, has pushed the group on the brink of insolvency, is what they have mentioned. Now, certain observations that the Viceroy Group has made against Vedanta, they say that their interest expenses have vastly exceeded their reported note rates, and despite the decline in paydowns and restructuring, despite the decline in debt, the interest expenses continue to rise for the group. Now, they also say that there are a lot of non-performing operating subsidiaries with inflated asset values, is what they have observed, and the debt across these non-performing subsidiaries vastly exceeds their true value, and it is cross-collateralized across the group, is the observation that they have made, and billions of dollars worth of disputed amounts have been kept away from the balance sheet and are not disclosed in the financial statements, is what Viceroy Research has said. Now, over the last 4 years, Vedanta Limited has paid dividends worth over 80,000 crore rupees, where the parent company at one point of time owned around 65% stake, but they have sold that down to around 56% currently. And if you see the last 4 years as well, the payouts have ranged anywhere between 16,000 crores to as high as 40,000 crore rupees. Now, in a response to CNBC-TV18, the Vedanta Group said that this report is a malicious combination of selective misinformation and baseless allegations to discredit the group, and it has been issued without making any prior contacts to the company, and they have issued this with the sole objective of creating false propaganda. They've chose to sensationalize information that is already available in public domain, and the timing of the report is also suspect, and it could be ahead of the corporate activity that the group is about to undertake. They've also added disclaimers saying that the report is only for educational purposes on multiple occasions, and Vedanta continues to remain focused on the growth of their business, and they have appealed to avoid
speculation and unsubstantiated allegations. In response, the Viceroy Group also wrote on X saying that they have dismissed their 85-page report thoroughly without attempting to discredit their work, and this is likely because they are unlikely to refute their holdings and their findings, and they are happy to take questions. So more short seller allegations emerging against Vedanta right before the demerger is about to be completed. The stock reacting to that in response.
All right, Hormaz, thanks a lot for that. So that's about the Vedanta saga. But by and large, metals were slightly under pressure in today's trading session. The fear of, maybe tariffs on imported copper and aluminum, those stocks were under a wee bit of pressure in today's trading session. Let's get Sudeep on. Sudeep, good evening. What do you make of the metal space chartically? Is there a trade that is, likely to emanate here?
Good evening, Mangalam. Mangalam, if you see the Nifty Metal Index also, that index is topping out, or it's just giving some signs of a fatigue at higher levels like most of the indices are doing on Nifty. Here, what we feel that within the metal space, say a stock like JSW Steel or Nalco, they look still relatively better compared to other stocks. But a lot of these other names, apart from these two, there we are seeing some kind of fatigue creeping in. And today, for the first time after 23rd of June, we have seen the Nifty Metal Index close and break the 20-day exponential moving average and close below that. So I feel for the time being, one just needs to wait and watch how the trade deal pans out and how the metal stocks, these commodity stocks react in the next couple of days.
Okay, will be important to keep an eye out on that and how they react as well. But let's move on to another couple of names that were buzzing into it today, and this is the EMS pack. Now, JP Morgan is bullish on the electronic manufacturing companies, where they'll talk about a Syrma SGS, Dixon Technologies, as well as Kane Technologies. And an upgrade came in from the brokerage house, which helped the stock soar in trade. Upasna is here to give us the highlights of that report. Upasna?
Well, EMS stocks continue to remain in focus today as JP Morgan initiated coverage and has recognized the sector as the sunrise sector, estimating strong revenue growth of nearly about 32% CAGR for the next 5 years. Now, the brokerage believes this growth will be led by rising electronics content in the products, Make in India push, and even realignment of global supply chain to India with China Plus One strategy playing out. It is also recognized to emerging opportunities such as OSAT and PCB, while it expects that the export could be the next growth frontier for these companies. Now, it has given an overweight rating on 3 stocks, that is Syrma, Dixon Tech, and even Kane's Technology, and target for Syrma at 800 per share, Dixon at 17,700 per share, and Kane's at 7,150. While it has given a neutral rating on Amber and signed DLM, and an underweight rating on Avalon Tech. The target price for Amber, it is set as 7,350, signed DLM at 450, and Avalon Tech it sees at 650 per share. Now let us look at the key growth drivers that the brokerage has highlighted, which is the reason why it is overweight on these 3 stocks. Coming to Syrma first, it expects the exports to come back by FY27. Hence, it sees a growth acceleration and margin expansion going forward. Next up is Dixon. It expects that the mobile-led growth will be the key driver until FY27, and beyond it, non-mobile segment will be the key growth driver. For Kane's, it sees the fastest 46% revenue CAGR over FY25 to FY28, and it also targets a revenue of $1 billion by FY28 on this company. For Syrma, signed DLM and Avalon Tech, it believes that the export could be the next growth frontier over the long term. Overall, it sees a 3x times 3-year rally and demanding valuation, which is why it is seeing an earnings upgrade on this sector. So overall, it's a positive note, and EMS continues to be the sunrise sector is what the JP Morgan has highlighted.
Okay, Upasna, thank you so much for that, keeping an eye out on those EMS players. Anand, what's your view coming in for the EMS players, whether you look at Dixon Tech, Kane's Technology, on the smaller end you have Avalon Tech, signed DLM also. Would you play with someone who's already seen the rally like Kane's, Dixon Tech, or would you go for the smaller names which are coming in there?
Well, I think the sector is still in a nascent stage. The companies still have a long way to go in terms of growth. So it is perhaps better to look at, if you want to be invested in the sector, to look at those which has an established execution track record, because it's not like we are doing anything much in this sector other than being able to deliver in volume and at a reasonable price. It is still a long way to go before we can add value and capture more of the value in the final product, because we are not backward integrated. Some of the companies that you mentioned are now looking at getting backward integrated. So at this stage, I think the value addition is more likely to be in the companies which have at least gone past the initial screwdriver stage technology and have started to manufacture some of the components. The newer companies will actually be in the front end, and therefore, while they'll be reflecting the excitement in the stock price, their ability to absorb and technology and deal with larger players internationally may be far lower.
Right. Also, Sudeep, what's your view coming in the charts? Anything that you're finding attractive right now in the EMS play, or one could look at entering right now?
I feel it's time now. I guess in the next 1.5 months, these stocks such as Dixon or CNBC-TV18 they would see a good traction right now. A base building activity is happening here. Dixon, in the last few months, we have seen it fall up to 13,500, 14,000 from a price action perspective. But in the last couple of weeks, we have seen, especially a stock like Dixon, building up a base closer to this 15,000, 15,200 mark. And the 2 days, the 2 trading days, that is Monday, Tuesday, and Wednesday, all the 3 days, we've seen some kind of a positive action coming in this stock. So I feel out of all these names, CNBC-TV18, Dixon, although they are at expensive valuation, but the price action is supportive right now here. And overall, till from a Dixon's price action perspective, till 15,000 holds, I feel 16,500, 17,000 zone is coming in the next couple of months.
All right, we take that point. With that, we'll take a short break. On the other side, we'll get you more on the markets as well as individual stocks, get you key events to watch out for tomorrow, along with some of the corporate prices that we have as well. Anand, Sudeep, thank you so much for staying with us and talking us through with what the market situation is like right now, what sectors and stocks are in focus. Stay with us. Welcome back. You're watching us here on Markets Forward. A listless day for the frontline indices. A lot of individual stocks abuzz as well. We spoke to a bunch of corporates today. Let's get to the key corporate voices. First up, from the primary markets, the IPO that's opening later this week, Anthem Biosciences is betting big on the China Plus One strategy. The management says it's proactively investing in manufacturing facilities to address the growing demand. That's not all. They also added a number of queries or inquiries that have increased in the last 6 months, specifically on the China Plus One category. The company's dependency on China's supply chain is less than 20% against the industry, which is in the range of 60 to 70%, and also has 10 new peptide projects in the pipeline, working with clients to develop the next generation life-critical drugs. Commenting on the key metrics, they said they'll be able to sustain margins at current levels and does not anticipate any challenges in terms of revenue and margin going forward. The last 3 years, revenues have compounded over 30%.
Next up is Signature Global. The realty firm has a target to line up new launches worth 70,000 crore rupees. 4,000 to 3,000 crore rupees worth of projects were unveiled in the first quarter, that is Q1 FY26. Now, projects worth 13,000 crore to 14,000 crore rupees will be out in the coming 3 quarters as well. The management adds that sales were low in Q1 FY26 on account of high base in the same quarter last year. Further expects collections to spike up at the end of Q2 FY26 and Q3 FY26. But the company doesn't see the price going beyond the 7 to 8% increase that one has seen in micro markets.
We also had the management of Sanathan Textiles join in. They're bullish and optimistic on the textiles and yarn space, seeing momentum for both domestic and export demand. To make the most of growing demand, it's now starting a greenfield facility in Punjab, the capex of 2,100 crore rupees, something that it had alluded to the street earlier itself. Starts commercial production in the next 3 to 4 weeks. Expects to see about 60 to 70% revenue contribution from the new facility, which basically doubles their capacity, which implies the revenue growth for this year could be 70% with double-digit EBITDA margins for this year. On an absolute basis, the revenue 4,500 to 4,800 crores in FY26.
And before we wrap up this edition of Markets Forward, let's go across to Ria, who's here to tell us which are the important events to watch out for in tomorrow's trading session. Ria.
Well, yes, Vinny, it's a data-heavy Thursday. Globally, in the US, we have the initial jobless claims rolling out tomorrow, and Fed Governor Waller is also set to speak, so watch out for any important comments coming out of there. Germany's CPI and Japan's PPI data are also on the radar, while the OPEC meeting in Vienna continues tomorrow. Back home in India, TCS kicks off the earnings season tomorrow, and Tata Elxsi, Anand Rathi and IREDA will also be reporting their quarterly numbers tomorrow. On the corporate front, PC Jewelers Board will meet to consider a fundraise, while Tourism Finance Corp will weigh a stock split. Also on the radar, Dr. Reddy's Labs will trade ex-dividend, and MCX is set to launch its electricity futures contracts tomorrow. And finally, in the primary markets, all eyes on SmartWorks co-working spaces. The IPO opens for subscription tomorrow.
All right, Ria, thanks a lot for that. Those are the bunch of events that we need to watch out for in tomorrow's trading session. With that, Vinny and me will take your leave on this edition of Markets Forward. Thank you so much for watching. Stay tuned to CNBC-TV18 for more news and updates.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. US President Trump widens his trade war, announces 50% tariff on copper without mentioning when it will take effect, also promises tariffs on semiconductors and pharma, warns pharma tariffs could even hit 200%, but only after 18 months. The wait for a decision on the India-United States mini trade deal gets longer. Sources say that the ball is now in the US president's court and further talks have not been ruled out. Trump reiterates that all members of the BRICS bloc, including India, will have to pay an additional 10% tariff. Sensex and Nifty remain stuck in a tight range and end with minor cuts. Inflows into equity mutual funds see a 24% rise in June. Gold ETFs see a sharp surge. SIP inflows touch a record high of 27,000 crore rupees. Shares of Vedanta decline after a short seller says the company resembles a Ponzi scheme. Viceroy Research takes short positions on Vedanta's debt, saying the group structure is financially unstable and operationally compromised. Vedanta hits back, calls the report a malicious combination of selective misinformation and baseless allegations. The Sun TV family feud is likely to have ended. Money Control reports the Maran brothers may have settled the dispute over shareholding after mediation by Tamil Nadu Chief Minister M.K. Stalin. Quick commerce company Zepto set to raise up to $500 million in fresh funding rounds. Also say existing investors will lead the round, which values the company at $7 billion. Cisco seeks to triple its India business, citing huge advantage due to demographics. Global CEO Chuck Robbins says India is among the top 3 markets for the company, adds uncertainty around tariffs is freezing business decisions worldwide. That's an exclusive. At least 9 killed as multiple vehicles plunge into a river following a bridge collapse in Gujarat's Vadodara during peak morning hours. The death toll is expected to rise as search and rescue operations continue. At least 109 people are dead and more than 160 missing after floods ravaged the U.S. state of Texas. 86 people died in a single county in what is the worst flooding disaster in the U.S. in nearly 100 years. All right, our top story this evening. U.S. President Donald Trump is broadening his trade war. After threatening 14 countries with higher tariffs from August, Trump is now targeting copper imports and has promised higher duty on semiconductors and pharmaceutical products. Now, copper prices hit a record high in trade after Trump announced 50% tariffs. He's already imposed a 50% tariff on steel and aluminum imports. President Trump did not specify when the copper tariffs will take effect. Copper, remember, is the third most consumed metal behind iron and aluminum. Now, the U.S. imports nearly half of the copper it uses. That's not all. Trump also threatened tariffs on semiconductors and pharma imports, adding that duties on pharma could surge up to 200%. However, he promised 18 months so the pharma industry can be prepared for the tariffs. Now, 2 days ago, Trump had threatened 14 countries with higher tariffs from August, but there was no mention of India. Now, sources say the final decision on a mini trade deal with India squarely rests with President Trump, and further talks have not been ruled out. Trump has once again threatened 10% tariff on BRICS nations that include Brazil, Russia, India, China, and South Africa, calling it an anti-American alliance.
They have to pay 10% if they're in BRICS, because BRICS was set up to hurt us. BRICS was set up to degenerate our dollar and take our dollar as the standard, take it off as the standard. And that's okay if they want to play that game, but I can play that game too. So anybody that's in BRICS is getting a 10% charge.
Is that immediate, sir, or is
Yeah, pretty
if
soon.
they engage in some behavior?
Well, if they're a member of BRICS, they're going to have to pay 10% tariff, just for that one thing, and they won't be a member long. I thought BRICS was, I said this about a year ago, and it largely broke up. But, there are a couple that hang around, but I thought it largely broke up. BRICS is not, in my opinion, not a serious threat. But what they're trying to do is destroy the dollar so that another country can take over and be the standard. And we're not going to lose the standard. Ones we did seal, as you know, they're 50%. We did aluminum, 50%. Lumber just came out.
Why don't you announce copper?
And we did cars. And now today we're doing copper.
Copper and lumber. What would that tariff be on? The sectional tariff?
I believe the tariff on copper, we're going to make it 50%.
50%.
And we'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%. We'll give them a certain period of time to get their act together. But they were all here, now they all left. They went to other places because we allowed, people that sat in this room allowed it to happen. And I don't allow it to happen. The people in this room don't allow it to happen.
Now, the decision on the India-United States mini trade deal is imminent. Sources have said that the ball is now in the US President Trump's court. Parikshit Luthra joins us now with the details. Parikshit, what can we expect?
Well, sources in the Indian government have been saying that talks between India and US on the mini trade deal or the early harvest trade deal have been quite positive. However, there are certain sticking points or unresolved issues which still remain. From the Indian side, the negotiations are over in terms of the deal that India could offer. And earlier, we were working with a 9 July deadline in mind with a view to have some sort of interim arrangements with the US so that the 26% reciprocal tariff threat could be averted. Now that the 9 July deadline for reciprocal tariff has been extended till the 1st of August, there may still be some room for negotiations, and there is a possibility that this trade deal may spill over the next few days or even weeks. However, the Indian government, we're told, and this is highly placed sources telling us that we've done whatever we could. For the moment, we are waiting for the Trump administration to decide whether they want to accept India's offer at this stage and have an interim deal and negotiate the rest of the sticking points later, or indicate to us that, yes, we do want a trade deal with India, but more issues, more of the unresolved issues need to be negotiated over the next few days. One can't rule out the Indian negotiating team going back to US again over the next few days. But frankly, all hinges on the president. It could happen over the next 1 or 2 days. We'll wait and see. But the sticking points remain agriculture and dairy. These are red lines for India. We will not be giving access. We've not given access to anyone for that matter. There is a threat of the BRICS tariff, which has also now come in, which is a new thing in terms of the talks between India and the United States. So let's see how India navigates. For the moment, we're waiting for Trump to give us the signal.
All right. Thank you, Parikshit, for that update. And speaking of tariffs, Cisco CEO Chuck Robbins has said that the uncertainty around tariffs is freezing business decisions worldwide. Speaking exclusively to CNBC-TV18, Robbins added that the company will try to adapt to the tariffs and that its impact has not been meaningful yet.
Well, this is the issue in the business community right now is the uncertainty just freezes everyone. Because if and when we get to the end game, then we can adapt appropriately. And so if you look at the tariffs that were put in 2018, I think it was, we knew what they were put in, and we were able to kind of flex our dynamic supply chain in order to adapt to those things. And we'll do the same to the extent we can once we see what the end game looks like. But right now it's a little more complicated, looking at a multi-quarter P&L for the business because you just don't know which tariffs you have to consider. So what we've effectively decided to do is we're just going to look at our numbers based on what's in effect today. And then, I mean, we can do all sorts of speculating and scenario planning, but tomorrow they could be useless.
Right, on to the day's market action. Sensex and Nifty ended with minor cuts after a range-bound session. A sharp fall in Reliance in the last hour dragged the Nifty to levels below the 25,500 mark. IT stocks were under pressure ahead of TCS earnings tomorrow, with the index ending 1% lower. From equities to mutual funds, inflows into equity funds rose 24% in June after 5 straight months of decline. The improvement was largely driven due to inflows into mid-cap and small-cap funds. SIP inflows continued their solid run, crossing the 27,000 crore mark for the second straight month. Surabhi joins us now with a detailed report card.
After a really disappointing May, when flows had dipped below 19,000 crores, mutual fund equity inflows for the month of June have recovered. There's about a 24% recovery. You can see that last bar is now at 23,500. Now, how is it split across mid-cap, large-cap, small-cap? The preference for investors is still small and mid-caps. That's the headline, because you can see the large-cap funds there. They've recovered from May, but now compare this with how the flows are for mid and small. Mid-cap funds flows are about 3,750 crores. Small-cap fund flows are even better at 4,000 crores plus. So overall, there's a recovery coming in. But I do want to point out here that the data is telling, and it probably is telling us that the investors are becoming very smart. Because while equity funds have pulled in 23,500 odd crores, look at hybrid funds. They have also pulled in over 23,000 crores, 23,200 something to be more precise. So we're almost neck to neck in terms of pure equity flows and hybrid flows. And it's telling you that people are taking a balanced approach. They are looking at diversification. And the fact that a lot of the hybrid funds have very attractive tax structures as well now after the budget. This is making this particular category fairly popular. The other good news is that the SIP picture is rock steady. In fact, monthly SIP flows are now above 27,000 crores. So that pillar is rising higher and higher. So looking fairly good.
Thank you, Surabhi, for that. A report published by US-based short seller Viceroy Research has alleged that the Vedanta Group structure is financially unsustainable, operationally compromised, and poses a severe underappreciated risk to creditors. The company has hit back, calling the report a malicious combination of selective misinformation and baseless allegations. Now, Hormaz Fatakia joins us with more on this. Hormaz, what are the key allegations leveled by the Viceroy Research against Vedanta?
Another short seller saga that has emerged here, and this time around it is Viceroy Research. This come out with a note against Vedanta, and they've mentioned the fact that this entire group structure is financially unsustainable and operationally compromised and poses a severe underappreciated risk to the company's creditors. Now, they have highlighted the parent company, that is Vedanta Resources, that is systematically draining the listed entity by draining cash out to service its own debt burden, and this entire arrangement, according to Viceroy Research, has pushed the group on the brink of insolvency, is what they have mentioned. Now, certain observations that the Viceroy Group has made against Vedanta, they say that their interest expenses have vastly exceeded their reported note rates, and despite the decline in paydowns and restructuring, despite the decline in debt, the interest expenses continue to rise for the group. Now, they also say that there are a lot of non-performing operating subsidiaries with inflated asset values, is what they have observed, and the debt across these non-performing subsidiaries vastly exceeds their true value, and it is cross-collateralized across the group, is the observation that they have made, and billions of dollars worth of disputed amounts have been kept away from the balance sheet and are not disclosed in the financial statements, is what Viceroy Research has said. Now, over the last 4 years, Vedanta Limited has paid dividends worth over 80,000 crore rupees, where the parent company at one point of time owned around 65% stake, but they have sold that down to around 56% currently. And if you see the last 4 years as well, the payouts have ranged anywhere between 16,000 crores to as high as 40,000 crore rupees. Now, in a response to CNBC-TV18, the Vedanta Group said that this report is a malicious combination of selective misinformation and baseless allegations to discredit the group.
and it has been issued without making any prior contacts to the company, and they have issued this with the sole objective of creating false propaganda. They've chose to sensationalize information that is already available in public domain, and the timing of the report is also suspect, and it could be ahead of the corporate activity that the group is about to undertake. They've also added disclaimers saying that the report is only for educational purposes on multiple occasions, and Vedanta continues to remain focused on the growth of their business, and they have appealed to avoid speculation and unsubstantiated allegations. In response, the Viceroy Group also wrote on X saying that they have dismissed their 85-page report thoroughly without attempting to discredit their work, and this is likely because they are unlikely to refute their holdings and their findings, and they are happy to take questions. So more short seller allegations emerging against Vedanta before the demerger is about to be completed. The stock reacting to that in response.
All right, thank you, Hormaz, for that update. Moving on, India's aviation regulator DGCA has told a parliamentary panel it is taking steps to curb the rise of airfares during periods of high demand. The DGCA said that it's working on a mechanism and may fix a price ceiling on certain routes during periods like festive seasons. Members of the panel also questioned official agencies and private airlines over safety standards being followed. The Sun TV family feud is likely to have ended. Money Control reports that Maran brothers may have settled the dispute over shareholding after mediation by Tamil Nadu Chief Minister M.K. Stalin. Now, the Bombay High Court judge has recused from hearing HDFC Bank MD Shashidhar Jagdishan's plea to quash an FIR registered by Leelavati Hospitals Trust. This is the fourth judge that has recused himself from hearing the case. The HDFC Bank CEO had moved the Supreme Court to seek relief after 3 judges refused to hear the plea. However, the Apex Court did not hear the case after noting that the matter was listed before the Bombay High Court. The top court expressed hope that the High Court would take it up on the scheduled date. Quick commerce giant Zepto is in advanced stages to raise $450 to $500 million from existing investors in a fresh funding round. Sources have said that this funding round will value the company at $7 billion. Aishwarya Anand joins us now with more. Aishwarya, please take us through Zepto's fundraising plans.
Zepto is gearing up for another major fundraise. Sources have confirmed to CNBC-TV18 that the IPO-bound quick commerce unicorn is in advanced talks to raise $450 to $500 million in primary capital at a post-money valuation of $7 billion, a sharp 40% jump from its $5 billion valuation last year, when it raised $1.3 billion. The round will be led by General Catalyst and Avenir Growth, with other existing investors expected to participate on a pro-rata basis. Now, this comes as part of Zepto's broader strategy to increase domestic ownership ahead of a potential public listing. In May this year, Motilal Oswal and Ramdeo Agarwal invested $50 million each in their personal capacities to acquire stakes. Meanwhile, competition is intensifying. According to ICICI Securities, Blinkit's gross order value grew over 25% on a sequential basis in the first quarter of this fiscal year, with Swiggy's Instamart rising 22%. Datum Intelligence reports that Zepto's daily active users fell from 5.5 million in December 2024 to 4.9 million in June 2025, while Blinkit rose to 6.2 million. Despite rising competition, Zepto remains a strong player. As per a Citi report, while Blinkit leads the market with a 41% share, Zepto is either equal or slightly ahead of Swiggy Instamart's 23% market share.
Right, thank you, Aishwarya, for that. On that note, we'll slip into a short break. Coming up next, 9 people have been killed so far as multiple vehicles plunged into a river following a bridge collapse in Gujarat's Vadodara. More details when we return. Welcome back. At least 9 people were killed and several vehicles plunged into the Mahisagar River after a bridge collapsed in Gujarat's Vadodara district. A portion of the Gambhira bridge gave way during peak traffic hours. The 4-decade-old bridge connects the districts of Vadodara and Anand. A large-scale rescue operation is currently underway and authorities are investigating the cause of the collapse. Prime Minister Narendra Modi has announced a compensation of 2 lakh rupees for the families of the victim. My colleague Hardik Dikshit gets us the latest.
गुजरात के वडोदरा जिले से आणंद जिले को जोड़ने वाला जो ब्रिज है वो सुबह ही ढह गया और उसकी वजह से लगभग 9 लोगों की मौत जो है वो हो चुकी है। अभी आप ये जो तस्वीरें देख रहे हैं ये पादरा तहसील से लगभग 15-16 किलोमीटर दूर ये जो गंभीरा ब्रिज है वहाँ की तस्वीरें आप देख रहे हैं और ये महिसागर नदी के ऊपर से ये जो ब्रिज है वो जाता है और पादरा तहसील से आणंद जिले को जोड़ने का काम ये ब्रिज करता है। और अभी जो है रेस्क्यू की पूरी जो कार्रवाई है वो की जा रही है। NDRF, SDRF और फायर ब्रिगेड की ओर से पूरा रेस्क्यू ऑपरेशन जो है वो चलाया जा रहा है। तकरीबन 9 लोगों को बचा लिया गया है और 9 लोगों की ये जो पूरी घटना हुई उसमें डेथ हो चुकी है। और यहाँ पे सबसे बड़ी बात कि पिछले 5 साल से यहाँ के स्थानीय लोग हैं वो प्रशासन को बता रहे थे कि ये जो ब्रिज है पूरा क्षतिग्रस्त है, ये इस्तेमाल करने के लायक नहीं है, लेकिन प्रशासन ने स्थानीय लोगों की एक भी नहीं सुनी और पिछले 5 साल में सिर्फ और सिर्फ ऊपर से मरम्मत करके ये ब्रिज का काम जो है वो चलाया गया। और स्थानीय लोगों ने कहा था कि हैवी व्हीकल के लिए ये ब्रिज जो है वो बंद कर दिया जाए, लेकिन प्रशासन ने वो भी बात स्थानीय लोगों की नहीं सुनी। उसकी वजह से आज इस प्रकार की गंभीर जो घटना है वो यहाँ पे हुई है।
Thank you, Hardik, for that update. In international updates now, Israeli forces continue to bombard Gaza, hitting a refugee camp in the enclave. This comes a day after the military killed at least 95 Palestinians. US President Trump and Israeli Prime Minister Benjamin Netanyahu met for the second time to discuss a ceasefire. However, there was no breakthrough. Around 109 people have died and over 160 are still missing after flash floods ravaged central Texas on the 4th of July. The state governor has said that search and rescue operations are ongoing. He added that most of the unaccounted people are from hilly country, since no one from that region has checked into hotels or registered at camps yet. Apple has named Sabi Khan as its new chief operating officer. Khan will take over from Jeff Williams as part of a long-planned succession. Sabi Khan currently serves as Senior Vice President of Operations and has been with Apple for 3 decades. Khan is set to officially take over the CEO role later this month. Uber has unveiled a number of features in India as competition in the ride-hailing space heats up. Uber India head Prabjeet Singh told my colleague Shilpa Ranipeta that they were building products in the country for the globe. He also welcomed the new cab aggregator guidelines, said it reflects inputs from all stakeholders.
So today we already have 1.4 million active drivers on the platform, 14 lakh drivers who are using us every month. We continue to scale our business as the 3rd largest market for Uber globally in terms of trips we do and among the fastest growing markets. Second, Uber is also a very important innovation hub for us. A lot of the products which we are building in India are actually finding relevance and we are taking it global. So examples being Uber Bikes, where you are able to now take a 2-wheeler, or Uber Intercity, which is one of the fastest growing products, are actually now being scaled globally.
I have to ask about the recent MVA guidelines also. The whole host of guidelines under that, whether it is about cancellation fees, whether it's surge pricing and all of that. How do you see the MVA guidelines and what does that mean for the ride-hailing market in India and for Uber as a player?
I think as in mature industry, even though we are 12 years old, we are still evolving. The fact that there are regulatory frameworks is a signal that the industry is maturing. Right. And we welcome the MVAG 2025 guidelines. I think they reflect both the inputs from all stakeholders, including industry participants, and we're looking forward to implementation of those and adoption of those by different states. So we look forward to dialogues with all the states and hope for a quick adoption by different states.
And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Let's talk money.
Hello and welcome to another brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. The futures and options market almost never ends being in the headlines and in the news. From SEBI cracking down on multiple expiries that both the exchanges were offering us, to tighter regulations overall, to the latest Jane Street saga. Now, I want to focus on this last event that I mentioned, Jane Street, SEBI taking on a global giant HFT, which is high frequency trading, algo firm for alleged market manipulation. So the question is, does this large event and this ongoing legal battle, does it have any bearing on us mutual fund investors? Do we need to make any changes to our investments, to our portfolios? Is there anything to be wary of given the SEBI order? Well, that is what we'll start discussing on the show today. And to do that, I have with me Niranjan Avasthi of Edelweiss Mutual Fund. And in a bit from now, we'll also bring in Misbah Buxmusa of NJ Wealth to talk about overall MF investing trends and where we stand at the end of the first half of this calendar year. Niranjan, thanks so much for taking out the time. I know this is a tricky issue. A lot of people are a little hesitant in talking about it, but we thought it's important to clear the air so that mutual fund investors know what's going on. So first things first, tell us your interpretation of what's happened. We know that this is a big legal case. It's probably going to go on in the courts. And SEBI is looking to impound a large sum of money, almost 5,000 crores, because it feels that this one global entity was, abusing our market framework. Should mutual fund investors be worried?
Right. Thanks, Ruby. Thanks for having me. So my one-line answer is absolutely not. Mutual fund investors should not worry. Thankfully, SEBI has many guardrails and very strict regulation around how mutual funds can participate in F&O market. The issue that has happened has impacted or will impact most likely the weekly option market in India. Mutual fund per se do not usually get into or participate into weekly option market. Largely, mutual funds are allowed to participate in F&O only for hedging and rebalancing purposes. And the participation is largely in the futures market. And if at all in the option market, it is in the monthly expiry market. So weekly expiry market, mutual funds largely do not participate. And hence, there is nothing to worry for mutual fund investors because of this entire issue.
Okay, so that's reassuring to hear that we don't need to worry. But just to understand this a little better, Niranjan, what you're saying is that mutual funds, equity mutual funds, whether it's large caps or mid cap or a flexi cap fund, typically they will not have any participation in the options market. If at all, they might have some hedges, but that's through the futures market. Is that right?
That's correct. That's correct.
Okay. Also, are there any regulations that restrict mutual funds from overall F&O trading? We know that the regulation for mutual funds is far more tighter. It's the new asset class, this, the other SIFs, where SEBI is looking to relax it. We'll come to SIFs later, but just set the rules straight in terms of F&O. What can mutual funds do and what are they prohibited from doing?
Great. So in mutual fund, if you see, largely hybrid mutual funds are usually the ones which, trade or take exposure into F&O market. As per regulation, mutual funds are allowed to participate in futures and options only for hedging and rebalancing purposes. No naked exposure is allowed, no leverage is allowed. So if at all a future exposure is taken, it is only for hedging purposes. Even if it is taken in the option market, it is probably a covered call strategy, which is against hedged. At the same time, leverage is not allowed. So even if there is an exposure into futures or option, the overall exposure in the mutual fund portfolio cannot go beyond 100. So the beta that we talk about is basically within that limit of 1. So once the leverage is not allowed, a lot of other risk parameters gets checked. Now within hybrid funds, if you see, there are funds like Balance Advantage Fund, which take exposure into hedging, into futures for hedging purposes, because they reduce equity level from maybe 70-80% to as low as 30-40%. This reduction in equity exposure is done via taking some future exposure. But as I said, it is a hedge exposure. There is another category, which is equity savings fund. Equity savings fund also use derivative exposure, but again, it is to create an arbitrage exposure, which is completely hedged, 100% hedged. Other funds like multi-asset allocation funds, they may also use derivatives, but again, it is for hedging purposes. So largely mutual funds, as I said, are allowed to take exposure only for hedging. There is no leverage allowed. Mostly only hybrid funds usually take these exposure. None of the other equity funds or diversified equity funds usually take exposure to options. They may take small exposure to futures, to take maybe exposure to a stock which is not available in cash today, but usually with an intent to take delivery and not speculative. So
So I
mutual
think that
funds do not take any speculative exposure. They are not allowed to take speculative exposure in the derivatives market.
I think that's a really important headline, and that we should all remember, and all mutual fund investors should keep it at the back of their mind, that mutual funds do not look to speculate and make trading gains with the F&O market. They use the F&O market purely from a hedging standpoint, or like Niranjan explained, if they can't get a cash market stock immediately, then maybe take a futures position with the intent of eventually taking that cash stock and holding it in the portfolio. But Niranjan, I get your point. So the MFs don't play in and out of F&O with the intent to make speculative gains. But given what's happening in the market right now, and that now Jane Street is being told that they need to wind up all their positions, and apparently they had very large positions in the market, could this in the interim impact the hedges that mutual funds have?
So, as I said, the entire issue which has happened is largely related to weekly options. Mutual funds do not participate in that segment. Whatever winding up may happen will happen in the weekly option segment, and there may be some illiquidity concern, or the volumes would be lower. But later on, this will make up, because there are other participants in market, whether it is AIF or maybe SIF coming into picture over the medium term. However, MF, which usually operates in futures market, almost 80-90% exposure is only through future market. That is not impacted. Volumes will be consistent out there. And even if it is in the option, it is in the monthly space. So largely, whatever winding up will happen may impact the weekly option. Liquidity may come down, to some extent. However, mutual fund again will stay immune to this, because they are not the participant in that weekly option market.
In the weekly options market, yeah, absolutely. And that's where a lot of tighter regulation is also happening. That's what I was saying, that the regulator has reduced the number of weekly products per exchange to just one a week. Now there is some chatter about whether instead of weekly options, whether it will be made fortnightly. So you don't speculate every week. You limit it to just once in a fortnight. It's all within the realm of sort of chatter and talk. We need to see what the final regulations could be from SEBI on this account. Fair enough, Niranjan. So that point has been driven home loud and clear. But now I want to talk about second-order effects, and if at all that should, worry us. A lot of the capital market stocks were doing so well in the last 12 months. Stocks of brokers, of stock exchanges, wealth management companies, really doing extremely well. Now, with this whole volatility and the whole Jane Street saga against many of these stocks, including, whether it's exchange names like BSE, etc., or wealth managers, these stocks have started correcting. Now, investors have been writing into us as well, saying, should I be worried? Should I be booking profit? What should I do? Is there a larger capital market issue which will, which will take some time to sort out? What would your suggestion or advice be?
So the entire capital market story, if you see, it's largely structural, right? In the last 3-4 years, especially after COVID, the financialization of saving that has started has actually taken shape, and forget about only broking, right from mutual fund industry to other capital market, whether it is wealth management, have been doing well because of this structural change in the way household savings is getting into financial assets. Having said that, recent times, definitely valuation of some of these capital market stocks have been on the higher side. We've seen some dip in volumes also in the option market, specifically after SEBI taking several steps in last 1.5 year. If you compare last 1 quarter numbers versus numbers in the first half of 2025, there is some bit of drop in the number of trading accounts, in number of volumes, in terms of turnover as well. So that, apart from this event, also definitely had some impact on the capital market stocks. But I think so that will be limited.
Let me bring in Mr. Misbah Baksmusa of NJ Wealth into the conversation as well. Mr. Baksmusa, thank you for joining in, and for the benefit of our viewers, I do want to point out that NJ Wealth is among the largest, probably the largest mutual fund distributor in the country. So obviously a huge role to play when it comes to expanding the industry in terms of expanding investor education as well. Mr. Baksmusa, I know you don't want to directly comment on the issue, but I'm just wondering, because we've been getting a lot of queries from viewers. Viewers are curious. They want to know whether this whole Jane Street issue is just it's an issue for the courts, it's an issue for direct traders, or whether from a mutual fund standpoint, does it impact anything as well? And apart from this, overall, the F&O market, I mean, on and off, like I've been saying, a lot of issues, a lot of regulatory action. Have you been getting any queries on this from your client base?
Yeah, very good morning, and thank you, Surbi, for inviting me. So, I've been also been reading the Jane issue in the media. But to be very honest, we being an organization which has been promoting mutual funds and systematic way of investing into mutual funds and not offering derivatives on our platform, we have never got a query as to what's really happening from our large base of investors. But I think so few things that we have to learn from this particular issue which is popping up, that and again, I think so SEBI has been publishing the data of the extent of the loss the F&O traders have been incurring in the last last 3 financial year data they have been consistently publishing, and the kind of losses the investors are making out, investing into F&O. I think so it's a big learning for the young generations who have been investing through this F&O market, that invest into equity is not very simple, or probably making money from it in a very short period of time is just a fancy. If you really want to make money from your investments, you have to be very disciplined, long-term, systematic, and probably mutual fund is the best investment vehicle, So I think those are the learnings rather than worrying about, because as my colleague previously also said that mutual funds are not affected by this particular event. And that's what the beauty is, that our regulations are so strong in mutual funds. And probably we have a history now of nearly 30 years of the regulation in place. And we don't have any instance in mutual funds which have occurred in the last 30 years, which is of worry to an investor. And people have made money out of it. So yeah. Yes, I think that there are good learnings which the young investors should take from such events and try to probably change their investment habits.
Absolutely. And SEBI has been really going over again and again with its study. And that's the findings of the study, by the way, are very consistent. Almost every year, SEBI study says that 90% plus retail traders end up losing money in F&O. And in fact, this year's study is telling us that the losses are going up. The losses have increased 40% this year. Which, brings me to a final point on this whole issue of F&O and how we investors should look at F&O, is the whole concept of SIFs. These new investment funds that the AMC world is going to launch, and these will be far more sophisticated than plain vanilla mutual funds. And we just heard, Niranjan, you were telling us that mutual funds cannot take very sophisticated speculative positions in F&O, but SIFs will be allowed to do that. So then what would your thoughts be? I mean, is it a right time, or maybe it's not such a great time to be launching SIFs till our F&O market stabilizes and the regulation stabilizes?
Not really, Surbi. If you see, SIF also comes under the gamut of mutual funds, and SEBI is again put very, very tight guardrails when it comes to SIF as well. Only one difference which, pertaining to F&O trade, and the difference between MF and SIF is that SIFs will be able to take 25% exposure, up to 25% exposure to naked shorts, whether it is in the futures market, or they can write options in the option market. This 25% has to be part of the portfolio. Again, here, they haven't allowed leverage. Most speculative trading happens because there is a higher leverage available in derivative market for retail investors. Even in SIF, the gross exposure the total exposure of the portfolio will not be allowed to exceed 100%, which means if you have 100 crores in your portfolio, 75 crore can be invested in equity shares or stock, cash market. Remaining 25 crores can be used for hedging purposes, for taking naked short exposures. But again, the overall exposure cannot exceed 100 crores.
Let me quickly take maybe a 30-second view from Mr. Baksamusa on this, because like I said, NJ has been one of the largest distributors in the country when it comes to plain vanilla mutual funds. What about SIFs, Mr. Baksamusa? Niranjan is making a strong case for them because they'll be far more regulated rather than me as an individual investor trying to dabble in F&O and do all kinds of pluses and minuses. Maybe it's better to let experts do it for me. There's a strong argument there. Your quick thoughts on whether we're ready for SIFs?
Very honestly, Surbi, at this juncture, we as an organization are also in process of understanding SIF. And but our core philosophy is that globally and even in India, the structure of mutual fund is so simple, so efficient. From a regulatory framework, is one of the best structure an investor could have. And in India, currently, only 5 crore investors have invested into mutual funds. So as far as we as a distribution house is concerned, we see that a lot of things currently needs to be worked in making investor understand this concept and try to get more and more people invest into mutual funds to really bring in the financial inclusion. As you rightly said, yes, SIFs are going to come in. We will understand it. But I strongly believe that it will never be a very core product in the investor basket. Probably it will be a pudding or probably some small portion, depending upon a certain need of certain investors, will definitely get fulfilled. But we need to see and understand it more detail before I really comment on it.
No, absolutely. And let me plug in our earlier episode of Let's Talk Money here as well, viewers, in case you want to know more about SIFs, because you'll be hearing a lot more about these specialized investment funds in the months ahead. Check out our playlist on YouTube, because we've done a full show on what are SIFs, what are the kind of trading strategies they're looking to deploy, whether their returns will be better than MFs. So do catch that show as well. But for now, a quick break. Then we talk about some of the other trends that MF investors can watch out for the remainder of 2025.
Let's talk money. talk money.
Welcome back. You're with us on Let's Talk Money, and this week we're discussing what the ramifications of the Jane Street episode could be, if at all, on mutual fund investors. And our guests agree that it really is not a issue of bother at all for MF investors, because MFs are very, very tightly regulated and they do not speculate in the futures and options market. So, gentlemen, let's move on to some other thoughts. I mean, overall, what we've seen in the last couple of months, still actually the June data, which just came out this morning, is that total equity flows coming into mutual funds, they were dwindling. I mean, from highs of 40,000 crores every month, we had come down to about 19,000 crores in May. Now it's recovered to about 23,000 crores in June. But really, what are we in for? Mr. Baksmusa, if I could come to you, NFOs were pulling in a lot of money in 2024, up until a couple of months back. What are the big trends that you see ahead in terms of more offerings and investor appetite? I mean, do you see us getting back to MFs pulling 40,000 crores in equity funds every month?
See, to my understanding, most of the time in mutual funds, the major flow into mutual funds, the major source had always been SIPs, right? And if you see the trend, SIPs are continuously increasing. So at an industry level, we are now at around 28,000 crore of SIP. So without much of doing, this 28,000 crores are expected to come in. Now, from a per se level, as I previously also said, the crux is not about that level of 40,000 going to 28,000. In the past also, we have seen some periods where the money have dwindled and again picking it up. So that's a very normal, natural phenomenon of a market, where at some point of time, money automatically increases, or at some point of time, it goes down a bit. But I think so from a very long-term perspective, the need of an hour is that how we are able to make more and more people participate into mutual funds. And to us, SIP is the most logical way for participating into the equity markets, because it's the only way where at every level, if the markets are going up, investors are happy because their values are going up. If the markets are going down, again, it's a win for an investor because you are gaining more number of units, right? So I think so the SIP had been the heart of this industry, and it's very, very good that that particular thing is growing very, very steadily. The time is coming that at what high speed we are able to increase that SIP, how we are able to reach to more number of investors. That would bring in a lot of consistency as to how money is coming into the equity markets, and that will give the stability to the market also. And probably from an investor perspective is also a great win-win over a longer period of time. So as an organization at NJ, we are just working on to, spreading the awareness about mutual funds and spreading the awareness about the simple concept of SIP. And it's very, very pleasantry to see that number overall in the markets are going up.
Yeah. No, absolutely. Niranjan, final thoughts with you in terms of what can investors expect from the industry for the remainder of this year. Like I said, lots and lots of passive launches have been happening. In fact, even now, when I look at the NFOs, mostly it's happening on the passive side. Once in a while, we get a large, actively managed fundraise. But what should investors expect from you guys in the coming months?
Right. So I think so. The industry will keep coming up with innovation and multiple fund launches as the time fits for the investors. And I think so, as you said, the number of launches has come down drastically. Most importantly, what the point to note is in the last 6 months, it has been a challenging months for mutual fund investors. And at the same time, it's quite heartening to see that SIP numbers continues to be very, very strong. Which shows that retail investors' faith in mutual fund has just started, has been very, very strong. As far as NFOs are concerned, I think so, yes, passive launches will be there. But I think so a large part of, product gaps have been filled in last 1 or 2 years. That also could be one of the reason why, the NFO pace has come down. Passive, yes, there could be a lot of innovation that can come in, especially in the smart beta phase, because largely the plain vanilla index funds or ETF offerings are full today. But yeah, I mean, let's see how the time goes. And most importantly is investors should continue investing in their existing funds. And at least from that perspective, we are seeing the trends being very, very healthy.
Okay. All right. Well, investors are keeping the faith. They're still making a beeline, for instance, for a lot of mid-cap and small-cap funds. So there's enough appetite out there. And let's see how the markets also shape up in the second half of the year. Gentlemen, thank you very much. A helpful discussion. Lots of perspective there for all the mutual fund investors in the country. Thank you for joining in. And viewers, keep sending us your feedback, comments and queries. Tell us if you want us to address any newer topics. And we'll see you again on the show next week. Thanks for watching.
Let's talk money.
Hello and welcome to News Center. I'm Parikshit Luthra. Here are the headlines this evening. US President Trump widens his trade war, announces 50% tariff on copper without mentioning when it will take effect. Also promises tariffs on semiconductors and pharma, warns pharma tariffs could even hit 200%, but only after 18 months. Sensex and Nifty remain stuck in a tight range and end with minor cuts. Inflows into equity mutual funds see a 24% rise in June. Gold ETFs see a sharp surge. SIP inflows touch a record high of 27,000 crore rupees. Shares of Vedanta decline after a short seller says the company resembles a Ponzi scheme. Viceroy Research takes short positions on Vedanta's debt, saying the group structure is financially unstable and operationally compromised. Vedanta hits back, calling the report a malicious combination of selective misinformation and baseless allegations. The Sun TV family feud is likely to have ended. Money Control reports that Maran brothers may have settled the dispute over shareholders after mediation by Tamil Nadu Chief Minister M.K. Stalin. Quick commerce company Zepto set to raise up to $500 million in fresh funding rounds. Sources say existing investors will lead the round, which values the company at $7 billion. Cisco seeks to triple its India business, citing huge advantage to demographics. Global CEO Chuck Robbins says India is among the top 3 markets for the company. Adds uncertainty around tariffs is freezing business decisions worldwide. That's an exclusive. At least 9 killed as multiple vehicles plunge into a river following a bridge collapse in Gujarat's Vadodara. During peak morning hours, the death toll is expected to rise as search and rescue operations continue. At least 109 people are dead and more than 160 missing after floods ravaged the U.S. state of Texas. 86 people died in a single county in what is the worst flooding disaster in U.S. in nearly 100 years. All right, let's talk about the critical mineral crisis that we are looking at right now. This is a priority for the government, even during his visits to countries like Brazil recently and Argentina. How to secure critical mineral supply chain was the big talking point. And this is in light of the rare earth magnet crisis, which has emerged because of Chinese restrictions on rare earth supply chains. They're not letting rare earth consignments go to any company in India. At this point, India and Australia are seeking to identify key investment opportunities in the critical mineral space. That's the word coming in from Nathan Davis, who is the Australian Trade and Investment Commissioner. Speaking to Abhimanyu Sharma, Davis added that Australia is committed to boosting trade ties with South Asia and plans to bolster its relations with India.
The Australian government's committed to South Asia in a number of ways, and certainly increasing our trade and investment relationship. We have an interim free trade agreement in our AEI ACTA, and certainly on our way to hopefully a full comprehensive trade agreement. The Australian government has a number of initiatives within the Australia-India ecosystem. What I'd like to briefly discuss with you is, so we have for the Australian Trade and Investment Commission, the South Australia Business Exchange, which is a $40 million commitment over the next 4 years to increase two-way trade and investment with on the ground tangible proposals. We've also announced the Australia-India Economic Roadmap, which is a sort of forward-looking strategy to across the next decade, which identifies 4 super highways of growth that the Australian economy can work with India in its complementarities. So that's tourism, education and skills, agribusiness, and what we're here for today, the clean energy agenda.
Speaking about clean energy, it's not just about solar panels, it's also about using critical minerals for many of the implements which are often used in heavy industries and also in renewable energy equipment. Now, speaking of further collaboration in that domain, Australia also has some degree of refining capacity which otherwise is dominated by China. What kind of further collaboration can be looked at, and what kind of capacity addition can be looked at with respect to collaboration between India and Australia on critical minerals, particularly on the refining aspect?
Sure. So the Australian industry on critical minerals is very good. We have over 30 nationally recognised critical minerals of significance, and our extraction techniques, our identification techniques and our processing is world-renowned. Certainly what we're looking here to do and what we're looking to increase is twofold. What we can help on for the processing side of things is certainly the technology transfer, and part of what the solution is here today is bringing companies that have that sort of technology transfer in critical minerals and also the manufacturing capability. For processing, it's an area that Australia is looking to uplift as well as India, and so to that extent we're both seeking to identify suitable investment opportunities for increased processing and refinement in Australia, but then also being able to bring those experiences from Australia into India.
And Indian Cellular and Electronics Association Chairman Pankaj Mohindru has said that it's important to encourage entrepreneurs to set up large factories for recycling lithium-ion batteries. Speaking to CNBC-TV18's Ashmit Kumar, Mohindru also explained how recycling lithium-ion batteries is cost-effective.
I think the total volume of digital industry lithium-ion batteries is very large, but the weight is not so much because they are small batteries. But today we are getting into electric vehicles and solar storage in a very big way. And these are then, heavy hitters, big weight, and less complex though. So I think it is very important that in the next 3 to 5 years, we are able to establish large factories, and the entrepreneurs have to be encouraged that this is not something which is getting imposed by the government, but it's a great optimum and a very good proposition, as a commercial and economic proposition to get into recycling of lithium-ion batteries.
How cost-effective is recycled lithium-ion? Just a word on that, in terms of cost efficiencies, will it be able to compete with raw materials otherwise?
Yes, because you are extracting the three major stuff in this, the cobalt, nickel and lithium-ion. So in the report there are copious figures, charts, what the composition is, what you will be able to extract, and if you have great technology, then I think the whole recycling, reverse logistics will also start falling in place. Because there is a cost of aggregation, there is a cost of transportation, and because things are so suboptimum, because of the informal sector not having good technology, there is some formal sector in this sector, but that's not too much. So I think the virtuous cycle has to be set in motion.
Sure.
That is what our attempt was, to catalyze that with the help of this report.
The big global story now. President Trump has reignited his trade war. The Indian government has informed the World Trade Organization about its proposal to levy retaliatory tariffs on U.S. goods worth over $700 million. The move comes after U.S. increased tariffs on the imports of automobiles and automobile components from India. The move comes at a time when both nations are locked in trade negotiations amid hopes of sealing a mini trade deal to avert tariffs. Joining us right now to discuss this is Jayant Dasgupta, former Indian ambassador to the WTO. Mr. Dasgupta, I'd like to ask you about the kind of tariffs he's imposed on at least 14 nations. There is criticism from these countries, but it is also being said that whatever Donald Trump is doing is not on firm legal footing and it's not compliant with WTO processes. What is the kind of challenge these US tariffs could throw in the days to come, and how will this impact the working of WTO and the efforts of these countries to utilize WTO as a forum?
There are several important questions which you have raised, Parikshitji. The first one is about recourse to the WTO. That I think is not possible at this juncture, because the US has blocked appointments to the appellate body for a number of years. And by December 2019, the appellate body of the WTO became non-functional. So if any country raises a dispute and gets a favorable verdict at the dispute settlement panel stage, which is the lower stage, then the other country which loses normally goes to the appellate body. And since the appellate body is non-functioning, the appeal is into a vacuum. So the appeal is kept pending till such a day when the appellate body starts functioning again. And what happens is that without the appeal being disposed of, the country which has gained a favorable verdict cannot retaliate or does not have any recourse to redressal. So the WTO is non-functional in that sense. There are some voices which are being raised that countries should get together which have been affected badly, and by and large, all countries of the WTO which are like-minded, to block the US and try to suspend it or expel it. Now, there is no provision in the Marrakesh Agreement which set up the WTO to expel a member. So it is again treading into new territory altogether. So the WTO for the moment, I think, is not available as a forum for redressal of these grievances.
So US is not just imposing tariffs, but also making sure that the WTO cannot function properly either. But let me ask you the next question, and this is a threat that Donald Trump has reiterated, that if you're a member of BRICS, you will get that 10% additional tariff. Where do you think this anger against BRICS is emerging from? When it comes to BRICS having its own currency, the Indian government has said that the idea was dropped. Russia had floated it, but during this BRICS summit, there was no talk about it. So where is this anger and threat about degradation or harming the US dollar coming from?
Well, even in this BRICS summit, President Putin has very strongly advocated the use of national currencies. And the resolution or the discussion on setting up a bank for settlement in BRICS currencies, or one BRICS currency, which can be kind of a composite of several BRICS currencies taken together, a weighted average kind of a thing, that was dropped only in 2022. And meanwhile, what has happened is that countries like China have started trading with Brazil, Russia, other BRICS members, and non-BRICS members also in their own national currencies. The Russians have started doing it. The India ruble trade is quite old. The Indian government has now started exploring possibilities of trading with the UAE, its second largest trading partner, in terms of their national currencies. So all these things are taking place on the sidelines. And perhaps President Trump is afraid that the dollar will no longer hold sway in the international trading market as it has done for the past 70, 80 years. So that is the fear which I think propels him to make these statements. I think he had said initially that he would impose a tariff of 100% against the BRICS nations if de-dollarization was taken forward. Then he raised it to 150%. Now he's come down and he's saying 10%. But there is another thing which has to be read into this statement. Of course, President Trump's statements should not be taken at face value, but he has said that any country aligning with the anti-Americanism of BRICS, so other countries, trading countries, which are outside the 10 of BRICS, if they trade with BRICS and they trade with their national currencies, possibly this could get invoked by President Trump. But one doesn't know about President Trump. He says something today, he says something just the opposite tomorrow.
Okay.
So, and the other point is,
question.
anti-Americanism has not been explained by any US administration official yet.
Absolutely. And my final question to you, sir, would be about with the current tariffs on 14 economies, including economies like Japan, Laos for that matter, Malaysia, Myanmar, South Korea, Vietnam trade deal has already happened. How does this impact the supply chain in Southeast Asia, and does India at this point emerge as a more advantageous option?
The advantage that India can derive will only come about if India's tariffs are retained at 10% levels, and Vietnam is at 20%, and Malaysia and the other Southeast Asian nations are again between 25 and 40%. And China is retained at 55%, though very little is known about the US-China trade deal, apart from the fact that China has resumed the supply of rare earth magnets. So it is a bit hazy, but if the other tariffs which comprise, these 14 nations, if they remain in place, India remains at 10%, only then India will derive an advantage. But if tomorrow President Trump were to announce, or by 1st of August, hypothetically, if further negotiations fail and the US does not accept India's offers, and again goes back to 26% or 25%, then that advantage will get negated completely.
Right. Thank you so much, Ambassador Dasgupta, for joining us on the program. We're going to take a short break here on News Center, but when we come, we will try to understand the politics of Donald Trump's trade wars and why is he pursuing this very strong American policy with regard to trade with all nations. We're taking a break here, but on the other side, we will be speaking to Harshvardhan Shringla, India's former Foreign Secretary and also Ambassador to the United States. Welcome back. United States President Donald Trump has said that they are close to having a trade deal with India. We learned from sources that India has offered substantial market access to U.S. products in almost all sectors, barring agriculture and dairy. Trump sent letters to leaders of 14 nations, starting with staunch U.S. allies, Japan and South Korea, proposing a 25% tariff. This is similar to the high duty proposed by Trump on the 2nd of April. Malaysia, South Africa, Indonesia, Thailand also facing higher tariffs. Trump said, and I quote, "If you want to play ball, this is how we play." End of quote. He also threatened an additional 10% tariff rate on nations aligned with the BRICS bloc. Joining us right now is former Foreign Secretary Harshvardhan Shringla. Ambassador Shringla, always a pleasure having you here on CNBC-TV18. First of all, I would like to ask you to help us understand why Donald Trump delayed the 9 July deadline for imposing reciprocal tariffs for everyone to the 1st of August. Does it show that he's not got that trade victory that he was looking for from some of the key nations?
I think negotiating tariff agreements with such a large number of countries requires a fair amount of time and attention in terms of the backup that you need for each and every negotiation that you conduct. So from that perspective, my sense is that many of the ongoing conversations have not yet reached their conclusion, and many of those that are also, I think, well on their way require a little more time to reach a satisfactory conclusion. So the timeline seems to have been unrealistic, and what I think the extension of deadline indicates is that he wants more time to be able to negotiate satisfactory deals with a large number of countries. Mind you, these are tariff negotiations, and they're different from the trade deal that we are working on. So there is a difference between a trade agreement, ours is a mutually beneficial bilateral trade agreement, and the ones that you see are essentially, tariff negotiations which determine a sort of average level of tariffs that would be charged by the United States on these countries that are, on the negotiation table.
Right. I would also like to ask you, how does the current tariff policy really help Donald Trump? Yes, he's scoring political victories. Yesterday, he said that they are going to earn at least $300 billion worth of revenues through these tariffs that they have imposed. But is this tariff war going to settle down anytime soon, Ambassador Shringla, or are we going to see this throughout the Trump administration? Or do you expect it to slow down after the midterm elections in the US?
Well, the basis for the entire exercise, Parikshit, is that the US's current trade profile is not sustainable. They have $1 trillion in terms of trade deficit. Much of it is in China, about $450 billion. And I think his focus is on their 10 major partners, including India, where I think he wants a more equitable, trading system, which essentially negates all that the WTO has prescribed. I mean, there are gradations depending on least developed countries, developing countries, and so on and so forth. He, I think, is not accepting this. From Trump's point of view, I will charge you what you charge me in terms of tariffs, and he wants an equitable trading arrangement with major partners, but also countries across the globe. And the second, of course, is that by charging a base price of at least 10%, and in certain cases more, but higher duties, like in the case of China and the 14 countries that you just mentioned, they also earn more revenue, but it also makes the bar higher to access the US market, and so gives a better opportunity for US domestic manufacturers to compete effectively. I think those are the objectives from the American point of view. Whether this settles down is something that we have to see. Trump's best bet would be, I think, to be able to settle as many of these tariff agreements. He's looking, as I said, primarily at between 8 and 10 major partners that he could conclude deals with. And if that happens, then you unilaterally, for the rest, impose a certain level of tariffs, and then allow the let's say playing field to settle. In other words, the market settle. There is less amount of uncertainty in terms of the consumer pricing also in the United States, and it's very important for him politically to be able to reach a conclusion and to tell the public that, the mandate that you brought me in for is being fulfilled. We have managed to, sort of increase our tariffs. We are getting more revenue, but at the same time, I think we are able to provide a better level playing field to our own manufacturing industry. And that is what I think he will end up doing at the earliest possible opportunity.
Right. I would also like to ask you, the current tariff wars that he's having with China, the kind of tariffs he's imposed on Vietnam, Japan, Korea, if these tariffs stay, do you believe India is going to be in a strong position in global supply chains? It could be seen as a better partner in terms of exports?
So I think our approach has been a very well thought through one. We have engaged very early in the game. You'll recall that Prime Minister Modi was in Washington, D.C. in February, 25 days after Trump took office. At that time, both sides declared that they would be looking at doubling trade to $500 billion and concluding a mutually beneficial free trade, bilateral trade agreement as early as possible. And I think we have been negotiating earnestly from that time. Today, at least the first phase of that negotiation, which means that the first part of that bilateral trade agreement is ready to move forward. I'm told that all the discussions have been completed. The entire issue now lies with Washington, mainly the White House, to take a final call on how this should go. But given Trump's recent statements, there is an expectation that he should be able to announce a first trade deal with India shortly. I think both sides have made the necessary adjustments, the necessary compromises that would enable us to have a preferential trade agreement with our largest trading partner. Keep in mind, Pariksha, that we've been concluding trade agreements with many of our major partners, from Australia to the UAE, to the UK, to EFTA countries. I think the significant omission has been the United States. We have been working on this deal since Trump 1.0. And I think a trade deal that could be announced would certainly send a strong message to the markets, to our industry. And this, I think, will be to the benefit of both the United States and India. We will also benefit greatly by such a deal in many ways.
Right. But Ambassador Shringla, considering that Donald Trump is looking out for US national interest, and he has not honored some of the existing trade agreements that allies like Japan, Australia, European Union have had with the US, do you believe that it's important for India to keep its options open while we show a strong intent to have a good trading partnership with the US? At the same time, we must pursue a very strong export agenda and trade deals with other nations, which is very, very beneficial to us in the long run. And we must speed up that effort.
It goes without saying, Pariksha, I think that's exactly what we are doing. The fact that we've concluded a deal recently with the UK, which is to be signed. We are looking at a deal with the European Union. I think these are our partners that could offer us alternative markets, alternative options. But let's be clear. I mean, the US is the mother lode. Everything will emanate from that. And the tariff concessions that we give the US will determine the milestones on which we will base our other agreements with everybody else, which will be less than what we would offer to the United States, I imagine, given the respective size of markets. But certainly, I think we should not only work on the deal with the United States, but continue to work with all of our partners to have, as good and as mutually beneficial trading arrangements that we can. This is a very important time in which you have to consolidate your access to global value chains, to reliable, sustainable supply chains with major partners. I think there is an attempt to also renegotiate the deal with ASEAN, which has not been in our interest. I think the rules of origin there are weak, and there is quite a lot of scope for diversion of goods into India. We need to address and plug those loopholes as well. But on the whole, I think this looks like, if we can manage it, it will be a very, very good situation for our industry and our economy. And as you mentioned, exports, I think, would be a high priority from that perspective. We would be able to access many more markets more effectively.
All right, Ambassador Shringla, thank you very much for joining us on the program. It's a pleasure talking to you. So let's see what happens in terms of the 7 more tariff letters that Donald Trump will be sending out later tonight. That's all we have time for. Thank you for watching. Goodbye.
Focus and simplicity. Steve Jobs said that this was his mantra. In his words, simple can be harder than complex. You have to work hard to get your thinking clean to make it simple. But it's worth it in the end because once you get there, you can move mountains. I have a feeling my guest today would readily agree with Steve Jobs. Anish Shah assumed leadership as the managing director and CEO of the Mahindra Group in 2020. When Shah took over the company, it was facing challenges and it was what Motilal Oswal's 29th wealth creation study defined as a bruised blue chip, a fundamentally strong company that had lost over 50% of its market value. Within 18 months, the company divested 15 non-core businesses. M&M delivered 22% compounded annual growth rate in revenue and a 31% CAGR in profit after tax between FY20 and FY24, while its return on equity improved from 10% to 22%.
So the first thing starts with company first. Anything we're going to say, anything we're going to recommend is because it is for the benefit of the company.
Like life in business, you do get emotionally attached to decisions, to businesses.
The role of a CEO is to have a wide spectrum where emotions one end of that spectrum and practicalities on the other end of that spectrum.
You know, you talked about Anand and working with him when you joined the Mahindra Group in 2014. I mean, those are pretty big shoes to fill.
So Anand is a remarkable leader. What I've learned from him is find ways to bring out the best in people.
Is there an innings, a captain's innings that you would like to emulate?
I have a lot of regard for Dhoni as a captain, for how he brought the team together. He actually put 20% of our KRAs for everyone as helping others.
So what is the best piece of advice that you've received?
To get control, you must give up control. And it was finally my older son who helped me understand that, because I would continue to tell him, here's what you need to do. He just rebelled, as I had done when I was growing up.
You rebelled against your dad?
Oh yes, of course.
Really?
Yes.
You don't seem the sort. You haven't been bitten by the marathon bug yet, like many of your peers in the city.
I shall get to it at some point in time. I think it's good for everyone to have things that they really love doing. For me, it's a range of things right now. So it's been difficult to focus on
one thing.
Just one thing from a personal standpoint, because again, for many years I've always wanted to spend weekends with family. And that's always been the one driving part. Because weekdays tend to get quite crazy usually.
But do you like? Is there a family passion that all of you kind of share, or
so we love traveling.
Yeah.
And we usually do 2 trips a year, one in summer, one in winter. And then maybe a few smaller weekend trips at times.
Okay. Joining me today to talk about the art of sacrifice and his formula for focus is the man himself, Anish Shah. Many thanks for joining us here on the Leadership Language. Let me start with that, Anish. We were talking earlier and you told me that you finished your PhD thesis in less than 3 years. You divested 15 companies after taking over as CEO of the group in 2020. Many people say that you're a man in a hurry. Where does that sense of urgency come from?
So Shireen, first, it's a pleasure to be here with you and an honor to be here as part of the Leadership Language program. In my mind, it's about focus, what you just mentioned earlier. I've always believed in the mantra of doing less, but doing it very well. Completing something, moving on to the next thing after that. And that has helped across my career in various things I've done. Though I must say, the credit for my PhD goes entirely to my advisor. He played a big role. In fact, a set of advisors, both of them played a huge role in enabling me to complete fast. So I shall give credit where it's due.
Oh, so the doctor in Anish Shah is actually the real deal. It's not an honorary doctorate. This is something that you've actually earned. But, Anish, let's talk about 2020 when you took over as CEO. And I want to understand from you, in light of the experiences so far, what you believe the job of a CEO is today. What is the role that you believe a CEO plays today?
I think it's very important for the CEO to have clarity in terms of the direction, because everyone in the organization must march to the same tune in the same direction. A CEO must have a clear understanding of stakeholders and what does each stakeholder want. And then third, a set of priorities that's going to enable us to get to the direction we want in sync with what the stakeholders are looking for.
But, as you said about divesting these businesses, and I would imagine that these are not easy choices to make. And these are entrenched businesses. Learning the art of sacrifice, learning that less is more. What have been some of the metrics? What have been some of the guiding principles that have helped you take that course of action? What have been some of the things that you've done that you communicated to all stakeholders to ensure that everyone was on board with these decisions as well?
So the first thing starts with company first. If that is well ingrained in all the discussions you have, which is anything we're going to say, anything we're going to recommend is because it is for the benefit of the company and not for your personal benefit or not for the benefit of the department or the unit that you run. It changes the tone of the conversation completely. It allows people to speak a lot more freely, a lot more openly, because they know that they're giving ideas that are important for us to consider in taking the right decisions. The second is the courage to take the harder decisions. It's sometimes much easier to say, let's go with hope, this will work out. But if we really go through the details and analyze, and in the instance of the companies we exited, our question was, will we ever make profit in these businesses? What will it cost for us to make profits? What do we need to do differently? And in almost all the cases, we realized that it was not a business that made sense from our standpoint. We were never going to make profit for our shareholders for that. And therefore, a tough decision, but the right decision for the company was that we need to exit and maybe hand the business in someone else's hands, where there's a greater synergy, where they can do more with it for whatever reason, and focus our efforts on things that make sense for our shareholders and grow those businesses.
Is it harder to be in a diversified conglomerate like the Mahindra Group to actually get everybody to operate on the same page, to have an alignment not just of purpose and vision, but of execution as well?
So there, I would say that we've been blessed with the DNA we've had, because I give a tremendous amount of credit to our leaders from the past. Mahindra has been the best performing stock in the Nifty from 2002 till 2018 for 17 years. Right? And I always remind folks of that. So while you may call us a blue chip, it is a blue chip. That's where the starting point is. And that DNA has helped us a lot. Our leaders from the past always believed in company first. So therefore, for us, that was not something difficult to get to. It was part of who we were. We believed in entrepreneurship. We believed in taking bets. Some bets may not work. But yes, we need to then act on them quickly enough. But then we've got to take other bets that work and be able to create value. So all of those metrics were important. And therefore, when I took over, one of the most important things was what we coined as continuity in change. It was a significant change. It was a non-family member taking over as group CEO for the first time in 77 years, and the first time in the history of the company. But it was very important for us to ensure that the principles of the company, the DNA of the company did not change. And therefore, while from the outside you might look at it and say that, yes, you've exited 15 businesses, there are a bunch of other things that have been done, there is a stronger performance orientation, the foundation for us stays the same, and therefore continuity in change was the most important mantra for us during that phase.
You know, it's interesting when you talk about continuity in change, because it suggests that there has to be a balance, that while you are changing, you're still holding on to fundamentally who you were or who you continue to be. But easier said than done, isn't it?
Oh, absolutely. Because everyone is expecting change. That's the starting point. Right? They're basically saying, you've come in, things are changing. Right? We're a different company now. And therefore, it takes a lot of effort to be able to continue to deliver that message, not just in terms of what was said, but in terms of your actions. And it takes time for people to look at it and say, you actually mean what you said there. But that requires consistent set of actions and efforts, and that also requires support from a much larger set of folks around us. And many of our senior leaders stepped up to give that support, and that helped the transition be a lot more smoother than it would have been otherwise.
You know, speaking of the transition, and something that you just alluded to, that you were the first non-family member ever in the history of the group to take over as CEO. In your own head, you know, how were you looking at this? Because for many years, across different sectors, across different companies, this issue of ownership and management and how the two are different and how the two should actually converge has been discussed and debated. How did you look at that issue before you took this role on?
So, to be honest on that, Shireen, in my mind, it really wasn't any different from what I've done through my career. And I think a big reason for that was the management style that Anand had. When I came into the group in 2014 and worked with him closely for a few years, his style was completely empowering. It was not the traditional family-based business that you would see. The Mahindra Group had been set up as a professional group by him many years before I came in. He would trust his leaders, empower them completely, and create an environment where everyone was free to say whatever they wanted to, create an environment where people could take the bets that they wanted to. And that was a very, very different environment than what you would look at from a traditional family-based organization. So in that environment, it wasn't really difficult to move forward, and which was also more important for us to establish that aspect of continuity and change, because a lot of things we had were outstanding, and we needed to make sure that they stayed as part of that change.
What was harder, the diagnosis of the problem, or then finding the right prescription to address the diagnosis?
The diagnosis was fairly straightforward because it's something we had been seeing for some time, and it was just about execution. What helped was a burning platform in some sense, because COVID had come in as well, and revenue in that first month in April was literally zero. And therefore, the ability to take actions faster was made easier. And sometimes you have to take advantage of a crisis. And we took advantage of that and moved fast. And that got everyone on the same page very quickly. The toughest action was taken first, which was SsangYong. And for many months, our analysts and investors did not believe that we actually had taken that action. They kept telling us that you're going to come back in it somehow. Right? And when they realized that that was a real action.
Why do you think that was the case? Why do you think they didn't believe you?
Because it was a large company. It was one that emotionally was a difficult decision, and one that made a lot of sense for shareholders. So the result of it was that our stock price actually had gone up quite significantly with that one action and with a few other things we'd done. And that got the troops rallied around very quickly, saying, we're doing something right here, and let's continue on that path. And that really helped us get momentum, and that momentum has continued through that time period.
You know, you talked about how SsangYong was the toughest decision, but the decision that you decided to take first in this effort to kind of get rid of companies that no longer made sense from a profit point of view. You also talked about emotional attachment. And like life in business, you do get emotionally attached to decisions, to businesses. What has been your way of creating a distance so that you can observe without getting attached?
I come back to the point around company first. And I will also go back to your question on the role of a CEO is to have a wide spectrum where emotions one end of that spectrum and practicalities on the other end of that spectrum, or rationality, and be able to traverse that spectrum, because you have to understand emotion well. You have to understand where people are coming from. It's all about people. You have to understand their aspirations, where they want to go, their fears. You've got to be able to understand what's right for the shareholder as well. What do the financials tell us? And where on that spectrum should one be? And then collectively try to get everyone to making a decision that's right for the company. And to me, that framework helps make those difficult choices.
SsangYong was a difficult choice. What have been some of the other difficult choices that you were afraid of making the choice, but also of the response and the reaction to those decisions?
I would say every single company we exited was a difficult choice, because it's not just a matter of scale. Even for a smaller company, there is something that's invested in there. There are people there. And therefore, each of those choices was a difficult one that we had to consider very closely before we did it. There were a few others that we put on a turnaround mode, and I'm very glad today that many of them have turned around and are on a very good path today. So that's always a difficult path. The second difficult choice was, in many ways, to create a much stronger performance orientation and create a culture which is a very healthy mix of being a friendly and a caring culture to being a strong performance-oriented culture. This is one thing that I would say is unique among what I've seen across the world. You have cultures on both ends, but what we've got at the Mahindra Group, and here again, a lot of this has come from the past, is this very healthy mix between a caring culture and a performance-oriented culture. One where people care for each other, people help each other in what they do, where teams are focused on performance. It's not about individuals. It's about the entire team working together. It's about coming to work every day and loving coming to work, because you know that people are going to be helping you in everything you do. That is the kind of culture that we've created. But having the performance orientation aspect along with the friendly and caring aspect, I think was an important part there.
How have you tried to prioritize what the culture should be for the group? And in terms of leadership, walking the talk, in many ways, that demonstrates action. So what have you done, especially over the last 4 years, to demonstrate what the organization stands for culturally?
So I'm going to focus on one specific area on this, Shriram. I'm going to go back more than 4 years. And that specific area is around helping others. Right? It's easy to talk about performance orientation. It's easy to talk about many of the other parts. But let me focus on this one because it's not easy to do. And here I'm going to give you again a longish answer to your question because I'm going to go back in time when I realized this part. Early in my career, in my second year at GE, I had been asked to go and be the sales and marketing head for a .com in GE. This was during the .com boom. And it was a fun business. It was setting up a mortgage marketplace in the US. We had got the top 5 mortgage banks on the marketplace. We had 200 brokers on the marketplace. And everything seemed to be going really well. We just got $5 million. At that point was a big amount of funding from the parent GE company for this .com. And as we looked at certain things around how it worked, over time we realized that the technology that existed in 2001 wasn't sufficient enough to be able to tackle the complexities of how the mortgage business was done in the US. And at that point, we went to our CEO and said, you've just given us $5 million, but here is what we've learned along the way. We should not do this as a .com. Let's save that money, fold it in the parent business, which was a mortgage insurance, use that as a tool or a value-added service for our customers. And that's going to be better for the company. And the CEO looked at me and said, are you sure? Because this means that you and the team are going to be out of a job. And I said, I'd rather put myself out of a job than have you put me out of a job 6 months later. I'm not sure where I got the courage to say that at that point in time, but I did. And that evening I called one of the senior leaders in the business who didn't know me and said, look, we've just had this discussion. I'm going to be looking for a new role. And he said, Anish, I don't have time. I'm rushing to the airport, but I'm back on Tuesday. Don't call anyone else. You have a job here. I don't know what it is, but you're staying here with us. Right? So I asked him, I said, you don't even know me. How did you do that? He said, I've heard a lot about you helping others across the organization, and that's what we need here. Right? So to me, that was the learning around the fact that when you help others, you're giving credit to them often for what you've done. And that's a painful process at times. But that enables something that's better for the organization, that creates a better environment, and that makes you wanted in the organization. And which is why through the years, I've always focused on that. And when I came into the Mahindra Group in 2014, the group strategy office, we actually put 20% of our KRAs for everyone as helping others. And we had folks coming in from McKinsey, BCG, Bain, all the top consulting firms. And there was always a topic of conversation saying, 20% of our KRA, everyone's so used to, I need to do ABC to be able to get to my goals and to be able to get to my performance pay. And we have L1 to L5, which is a measure of performance, where L3 is meets expectations. So we'd have these interesting discussions. And I finally got to a way to be able to articulate that well, which I would tell folks is L3, which is meets expectations, is if you can articulate, here's what I've done to help so many people, and this is how I've helped them succeed. L4 has nothing to do with you. If other people come and tell me that
you help them,
and therefore they really value what you brought, that's L4. And L5 is when we don't need to ask anyone, where you can just go to anyone and say, who do you go to when you need help anytime? And in a couple of instances in group meetings, I asked, who do you think is L5 here? Right? And 5 or 6 people shouted out the same name, because that person was always there to help everyone. And folks just knew it, saying, if I have a problem, I go to that person.
But you talked about this realization, and in the journey between sort of hoping that the realization will dawn on your leaders and working through that. I mean, you do deal with your own insecurities, you do deal with your own apprehensions and fears. What do you believe is now the relevant organizational structure. You talked about the way that you're mapping things within the group. And again, there's a lot of conversation on currently on how hierarchical organizations need to be, how lean management teams need to be, how agile and adaptable they need to be in a state of constant volatility and flux that we live in today. What do you believe is the relevant organizational structure for the future?
So I would talk about the key principles because it's different for every organization. A key principle I would always use is to have as few layers as possible. Because hierarchy often becomes something that takes away the empowerment, it takes away the agility in an organization. So fewer layers. Second is a clear alignment between the organization and the priorities of the company. Third is focus on value creation, not on how wide a role do you have. And that is, again, something very difficult for any leader to understand because a natural tendency always is
add more.
Add more. The wider the portfolio I have, the bigger the leader I am. And that's one thing we worked very hard at Mahindra to talk to people about and say, that's not the right way to think about it. The more value you create, the bigger the leader you are. So if you want to do A and B and C and D, you may not do any of it well. But if you focus only on A, you can create a lot more value than actually doing all four. And as we think about promotions, as we think about bigger roles, we're going to look at the value you create, not about how many things you have on your plate.
Speaking of value creation, one, of course, was the aspect of getting rid of things that didn't make sense any longer. And the other was actually identifying engines of potential growth that would fortify you in the future. Take me through that journey. What was guiding the thought process at that point in time for you to say, we're going to double down on this bet?
So having spent a few years in the group strategy office, I had seen many of our businesses and they were very strong businesses. And that's where, again, I go back to what had been built earlier was really the foundation for us to take it forward. And there have been many who've told us, you've got the capital, why aren't you entering new areas? What is the next new area you're entering? There have been many such conversations. I think we've had one as well in the past.
Yes.
And I just look at our business and say there's so much potential here. We've grown organically at 25 to 30% a year for the last 5 years because our businesses have that potential. We've got what we call our growth gems that are very well positioned in the industries, and we want to put more capital behind them to be able to help them grow in multiples. So for us, it was in many ways a much easier choice because we saw these businesses with a lot of potential and we said, let's put our shoulder behind it. Let's put everything we have behind it and enable these businesses to grow. It's going to create a much better outcome for our shareholders. And it has. Our market cap is up 12x in the last 5 years. And it's a function of what we've seen from our current set of businesses growing without really any major acquisition except for the recent one on SML, which again is going to help one of our growth gems catapult into a different league.
But, so far, as you pointed out, with the exception of the acquisition that you've just done of SML, it's largely been organic. But you're now in that wanting to take bold bets. How much of this is going to continue to be organically driven? How much of it is now likely to be inorganically driven? And I know that you're also focused much more on expanding your global footprint. How crucial is that as a priority for the group today, for Mahindra to become much more of a globally relevant brand?
So I would outline 3 specific areas. First is continue the organic growth and ideally strive for a 25 to 30% organic growth every year in our core businesses. Second is international, because having now produced products in India that are of very high quality, we have earned the right to go international and compete internationally. And that's going to be a very important growth vector for us. It will require potentially a different set of skills because we want to be a major player in many international markets. We do believe that we can make in India for the world. And this is one area in automotive in particular where I think India is starting to get to a place where it can become the manufacturing hub of the world. Yes, more needs to be done. We need a broader ecosystem. We need more companies to come and manufacture in India to be able to create that ecosystem. But as we do that, we will get more cost competitive. We have the quality today, and that will allow us to manufacture for the world, not just for us, but for every player that's in India, including the foreign players who come in.
So what is the timeline that you've set for yourself as far as this international aspiration is concerned? What are the benchmarks that you're setting for the team in terms of what they need to deliver on to continue to kind of gather momentum, and at what pace?
So given the history of the group, I have a little more luxury in saying that we are building a business for the next 20 years. So my timeline is the next 20 years and what we need to build. At the same time, we have to deliver results in the short term as well. So we look at it as what are the set of markets we would focus on right now in the next year, in the next 3 years, next 5 years. Our immediate focus is on Australia, South Africa, and Chile. 3 markets that we have been present in for some time. We have 10% share in one of the segments in one of the markets now, 5% in the other. And we want to try to get to 15% in all 3. As we do that, we will then select the next set of markets that we go after and the next set after that. So for us, it is a long-term time horizon, but at the same time, one that we would look at each step as an important one and being able to deliver on each step, creating that foundation, moving on to the next one.
How do you believe that you've evolved and changed as a leader? Where do you believe you find yourself on the spectrum of leadership today? And what is it that you would like to see you change about your own leadership style?
I would say, Shireen, a very significant evolution. There have been lots of things that I have not been good at. And,
like what?
So I'll share feedback that one of my managers at Bain gave me very early. This was literally in the first 3 months of my joining Bain after Carnegie Mellon in Boston. We'd gone to a client meeting somewhere in Ohio, and we were driving back to the airport, or I was driving, and my manager looks at me and says, "Anish, you add no value in meetings." So I was trying hard to focus on driving and not on what he was saying, but I asked him, I said, "Why do you say that?" He said, "You don't say anything in meetings. So you may know a lot, but if you don't say anything, you don't add value." And he said, "Let me give you one tip. Use the whiteboard. Stand up and put your thoughts on the whiteboard. It takes the attention to you. You're good at structured thoughts, and you will set your structure there. That will allow you to be able to share what you want to share, and that way you will add value in meetings." I said, "That's a great suggestion." I still get up and use a whiteboard on lots of occasions. That just has become a habit. But that enabled me to come in there and be able to add value. There were many such things over time that I've been fortunate to have leaders and managers tell me that, "Look, you're not good at this." Today, I'm fortunate to have a number of folks on my team that will tell me that, you're not doing this well. And
people in your team tell you you're not doing this well?
Yes.
When was the last time this happened?
So a few months ago, someone came and told me, I said, "Anish, when you send us messages on email versus you talking to us in person, there's a very different tone to it." Because on email, often it comes across as very impersonal and cold. But when you have the same discussion in person, it's a very different tone to it. So, either do more in person or improve the tone on the email. I found that to be a very useful suggestion. Right? But that to me is important for a leader, to have that environment where people can come and tell you that you need to improve on this. And it's a journey for every person. If I put the list of things I wasn't good at, you'd look at it and say, "How did he ever become a CEO?" But it's about the openness to accepting that and then having the courage to say that, "Yes, that you're right. I am bad at this and I need to change."
How did you check your ego at the door? Because it's not easy, and it's certainly not easy when you're operating in a position of power for somebody to tell you that you're not doing something right. Egos get in the way. How did you find the grace the humility and the acceptance?
I think those are big words, grace and humility. I look at it more as if there's a job to be done for the company and that's what you put first, you have to do it in the best way that you can. And to be a better person, to be a better leader, you need to be able to get that feedback and have the courage to be able to address it. And this is something, again, maybe there is an element of the US culture that comes in, which is very direct. That helped me learn this early on. I saw myself improving and I valued getting that feedback before it was appraisal time or promotion time, because then it's okay, you haven't got this promotion because you're not good at this. Right? I'd rather get it up front and address it so that by that time that is addressed. Right? I've been in a situation again many years ago where my team had feedback that said that you don't like some of these things that you do. So I actually got all the team together, got a whiteboard again and said...
Again, a whiteboard.
Yes. And I said, look, I've written down a few things that I've heard from you that I don't like. So I want to talk about this a little more. I want to understand, what I should do differently.
As you look at what's happening today, I mean, the transformative pace of technology changing, AI, what are you fearful of? And what do you feel confident of embracing today? I mean, everyone's talking about what this wave of disruption is going to mean as far as organizations are concerned. Will you be relevant? Will you no longer be relevant? As you look at this, are you being driven out of a sense of fear, or are you being driven out of a sense of purpose and relevance?
I see opportunity. This is time for us to get in and establish tech leadership, do more with customers, do more with the products we can create. And for me, this is an exciting time. Any time of change is a time of huge opportunity.
So in an AI world, I mean, how much of that is already a reality at the Mahindra Group? How much of it do you believe you will need to invest in, both in terms of bandwidth and resources, to make yourself future-proof?
So I'll tell you what we've done and what we still have to do. We have a far way to go, but what we have done is first instilled in every leader that they have to be a tech leader. If you are not a tech leader, you can't be a business leader. You can't rely on your CTO to say, here's what you should do from a tech standpoint. Every leader should understand technology. Second is, each of our top 100 leaders has one project that they've got to work on for AI. That's in their organization, an idea that they have, and they've got to show results from there. Third is we've taken teams from across all our businesses and in some ways tweaked our federation model in this particular area and said there'll be one common team that looks at AI across the group, because there will be lots of lessons that we will have from across the group. And that has to focus on delivering results. And then fourth is skilling for AI. So these are the 4 areas that we've done.
How tech savvy are you today?
I'd say reasonably high. But I've always believed that technology is going to be important. As part of my PhD, I had mentioned to you offline, I'd created this network lab environment where we had 30 computers connected for a game that was a stock exchange game with CEOs, stock market traders, and directors in the game. And this was in the early 90s, and I literally took a book and learned how to code and spent nights coding it and creating a network lab.
You talked about gaming. What do you do to reinvest in yourself? Not just as a leader, but also as a person. I mean, what are you passionate about today outside of work?
So for me, the biggest source of energy is spending time with family. And that's something that over the career, I've always believed that weekends should be with family. For my boys growing up, that was a huge thing for them because they knew that they had my calendar for the weekend and they could set it as they wanted to. And that still continues to be the biggest source of energy, spending weekends with family. I do,
so do you
end up
calls?
working.
Do you do emails?
I do end up working a lot more on weekends in the last 3 or 4 years than I have in the past before that. So I'm still trying to get back to the balance that I ideally want on weekends. I haven't been successful on that front as yet. But to me, that is, we travel as a family twice a year. And that's something that we all look forward to. Both boys come down to India at least 3 or 4 times a year, even if it's for a weekend at times. And we encourage that and we love spending time together. So to me, that's the biggest source of energy. Beyond that, travel, sports, love playing sports, love watching sports.
What do you play and what do you spend most of your time watching?
So I can tell you what I love playing. I don't think I play it often enough.
Okay.
But cricket, volleyball have been the 2 sports I've loved playing over the years. Table tennis to some extent as well. I love watching American football and cricket, of course.
Let's talk cricket. I mean, is there an innings, a captain's innings that you would like to emulate?
I have a lot of regard for Dhoni as a captain, for how he brought the team together and how he dealt with various personalities in teams. And to me, I come back to the concept of team, because that's the most important aspect. And I'll extend that to American football and my team there was the Pittsburgh Steelers from my days in Pittsburgh. And this is a team that has won 6 Super Bowl titles. Over the last 60 years, it has had 3 coaches. So there's been longevity in each of the coaches. Through that time period, it's very difficult to pinpoint superstars in that team. And to me, that's what I take from sports as to how do you create those teams? How do you have people work together and thereby create a winning record?
Well, speaking of creating a winning record, the last 4 years, you've been able to deliver on several milestones that you had spoken of, and that's a reality today. As you look 5 years on, what do you believe the group will look like?
So first, we will continue our path on value creation that we have. That's an important commitment to our investors. Second is we will continue the culture that we have and the DNA that we have around purpose. That's a very important aspect of the group. And with purpose, the environment around helping others, being a friendly, nurturing environment and being performance-oriented at the same time. We will enhance the level of diversity and inclusion that we have in the group. That is one that, again, we've made some meaningful strides on, but I still think we have a long way to go in being able to get to a place where everything is equal. There is no question about it. There is no conversation that's required. And that to me is a North Star for that. And we continue to be a place where people look at us and say, that's where I want to be. I want to be part of the Mahindra Group.
What is the best piece of advice that you've received in the course of your career that has shaped who you are today and shaped your journey in many ways?
It's a piece of advice which I didn't understand for many years. But the advice I got was, to get control, you must give up control. And I just struggled with that. I said, I just don't understand what that means. And it was finally my older son who helped me understand that, because I would continue to tell him, here's what you need to do. You need to get to this level to be able to apply to these colleges and everything else. And he just rebelled, as I had done when I was growing up.
You rebelled against your dad?
Oh, yes, of course.
Really? You don't seem the sort.
There are many other elements which we shall not go into at this point. As a leader, the easiest part is to go in and want to control. And we talk about different spectrums. I talked about the emotional versus rational spectrum. The other spectrum is control versus giving it up completely and empowering completely. How do you consciously decide what part of the spectrum you should be on? And in what situation should you be on a certain part of that spectrum?
You talked about Anand and working with him when you joined the Mahindra Group in 2014. I mean, those are pretty big shoes to fill. What was it that he told you, a piece of advice that he gave you that you remember?
So Anand is a remarkable leader. And for me, it's never about filling his shoes. I think it's about his having helped me walk a path which is far better than what I had imagined at one point. And what I've learned from him is find ways to bring out the best in people. I'd come from, I would say, a lot more clinical set of organizations where performance was looked at with a certain lens. And I think what Anand brought was a very different perspective around there's a lot that people can deliver. Look for how you get the best out of them. And that's been remarkable in terms of how we've been able to build teams and how we've been able to get everyone to contribute. And that's helped build a much stronger group. In fact, that has been the DNA of the group that Anand has built over time. But to me, his continuing guidance, mentorship, and I'll still reach out for lots of questions I have. And he'll always tell me that, look, it's your decision. But he'll always give the guidance that I would seek. And that continues to be very, very helpful.
But what was the role that your parents played? And, I bring this up because when I started my career as a young reporter, your father was somebody that I would call up to understand what was happening in the world of pharma. And he was hugely accessible and generous with his time to explain to me the ins and outs of Indian farmer. And I will always have the fondest memories of him. What was it like, growing up?
They played a huge role in who I am today. First was the expectations that they had. Second was, in many ways, the role models that they were. And some of this I've learned, in fact, over time. But my father went out of his way to help lots of people. And I talk about helping others in the professional context. He would always be accessible for people. And to me, that is a trait that I would say I've taken time to imbibe. And it's gradually increased over time. My mother was someone also who was in the second batch of IIM Ahmedabad, set up her own business in the late 60s because she wanted to balance time with young kids as well as career, and ran a business which was making packaging for Colgate and Sivagaigi and others at that point in time, and ran a successful business, finally retired and sold it. So she was amazing in terms of what she's done. And again, the values, the belief that you can do what you want, the importance of balance in life. I think all of those things are important aspects that have got me to where I am today. Right? And while on that, I have to talk about my wife and her shaping me, because I would say I had a lot more hard edges, and she's been the one instrumental in softening them over time.
She's polished the hard edges.
Yes. So when I talk about the emotional versus rational spectrum, I was very much on the far side of the rational spectrum, and she's helped me learn over time that the emotional spectrum is very important as well.
Thank you so much for joining us. And for very candidly, I have to say, talking about the journey that you've made so far, the changes that you've not just built within the organization, but even as far as your own leadership style is concerned, I don't think people talk about them as candidly as you have. And so we truly appreciate that. Thank you so much for your time on the Leadership Language today.
Thank you, Shriram.
Well, thank you very much. Well, the fabulous and formidable martial artist Bruce Lee said, a successful warrior is an average man with laser-like focus. We do hope that you enjoyed the conversation that we brought you on this edition of Leadership Language, insightful stories that have helped shape India's successful entrepreneurs. And if you want more, then tune into Leadership Language on CNBC-TV18. But for now, from all of us here on the team, goodbye and many thanks for watching.
and welcome to Startup Street. I'm Ritu Singh, and with me are Shruti Mishra and Arundhati Ramanan. Here are the key headlines from the startup world. Quick commerce company Zepto is set to raise up to $500 million in a fresh funding round. Sources say existing investors will lead the round, which values the company at $7 billion.
Chai Biscuit, a digital content platform, has raised $5 million seed funding round led by InfoEdge Ventures and General Catalyst. The funding will power the launch and growth of Chai Shots, a mobile-first short-form OTT platform designed to deliver fiction in ultra-short formats.
CCI has cleared a proposal by private equity firm Kedara Capital to acquire a stake in SmartShift Logistics Solutions, which is the parent company of on-demand logistics turn unicorn Porter. Now, Kedara is acquiring a stake through its two affiliates, Sapphire Holding and Fund4AIF, in the company.
Apple has named Sabi Khan as its new chief operating officer. Khan will take over from Jeff Williams as part of a long-planned succession. Sabi Khan currently serves as senior vice president of operations and has been with Apple for 3 decades. Khan is set to officially take over the COO role later this month.
And Starlink has received a license from India's space regulator to launch commercial operations in the country, clearing the only remaining regulatory hurdle for the satellite provider to enter the market, as per a Reuters report. The Elon Musk-led firm has been waiting since 2022 for licenses to operate commercially in India. Well, those are the key headlines from the startup world that we're tracking for you today. Now, on to our top story today. Quick commerce giant Zepto is believed to be in advanced stage talks to raise $450 to $500 million from existing investors in what will be a fresh funding round. Now, sources have told CNBC-TV18 this funding round will value the company at $7 billion. Aishwarya Anand joins us now with more details on the story. Aishwarya, take us through their fundraising plans.
Zepto is gearing up for another major fundraise. Sources have confirmed to CNBC-TV18 that the IPO-bound quick commerce unicorn is in advanced talks to raise $450 to $500 million in primary capital at a post-money valuation of $7 billion, a sharp 40% jump from its $5 billion valuation last year, when it raised $1.3 billion. The round will be led by General Catalyst and Avenir Growth, with other existing investors expected to participate on a pro-rata basis. Now, this comes as part of Zepto's broader strategy to increase domestic ownership ahead of a potential public listing. In May this year, Motilal Oswal and Ramdeo Agarwal invested $50 million each in their personal capacities to acquire stakes. Meanwhile, competition is intensifying. According to ICICI Securities, Blinkit's gross order value grew over 25% on a sequential basis in the first quarter of this fiscal year, with Swiggy's Instamart rising 22%. Datum Intelligence reports that Zepto's daily active users fell from 5.5 million in December 2024 to 4.9 million in June 2025, while Blinkit rose to 6.2 million. Despite rising competition, Zepto remains a strong player. As per a Citi report, while Blinkit leads the market with a 41% share, Zepto is either equal or slightly ahead of Swiggy Instamart's 23% market share.
Well, Aishwarya, thank you for those details. Appreciate you joining us. Moving on, remittances to India have surged from $82 billion in 2019 to $129 billion in 2024. But despite this growing inflow, the NRI share in mutual fund assets has declined from 2.9% to 2.3%. This shows that regulations, not intent, seem to be the barrier. One startup is looking to change that. Belong, a fintech app built exclusively for non-resident Indians, has just announced its official launch along with a $5 million seed round led by Elevation Capital. The round also saw participation from Reliance Ventures and a host of marquee angel investors. Joining us now to talk about the platform and the vision behind it is Ankur Chaudhary, the co-founder and CEO of Belong. Ankur, welcome to Startup Street. Let's first talk about how Belong is building for the 35 million strong NRI community. Some of the friction NRIs face when investing in India are high conversion costs, complex KYC or repatriation hassles. Tell us, why have traditional players failed to solve this, and what is Belong doing differently?
Thank you for inviting me to the show. So the primary issue, as you have already pointed out, is of regulation. So there are complex regulations around cross-border banking and investments, and that is why traditional players have faced these challenges. Now, what is Belong doing differently in order to solve these problems is that from a regulatory perspective, it is based out of GIFT City, which is India's international financial center, where regulations have been relaxed specifically in order to attract foreign capital into India. So there is a single KYC format for all GIFT City products, whether it is investments, banking, insurance. The remittances into and out of GIFT City are not restricted in any way. And the most of the products are denominated in USD so that the conversion costs are very low.
Okay. Ankur, you claim to be the first fintech to offer retail products through GIFT City. Like you mentioned, you've secured a payment services provider license and broker-dealer license through GIFT City to build innovative and well-regulated products for NRIs. Explain what that means for NRIs and how it changes the game really for cross-border investing.
So as a payment services provider in GIFT City, basically we can move money in and out of GIFT City in a safe and regulated way for NRIs. Now this money can then further be used for any savings or investment products. So currently we are live with a USD denominated fixed deposit for NRIs. After this, we'll be launching some equity products via our other licenses as well. So as I said, the GIFT City regulatory platform actually provides a regulatory light environment for NRIs to participate in India's growth story. And through Belong, that is what we are enabling.
All right. Like you mentioned, you're starting with USD fixed deposits for NRIs in the UAE. Tell us why this market and why this product. First, also, how does the product work on ground? No NRE, NRO accounts, tax-free returns in India, INR depreciation hedge. It almost sounds too good to be true.
Yeah, so first of all, we chose UAE because it has a very high concentration of NRIs. It's one of the largest NRI populations globally. And also NRIs in UAE have a high propensity to invest in India. Coming to fixed deposits, so they're a very simple product to understand. Indians love it, whether they're resident Indians or NRIs. Yes. Because of their safety and fixed returns. So it's a very simple product to understand. Hence, it was an obvious, place for us to start. And the benefits that we have mentioned, they're primarily due to the nature of GIFT City itself. It is structured as a global financial hub. So we can offer these US dollar denominated products like these fixed deposits, and NRIs can invest directly from their foreign bank account, right? And with tax benefits that the GIFT City provides.
Okay. Ankur, you're also building tools like an NRI FD Explorer, Compliance Compass, and a rupee versus dollar tracker. What's the larger product vision here? Is this going to be a full stack financial home for NRIs?
Yes, very much so. So NRIs are juggling, multiple time zones, multiple currencies, and multiple regulations, right? It's not easy for them. Even something as basic as understanding whether you are an NRI or not is a task. Like there's an entire section of IT Act just on this. So we want to give them all the tools that they need in order to make better financial decisions when it comes to saving, investing, and staying compliant in India.
Okay. Ankur, you're offering India tax filing without the typical NRI markup. How big is the opportunity in simplifying compliance for NRIs?
Yeah, so there are about 16 million NRIs, across the world. Most of them, have some form of income in India, whether it is through interest from bank deposits or through rental income from their property investments or capital gains, from their equity investments. Now, with increased scrutiny and data collection from the income tax department, compliance is today one of the top concerns of NRIs, especially those who are looking to move back to India at some point in future. Also, apart from being compliant, India has beneficial DTA arrangements with several countries with large NRI populations, like UAE, for example, under which NRIs can get significant, tax benefits. But for that also, they need to file taxes in India. So it's a huge opportunity for us.
Let's get to the seed funding now. How will the $5 million fundraise be deployed? What's your immediate roadmap of the next 12 to 18 months? And beyond the UAE, which markets are next? What new products are in the pipeline? Mutual funds, global insurance, NRI cards? What's the big vision, Ankur?
Yeah, so the funds that we have raised will primarily be used for three things. One is to acquire more licenses in GIFT City so that we can build more NRI-focused products. Then we want to expand our team as well. And the third bucket is for customer acquisition across multiple geographies. So we are starting with UAE. After that, we plan to expand to other GCC countries like Saudi Arabia, Qatar, Doha, and then after that expand to UK, and then eventually to US. In terms of product roadmap, we are already live with the US dollar denominated fixed deposit. After that, we are working on some equity products like Gift City based mutual funds and AIFs, trading in US equities and Indian equities, and also global coverage, insurance, and international cards. So everything, we are building out of Gift City. So in a sense, you can say the bigger vision is to provide a full financial suite of products for NRIs, almost like a bank for NRIs.
Okay, a bank for NRIs. Well, on that note, it's time for me to wrap up our conversation. Many thanks, Ankur, for joining us today on Startup Street. Wish you the very best for all your growth plans.
Thank you so much.
Moving on, India's fine jewellery market is undergoing a transformation and lab-grown diamonds are at the heart of it. Okera has just raised $15 million in fresh funding. The round was led by Peak 15 partners with participation from Fireside Ventures and others. In just 2 years, Okera has expanded to 13 company-owned stores across key Indian cities. This fundraise will power their next phase of growth from retail expansion and product innovation to brand building, as Okera looks to become a 1,000 crore rupee label and redefine what luxury means for the modern Indian consumer. So how is Okera challenging legacy players and building trust in a new category? Let's find out. Joining me now on the hot seat is Lisa Muketkar, the founder and CEO of Okera. Lisa, thank you so much for taking time out and being here with us on Startup Street. Okera was launched 2 years ago, right? Talk to us about why you decided to embark on this journey of lab-grown diamonds. There are a clutch of firms that have entered the space, intensifying competition. So how are you sort of staying ahead of that as well?
Thanks, Arundhati, for having me. It's my pleasure to be here. Started this business simply because if you saw what was happening in the precious jewelry market with diamonds, the way prices were going, you were getting smaller and smaller and, yellowish color diamonds by the end of it. Lab-grown diamonds came along and challenged everything that Mine Diamonds were doing. You saw a disruption in the US, and we've begun to see the same play out in India. So for those of you who don't know, lab-grown diamonds just offer a significantly better product at a significantly advantageous price. So with that kind of consumer value proposition, it's hard to not want to do something like this. And yes, there are several other brands. It's becoming a crowded market already. But I believe that with Okera's strategy and Okera's vision and the team behind it, we're very clearly poised to be leaders in the market.
And we will discuss that strategy that Okera has a little bit further on in the show. But let's talk about the fundraise. How will this $15 million capital infusion fuel the next phase of growth for the company? What would be the immediate focus?
So it's primarily three things. One is really retail footprint expansion. We believe that even though we're an omni brand, consumers really enjoy shopping jewelry in physical stores. So expanding our retail footprint is going to be one key usage of funds. The other thing is really to build the brand out, which means marketing, and build the organization because we're building a business for the long term.
Sure. And, speaking about your retail presence, you've grown to about 13 stores in just 2 years. What's sort of the roadmap now? How many cities are you planning on entering? And what's the ideal store count that you want to have in the next 12 to 18 months?
So we're currently in 3 cities, and we will have 15 stores, in fact, in the next 2 weeks. We're in NCR, we're in Hyderabad, and we're in Bangalore. We're looking at expanding further in these 3 areas, but also expanding to the rest of the country because Okera is clearly looking at being a national player.
So you're looking at being a national player, but you're very focused on building this sort of big retail-led brand presence in an increasingly digital world. Why the heavy focus on the offline space, and what role will online or the omni-channel play in your strategy?
Sure. So, Arundhati, you will understand that women really like to touch and experience jewelry physically. They look for trust, and therefore a physical retail store is extremely important. So the omni-channel play is important because discovery happens online very clearly, but conversion really happens in store. That's been our experience, and I think that's the experience of brands across the category.
Sure. And, you have spoken about becoming a 1,000 crore rupee brand in the next 5 to 7 years. What gives you sort of that confidence to scale that fast? Is it, repeat customers, ticket side, or, sort of a clear market shift right now?
Yeah, so it is really a seismic shift that we expect that we're going to be seeing in the market. And that's simply because of the consumer value proposition that lab-grown diamonds offers, and the kind of jewelry and the kind of service experience that Okera offers. So we've seen a tremendous increase in the customer walk-ins, in interest, in conversions that we've had over the last 2 years, so much that we're looking at really ramping up our entire expansion plan. And I think, like in many categories, we will see a hockey stick, curve that's happening very soon. We're at a tipping point, we believe, where you can see consumers just shifting to lab-grown diamonds from mined diamonds. Also, there are new customers entering the category. That's happening as well, because I don't know if you know, but diamonds has less than a 10% penetration in India. So there are new customers that will enter the category, and the category will expand. But yes, there is a clear shift from mined diamonds to lab-grown diamonds.
So clearly at that tipping point right about now. But if you could sort of, tell us a little bit more about your design strategy, right? How are you sort of differentiating your collections in a space where sort of legacy brands dominate on heritage and trust? So if you could talk to us about your design strategy, as well as, the kind of clients that you're catering to.
Sure. So the first thing about design strategy, I think, first of all, our view is not about one collection or the other. Our view on design is that design means multiple things. One of them is innovation, one of them is craftsmanship, and yes, of course, there's the aesthetic. Okera has a team that focuses on innovation because we believe that it's part of our DNA to bring a better product to customers, and lab-grown diamonds offers the kind of innovation that we want to do. So we're constantly pushing the boundaries to see how we can make better diamonds, larger diamonds, better quality diamonds, colors, shapes, really pushing in terms of the cuts that we can do to make more brilliant, larger, more beautiful diamonds. That's one part of it. The other part of it is in terms of craftsmanship, and there's so much there again that can be done to bring in better finishes, a lot more beauty that can be added to a product that is bought for desire and that is meant to bring joy to women. So there's a lot that we push by way of design, craftsmanship, and innovation. And I think that's what's different. It's not about one collection or the other. We have that, but there's a lot more that goes into Okera's design strategy.
So a lot more that goes into it. But, before I let you go, if you could quickly tell us, what about revenues? Where are you currently at? What are you clocking, and where do you hope to end this year?
So we expect that we'll be ending this year with about 250 crores. That's our expectation. It could be better. A lot depends on the upcoming season. But at the very least, we'll be at 250 crores.
All right. So 250 crores is what you're looking to end this year at. All right, Lisa, thank you so much for taking time out and being here with us on Startup Street.
Thank you, Arundhati.
Well, with that, it's time for us to head into a short break. But coming up on the other side, new age stockbroking platform Sahi recently secured $10.5 million in a Series A funding round. Manish Jain, the co-founder and CPO of the company, discusses the company's growth plan and more. Stay tuned.
Welcome back. You're watching Startup Street. Now, new aid stockbroking platform Sahi recently secured $10.5 million in a Series A round that was led by existing investors Accel and Elevation Capital just months after its launch in December of last year. Now, the platform, which says it charges 50% lower fees than competitors, claims to have had 200,000 plus app downloads and active traders growing at 50% month over month in the last 6 months. For more on this, joining me now is Manish Jain, the co-founder and CPO of the company, for the relevance of this funding and the company's growth path ahead. Manish, thank you very much for your time here on CNBC-TV18. $10.5 million in just 6 months since launch. What convinced Accel and Elevation to double down so quickly, and what is your plan to deploy the capital?
Thank you, Ritu. It's a pleasure for me to be here. So let me tell you about the Sahis, why we are building Sahi at Sahi. Our mission is to give Indians retail traders a high performance trading platform with a speed and precision which all professional traders have access to currently. And we started with this mission. And in the past 5 to 7 years, you could see that the ease of access has been solved, but most platforms are still one size fits all. They're very clunky, they're very fragmented, they're very slow. And that is why we have built Sahi with an integrated analysis and execution engine, which is designed to keep the traders in a mental state of flow, where the action and decision happens very seamlessly. So we saw very, very great early adoption, and we saw a lot of user love in the last 7 months, which led to the second round of funding.
Okay, and how do you plan to deploy this money?
Right, so there are 3 main areas, Ritu, where we plan to deploy this money. One is we definitely want to scale our user base because we have seen great traction. Second is we want to enhance our product and technology offering. Particularly we want to incorporate a lot of automation and AI-based features. And thirdly, we want to grow our team. Currently, we are a 35-member team. Yeah.
All right. Speaking of growing your user base, you say that you have 200,000 plus downloads in 6 months and 50% month-on-month trader growth. Is this kind of trend going to be sustainable going ahead? You're starting with a small base, and what has driven this kind of engagement in the last 6 months or so?
Yeah, I think what has driven the engagement, Ritu, is that users have really appreciated that we have thought very deeply about their journeys, and we have built very specific journey for each of the different trader and investor class. And that is why there is this heavy adoption. In the last 7 months, we have executed more than 5 million orders on Sahi already. And at our current pace, we are doubling our business metrics every 2 months. Our aim by end of this financial year is to grow 5x from here and be the go-to choice for every active trader and every active investor in India. That Sahi should be their go-to choice.
Manish, I'm sure what's also helping is that you say you're charging 50% less in brokerage fees and still offering these advanced tools. So tell us what your business model really is, and with this kind of discount that you're offering, what kind of revenues and profits are you clocking? And again, what are the projections you can give us?
Sure. So see, we are able to offer this lower brokerage because we are starting in this new era of AI. All our teams are AI driven. Each of our engineers are a lot more productive. And that is why we want to pass on all these benefits to our consumers. So it's not really a discount. We are going to keep our cost model low, and we pass on all these benefits to our users. In terms of our revenues, we are a transaction business, so we'll continue to earn only from these transactions. We do plan to launch a Sahi Plus or a Sahi Black sort of a subscription plan later in coming months once we have built a larger product suite.
But, just to pick up on that again, legacy brokers are also cutting fees and they're also launching new tech. While, of course, you don't have the burden of legacy, you're using AI tools, so are your competitors. So what is really going to be your moat?
So the speed of innovation, I would say, would be our moat, because we are a very small team. We are a very highly powered team, and we are very, very close to our users. We talk to these users on every day, and we are able to roll out the feature request in a week or 2 weeks time, and we are able to move very fast. And that's our moat right now. But we are very super focused on different kind of users. And so we are not going to build a one size fits solution, which all the existing platforms have currently are.
Just take a minute and to explain to our viewers very simply what you say you built is a chart first trading experience. Can you explain what that means and how it's different from what, say, a Zerodha or a Dhan or an Upstocks is offering today?
Right. So, Sahi, I would say, so like there are two big pillars on which we have built our offering. Okay, first is we have built our in-house charts, and second is we have built our proprietary order execution stack. Now, how is this very different from existing stack is existing brokers is that they all provide one size fit all solution. You have to switch between multiple screens, you have to search, then you have to go to chart, orders, position. So you keep jumping across. What we have done is because we have built our own chart, a trader does not have to leave the screen. Your analysis, your execution, your managing of position, everything happens on the chart, and you are never leaving the chart. So there is no context switching. And that is how the users are in their mental state of flow. And that is why people are really loving our product.
All right. Manish, let me also ask you, in a space, that is crowded with broking apps, what is the end game really? I mean, we hear from some of your competitors, for instance, that they're vying for a banking license. What do you want to do eventually, say 5 years down the line? Is there a global play at work? Is there a fintech play at work as well?
Ritu, currently we are too deep down focused on solving the problem for our active traders and investors. But if I think of 5 years down the line, we definitely want to be a wealth platform. We want to be a platform which solves the wealth and financial needs for this growing class of Indians.
Okay, the focus right now as a young company, as it should be, of course, is growing your current business. Manish, we wish you the best with that, and we hope to hear more from you in the future. Thank you very much for your time here today on Startup Street.
Thank you, Ritu.
All right, on that note, we're going to wrap up this edition of Startup Street. More news and updates will continue on the other side, so stay tuned.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. The world is truly going nuts over pistachios. Dubai Chocolate Kunafa, a pistachio-stuffed dessert that went viral on TikTok, has sparked a global pistachio craze. The sweet treat has fueled demand for pistachios in everything from lattes to pastries, and prices have gone soaring. Despite a record harvest in 23-24, the US expects an even bigger crop in the upcoming season. But for now, supply is struggling to keep up with this dessert-fueled demand. To discuss this, we are now joined by Rajiv Pabreja. He's MD and CEO of Commodity Trading Corporation. Rajiv, hi, thank you so much for joining in. And I will talk about supplies later, but I do want to talk about the demand first of all, because we're looking at a huge surge in demand, whether it comes in from US or Dubai for that matter. Europe demand has been surging quite strongly as well. And then for the Indian markets, it is absolutely about pistachios as soon as the monsoons hit, and then Diwali would soon be starting, and then you have the winter demand coming in as well. How are you looking at the demand first of all? What we saw in the previous year, and what are the estimates for this year?
See, pistachios have become a very in nut because almonds were the main in nut. But if you see the growth, overall growth for pistachio has been the highest. If you see the history, if you see the last 5-year growth, it is almost, we have grown up by 3 times. Earlier, India was importing 3 years back, 4 years back, we were importing 10,000 ton. We are importing 30,000 metric ton. And especially we are depending on kernels only from Iran. Iran is one of the main supplier of kernels because the kernels best quality only come from Iran. Pistachio and shell, we were earlier depending on Iran, but now we are dependent. US is also one of the big player who is supplying us, one of the biggest player actually for that. But from USA, we have a time because anything shipped from USA, it reaches to us in 60 to 70 days. And anything shipped from Iran can reach to us 10 to 15 days. But due to this war-like situation and USA changing tariffs and everything, there has been a lot of dynamics changing every day. So there is a lot, and Diwali is this year early, and from last few days, shipments were disrupted because of the war-like situation. We were buying kernels from Afghanistan. The route from Pakistan also stopped. Demand will be another 1 week. There will be a big demand in India, and there will be a shortage in India.
We'll come to those numbers also in a bit. But you know what, Rajiv, in last 6 months itself, from trying a Dubai kunafa to a pistachio latte to pistachio desserts, almost everybody really seems to be going gaga over this. How have you seen value addition when it comes to pistachio, and why is it the latest crazy nut that everybody is going to?
See, one is that health benefit. If you see, there has been a study. If you see yesterday news only, there was an article. It reduces diabetes also. And it is a natural product from straight from the tree. It is coming to you.
It's high in protein.
And protein. Protein is important because people, you see, Indian population is a vegetarian population. If you see, if you know people who don't eat egg or a non-vegetarian, for them it's the best thing to have as an alternative for the protein. And especially after this chocolate kunafa thing, India is also getting crazy for that. Indian manufacturers have started making kunafa in India. And we have a lot of chocolate bars, we have coffees, we have shakes, we have drinks. So many things are coming up with, even, like we used to have almond butter, we have now pistachio butter in the morning. So there people are coming with new ideas, even the chocolates, even the cakes are being coated with pistachios and all this thing. So demand is going up. People are asking for more of pistachios, especially the kernels, as I told you. Indian kernels demand has gone almost double than last year. There is a big trend and a new change because of the health factor. Plus, the green color makes it's more attractive. Even the sweets, you have a lot of things to there.
But Rajiv, we'll soon have to pay higher price for this green color that everybody seems to be getting attracted to. So talk to us about the prices then. What is it that we've seen in last 5 years in sense of prices, and where do we stand right now? And with all those supply concerns and demand surges that we are seeing, what is your sense on a price forecast from here?
The prices, if you see the current prices in the next 2 months, the prices will remain firm because America is almost out from the supplies and they don't have much of supplies. And even if we buy today, it will not suffice. It will come for another 60 to 70 days. Because of the Iran logistics and the war situation, and they had some blast on the port. So last 2 months have been very irregular supplies from Iran. Turkish crops absolutely failed because the new crop Turkey is failed because normally when there is a prices go up, sometimes Turkey also supplies. But because of Turkey new crop failed, their consumption has gone up. They are not exporting anymore. And Afghanistan route is closed because of the Pakistan. We cannot buy directly from coming route is closed from the Pakistan. There will be a shortage. Prices will go up. But Indian population is so big, even if the prices go up and demand goes up, and the price will remain firm, very firm. And after 15 days, Diwali production will start. All the manufacturers will be planning for Diwali, they will start packing, they will start processing, because pistachios normally in shell is roasted. So you need roasting, packaging, and then reaching to the customers. It will take, it's a procedure, it will take time.
Sure. Rajiv, so when it comes to India, and as you said, in 3 years, did you say 3 years, from 10,000 tons to 30,000 tons of an import that's happening in India? That's a 3-year thing.
Yes.
In 3 years, we've gone up by 3 times.
Yes.
And
so
then,
last 3-4 years, the trend from last, if you see the history, India was doing very little, 10,000 tons. But from last 2-3 years, there have been a lot of promotions, a lot of work going on, and health benefits, and especially being a protein alternative to the protein. And Indian population is vegetarian, and the pockets of Indian people are having a good income. So automatically, the demand has gone up, and a lot of advertisements about it for the health benefits. The demand has gone up to 30,000. If you see compared to China, we are nowhere. China is consuming more than 100,000 tons. So we still are much more. If you see, as per the population wise, we are not eating much. But demand is going up, and this is one of the production which is the demand is going by 12 to 14% per annum growth is there still now.
I'm wondering how much that kunafa demand must have taken the pistachio demand as well on the higher side. But
it has.
It has. So how much was
and
Dubai?
Dubai was never. See, Dubai earlier was not a consumer. It was more like a. But now, because of this kunafa thing going crazy, a lot of everybody, Indian manufacturers started making kunafa. There are so many companies who are not doing, and big companies, big brands have also started making kunafa chocolates, because they want to be in. They don't want to leave this new thing coming in.
Yes. Rajiv, so when it comes to India, and I do want to know that, as you said, it's pistachio in kernels, and then it also is overall pistachio demand in India. So when you look at that as a basket, does India still consume pistachio the way it is, or there is a lot of value addition and there is a growth there as well?
Value addition has gone up. Earlier India was basically more eating it was used for the sweets purpose. But now we have shakes, we have cakes, we have, as I told you, we are using for morning, people are taking with chocolate, butter, as a butter. We have pistachio butter coming up, pistachio things coming up. Alternatives are coming in, even the drinks. You have coffee, you have shakes with this. So alternatives are coming in halwa. Earlier it was only traditionally for the sweets, but now a lot of consumption is going on. Even people are snacking. You go to the office, people just like the young generation X, which is new generation, is there. They carry a small packet into the office because they think we need protein. We just eat 1 ounce, or 20 grams or 30 grams of pistachios a day to keep us healthy and strong and get good protein in our body. So trends are changing, people are changing. And even earlier what happened, people have to have in-shell pistachios roasted. But now even people are getting kernels roasted in different flavors. Earlier there was not a flavor mark, only one salted one. But now it's low salted, black pepper. Some people are even using it with a little spicy one like chili flavor.
Rajiv, I've tried strawberry and chocolate as well. So I get you totally on when you say that value addition has been quite strong. But Rajiv, since you mentioned Diwali, and pistachio is of course one major big part of it, but there are other dry fruit expectations as well in sense of demand which are going to go up. What is it that you're looking at Indian markets now? Huge import, of course, for pistachio, but when it comes to cashews, almonds, walnuts, a lot of those superfoods, seeds, etc., what is the kind of demand that India is looking at?
See, India, as I told you, India nuts demand is going up by almost 7 to 8% per annum. And all the nuts, even like walnuts, if you see, walnuts were imported like only 5,000 tons or something of that sort. But now walnuts also, India was an exporter actually. If you see 10 years back, India was exporting walnuts. But now we are importing walnuts from Chile and from USA. So India is changing. People are going for healthy products, especially after the COVID, the demand went up very, very high. People wanted to have something healthy, which is directly from the trees. So demand is going up, as I told you. And as a new crop is coming out, all the new crops normally for all the nuts comes in the month of September, October. So the prices will hopefully come down when the new crop comes in. But for the Diwali, we have to depend all in old crop. So market will remain strong, stable, and demand will not come down. And everybody has to have nuts.
It's a good time for you, Rajiv. It absolutely is a great time for dry fruit guys at this point in time. But thank you so much for joining in. So that's what Rajiv's telling us, that overall dry fruit demand is 7 to 8% on the higher side when it comes to pistachio. Well, that market is going up by 12 to 14% as well. And yes, pistachio is in almost everything from chocolates to desserts to cakes to halwas, and you name it and you have a pistachio there. But with that, let's go for a short break. Don't go anywhere though, because when we come back, the Trump has proposed higher tariffs on Bangladesh's textile imports. What does that mean for the Indian textile industry? We will discuss that with Prabhu Damodaran of India Texpreneur Federation on the other side of this break. Welcome back. You're watching Commodity Champions, and shares of Indian textile companies rallied over 8% in trade after the US imposed a steep 35% tariff on garment imports from Bangladesh. The move is expected to boost Indian textile exports, particularly in the US markets, where Vietnam leads with a 19% share, followed by Bangladesh with 9% and India at 6%. While the tariff is a notch lower than the 37% initially proposed in April, it is still more than triple the earlier base rate of 10%. This could significantly shift sourcing decisions in India's favor. To unpack what this could really mean for the sector, we are now joined by Prabhu Damodaran. He's head of Indian Texpreneurs Federation. Mr. Damodaran, hi, thank you so much for joining in. First of all, your initial reaction. Everybody seems to be applauding this. At this point in time, the numbers look very, very good. Is India ready and has the capacity and the capex to make good use of this?
Good evening. Yes, it's good news emerging. All stars are aligning for Indian textile sector. Actually, if we want to see some kind of a data, yes, like the global trade is also in slow lane, and the same kind of things are happening in apparel also. We don't have any kind of a protein story like in the food sector to grow our kind of a trade in double digits. Only thing, how each country is grabbing the market share from others is the main key area to watch. In that sense, for example, for the past 3 years, if we take the CAGR of US apparel imports, US imported around $79 billion of apparel during 2024. If we take 2021 as the base year, the CAGR growth is only in the range of -1%. So the trade is not growing. The challenge is how we are going to capture the market from other countries. Now, with the Trump tariff announced as of now, we are at 10%, Bangladesh at 35%, and Vietnam at 20%. India definitely have advantage. Let us see what kind of a performance for India in the past 3 years. In 3 years, almost we and Vietnam and Bangladesh have similar tariff lines. So in such situation, India gained considerably in the US market. For example, for the past 3 years, CAGR of Indian apparel export to US stands at 3.8%. At the same time, Vietnam grown only at the rate of 1.4% CAGR and Bangladesh at 1% CAGR. This shows that even before these kind of tariff changes are happening, and American buyers are preferring Indian goods, Indian sourcing. So this trend will accelerate in the days to come because of the changes happening. At the same time, it's all moving parts. We can't say anything as static. For example, now August 1st deadline itself is a kind of a negotiation tactics with other countries so that Trump administration may even revise the tariffs based on the further whatever the trade deals happening with our competing countries before August 1st. So as of now, yes, we are at 10% and Bangladesh at 35 and Vietnam at 20 and Cambodia at 36, definitely leading to an advantage of for India. And already we are witnessing good amount of sourcing, and this trend will accelerate. Very, very importantly, India have some unique advantage. That is where global buyers are very, very upbeat on India. For example, we don't have any import dependency on raw material or intermediate goods to make textile apparels. That is a very big advantage. Now buyers demand supply chain visibility, source of goods wherever the origin is coming. So a lot of compliance also gaining momentum now. At this stage, India and China, only two countries have entire value chain in place.
Oh, absolutely.
So now China is already degrown by 6% in the US market for the past 2-3 years. Now India is the only reliable alternate to China. So we are very confident. Already our monthly export run rate from $350 million to US improved to $480 million now. And we may expect another $150 million of additional US exports in the days to come.
Okay.
Only thing, we need to invest boldly in capacities. We need to create scale and competitiveness to handle this kind of a massive inflow of orders. With the combination of US, for example, if we imaginary situation.
I just want to get to some numbers as well, Mr. Damodharan. You explained to us on where India stands, and yes, we are in a position of advantage here and our numbers seem to be increasing. But as you said, there is a need for capacity increase, competitiveness, and of course, investments as well. Just to get some numbers on table then, what is it that India contributes to the world right now in sense of exports? How much of that is a contribution to US? And with all this as a background, how do you see those numbers improving, let's say, in a year from here?
Okay, we can simply break down as monthly export numbers of apparel exports. China still, after all this noise around China plus one opportunity, China exports around $13 billion a month, apparel exports alone. Apart from the $13 billion, if you take textile and fabric exports, they are doing another $12 billion. They may be losing market share at US, at the same time they're gaining or they are diverting the goods to other Asian countries. And Vietnam also, so monthly run rate of China at $1.13 billion, Vietnam at $3.5 billion, Bangladesh at $3.2 to $3.4 billion. We are at $1.5 billion monthly run rate of apparel exports. We improved from the average of 1.2 to 1.3. From this 1.5, we need to reach at least $2 billion monthly run rate so that our market share in US will improve from the current 6% to 8% range. And from wherever you see, either Europe or UK or any developed markets, our market share is only in the range of 5 to 6%.
Okay.
So there is a plenty of opportunity to grab. As I said, we need to confidently invest in the capacities. For example, now, the low-hanging fruits, for example, spinning industry is a so matured sector in the entire value chain in the industry. We have good capacities, competitiveness. At the same time, due to various dynamisms of the industry, margin profile is changing, margins are shrinking. And so it's right time for the spinning companies to think of integration model so that they can venture easily into apparel, and asset turnover ratios are high in apparel, and EBITDA margin, ROC, everything is better. So India have more than 1,000 spinning companies, at least 100 companies have good size and scale. They can easily venture into apparel because somebody need to invest and create capacities. It is not until fabric stage we have a huge capacity. Apparel making is an area we need to boldly invest. Now Mitra Parks also coming.
Sure.
So 7 states.
So would you say it's a very divided market right now when you look at garments on one side and ginning and spinning, and of course these are different markets, and as you said, garments is something that India really needs to work on. So what is the kind of capex are we talking, and what is the number of companies that you think are ready to get head on into this?
Actually, we can categorize it small, medium, and large. 3 categories are there. Already integrated players who build size are making a decent margin, and they are very confident. And we are seeing a lot of listed companies also announcing a steady capex. Everyone is a little concerned about these kind of uncertainties because uncertainty is the enemy of any business. Now, if tariff clarity is coming up, naturally the integrated large companies must announce capex. They are the leaders and they need to demonstrate that in practical terms so that medium and small companies also will follow the same trend. In our own Tamil Nadu, already 35 to 40% of apparel exports contribution coming from Tamil Nadu. We are seeing a lot of SMEs also very confident about UK FTA, and a lot of UK buyers started engaging well on the ground. And we see that 70 to 80 companies are building up capacities in wherever the manpower is available. The workers availability is a very, very important thing. That is where the Mitra Park and the construction of staying facilities, those kind of infrastructure, plug and play infrastructure, these things are very, very important to scale up in garments.
Sure.
So we are seeing 6 to 7 states are very active, number one, and it's right time to launch PLI also. Say apparel PLI
That
for
exactly,
cotton apparel.
Mr. Damodharan, is my next question really, because while as you said, competitiveness and capex needs to increase and capacity needs and increasing as well, but do you see that you would require, the industry that is, would need a government push as well to make use of this opportunity?
Yes, definitely, because the uncertainties always create some kind of hesitancy among the investors. So if we create this kind of a plug and play facility and offer some kind of a PLI, the momentum or motivation will be much more. And it's right time, because if we improve $1 billion additional exports from the current level, it creates 1.5 lakh new jobs. Only furniture and furniture manufacturing and apparel creates so much of jobs for the whatever the investments we are going to make. So it's a win-win for everyone. Win-win for the government, win for the policy makers by way of job creation, for the export earnings. So PLI is the ideal answer, and PLI should be designed in a way that even the medium companies also can be the part of the story, because PLI means mega scale. And in apparel, we can't think in those lines. We need to design a scheme that even the medium-sized companies can move towards the next stage of growth by building 500 seats kind of a capacity.
So as you mentioned, Mr. Damodharan, that it's a big opportunity right now for the Indian textile industry with the current tariffs that we've seen across countries there. So, but what India needs to do is, of course, a bit of a government push from one side, capacity, capex, integration. There's a lot that India needs to do. Today, of course, has been a knee-jerk reaction, but to take it ahead and make it a reality, there are some steps that perhaps need to be fulfilled right now. Thank you so much. Yeah.
One more point I want to add, a lot of expectation about tomorrow's announcement on US trade deal. Number one, we hope that will happen. Number two, maybe we may get a zero duty on imported cotton from US also.
Oh, well, absolutely. Those are a couple of very positive things that you mentioned, and yes, the street seems to be anticipating it as well. But thank you so much for joining in today. And with that, that's all the time that we have on this edition of Commodity Champions. Thank you for watching.
Welcome to On the Record with me, Shireen Bhan. My guests today have a 30-year legacy in the real estate business. They delivered India's first real estate trust, and they've also delivered 75 million square feet. Joining me now to talk about the real estate sector's trends, but more importantly, what's ahead for the Embassy Group, Jitu and Aditya Virani. Gentlemen, appreciate you joining us here on the program. Let me start by taking you back. It's a 30-year legacy, as I pointed out, for you. A lot has changed in India's real estate sector. Plenty bad, but some good as well. The last few years have been good for the real estate industry. How would you sum up the journey so far?
So when I started on this journey and I joined my father, there was a whole sense of people who were making these smaller buildings, smaller offices, doing construction really the crude way. There was nothing comparable to what it is today, because today the industry is as international as anywhere else in the world, you could say. We had all these Gujarati contractors all over the place. People always were looking, all developers always thinking of how to build an extra floor. And, this over the time just transformed into these large business parks and, large developments in one location. And I think it's just the evolvement or maybe the newer generation stepping in, wanting to do things differently. And, I see I'm in the middle region where now I have kids in the same business. And I can see that they want to do things more differently than I did. And I would see the journey. The office space was My father built office space with 500 square feet office space. The toilet inside was just for the owner of the office.
Yeah.
And people strolled down the corridor to use the common toilets. And now all of a sudden we have these large business parks with huge floor plates, and concept of single office hasn't gone. And I think that's given the birth of flexi office.
Yeah.
A great opportunity. So I think it's just the people, the newer generation coming in, and India's fast adaptability to international standards, and to a lot. I think there are a lot of these for companies coming in, the GCC companies, the first the internet companies coming in. I think technology companies, that's actually changed the outlook, how Indian developers started looking at his product. And a lot of design elements started coming in. Otherwise, there was no design. I still remember in 1996, I appointed a lighting consultant, and my father told me I was crazy to spend so much money because all of them built nice buildings, but nobody lit them up correctly.
Yeah.
And that was a big thing. So you learn traveling abroad, you see things, and you want to implement it. And now I'm the victim of the same what my dad was.
They're telling you what to do now. It is.
But yeah, so the whole cultural thing was, to make this one buildings, look at the laws, try to exploit everything from one development, which I think is, taken a backseat. And I would honestly, not because I'm in this business, but I would say that all my colleagues in the business and generally the business in India, we are as comparable as any international developer anywhere in the world.
Well, he talked about the next generation. So let me come to you, Aditya. It's been about 9 years for you at the Embassy Group as well.
Yep.
As you look at the road ahead, the legacy that you take forward as well, and the opportunities that you are looking at, how different is the landscape today from what he inherited?
Yeah, look, 9 years have flown by, and even in those 9 years, I've seen a transformation of what Indian real estate was then and what it is now. And I think the big theme is the institutionalization of the asset class. Moving from these small offices that were strata sold, financed off plan, to now very institutional, large ticket. We did the first REIT, these large assets that are owned by huge institutions or REIT type of a trust. I think the whole financing of the asset class has changed. I think the whole design aspect of the asset class has changed. And I only think it's going to keep evolving, and you're going to see that strata grade B office actually slowly die a slow death. And that's the way forward actually for this asset class.
When we talk about the way forward, and you've set some pretty aggressive targets in terms of what you believe you're going to be able to deliver. As I pointed out, you've already delivered 75 million square feet. What's the expectation, given the fact that everybody believes that this is going to be India's moment as far as manufacturing is concerned, this is going to be India's moment as far as GCCs are concerned. Real estate has been seeing an upswing with regulatory changes like RERA, etc. coming in. I mean, what are we really talking about in terms of penetration, in terms of untapped potential?
I think that, there are big industry stalwarts in this, but I don't think anybody has a clue that what we're in for, because urbanization, is actually right now at a much slower pace than it should.